It's a very different picture once again. Futures pointing higher by 0.8%. Certainly weak dollar is going to be a positive catalyst. FTSE 100 futures pointing to gains of 44 points. DAX futures looking to add 159 points, pointing higher by 0.7%. Lizzie, what are you looking at?
Well, as we have all week, Tom, I'm watching the airline stocks, but in particular Lufthansa. They were out with earnings this morning, seeing a significant improvement in 2026 and looking to add long-haul flights because of the Middle East war. Also watching IAG, though, as the CEO of Heathrow Airports talked about the operational challenge from the war impacting BA. Hundreds of flights cancelled, aircraft sitting idle on the tarmac. Again, we watch energy stocks, oil up this morning, and we watch chips here in Europe after Marvell gave an estimate-beating revenue forecast, confirming strong AI demand. Anna, we're getting towards the open.
Yeah, we absolutely are. Let's have a look at where we are on the European market open then for this Friday morning, with payrolls still ahead of us. Plenty of headlines, no doubt, coming to us from Iran and about Iran. We'll certainly keep an eye on that. Here in Europe, we focus on the energy prices, and we have seen a drift higher in oil prices this morning, despite those news lines around India and what the United States will allow India to buy in terms of Russian oil. So the FTSE 100 out of the gates up by 0.3%. We have a fairly heavy weighting towards energy markets, so maybe that's part of the narrative there. But we had broadly been expecting then some positivity at the start of trade, catching up a little with the US of yesterday. So the CAC up by 0.5%, the IBEX over in Spain up by 0.5%. So broadly speaking, we seem to be starting at least the last session of the week on the front foot, Tom, with positivity in mind. But of course, we remember just yesterday we saw the markets whipsawed in terms of their risk appetite by headlines around Iran.
Yeah, and travel and leisure is certainly a sector that gets hit by those headlines. So you have to wonder to what extent the gains that we're seeing in the session today will be sustained as we continue to monitor developments, of course. Travel and leisure, so far, the top performing sector, having been one of the worst hit yesterday. That sector is currently up 1%. Banks also getting a bit of a lift, up 0.7%. Basic resources having faced some pressure yesterday, turning around in the session today. But again, it's travel, leisure, financial services, banks at the top of the list in terms of sectors. Just one sector in negative territory so far, which is food and beverage. We have to think about food prices as well. Fertilizer prices expected to tick up as well, what that could mean for food. But currently that sector is down 0.2%. Every other sector in positive territory, with travel and leisure at the top, Lizzie.
Well, checking in on some of those stocks we had flagged, Lufthansa shares are actually up more than 2% this morning, and IAG, despite the warning, is up 1.4%, despite the operational challenges at Heathrow flagged by the CEO. We talked about energy, and it's a mixed picture there, actually. Even though we've had Brent higher this morning, the Brent price has been fluctuating, and indeed we're seeing Shell flat to the upside, BP flat to the downside, and Total in just negative territory too. I'd flagged the chip stocks. It's a mixed picture there as well. BE Semiconductors down 3.2%, ASML down 0.1%, Infineon down 1.6%. We were factoring in those Marvell forecasts, which were positive, but it seems a pretty negative picture for European chips this morning. We'd also seen those losses in the US session for Nvidia and AMD. Perhaps that policy uncertainty around President Trump's chip policy is weighing in here a little.
Okay, let's talk about these markets in more detail, widen out our conversation. Let's bring in Karen Georges, who's a portfolio manager at EcoFi and joins us now. Karen, nice to have you on the programme. Thank you for joining us. So we're 7 days into the war in Iran, and clearly this is something that is at the front of mind for everybody in the markets and trying to work out what happens here, a lot of headline risk. As we come to the end of this week, how would you assess risk appetite in these markets?
Well, Iran, the war in Iran, it kind of broke two big shifts that we've had since the beginning of the year. First of all, the narrative of AI at risk. So it's very interesting to see that when there was this market meltdown since the beginning of the week, the stocks that represent, this whole AI at risk theme have been up. So they were down more than 20% year to date. Now they're down maybe minus 12 or 13%. So it kind of put that narrative on hold. And the second narrative it put on hold is the big rotation, because until the end of January, more than 1 trillion stocks have been rotated in the US. That's huge. That's a record. So that kind of narrative has been put on hold. So tech is back. It's seen as defensive, relatively not concerned by the war in Iran. So that's the first thing that we can maybe think about. The second aspect is the length and duration of this crisis. That's the whole question, because as you said, oil has been up to almost $100, but gas prices in Europe that doubled in 2 days are now only up 50%. So it's kind of a bit quieter on that front. The whole question is the duration of the crisis, and of course what it means on inflation if it lasts long. If it's short-lived, the impact on inflation should be manageable for Europe. So that's the first aspect of this crisis.
Yeah. And how inflationary, it's difficult to know, given we don't know how long it lasts for, Karen, but what assumptions are you making about how inflationary this becomes for Europe?
It's very complex, because a lot of people are doing like a parallel with the Ukraine war. The situation now is very different because at that time you had a supply shock and a demand shock. Today it's only a supply shock if it lasts longer, so there is no demand shock. And the budgets of European states are maybe less comfortable to give energy checks if it lasts longer. So the switching is a bit different. However, if there is an inflation shock that lasts longer, it will have an impact on demand, and so that is not inflationary. So it's very complex. So maybe it could lead it to still a statu quo from the ECB. The whole question is, what is the impact on demand? So obviously, if it lasts several months above $100, it would be a bad reason to increase rates, because up until now, markets maybe priced in a good reason to increase rates, which is a higher activity in the Eurozone. So that might be an issue for the ECB, but it's too soon to tell. I think De Guido's spoke this morning or yesterday saying that they are looking at the situation, but up until now, they're still in a good position because inflation is still close to 2%. So it's still comfortable for Madame Lagarde to keep interest rates unchanged.
Karen, good morning. It's Tom here in the studio as well. You're talking about upended narratives as a result of this war in the Middle East. One of those, of course, is weak dollar, and dollar has been a clear beneficiary of moves as a result of haven positioning. So my question is, to what extent the relatively weaker euro, can buffer European corporates? To what extent that will be a buffer for European equities and European companies going forward?
Well, we've seen there's been a clear disconnect between the euro dollar and European performance compared to previous years, because the dynamic for Europe has been largely domestic, so less sensitive to FX, and maybe unfortunately less sensitive to China also, because after 2 or 3 bad years, the European markets have been more focused on their domestic markets. So going forward, maybe there's less sensitivity. Even if the euro goes down, that's not going to boost particularly results of exporters in the Eurozone. So FX probably won't be a big issue for Eurozone companies, maybe a bit more for Nordic or for Swiss companies that have really seen a very strong currency compared to the rest of the world. But for Eurozone, it won't probably move the needle much. And also the second argument is that since activity is quite resilient, and if there is a little spike in inflation, it will be both in the US and the Eurozone. So you won't have that disparity between the two areas. So that won't justify a big increase or decrease in the euro.
Karen, if the war does come to a relatively quick conclusion, does European equity outperformance versus US return, and how quickly?
I think it would be very fast because, as you've seen before, the start of the war, Eurozone was really outperforming the US. So now they're almost equal. So they should be back into this narrative of outperformance. And that also has been partially on hold because Japan is still outperforming the US and Europe. So if the war comes to an end quickly, we should be back to this narrative of the rest of the world against the US. So we still think that if valuations are around 16 PE for the Eurozone, it's still a very hard, strong argument for outperformance and decrease in gap between the US and the Eurozone. And just to point out for the last results for EPS, the gap between increase in EPS for the US and Eurozone has narrowed. It was 14% for the US, plus 4% for Europe, up until the end of February, of course. So that also is justification for outperformance for the rest of the world against the US.
Karen, are UK equities a good place to hide out during this war? Or at some point, if oil keeps climbing and BOE rate cuts keep being priced out, is that no longer a good idea?
Well, the UK index is very particular because you have a big part of commodities, banks, and consumer stocks. So obviously the consumer part would be hit. And even before the crisis in Iran, the biggest warnings that we've had of big names on the stock market in the US and a bit less in Europe is consumer names, big consumer companies, Mondelez, McCormick, etc. So in the US, to give some examples. So that might be an issue also for consumer companies. Commodities should be a bit more immune, obviously, as for energy stocks. So the UK is still cheap. It's a cheap market even to the Eurozone, but it's a very complicated market. Also, there's another thing about the UK. It's a very good candidate for M&A. So that also could be a support for the index going forward if you have more operations on M&A.
And Karen, I'm looking at defence stocks up today, but are you surprised that European defence stocks aren't up more because of this conflict?
Well, there's been a bit of profit taking, I think, on defense stocks. That's the first thing. And the second thing that is a bit more maybe cynical is that a higher oil price is good for Russia. So it's good for pursuit of that war. And maybe that's also a reason why defense stocks have been down. Also, maybe issues on volumes that have been flagged for defense stocks in the US. And so also there's a form of contagion, a correlation. So that's why there has been a volatility in defense stocks in Europe. And that's why maybe they were down yesterday, probably.
Karen, great to see you. Thank you so much for your insights this morning. That's Karen George, Portfolio Manager at EcoFi. Thank you very much. Well, let's check in on the core six this morning. We were just discussing Rheinmetall. Those shares are higher by 2.75% this morning, as we are seeing gains for many of the names across the defence sector. We're also looking at LVMH actually up 1.2%. The losers in terms of the core six this morning are ASML and Nestle. But let's get a check on some of the individual stocks that we're in particular watching today with Chloe Melly. Chloe.
Good morning, Lizzie. Zealand Pharma is taking a massive hit this morning, down almost 30%, and Roche is also taking a bit of a hit after their experimental obesity shot failed to impress investors. So the weight loss was comparable to a placebo, and so it failed to clear the bar that was set by analysts, and it means that their product will not yet be able to compete with products from Novo Nordisk and Eli Lilly within that obesity space. So that is a big setback for those two companies, and we are seeing those shares down significantly this morning on the back of that. Moving on to Lufthansa, which is up this morning after saying that it expects significant earnings improvement in 2026. It said that there was still the challenge of all the uncertainty caused by the conflict in the Middle East, but that there's an opportunity there as well for those airlines that are not based in that region to expand capacity for long-haul flights connecting Europe, Asia, and Africa. And so we are up more than 3% for Lufthansa this morning on the back of that upbeat outlook. Defense is also in the green. This is a theme that we've seen, of course, throughout the week, with this conflict showing really no sign of letting up. And therefore, we are seeing all of those names up this morning, in particular Hensoldt up almost 4% at the open. And finally, DHL, the logistics company, was upgraded to new ratings by both Barclays and Bank of America analysts. And so they said that that company will see some tailwinds from that conflict in the Middle East. They'll be able to capitalize on some of that supply chain uncertainty. And so because of those upgrades, we're up almost 3% for DHL.
Chloe, thank you very much indeed on some of the stocks on the move this Friday. Chloe Melee. Coming up, flight cancellations, meanwhile, to Middle Eastern hubs have surpassed 27,000 since the Iran war began. We're going to bring you the latest developments next. This is Bloomberg.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
Bringing you up-to-the-minute global news whenever and where.
What is going to be the... We are seeing modest gains across European markets.
Know how the market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romain Bostic, and this is The Close.
Live every weekday.
Only on Bloomberg. Context changes everything.
Why do the biggest names in business choose
Close?
Live every weekday.
Only on Bloomberg. Context changes everything.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question.
Good question.
Great question.
I so appreciate that question.
You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
Good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Welcome back. This is the opening trade, 16 minutes into Friday's session, and the European equity market picture is positive, catching up a little with some of the positivity on Wall Street yesterday, unwinding some of the losses of yesterday. So European stocks up by 0.3%, Tom. US futures pointing higher, but not by much. And we have non-farm payrolls later, of course.
And we have a reminder, of course, of the threat that continues to exist in and around the region as a result of the war in Iran, with Dubai residents getting a missile threat alert on their phones. And we've seen in the last 24 hours another barrage from Iran targeting regions, of course, and many of its neighbouring countries, including Abu Dhabi, where there's been alerts put in place around the airport there. Now, Dubai residents get a missile threat alert on their phones. We can see a live shot from our Dubai bureau there of the city as those alerts come through.
Well, the number of cancelled flights to Middle East hubs has surpassed 27,000 since the fighting began now. Meantime, Lufthansa says that while the conflict adds uncertainty to the outlook, the carrier is considering increasing capacity on Asian and African routes to meet surging demand. As you can see, the share's up 2.8% in the session so far. Well, let's bring in Bloomberg's managing editor for aviation, Benedict Kamel, who's in Berlin. Benny, are other carriers who are also not based in the Middle East likely to add more long-haul routes, as we're seeing from Lufthansa?
You'll probably see more of that happening. Lufthansa came out with their earnings this morning, and as part of that, they commented as in the Middle East in particular. It's a bit of a sort of a two-way street. On the one hand, they're saying this obviously injects a huge dose of uncertainty into the outlook. The costs will probably go up. Supplies through the Strait of Hormuz are more complex now. On the other hand, they see an opportunity here on some long-haul routes to Asia, to Africa, to other parts of the world, because obviously those services have now been disrupted by the companies that previously had a really dominant hand here, principally Emirates and Etihad and Qatar. So we heard from the CEO in a statement saying this is a reminder that this the aviation world's Achilles heel is what he called it, and it's also a reminder, he said, that we should remain sovereign in Europe to direct our own traffic flows. So there's a, dare I say, a sense of politicization going on here, that the company sees an opportunity here, but it's also a thinly veiled reminder that this is a competitive environment and they see a chance to win some business.
Yeah, so expanding in certain areas then to take account of the fact that many of the Middle Eastern airlines that are based in the region, of course, are even more heavily affected. What's the assessment, Benny, of the extent of the impact on their businesses? I mean, do they operate any flights that don't go through their hubs?
So we heard this morning that Etihad is starting to resume some flights in the next 2 weeks. They put out a list of about 70 destinations. So that's a fairly aggressive sort of restart of operations. If you compare that to Emirates and Qatar, they are still on the ground, running only sort of rescue flights and exit flights for people who are trying to get out, but no real commercial operations. So Etihad is the first company that is resuming flights, but as you just said, we are still in a very, very difficult situation here in terms of the safety picture. We heard from that there are these alerts, that there are missile threats. So Etihad is doing this, with a backdrop of a very, very murky picture. So we'll have to see whether this is sort of on again, off again, start, stop kind of scenario. But they are trying to get to some degree of normalcy again, because we're talking about almost a week of totally suspended operations and about, approaching 30,000 flights at this point. So a huge financial hit on these companies.
Benny, when we do get a resolution to this conflict, how quickly can these airlines, not just in the Middle East, but globally, get back to pre-war levels in terms of capacity? And what are we seeing in terms of the jet fuel prices have shot up, well above Brent and WTI? To what extent are these airlines hedged around that fact? Are we going to see higher prices, ticket prices as a result of this? What does the picture look like post-conflict?
I imagine that things will return to normal fairly quickly in terms of operations. These are mobile assets that they can move around fairly quickly. The big question is, how will demand come back? Will people feel less inclined to board an Emirates plane that goes via Dubai, given what they've seen in terms of the stranded passengers, given the insecurity of the airspace, and that might change people's minds about boarding these aircraft, and then maybe turning to the likes of Lufthansa. Another route through maybe Helsinki on Finnair and so on, if they want to go to Asia on a long-haul route. So that's going to be a big uncertainty. in terms of how the passenger flows change. The other is on the cost side, as you said, jet fuel will get more expensive, already is more expensive. How much of that can airlines roll on to passengers? How much are passengers willing to stomach some of this? We know in the US that US carriers do not hedge their jet fuel costs. So that's something that will immediately hit through to their bottom line. So some of the more vulnerable companies over there might have trouble passing this on to onto their passengers. So sort of in a good state, you know, the big ones, United, Delta, and so on, they can probably stomach the additional cost for a while. But those that are sort of already on the edge of what they can do financially, those are the ones that will really struggle. So you might see some fallout in the next couple of weeks in terms of profit warnings and so on. We already heard from Wizz 2 days ago, you know, arguably a small carrier, but it gives you a sense of just sort of what a difficult situation we're in.
Okay, Bloomberg's managing editor for aviation, Benedict Cummel, with that update. Benny, thank you. Meanwhile, Bloomberg has learned that the Trump administration is considering sweeping new controls over the global AI chip industry. Officials at the US Commerce Department have drafted regulations that would restrict AI chip shipments to anywhere in the world without American approval. Joining us now is Matt Bloxham, analyst at Bloomberg Intelligence. Walk us through the proposals then, Matt, and how significant they could be.
Yes, well, this is still very much in a drafting phase, but you know, what we understand is that there could be different tiers of restrictions in place. So if you're looking to kind of export a relatively small number, say up to 1,000 NVIDIA chips, then the kind of approval process might be pretty light touch. But if you're kind of looking for a large-scale deployment, say in the hundreds of thousands of chips, which you know would be kind of a fairly large data center, and that's owned by one company, then the local government might get involved, much more deeper scrutiny about who this company is, what they plan to do with it. So yeah, you will have to see how this kind of plays out, but clearly some kind of clear signals there that the US government sees its strategic role in shaping the future of the global AI industry.
And Matt, we've had the news that Oracle's planning to cut thousands of jobs. Your team saying that this is likely tied to the CapEx decisions. How should we be interpreting it?
Yeah, so you know, Oracle's expected to go heavily into the red on cash flow in the next few years as they build out their data center strategy. So I guess they're looking to some degree to balance these books, and also I think just reshape their workforce. You know, this is if they're moving more into a kind of direct competitive cloud business, then perhaps the kind of headcount they've got needs to be rebalanced too. Oracle's no stranger to restructuring efforts. This would be a much bigger one than they've done before. Our estimates are about $1.6 billion of cost. In the past, it's been a few $100 million. So yeah, you know, I think to some degree, and again, we've seen this before, to kind of reshape a headcount, you sometimes have to kind of shrink it first before you start rehiring. And so I don't think we want to kind of rush to make too many broad implications, but I think there is a degree here of repositioning, but also anticipating that some of the kind of things they do today, they'll be doing with AI, not people, in the future.
Is this quite a specific Oracle story then? Or does it tell us anything about the broader?
No, I think you're. I mean, we've seen it in the recent past, and I think we'll continue to see it. That companies, whether they're directly in the tech space or whether they're kind of regular businesses that are kind of thinking about their strategy into the midterm and how they need to adapt and adjust their headcount, may well kind of be making some big headcount cuts soon and then reinvesting later. And actually, that would fit with the big survey that Bloomberg Intelligence did at the back end of last year, where corporates, said in the mid to long term, we actually don't see our headcount reducing that much, but we are making lots of short-term tactical reductions in our headcount as we reposition for that future growth opportunity.
Tech still has jobs in tech.
You have to wonder to what extent the US is the canary in the coal mine because of the proximity to the AI innovation and the looser labour laws, and whether we watch what happens in the US and then we start to see that 12 months down the line here in the UK.
12, 24 months, as you say, labour laws I think are a really important factor here. If you think about Europe and how difficult it is to make people redundant, say in France or Spain, then that's going to be a big issue, and I think certainly some governments will take a different approach to how you treat people.
Matt, thank you very much. Matt Bloxham, Bloomberg Intelligence analyst covering tech for us. Coming up on the programme, we will pivot back to the big geopolitical story of the moment. We'll talk to Kasra Arabi, IRGC Research Director at the United Against Nuclear Iran. That's as President Trump calls for a clean-out of Iran's leadership. Certainly wants to have a role in who comes next in terms of leading the country. That conversation is here on this programme coming up shortly. This is Bloomberg.
The problem we've got as an industry is when the government overtax, and let's say they tax at 30 or 40% of net gaming revenue, what happens is it starts making it uneconomical for the regulated operators like ourselves. And then the customers land up going to the black market, and the black market don't pay tax, do whatever, and there's no customer, there's no responsible gaming, and the fiscals of these governments don't collect any money. So it's finding a balance between overtaxing and then not regulating. Anything from 15 to 25% of the net gaming revenue paid on tax is probably the right number. And when you start going above that, the metrics start becoming a bit more complicated for lots of the operators.
It's the most fascinating time for the global economy in years, and our conversations are front and center.
We're stress testing consequential ideas, and investors around the world are scoring them in real time, helping to translate the policies from Washington into actionable ideas for Wall Street.
It's the morning call you actually want to be a part of.
Separating the signal from the noise, with some fun along the way.
This is Bloomberg Surveillance.
Welcome to Bloomberg This Weekend. I'm David Murray.
I'm Lisa Mateo.
And I'm Christina Ruffini. We're tracking breaking news today from Wall Street to Washington.
Let's start overseas. The sector is really propelling this yield forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up. At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
This is the opening trade. We're 30 minutes into today's session. It is day 7 of the Middle East war, and the European stock picture looks like this. Green across the screen this morning. We are seeing US futures pretty flat, which is usually the sort of picture that we would see on jobs day. But of course, the war is dominating today. Tom, what are you seeing under the hood when it comes to Europe?
Yeah, I mean, how much positioning do we want to be putting on ahead of the weekend, given what could change, of course, over the next 48 hours or so? So volumes are a little lighter, possibly in that context, down about 25% over and versus that 20-day average. On a member-by-member breakdown, so you do, of course, have the majority now of stocks in this modest risk-on environment in the session today, actually higher, 416 versus 168 to the downside. Let's split the board and have a look at some of the individual names and stories playing out then. Interesting is travel and leisure near the top of the list in terms of sector basis, industrials as well, into which, of course, defence sits. So Ryan Martell up 3% on the back of that expectation, of course, that defence stocks will perform better and get some upside as a result of the war in the Middle East. SAP, a third straight day of gains, interestingly, for this software company with the enterprise focus, up 1.8% so far. It's been challenged, of course, because of that AI disruption story, but in the week, SAP is looking a little brighter. Lufthansa, that is the lift across the travel and leisure space then, with the airline coming through for some pretty positive remarks in terms of how they could benefit longer term as they adjust some of their routes. Up 3.4% then, the German airline gaining in the session today. On the downside, let's flip the board, and in the pharma space, Roche is challenged. Zealand dropping very significantly as well in terms of an obesity drug and disappointment there, failing to clear a high bar set by Wall Street. Roche and Zealand partnering on that. Roche down 2.8%, but Zealand, look at that, plummeting, that Danish company down 31%. In the semiconductor space and the chip space, interestingly, some mixed picture in terms of the details coming through this week. Broadcom very positive in terms of revenues coming through. Marvel with an upgrade to the forecast, but maybe this is a supply chain story. BE Semiconductors currently down 9.4%. The Dutch company taking a big hit in the session today. Anna.
Tom, let's get an update on some of the other stories we're covering this morning. President Donald Trump is facing a major legal challenge to the global tariffs he imposed last month after the Supreme Court struck down his earlier sweeping duties. President Trump's proclamation placing a 10% tax on imports as of February 24th is, quote, fatally flawed and must be overturned. That's according to the 24 states who filed a lawsuit yesterday in the Court of International Trade. Trump has said he plans to increase that levy to 15%. Bloomberg has learned that SoftBank is seeking a loan of as much as $40 billion to help finance its investment in OpenAI. The potential size of the loan underscores founder Masayoshi Son's aggressive bid to try and position his company as a linchpin in the global AI boom. And the US has cleared the way for India to temporarily increase its purchases of Russian oil, reversing months of pressure on the world's third largest crude importer. The waiver, which expires on April the 4th and is intended to enable oil to keep flowing into the global market. Let's pivot our coverage back to what's happening in Iran. And a barrage of Iranian missiles and drones has targeted at least 5 countries across the Middle East. This as Israel carried out a 12th wave of airstrikes on Tehran. The Iranian Foreign Minister Abbas Araghchi told NBC News that his country hasn't asked for a ceasefire and had no intention of negotiating.
And we are prepared for any other eventuality, even, a ground invasion. So our soldiers are prepared for any scenario. When I said that we are waiting for them, it didn't mean that we are waiting for continuation of the war. No, but we have prepared ourselves to confront with any scenario, with any eventuality, any possibility, and we know that we can handle that.
For more, we're joined now by Kasra Arabi, who is director of the IRGC Research Unit at US-based non-profit and non-partisan policy organization United Against Nuclear Iran. He was previously the Iran program lead at the Tony Blair Institute for Global Change. He's also been a non-resident scholar at the Middle East Institute in Washington. Welcome to the program. Thank you very much for joining us, Kasra. Can we talk about succession and what that looks like in Iran? Help us understand a little what we should be watching for here. We hear lots about resilience in succession and resilience in the regime in Iran, but then we hear President Trump wanting to insert himself into the conversation about succession. Who is in charge of succession now, by your estimation?
So we've got 2 things here. We've got the visible state, where everyone is paying attention to, but actually behind that we have an invisible state, a hidden power structure. Ayatollah Ali Khamenei, who was eliminated, the supreme leader, he had created this hidden power structure, the Office of Supreme Leader. It wasn't really an office, it was an extensive apparatus that enabled him to A, make sure that he has eyes and ears all over the regime's elites, but B, more importantly, ensure that should he be eliminated, the Office of Supreme Leader, the BATE, made up of as many as 44,000 affiliates, can ensure continuity rather than confusion. So the BATE, his former office, the Office of Supreme Leader, alongside the IRGC, that's the Islamic Revolutionary Guard Corps, the terror army of the regime, behind the scenes, they are ensuring that there's no power vacuum, and they're the 2 bodies really deciding, alongside with the clergy as well, of course, deciding who's going to succeed. In that Office of Supreme Leader, crucially, Mujtaba Khamenei, the former Supreme Leader's son, second eldest son, he's operated as a bit of a mini Supreme Leader in that structure already. He is tipped to succeed his father now.
Okay, so for what you've said there, that sounds like the process as the Iranians would like to see it unfold. Are there other players that we need to be aware of who sit outside the regime, whether that's the theocratic regime or maybe parts of the secular state? Any other leaders that we need to be aware of that the West might be interested in giving more power, allowing more power to?
Well, there's no secular state. This is a totalitarian Islamist dictatorship. You don't have
there's
any...
the theocracy, but then there are elements that look from the outside like, presidencies.
And that's an incorrect external observation. This is an Islamist regime. To be able to even stand a chance of being a candidate, even at council level, you have to be an Islamist. You get checked. There are extensive vetting processes. You have to pledge full commitment, practical commitment to absolute velayat faqih. Absolute velayat faqih means absolute rule by the Supreme Leader. Ordinary Iranians cannot participate in the political process. You have to not only be a religious Iranian, a religious conservative Iranian, but you have to prove that you are an Islamist. You undergo extensive ideological indoctrination. So there's no... You're referring to the visible state, the presidency, the conventional apparatus, but even in that conventional apparatus, they are all Islamists. So if we take a step back, though, the most important in the long term here, in the short term, the most important player that we haven't mentioned are the Iranian people. Let's not forget, last month, they took to the streets in their millions. They have been taking to the streets, by the way, continuously since 2017. The protests that we saw They weren't a flash in the pan moment. This has been reoccurring. The message of the Iranian people has been clear. They want regime change. They no longer want to live under this dictatorship. Last month, they took to the streets, and this regime massacred as many as 40,000 unarmed civilians. Yes. And that's why the response has been, from the Iranian people, positive to the strikes that are ongoing.
What is the mechanism for the Iranian people taking charge then and avoiding a Libyan scenario where you get a civil war?
First of all, Iran's very different to Libya. Libya is a very tribal, was a tribal, and is a tribal society. Iran's community, Iran's society, the different ethnicities that have been living together side by side, have been living together for 2,500 years. So it's not a new nation. Iran is one of the oldest civilizations in the world. For the Iranian people to be able to take control, reclaim their country, this is what they believe. They want to reclaim their country. Ultimately, the suppressive apparatus of the Islamic Revolutionary Guard, called the IRGC, is an extensive apparatus that pervades every level of society. That needs to be dismantled. Right now, in the phase one of this military operation, the US, the Israelis are focused on decapitating the offensive and defensive capabilities of the regime. But we are starting to see them going after dismantling this suppressive architecture.
Well, Israel's trying to bring in the Kurdish forces. How risky would that strategy be?
I think we need to take a step back, first of all, and say, for Iranians of all ethnicities are united in toppling the Islamic regime. That's been consistent. We saw that in the protests. There was no sectarian or ethnic tension. Iranians are united. They've lived together. These different ethnic groups have lived together. Actually, Iranian nationalism, this pluralistic Iranian nationalism that involves Persians, it involves Kurds, it involves Iranian laws, it involves the Azeris. That's the most powerful weapon against this Islamist regime. Any move that is perceived by the Iranian people that Iran's territorial sovereignty could be at risk, that risks fracturing this unity and actually emboldening the regime. So if there is a strategy whereby, and we don't know yet, these aren't confirmed reports, the US has actually denied this, but if these reports are accurate, I think it needs to be equipped with a very, very clear communication strategy that says and speaks to the Iranian people and says this is merely a tactic to draw the IRGC to the battlefield so that we can enable the Iranian people to take to the streets, provide them with this space. This isn't an attempt to divide Iran, because that is the Iranian people's red line, and that would embolden this regime.
Okay, so some caution there. Thank you very much. Thanks for joining us, Kazra Arabi, Director of the IRGC Research Unit at policy organisation United Against Nuclear Iran. Now, the current intensity of the Middle East war is unlikely to endure. That is, apparently, if you do some analysis of stockpiles, Iran could exhaust its missile and drone stockpiles, while Israel and the Gulf may face pressure on their missile defense systems. Let's try and get into some of the numbers and talk about this. Jerry Doyle joins us, our global defense editor. Good to have you with us, Jerry. So from your research, from what we know about the stockpiles in the various locations, how long can this conflict last at the sort of current usage rates?
I mean, I am not sure there's any way to definitively put a time horizon on it. At the beginning of the war, the outset of the war, Iran was estimated to have something like 2,500 ballistic missiles and a much larger number of these Shahed one-way drones, sort of basically a rudimentary cruise missile. Since the war started, the U.S. and Israel have targeted not just the missile stockpiles, but the missile launchers, which has created sort of a bottleneck to using the ballistic missiles. If you don't have the launchers, it doesn't matter how many missiles you have in your stockpile. They're just going to sit there, right? And so we've seen that since Saturday, the volume of Iranian ballistic missiles has sort of tapered off a little bit, although there was a big uptick yesterday. The drones, on the other hand, have seemed to increase in volume. And so there's some indication that Iran has a large number of these. They may be producing them. And so that's why it's unclear, whether we can put a definitive horizon on how long the conflict could last. A high-intensity conflict with large numbers of ballistic missiles, we might be past that phase in a week or two, but a sort of enduring conflict with these continual strikes around the Gulf using the Shahed 136 drones, that could continue for a longer period of time. And then on the U.S. and Israeli side, they have been using many of these higher-end air defense weapons, the Patriot PAC-3, THAAD, even SM-3 Block 2As launched from naval ships to intercept ballistic missiles, but also because of the sheer volume of these drones attacking to destroy them. And so you have this mismatch between a very expensive interceptor and a very cheap missile, and it's causing those stockpiles to run dangerously low.
So, Jerry, if they're using those high-end missiles on Iran, how exposed does that leave the US to the likes of China?
At the moment, as far as I understand, the U.S. has not had to pull from stockpiles in the Indo-Pacific region. If it does, I think there introduces sort of a theoretical risk against a ballistic missile attack. However, China has the world's largest conventional ballistic missile arsenal, has large numbers it can concentrate on any one target, and so the actual operational impact might not be that high, just from a cynical point of view that China would be able to, if it wanted to, concentrate all of its ballistic missile fires on one target and get through.
Thank you. Thanks very much, Jerry. A lot to digest. Jerry Doyle, our defence editor, Bloomberg's global defence editor. Thank you for joining us.
Well, coming up, the smartphone industry faces pressure from chip shortages amid the rising geopolitical risk. And we'll be speaking to Carl Pace, CEO of consumer electronics company Nothing. That's next. This is Bloomberg.
Say that there's maybe a little bit of a bubble in AI. When you have companies with market caps of $5 trillion, you don't see any bubble there at all?
Whenever we have an acceleration in technology and people get excited about it, you have significant capital formation around new companies that are trying to capitalize on that opportunity. And, you know, we've seen this before through history, and you're seeing it now. It won't be a straight line. The opportunity set with AI is enormous. There will be winners and losers. And it's hard to pick the winners and losers now. And certainly a lot of the capital that's being deployed will not produce adequate returns. And a bunch of the capital that's being deployed will actually not produce any returns. But it's hard, it's hard to call the timing on these things. And the thing I'd point to just from a historical lens is in the fall of 1996, Alan Greenspan talked about irrational exuberance in stock markets, and the NASDAQ was at 1,300. And the NASDAQ peaked 3.5 years later on over 5,000. So, these things can go on for a long time, but ultimately, there are adjustments, there will be drawdowns, there'll be rebalancing, and just, it's hard to call it because the technology trend and the investment is real.
Astonishing day for US technology.
It's shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
welcome back. Now, London-based consumer electronics firm Nothing is introducing a new range of devices at a time of growing pressure on the global smartphone market. AI-driven demand for memory chips is tightening supply across the tech sector, while escalating tensions, of course, in the Middle East are adding fresh uncertainty around shipping costs. Joining us now is Carl Pate, CEO of Nothing. Carl, good morning. Thanks for joining us in the studio. We're going to get to the launch of the phone, of course, but in this moment that we are currently living in, with all the concerns and implications of the war in the Middle East, to what extent are supply chain challenges impacting your business at this point?
The supply chain challenge that we've seen in our industry is more around the memory, not around the war. Like all the AI servers, a lot of the memory is bought up by AI, so that for all consumer electronics, including phones, laptops, and anything else that has memory, the costs have really gone up this year.
And you're an upstart, and you're making challenges, and you made some pretty significant inroads, but you are, of course, still in that upstart position. Does that make it harder in terms of negotiating supply? What does it mean for pricing? Do you have to pass on that cost to the consumer?
I think about it this way, right? So there's different companies in our industry operating at different price points to the consumer. The more differentiated you are, the higher price you can charge, and the higher price you can charge, the more you're sheltered from supply chain shocks like this. So the low-cost players are the ones that are going to be really impacted. When you ask our users why they buy our products, design, user experience, software, and brand are like the top reasons. So we're a little bit more sheltered towards this. But just to illustrate as an example, last year about 15% of the cost of building a phone was memory. This year it's 40% for us.
So you've got enough memory in reserves?
We have enough memory, but the costs have gone up.
Yeah, because analysts are warning that shortage is going to extend to 2027.
Most likely.
And you've got the IDC saying that there'll be a 13% decline in the smartphone market. Is that about right in your view?
It's very early to tell. We're early into 2026 right now. I think consumers will be shocked when they see all the new launches at a higher price. But these are also products that you need, right? 1 billion phones are sold every year. 5 billion phones are used actively.
You don't need an expensive one, though, Carl.
Huh?
You don't need an expensive phone.
Well, we have phones in all kinds of price points.
So you talked about the fact that the cost of the memory is going up. I mean, what does that do to pricing? Does that mean that you have to charge more? Are you going to have to charge more?
Well, some companies are going to absorb the cost in their margins. Some are going to charge more. It's most likely going to be a blend of both.
And you say that the people will pay up for differentiation. So, and you listed the reasons why people might buy your phone. I mean, I could think of lots of tech products that people would apply those same reasons to. So what is it that differentiates yours?
Well, we're targeting the young and creative. That's where we're really finding a lot of resonance, and we're targeting them through very differentiated product design and also a software experience.
This is the 4A that's just been launched.
Yesterday, yeah.
What are your ambitions for shipments? How many units are you targeting at the 4A?
We're not talking about exact shipment numbers, but I can tell you that we're the fastest growing smartphone brand in the world, and we apprapproached $1 billion in revenue.
That's because the others are really big.
Yeah, correct.
But you know, there's a big market to go after.
Carl, what is your ambition with? I mean, you got Tony Fidel's an early investor and as a backer, and he helped co-design and co-invent the iPhone and the iPod. What is your long-term ambition? What does the business look like in 5 years? How much market share do you want to be taking?
I think that's not the most important thing. You know, as a kid, I was really inspired by all these tech products that were coming out, the iPod, the iPhone, etc. It felt like every year these products got better and better. And then as I grew up, it got more and more boring. Products became more and more iterative. So I wanted to bring that fun and inspiration back into the industry. And so hopefully for kids growing up today, they also have a company to look up to. And I think we can begin to make a mark in the industry, not only making products that have already been made by other people, like phones and headphones, but also beginning to bring our own innovations to the market.
But come on, I've read that you want to be $1 trillion company. Do you want to be the next Elon Musk?
No, I just said that, you know, it's an infinite game. I'm going to do this for as long as I can, maybe until I retire. And it's not really about the money.
Do you have to think carefully about production locations, manufacturing sites these days? We started off talking about the supply chain issues, which at the moment are all about AI, and they're not necessarily about security and geopolitics, but it's very easy to see instances where geopolitics interferes with your ability to get supply or product. I mean, do you have to think carefully about that? You manufacture in China?
That was more like a topic for us in the beginning when we just founded. We manufacture in China, we manufacture in India. In fact, we do more in India than we do in China right now. But these days, we have that pretty much figured out, yeah.
How do you think AI, embedded AI, evolves? What kind of devices are going to be? How central is the smartphone going to be to us in an embedded AI environment?
I think the smartphone is going to be the most important device in the AI era as well, because, you know, there's no other device with this much context on us, right? So AI, the basic logic for AI is the more data it has, the more it can help us, the more it knows us. So there's no other device with this.
It doesn't shift to glasses. It doesn't shift to earbuds. It doesn't shift to something on your lapel.
However, you know, the phone is not always going to be available, right? Sometimes we're walking around. Sometimes we're at a dinner. We don't want to have the phone on the table.
Yeah.
That's when the use for other form factors will emerge. You got to have other types of products to keep.
Are you working on some of those form factors?
We are, yeah.
You said that you want nothing to be ready to potentially IPO by the end of 2028. What's stopping you committing to London?
We just haven't really thought about it. And we said, let's be ready internally. Doesn't mean we do it. We look at the market conditions and decide whether it's better to go private or go public if we need more financing. But I just wanted our team to get the house in order by the end of 2028.
We have a question from a viewer, Carl. Are you looking into foldables? So Apple's been very slow to this. We've had foldables in China for years. My Chinese friends, they've all had foldable Huawei's and Xiaomi's for a couple of years. Is that a place for you as well, or do you steer clear of foldables?
Well, if you think about it this way, the smartphone market is 1 billion units a year. Foldables is less than 20 million out of that billion. And the average user for the foldable is like a man doing business in his 40s. We're targeting the young and creative consumers, so it's not a great fit for us.
Not your demographic.
I think that's a no.
He says, looking at me. Thanks, Carl.
Well, Carl, you suggested that I wasn't part of the younger market that you're targeting as well. But Carl, good to talk to you.
Thank you.
Carl Page, CEO of Nothing. Well, let's have a look at what else we're watching throughout the day. The Canadian Prime Minister, Mark Carney, is in Japan, so we'll listen to him there. At 10 a.m. London time, we get Euro area GDP numbers. Before at 1:30 p.m, we get, of course, the US jobs report with non-farm payrolls and unemployment in focus. And then at 5 p.m. London time, we'll hear from the ECB's Isabel Schnabel speaking at the Monetary Policy Forum in New York. How much hawkish is she in the environment of the Middle East war? We'll also hear from Fed speakers Daly, Paulson and Hammock at that same event, Tom.
And Bloomberg will have interviews with the Fed Governor, Chris Waller, Cleveland Fed President Beth Hammock, and Chicago Fed President Austin Goolsbee later today. Really important to hear from them, given the repricing we've seen around central banks and, of course, the Fed as well, Anna.
Yeah, the Fed in focus, jobs market in focus later on, headline risk at the Middle East. Certainly in focus as well. Let's think, it is Friday, it is just coming up to 9 o'clock here in London, so let's think about the weekend ahead. And we're fully aware that we have plenty of viewers in the Gulf for whom this might seem a little out of touch, but we all hope that these events can act as something of a distraction from everything that's going on in the world. So let's talk about what is happening this weekend. We have Grand Prix in Melbourne. That is taking place. Some difficulty in getting there for some of the teams. We understand there's rugby. Where's Guy when you need him? Tom? No. Over to you on the rugby. No,
Ireland, Wales. So Mark Cardinal's going to be tuning in for that. That's at 8 later today. Ireland versus Wales. That's going to be a good one. Italy, England. England's performance has been pretty mixed.
Moving on.
Sam Etienne, our executive producer, will have views on that. That's at 4:40 tomorrow. But I know you're particularly interested, guys, in crafts.
In crafts. I was going to the Fashion Week. That's for Lizzie.
Can I pick out the highlights of the weekend? You've got today Mugler and Loewe and Givenchy.
Tomorrow you've got the right team assembled.
And Hermes, and then on Monday, Chanel.
Speaking of the weekend, be sure to catch up on Bloomberg, the Bloomberg Weekend newsletter. That brings you a collection of interviews, ideas and stories to explore the fascinating places where finance, life and culture meet. No doubt they have some incredible context on all that the world has been witnessing over the last 7 days or so as well. So certainly that's something to tune in for. And Bloomberg TV over the weekend is also available to you. That is it for the opening trade.
European stocks are up on the benchmark, up 0.5%. US futures pointing to modest gains of 0.1%. That is it for the opening trade. The Pulse is up next. This is Bloomberg.
Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, only on Bloomberg.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Jemana Bersecci in Davos, Switzerland, and this is Bloomberg.
The trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe.
I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie.
This is your opening trade.
Only on Bloomberg.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Know how the market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romaine Bostic, and this is The Close.
Live every weekday.
Only on Bloomberg. Context changes everything.
President Trump says the U.S. continues to, quote, totally demolish Iranian forces and that he wants to replace the leadership structure in the country. Tehran responds with a barrage of missiles and drones targeting countries across the Persian Gulf. Shipping in the Strait of Hormuz has reportedly ground to a near-complete halt, with no oil shipments in the past 24 hours. And President Trump fires Kristi Noem as Homeland Security Chief after months of controversy, the first cabinet member to be removed during his second term. So it has been a very long week, especially if you're living in the Middle East. So, of course, everything is focused on that, what it means not only for global trade, but also there will be a lot of people that will be thinking about where they go from here that live and have lived in the region for quite some time. If you look at S&P futures, they're practically flat. Stocks, I guess, are wavering a little bit along. We're seeing muted gains in oil. You can see Brent crude at 85.35. Look, oil resumed a little bit of gains yesterday. We had Brent ticking towards $86 a barrel. Data showing maritime traffic, again, the Strait of Hormuz had ground to a near complete halt. And then you look at European gas futures. They've been up some 36% since the start of the week, currently at 50.150. So for the conversations that matter and the insights you need, let's get started.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, Iran has launched a fresh wave of missile and drone strikes across the Gulf overnight, targeting at least 5 countries across the Middle East. Under fresh attack from Israel this morning, Iran has increasingly relied on drones in its retaliatory assaults over the past few days. Well, we're now joined by Becca Wasser, a defense lead for Bloomberg Economics. Becca, thank you for joining us. Do we know how many missiles and drones Iran has now left?
No one actually knows how many missiles and drones they have left, in part because no one actually knew how many they had at the start of this conflict. But we have seen the United States and Israeli strikes really going after Iran's missile program, but they've taken the approach of going after the Archer rather than the arrows. And by that, I mean they've gone off after Iran's missile factories, its underground missile cities, as well as really going after missile launchers, trying to make it so that Iran cannot actually send those missiles to various countries, including the Gulf states and at U.S. bases in the region. But there are still a number of missiles that haven't been accounted for, but even more so, the drone threat is intensifying because those don't need launchers to be able to be set off. And that means that those are being used in increasing numbers for attacks on the Gulf states, U.S. bases, and other areas.
So, Becca, can the U.S. sustain this campaign indefinitely?
So that's a great question. And I think it's one where the U.S. can sustain this conflict for a longer period of time. We've heard President Trump say 4 to 5 weeks. We've heard, the idea of this could go on for as long as it takes. That doesn't mean that this is necessarily going to be what happens, in part because President Trump has campaigned against the idea of forever wars and for the U.S. getting mired in the Middle East in the past, and those being relics of the past and mistakes that he's not willing to make. But that being said, there are some constraints on U.S. military power and how long they can go. One of those is what its munitions stockpile looks like. And I think we're starting to see the U.S. take a shift in its campaign where it's moving from these standoff strikes, where it was using some of these high-end, longer-range missiles, to trying to move closer in using cheaper weapons, frankly, that it has in greater amounts. And these are usually air-delivered joint attack munitions. But that requires the U.S. to have air superiority over Iran, and that's not something that they've been able to achieve just yet.
Becca, thank you so much for the update. Becca Wasser there, defense lead for Bloomberg Economics. Now, the war in Iran has, of course, entered its 7th day with no apparent end in sight. U.S. and Israeli strikes continue whilst the Iranian foreign minister told NBC that his country has not asked for a ceasefire and has no intention of negotiating. Well, joining us now is Catherine Ashton, a former European Commission vice president, former EU foreign policy chief who led the bloc's previous nuclear negotiations with Iran. So, Cathy Ashton, thank you so much, and welcome to The Pulse. 7 days, and I don't know how you think this ends or how long this lasts for.
Well, it's a big question. It's a question that's attributed to David Petraeus in Iraq when he said, "So tell me how this ends." And I think it's a question we're all beginning to wonder about. No doubt that President Trump wants to see a different regime, wants to see the end of any nuclear ambition for Iran, wants to get rid of ballistic missiles as well, and wants to see Iran severely weakened in the region. And, of course, for Prime Minister Netanyahu, that's a good ambition from his perspective too. But as we know, wars don't follow straight lines. They do things that you're not expecting. So it's really difficult to see quite where this will go. And Abbas Araghchi, the foreign minister, saying no negotiations yet, is an interesting position for Iran to put itself in.
I mean, a lot of people were taken aback by the intensity of the Iranian, retaliation, but also its capabilities in terms of weapons. Was this a gross miscalculation on the U.S. side?
Well, one of the things that happened when they ripped up the JCPOA some years back, the big agreement with Iran on its nuclear capabilities, was, of course, there were no more inspections, there were no more monitors, much harder to get information about what was going on. So knowledge about what was happening in Iran was much more severely limited, and that is a problem. I think what's taken everybody by surprise as well is the way that Iran has chosen to conduct its retaliation. I mean, firing against civilian targets, firing across the Gulf, I presume in the hope that those countries would say to America, enough, we want you to stop.
Do you think, they're quietly saying enough, or is this a matter of survival? That actually, if you're Dubai with the big financial hub, if you're some, the countries with a lot of tourism, you actually need to really see a change of regime in Iran now?
Well, it's unquestionably affecting people who either live in the Gulf, who are expats, as we would call them, from different parts of Europe or the US, who came there for a higher quality of life and a peaceful and secure environment, who are now beginning to wonder how this ends, when it will end, And I think it's also for the people who live there all the time, a sense of, we're being dragged into something. How do we stop this? And that's inevitably going to put pressure not just on Iran to stop firing the missiles, but on the US and Israel too.
I mean, as a career diplomat, is there an off-ramp for President Trump right now?
Well, I think the president will decide for himself when he's done it, as he would put it. And I suppose my concern more than anything is we end up with a weakened Iranian regime, but still a regime that can continue. And as somebody said to me the other day, if the IRGC, this group, this well-embedded group that really do lead the country, if they decided to surrender, well, who would they surrender to? Because there isn't the kind of organised opposition. And although there's a coherence across Iran that they want to see the end of the regime, there are 13 different ethnic groups. And there'll be those who want to see perhaps a bit more power, want to see themselves more able to participate in life in Iran. And that leads to all kinds of problems and challenges and jockeying for position that can cause a lot of difficulty in the future.
I mean, what do you think will happen on the ground? Again, it's very difficult to have an uprising if you don't have arms, and if you've been, there are people that started an uprising that were massacred in January and February.
Well, exactly. I mean, this regime does not take prisoners. It will destroy people if it needs to. It is weakened, but it's still there. The discussions about who will follow on from Supreme Leader, the Ayatollah, are still in flux. We don't know what's going to happen. But there isn't yet a sense that from this will come the kind of democratic regime we'd want to see. We'll have to see how that unfolds in the days ahead. But if President Trump is going to stay engaged with this, I think they need to move to the next phase of thinking about, well, what does this mean in terms of supporting people on the ground? And that's not just about arming people, it's also about how do you build the kind of structures and so on. And that's a really complicated and complex thing to do, and requires the region to engage with that as well.
But have you heard, I mean, this is also the thesis of your book, right? What next? In foreign policy, you have to have an idea of what happens the next day. Do you see that consciousness in the American administration?
Not yet. I think when it began, one of the things that was so challenging was trying to work out what the end game was. If you begin a conflict, first of all, it doesn't go the way you think it's going to, because they never do. But also, what are you trying to achieve? What is the end game? And it was quite complex to understand. Was this just about degrading the capacity of Iran to be able to use any kind of weaponry, nuclear or otherwise? Or was this about something much more fundamental? And we know, our history in the region tells us that it's very easy for things to become difficult and implode, and actually you can end up with a much more chaotic situation. So at this point, I'm not sure that the US really does know what it wants to achieve beyond certainly degrading and preventing Iran playing the role in the region it's played in the past.
I mean, a lot of people are banding around, especially on social media, is this the Third World War? Is there actually an idea that China could get involved, or that Russia can get involved, or you dismiss that?
I don't think they will. I think for Russia, they've got another war to conduct. And one of the problems, of course, is while we're all focusing on this, we're not focusing on what's going on in Ukraine and the challenges of weaponry for Ukraine. If America is depleting its own resources in the Gulf and is actually looking elsewhere for weaponry, what does that mean for how Ukraine can conduct the war? And that is a really difficult position. But I don't think this will expand in the way that people's worst nightmares might be. Having said that, it is still across a huge number of countries where people are being hit, and we're seeing missiles and attacks coming forward.
And now we're also talking about, the Straits of Hormuz almost being at a standstill, and this idea that the U.S. promised maybe some insurance, unclear how that would work, but also maybe safe passage through, with help, I guess, armed vessels taking care of the tankers. How would that work? And, I mean, would Europe need to be involved in this kind of operation?
Well, as you've seen, European nations have taken their own views about how this would engage them, from the Prime Minister here through to Chancellor Merz through to the Spanish Prime Minister. Very different positions, if you like. However, when it comes to providing support for tankers and for shipping, that's providing for our energy needs, and I think Europe will consider at least what it should do. But it's very complex because what we're also going to see is energy prices rising, and this for a lot of countries is a real problem.
Yes, especially the U.S. when you have the midterms around the corner. What is China thinking right now? There's been a lot of speculation in the last couple of years about what they would do with Taiwan and, you know, the waters around there. Does it make it more likely to do something or less likely?
It's hard to read because for China, this region was really important to remain stable. They were a big part of the JCPOA negotiations. The Chinese participated in all the 4.5 years that I led the negotiations and participated properly and well. And that was a demonstration that they saw this as an important region of stability because of energy and so on. So they won't be happy at all with what is happening here. I don't think they'll want to engage directly with it. I think they'll also be looking at what this means perhaps in Russia and Ukraine and their engagement there. But they'll be thinking about what this means for the stability of the markets, for the stability of their economy, fundamentally.
Kathy, if you had one question that you could get answered by anyone in this conflict, what would that be?
I think the question would be to President Trump, which would be the David Petraeus question. So tell me how this ends.
Thank you so much, as always, Cathy Ashton, a former EU High Representative for Foreign Affairs and Security Policy. Now, coming up, we discuss how markets are pricing the Iran war with Peter Oppenheimer. He's Goldman Sachs' Chief Global Equity Strategist. So that interview is coming up next, and this is Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
It's the most fascinating time for the global economy in years, and our conversations are front and center.
We're stress testing consequential ideas, and investors around the world are scoring them in real time, helping to translate the policies from Washington into actionable ideas for Wall Street.
It's the morning call you actually want to be a part of.
Separating the signal from the noise, with some fun along the way.
This is Bloomberg Surveillance.
Investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onim, only on Bloomberg.
Well, Tom Barkin, the Richmond Fed president, says the central bank's response to the war in Iran will depend on how long it impacts the U.S. economy. He's been speaking exclusively to Bloomberg's Mike McKee ahead of the Fed's next meeting on March 17th.
Don't have any sense on how long it's going to take or what the implications are going to be. Obviously, you watch oil prices. While the U.S. is no longer a net importer, it's still the case that the price at the pump matters a lot in terms of sentiment, in terms of crowding out other spending. And so I'm just watching prices at the pump. They've jumped up over the last week. You can see that when you drive around. But of course, no one knows whether this is going to be short-term or long-term, and so we'll just see where it goes.
Well, back in the 1970s, we had the oil price shock, and we had gas lines, and people were miserable and having to pay all this money, and so the Fed eased into that. That turned out to be a mistake. Does this put on hold ideas for the time being of continuing to cut rates?
Well, I think we'll go meeting by meeting, and we'll see what we see when we get there. Gas prices, obviously, if they're up, that is inflationary. Textbook monetary policy would be you look through a short-term shock, but you don't look through a long-term shock. And I think that's a lot of the assessment people are going to have to make.
Well, the Open Market Committee, before the Iran war started, basically the views seem to be that we're at peak tariffs now, and inflation will start to come down in the latter half of the year. But you throw this into the equation, where would you put yourself in terms of thinking about the progression of inflation and when you might have enough information to decide whether a cut is worthwhile or not?
Well, we'll have to see how it evolves. If you go back to the fall, the conversations I have with businesses suggest to me that they believe their pricing power is very limited. Consumers are exhausted by inflation, affordability. People are pushing back, whether that be not purchasing or private label or trading down to lower price retailers or repairing rather than replacing. And so in the conversations you do have a sense that we're on the backside of this inflationary period. We'll head back to normal. And the numbers in the fall, absent the government shutdown, we're saying much the same thing.
Well, Tom Barkin, the Richmond Fed president, speaking exclusively with Bloomberg. Now we're joined by Peter Oppenheimer, Chief of Global Equity Strategist at Goldman Sachs. Peter, thank you so much for being here. I mean, for the last 7 days, we've been focused almost on nothing else than the Mideast war and, of course, what's happening with Iran. Does that change the trajectory for equities?
I think it does certainly raise the risks. And the reason for that is because it's another uncertainty. We already had a degree of uncertainty building in around AI. Maybe we'll talk a little bit more about that. But I think that clearly anything that changes the sort of inflation growth mix or the risk around that is going to have an impact, particularly so given that equities are relatively expensive. And that's been true in the US for a long time. But the rotation diversification trade we've been talking about over the last year with other markets outperforming has basically left them all quite expensive. And I would also say, bear in mind, in all equity markets in the last 6 months, you've seen a big upgrade to cyclical performance, reflecting a lot of confidence in growth. So anything at the margin that dampens that leaves them vulnerable, I think, to a correction, but not more than that. Nothing, I think, systemic.
So give me a sense, first of all, of how long, oil prices have to stay elevated for it to have an impact on how, I guess, CapEx for a lot of chief executives, but also prices and margins.
Yeah, well, I think there's obviously two things here. There's how much oil prices go up and for how long they go up. So our assessment is that given the changes we've seen so far, in aggregate globally, the effects on inflation are relatively modest, something like 0.2 on inflation globally, a little bit more in some other places, and very modest global impact on growth, around 0.1, a bit more than that, 0.2 in Europe. But if we start to get them going to $100 or more, and they're prolonged, then you start to get into global inflation going up maybe 0.7 and a contraction in global growth by about 0.4. And any combination there between. So clearly this is an anxiety not only about how long the conflict goes on, but what kind of effect it's going to have on the mix between growth and inflation. And we should also say that there's another channel, the whole sentiment channel. Financial conditions have been tightening globally about 0.3 since this conflict started. And that's another route to which it can affect confidence and equity valuations, at least in the nearer term.
I mean, we're talking about the closure of the Strait of Hormuz. I mean, it's not closed, but actually there's no traffic almost at the moment. It's almost ground to a halt. Does that impact, I mean, does that play on inflation expectations or on shipping costs more directly?
Well, both of those, I think. Again, the issue really is 20% of world supplies are going through that channel. It's obviously very, very significant. But there's a lot of uncertainty about how long that disruption will go on for. And that knocks on through to higher shipping costs, of course, and the routes that need to be diverted in order to get goods and services around the world. And that can take longer to do as well.
And I guess there's still the uncertainty of trade and tariffs, because we don't know if, some of the tariffs that were paid, you can claim it back, whether now there's 15%. I imagine chief executives are also distracted with what's going on geopolitically to really look into that as much as maybe they should.
I think that's all right. And the last thing that investors like to see is uncertainty. And this is coming on top of a period where you've seen very, very strong rises in risk assets. So the valuation is part of that equation. But I do think it's important to also say, and we've written a note this week about correction risks, we do see further downside, but I don't think this is likely to morph into something more prolonged or deep or a bear market. And I think partly that is because the underlying growth cycle is pretty robust globally. You've got a lot of policy support coming through. Secondly, earnings, actually, at least up until this point, have been quite strong. And rather unusually, actually, earnings revisions globally so far this year have been going up. That's typically not the case. But thirdly, and very importantly, I think private sector balance sheets around the world are healthy. Households, corporates in aggregate, and banks, of course. And that, I think, again, softens some of the worst second-round effects that a shock like this might generate.
And again, you touched on private credit and the fact that you don't think there's anything systemic, right? If there was I don't know whether a correction or just basically a wipeout of certain parts, what's the read across to equities?
I think that there are risks in the private credit market. Of course, it's not as regulated, and in the US in particular, there's a lot of private credit that's been extended to software companies, which have derated a lot. And so, again, I think you can get a correction there, as with the equity market. Not systemic, I think, because you don't have the same leverage in the system that you have when credit is extended through the banking system, which obviously happened significantly in the period before the financial crisis, for example. But in an environment where people and investors are jittery and concerned, narratives and any potential risk to their current positions, I think, just get exaggerated in price moves.
Peter, overall, what's your take on AI? So I read almost every note that's on AI because I'm trying to get smart and understand. And of course, it's just very difficult because you go from how much disruption, it could be 200,000 jobs to 50 million. So it's difficult on how do you see it? There's so many angles to AI and how quickly this is interpreted and changes our economies.
Yeah, well, I think there are two parts to this. One of them is the impact on the economy and on the labour market, but very importantly also on productivity, because we and my economist colleagues are quite optimistic about the ability for these models and technologies to generate a relatively rapid ramp-up in productivity over the next decade. And of course, in time, we also believe that new products and services and jobs will come along. We do see some disruption to the labour market, but I think what we're also seeing from a market perspective is investors going through waves of reinterpretation about what the impacts of this could be. So we saw, of course, fantastic performance, and we should say the fundamentals remain extraordinarily strong for the hyperscalers. But of course, this scale of the increase in capex has been so intense that investors are beginning to worry about the potential returns that those can generate, at least for all of them together. Secondly, and understandably, investors have become very heightened to the potential risks of disruption within the technology space. Software has been the most obvious casualty of that repricing of longer-term growth confidence. And we're seeing waves of that going through the market, which I think in some sense is quite healthy. But I think the third thing that we should emphasize is that this ramping up of capex is re-engaging the growth prospects of the technology sector with the physical world. For the first time really since the rollout of the internet. So we're seeing within markets a broadening out of returns and the value that investors are prepared to attribute, on the one hand, to things like software and technology, but on the other hand, to physical infrastructure that's helping to roll out more data centers, but also energy supplies, at the same time that governments around the world are raising spending on defense. And that's all physical, and that is helping to broaden markets.
So net benefit.
Well, certainly a change in the leadership drivers, but within the context, I think, of really still quite a healthy economic cycle underlying what's happening at the moment.
Peter, thank you so much, as always, for joining us. Peter Oppenheimer, their Chief Global Equity Strategist at Goldman Sachs. Now, coming up, Donald Trump fires Kristi Noem after a controversial tenure in charge of U.S. Homeland Security. So we'll have that story next. And, of course, we'll also go back to what's happening in the Middle East. Qatar warning that the war will force the Gulf to stop energy exports within weeks. So this is a huge development. It's a new Bloomberg story, so we'll have plenty more on that shortly. This is Bloomberg.
Have you ever thought about, or would you make a movie for a streaming service? Would you make a Netflix movie?
Man, that's a great question.
I mean, I'm waiting for one where I ask and you go, that was a shitty question.
Yeah. I mean, you know, you good at your job, bro. Like, this is actually the first time anybody's ever asked me that. You know, I'm not here to say what I would and wouldn't do in the future. You know, but the theatrical experience is one that means a great deal to me. It means a great deal to us. Mm-hmm. I feel a certain responsibility. Like if Fruitville had happened a calendar year later, it probably would have come out on streaming. You know, I've been fortunate enough that everything that I've written and directed has been a theatrical release. So I feel a duty to try to protect that. You know, but that's where I'm at today.
Welcome to Bloomberg This Weekend. I'm David Burr.
I'm Lisa Mateo. And I'm Christina Raffini. We're tracking breaking news today from Wall Street to Washington. Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up. Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Bringing you up-to-the-minute political news whenever and wherever it happens. I'm Tyler Kendall in Washington, and this is Bloomberg.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London, and these are your top stories. President Trump says the U.S. continues to, quote, totally demolish Iranian forces, and that he wants to replace the leadership structure in the country. Now, Tehran responds with a barrage of missiles and drones targeting countries across the Persian Gulf. Shipping in the Strait of Hormuz has reportedly ground to a near-complete halt, with no oil shipments in the past 24 hours. And President Trump fires Kristi Noem as Homeland Security Chief after months of controversy, the first cabinet member to be removed during his second term. So President Trump has removed Kristi Noem as Homeland Security Secretary. She's the first cabinet member, as we were just saying, being dumped during the second term. For more, we're joined by Laura Davison, Bloomberg's Washington Deputy Bureau Chief. Laura, thank you for joining us. So why did President Trump sack Noem?
Well, as you noted, Noam has had a really controversial tenure, including most recently with the killing of 2 Americans in Minnesota during a federal agent crackdown, immigration crackdown in the city. She's also a federal official, said that the best kept secret in Washington was the affair that she was having with her chief of staff. However, neither of those things ended up being the root cause. It was an ad campaign featuring herself that cost nearly $250 million. She was testifying on Capitol Hill in recent days about this, and she said that President Trump personally approved the budget for this. He was not happy about that, including a senator saying that he heard this and as she was testifying this, realized that she was going to be dead as fried chicken with regards to this, and just really within a couple hours, a couple days, she was out of a job.
So who's going to replace her as Homeland Security Chief?
Yeah, so there's a senator from Oklahoma, Mark Wayne Mullen is his name. He's a relatively young guy, only been in the Senate a couple years, who will be taking over for her at the Department of Homeland Security. That means it will open up a Senate seat. But this guy has an interesting background when it comes to immigration. He is very much a hardliner. He's a staunch Trump ally, and particularly when it comes to issues like birthright citizenship, he's taken a very staunch position. He said that babies who are born to illegal immigrants, but in the U.S., which means, per the Constitution, that they are U.S. citizens, that they should also be kicked out of the country along with their parents. So at least the policy that we saw from Noam when it comes to Homeland Security, we can expect to see that. We may see a little bit different management. There was a lot of concern among Republicans that, Noam had things had gotten under control under her tenure, but broadly, the policy will continue.
Laura, thanks so much. Laura Davison there, Bloomberg's Washington Deputy Bureau Chief. Now, marine traffic in the Strait of Hormuz has ground to a near complete halt with no oil shipments passing through in the last 24 hours. More and more shipping companies are avoiding the Gulf region altogether. We're now joined by Albert Nightingale, Bloomberg's Europe Oil Markets Editor, and Brendan Murray, who leads our global trade coverage. So thank you both for joining us. Al, let's start with you. How could this oil trade disruption actually affect some of the buyers and sellers in Asia and Europe?
Well, it's already affecting the buyers in Asia in a very clear way. They're hugely reliant on the Persian Gulf as a source of crude oil for their refineries, and we're seeing signs of cutbacks across Asia. In the Middle East itself, refineries are already cutting back quite sharply. So we're losing supply, and the prices of some of the fuels like diesel and jet fuel are soaring. It's a huge problem that is kind of moving into the retail sphere as we speak.
Oil isn't the only thing, Brendan, that's transiting through there. If you look at, I think, 20% of global trade, so what does it mean for other shipping containers?
Yeah, there are two main ones, container shipping and air cargo. And at the moment, container shipping is also at a virtual standstill. There are about 100 container vessels in the Persian Gulf just unable to move and unable to either discharge their cargo or pick up cargo and move on. The port of Jebel Ali, operated by DP World, is the biggest port outside of Asia. It's a transshipment hub, so goods come in from Asia, and they come off. They sit on the dock, and then they go on another ship to Europe or to the U.S. And the port is operational, but there's not a whole lot of cargo moving in and out of it. The air cargo side of things is also at a virtual standstill. The big carriers, Qatar Airways, Emirates, Etihad, they're all more or less completely grounded, operating some limited flights. So that's disrupting and really halting a lot of the goods that flow through there. Big companies have their supply chains connected through there, so we could see the ripple effects in Europe and the U.S. as well.
So I know we've talked about this, before. It depends on how long it's. I mean, if not closed, certainly how long traffic doesn't pass through. What do we know about some of the oil containing ships or the producers? Do they go round and kind of go through, South Africa, or do they ship it in other means?
I mean, if the Strait of Hormuz is closed, you lose a fifth of the supply of oil. That is just kind of cannot be rerouted. You can get some across Saudi Arabia, and we're seeing that. Some going to the port of Yanbu for export instead. So that's helping a little bit. But fundamentally, there is a vast loss of supply. And if this continues, eventually all of the tankers that are in the region are going to fill up.
Yeah.
And then they have to fill up their domestic storage, and then that starts to run out of space, and you can't keep producing. We've already seen that in Iraq.
I mean, just to be very clear, is it that insurance is so high and that the dangers are so high that you say, why would I put my tanker with my staff in that strait? Or is it that it's actually closed?
So, as you may remember, the Trump administration were talking earlier this week about having an insurance and convoy plan. From the owners that we've spoken to, the concern is not about insurance. The concern is about the safety of the ships. Right. And even if you have a convoy, it doesn't necessarily solve everything. Would you want to go through even in a convoy in this environment? I think a lot of owners are saying, I'm not so sure.
Yeah, absolutely. I went actually fishing, which was also not a good idea 6 months ago in that strait. Air shipping, is that even a possibility? I mean, it's considered for some things, but you can't airship a lot of this heavy stuff.
Yeah, exactly. And it's very expensive compared to ocean shipping, and the cost of air freight is already going up. We've seen increases from Asia to the Middle East, and then from the Middle East to Europe, already going up in the neighborhood of 10 to 20%. And it's only going to go higher the longer the airspace is closed in the region. And so a lot of goods can be moved from air to ocean, but there's no ocean freight moving either. So there's a bottleneck that's forming. It's mostly contained in the region right now, but we're already seeing the carriers, the ocean carriers and the air carriers, trying to figure out where this cargo that can't go through this main transshipment hub, where it's going to go now, and it has to go to ports in South Asia, ports in Europe, and those ports don't have the capacity to handle any extra cargo at the moment either. So we've got the makings of another supply chain crisis if this drags on for weeks and weeks.
Brenda, I mean, for me, that's very, it's another supply chain crisis. I mean, this is like shock after shock after shock for a lot of these trade and shipping and vessels. Does it mean they're more agile, or is it just difficult because this is like the 10th shock in 2 years?
Yeah, exactly. It's like a port shutdown during the COVID pandemic. It was, but you knew it was temporary, and supply chains were flexible enough to recover. So this is open-ended. We don't know how long this war is going to last, and so if you're a logistics manager, or you're a company trying to figure out that you need to make sure that you get your parts for the cars that you're making or the machines that you're making. There's just so much uncertainty right now. The bottom line is, as Al said, it's going to mean higher costs, and those are just going to filter through eventually down to consumers if we see this a much longer protracted situation.
Thank you both for joining us. A terrific panel to try and understand what the way forward could be. Alaric Nightingale, Bloomberg lead Europe oil reporter, and Brendan Murray, who leads our global trade coverage. Coming up, Philip Sal, the Atos chief executive, on the company's full-year earnings and what's planned in 2026. That's next. This is Bloomberg.
Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, only on Bloomberg.
What is going to be the consequence for U.S. markets?
We are seeing modest gains across European equity markets.
Take a look at how we're faring when it comes to Asian markets.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
The conversations that matter, the insights you need. This is the Paul Sanam Francine Lacqua here in London. Now, our next guest has recently returned from a trip to the U.S. as part of her ongoing work advocating for the City of London as a global financial hub. Well, we're now joined by Susan Langley, Lady Mayor of the City of London. So, Lady Mayor, thank you so much for joining us. I mean, there's all this history and, of course, everything that we've seen in the City of London over the last hundreds of years. What's been the most remarkable thing in the last 2 to 3 weeks? There's a lot of trade. Now we're talking a lot about what's happening in the Middle East. Do you see that from the position you sit in about even people in the City of London being anxious?
I don't see the people in City of London actually being anxious, but you do see the insurance industry coming to the fore. I mean, we're still number one in terms of the global hub for insurance, specialist insurance. Lloyd's of London, really innovative. And this is where Lloyd's comes into its own. I mean, catastrophe, terrible things happening, but for global trade, it's really important that shipping continues. And I'm really pleased to say that Lloyd's is right in there and is continuing to insure, because that's what we do in the City of London.
Yeah, it's just very difficult. We're hearing, some of the insurance premiums going up to $1,500 if you have tankers going through the Strait of Hormuz. I mean, again, what does it mean for the City of London? I'm sure they're very busy insurance traders right now trying to figure out what happens next.
Yeah, I mean, think in terms of risk, it's such a fluid situation. And I think the thing that's happening at the moment is not necessarily the insurance, it's safety of the crews. And that's why we're seeing many of the ships actually not moving through. But I think on a day-to-day basis, I mean, business continues. Business to business always continues. The great thing about London is our stability, financial strength. We're not going anywhere. We just continue to perform.
I mean, does all of this instability across the world change the strengths of London? I don't know whether it's a moment to lean in on some things that could actually put the City of London more in the spotlight.
I think you're absolutely right. And when I travel, one of the key words that I use now is actually stability. You know, we have the ecosystem, we have the talent, we have the infrastructure, but based on our history, London is a stable environment, always has been, always will be. One of the things I heard in the US is people are actually far more positive about the City of London, the UK, overseas than we actually are here. But it's just a brilliant centre, and I think that stability, our dependability, the rule of law is really important right now.
I mean, do they ask about crime rates in London? I don't know whether there has been a campaign to portray London as extremely dangerous that you see as misinformation or just misinformed or misinformed.
Yeah, no, you're absolutely right. It's one of the things I heard in my first week, and I was actually quite unsettled by it. Yeah. And I've heard it 2 or 3 times, both here in the UK and overseas. There is an active disinformation campaign portraying London as this crime-ridden city. You step outside of your office and you're bowled over by a tsunami of crime, and that's absolutely not true. So there is an active campaign out there that we do need to counter. I was thinking the word disinformation, though, almost gives it kudos. I mean, it's lies, okay? There is...
I was going to say, is it malicious?
I think it is malicious in some cases. It's difficult to know where it's coming from, but it's the fake TikTok videos, you know, that are very clearly AI generated. But when I hear people in the US actually say, I'm going to come to London, I'm not going to wear my jewellery, we know it's something we've got to counter. You've got to counter it, but also people have to take responsibility for where they get their news. Do they get their news from you, or do they get it from TikTok?
Well, that's always a good idea to get your news from Bloomberg. Lady Mayor, talk to me a little bit about what the City of London needs. I don't know whether it's a big IPO or just a big win that they can show the world that they mean business, because there is a lot of negative headlines, not on misinformation, but just the fact that it's becoming a less attractive place to list.
I don't think that's true. I think what London needs to do is talk about its strengths, okay? So being British, we're really, really good at saying what we're not good at, but we're very, very bad at saying what we are good at. So we shouldn't sugarcoat anything. But if you look at our strengths, I mean, business confidence in business is actually really positive, but we don't shout about it, which is why one of the things I want to do is a bit of a kind of a Team UK approach and try and get businesses and associations and government to talk about our strengths, because it is really not a as negative as it's portrayed, but that's our responsibility to tell people that's the case.
But do you, I mean, does the City of London need a stronger government? Because there are a lot of question marks about the future of the Prime Minister, which again, when I travel, I get asked quite a lot about.
I think what we need to do, when you look at the economy, to me, there's three legs in the stool. So you talk about the costs, which we can't do much about. We talk about the tax, which we can't do much about. So the third leg is actually, how do you make business as simple as possible to transact? How are we the simplest place in the world to do business, which means simplifying regulation, making it really easy to list and really fast to get licensed. That's the leg we need to talk about.
Lady Mayor, I mean, the UK pension industry is going through a massive transformation, and there's also more U.S. private equity getting into the insurance market here. And so there's a worry that actually, some of the pension schemes will now be buying U.S. private equity instead of UK gilts. I don't know if it's something that you're having discussions about, or, there was such a big push to make sure that the pensions in the UK also invested in UK stocks.
Yes, and there's an awful lot of work going on in that space. We have something called Sterling 20, which is the 20 large asset management and pension funds looking at the infrastructure projects. So there's active work underway on that, and I do know that the pension funds are looking at how they do invest, so completely focused on that.
And you think they will do it? Does it mean more risk? But then if you look at private credit in the US at the moment, it's even more riskier than anything we could buy in the UK potentially.
I honestly don't think it means more risk. I just think it's a trend that's happened over the past few years. It's something that's happened, and the focus now has to be on how we get it into the UK. And I do know the government and the business and the city are fully focused on it.
I know when you go and meet heads of businesses, heads of trading floors, of financial services, what do they ask you?
They actually ask us why we're so hard on ourselves, actually. It comes back to that thing. If you're talking about overseas, it comes back to the thing about why are the British so down on the British economy when we actually think it's great. People want to invest in London, they want to trade with London, they want to live in London. I think within the UK, once again, I come back to they're actually really positive. I think what you have to do is we have to be clear that how we match investment with opportunity. And I think some of the opportunities to invest in UK businesses are not as clear as they should be.
Is the City of London engaging much more with reform? We're a long way off, actually, the elections, but actually they're doing very well in the polls.
Yeah, I mean, I can't talk for what businesses and the associations to do because my role for the year is purely apolitical, so I stay out of that area.
Yeah, which is always actually a good idea. When you look at the priorities, so you've been in this job for
almost
6 months.
Yeah,
5 months.
Almost halfway through.
And then it's a 12-month role. What will you focus the next months on?
It's more of the same. So one, it's making sure we're positive about the UK and we're actually talking London up and selling its strengths, not being negative. But it's also matching investment with opportunity, and that's financial investment, and also it's human capital, doing something around talent. You know that I'm an East Ender, so I really care about opportunity and how we get people into the city.
I know there's been a lot of connections with financial hubs in the Middle East. They must be going through an extremely difficult time at the moment. Are you planning any travels or any conversations with them?
Yeah, I did have a trip to the Gulf booked. It may or may not be postponed, but I absolutely hope that I can get there over the next 6 months because, as you say, we've got huge ties. It's a growing market and there's great opportunities for partnership with the City of London in the UK.
Susan Langley, thank you so much for joining us today. That was, of course, the Lady Mayor of the City of London. Now, the French IT company Atos has reported full-year revenue just below analyst expectations and says it sees 2026 operating margin of about 7%. Well, joining us now is Philippe Salle, Atos Chief Executive and Chairman. Mr. Salle, thank you for joining us. First of all, give us an indication of the year ahead. Again, I don't know whether you worry about price increases, about shipments, about everything that's concerning software, but what's your biggest risk right now?
No, we don't see that much, risk. The only, risk that could happen is that, of course, if the war in Iran is too long, it could have an impact on the economy and then, of course, on the impact on the, IT budget coming forward. For the moment, we don't see any impact at the moment, so we will see probably in the coming weeks.
I mean, you've done a huge deal, of course, with creditors to slash your debt last year. Where are you now in this turnaround plan?
So, in fact, yes, we do a big movement, I would say, in December 24 with a new debt and with a swap from debt to equity. We launched a Genesis plan in the course of 25, which is a transformation plan. And in this plan, there was a lot of different aspects. We repositioned the branding, we put a new place, a new organization, new talent. And of course, the transformation plan that we call Genesis was launched in the beginning of 25. We are almost 90% complete in terms of savings for Genesis. We will finish the plan in the course of 26. And I would say 25 was the year of the reset, putting a lot of things in place, and 26 is the year of the rebound. We are quite confident now that we're going to sign more contracts in the course of 26.
I mean, when do you expect to touch a low point in revenue? And actually, in terms of layoff, for example, have you done with the layoffs and the disposals?
Yes, in fact, for the layoff, most of it has been done in the course of 25. There are probably 1,000 to 2,000 more we're going to execute in the course of H1. And in terms of perimeter, the perimeter as it is right now in the, I would say, beginning of 26 is the perimeter that will continue going forward.
Many consultancy peers have suffered on the market because of this huge sell-off, because AI will disrupt them. Is some of this justified?
No, I think it was a fear in the market. And you know, the market sometimes is too optimistic or too pessimistic. I think we are too pessimistic. In AI, there is an impact for service company like Atos, but we definitely think that the position we have in the defense and what we talk about critical mission systems makes Atos quite relevant for the future. And we think that AI is quite a positive for us going forward.
Are you back winning contracts? And if yes, what kind of contracts?
Yeah, so in fact, with Atos, we have 6 different business lines. There are 3 of them that we are pushing, let's say, more than the rest. Agentic AI is one, cyber security and sovereign. Sovereignty, in fact, it's true for the different let's say, geographies in the world. It's true also in the US, it's true in Canada, it's true in Europe, in Middle East, in Asia. So that's the 3 where we're going to push quite harder, in fact, in the course of 26. And AI, in fact, will be embedded in these offers with agentic for sure, with cyber and with sovereignty. We definitely think that we will mix our operations with staffing and agents in going forward.
I mean, are a lot of these contracts actually related to AI? How do you expect it to change your business and how customers use you?
Yeah, in fact, for us, the impact will be twofold. There is one impact on agents. As I say, agentic, it's a big topic coming. We're going to put agents in the different delivery of our business, and we will put in place agents for customers also. In their process, and I would say probably back office is the one that will be probably more touched in the future. That's the first impact. The second impact is on applications, the coding. In fact, with agents, the coding is much more simplified than it was in the past. We estimate that, in fact, with coding and testing, most of it could be automatized, which means that, in fact, we can deliver projects faster and cheaper. So we don't expect, in fact, the IT budget to move that much in the course of 26, but with the same amount we're going to have, we're going to deliver more to the customers.
Monsieur Sall, do you think you'll have to renegotiate Atos's debt?
No, I think the debt we have, in fact, it's the timing is end of 29, end of 2030, and end of 2032. So there is no rush for us, I would say, to do that. The first tranche, what we call the 1L, due to end of 29, is quite expensive because it's around 13%. So that's why we say to the market that if we can, in the course of 26, we will try to refinance this first tranche just to lower, of course, the interest on this part of the debt.
All right, thank you so much for joining us, Mr. Philippe Sall, the Chief Executive and Chairman of Atos. Now let's also go back to the markets because there is, of course, quite a lot going on after the week that we've had. If we look at Bond and stock markets, look, it does seem that we have a bit of a risk-off shift. European bonds and stock markets are still telling us very different stories today. Now, this rapid repricing of central bank outlooks in the light of higher energy prices seems to be causing some of the big moves in bonds, with, for example, the UK two-year yield up another 10 basis points, Euro region yields also pushing higher. But if you look at stocks, they've just been much more sanguine, right? The stocks 600 only off by about 0.2%. S&P futures, you can see 0.4%. So it feels maybe like there's a little bit of a mismatch. It could spell, I guess, more trouble for stocks if equity traders start to align with their fixed income counterparts in general. I would suggest this is not only a European story, but also a U.S. story. And then we had, of course, the Qatar energy minister also warning of lengthy energy outages. Coming up, Bloomberg's Michael McKee will be sitting down with the Fed's Austin Goolsbee for an exclusive interview. That's at 2:30 p.m. London time today, and then at 8 p.m. London time. Mike will also be speaking with the Cleveland Fed president, Beth Hammack. So stay with Bloomberg for that. Up next, Bloomberg Brief, and this is Bloomberg.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question. Good question. Great question.
I so appreciate that question.
You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
Tariffs, I think, are probably the first time in my career I've had to deal with like a fundamental change in government policy in terms of how we think about how markets work.
The challenge, especially within my supply chain, is now how do you have enough productivity initiatives to offset the increased cost of all the product?
Can you just move your supply chain out of China and into the U.S. or out of Mexico and up to Canada? Is it that easy?
It's not that easy, but we do have flexibility. And we had been, prior to tariffs, prior to any of this, we had been on a journey to diversify our footprint out of China. So probably 2-ish years ago, roughly 65% of our toy and game volume was coming from China. Today, as we entered into 2025, that was around 50%. All we've done is really accelerate the path to get down to roughly, call it 30% by the time we enter into 2027. For us, I mean, if tariffs stay, if tariffs go, it's never good to have so much of your manufacturing base centered on one geography. We think the diversification is good, but it does take a bit of time to get vendors and suppliers up to speed. Quality is a big deal, especially when you're dealing with toys and kids. It's not an instantaneous thing, but it's not also a 5-year, have to build a new plant from scratch.
Know how the market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romaine Bostic, and this is The Close.
Live every weekday.
Only on Bloomberg. Context changes everything.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
In New York City, 10 a.m. in London. Good morning. I'm Vonnie Quinn with your Bloomberg Brief. Let's get you set up for the day. The war rages on. Iran unleashes a salvo of missiles and drones across the Persian Gulf while Israel resumes strikes. Oil marching higher. Crude on track for its biggest weekly surge since 2022 as the White House lays all options on the table to tame prices. And it is Jobs Day, with investors gauging whether the labor market will add to inflation concerns as gasoline prices hit their highest in 18 months. The 8th day of the war then, and let's look at these markets, particularly oil markets. We are looking at New York crude now that is almost at $85 a barrel, and you know it. That means that Brent crude is higher again, up past $87 a barrel. So taking out those levels that we were watching closely all week and then some. This probably means that futures are lower. The dollar index as well has reversed and it is now gaining on the session. It had given up some of those gains that we saw during the week earlier on in the session. But look at that 10-year yield. We are close to 417 now. Are we talking about nearly a 30 basis point move just this week? It is firmly risk off once again today. If anything, jitters right back on. And then in terms of the VIX index, look, we're closing in once again on 25. Gold is off its highs of the morning, but it's still higher by about 0.1%. And as I said, those futures are lower. Let's get to some individual movers now with Abir Abu Omar. Abir.
Good morning, Vonnie. I've got mixed themes for you this morning, starting with Marvel, advancing quite nicely in the pre-trade session this morning, 12% upward, as you see here. And that is on the back of the story that we've seen reverberate across the S&P this year, and that is strong demand for data centers. So what Marvel has said is that demand for its data centers had exceeded their expectation. First quarter revenue is also expected to come over analyst estimates. So this is a really good story for this semiconductor producer based in Santa Clara. But moving on, if we flip the board, we turn to another industry, and that is clothing. Gap is not doing as well this morning. It is retreating about 7% in the pre-trade this morning, and that is on the back of some disappointing results. Old Navy, that is the biggest brand in Gap, had missed some estimates. And this is perhaps also a story about some of those tariff shocks that we've seen. Some of the supply shocks that are happening right now across the Middle East may also have an impact going forward on that stock. And then finally, we move on to pharma, flipping the board to Zealand, that is already trading in Denmark this morning, and that is 31% down this morning in the intraday trade, Vonnie, and that is on the back of this weight loss drug with Roche that had disappointed Wall Street estimates. So it had caused weight loss of just above 10% in 42 weeks, coming shorter than Eli Lilly and Novo Nordisk. Those are rivals of Zealand and Roche. But Vonnie, back to you.
Abir, thank you so much. Abir Abu Omar will be back with us later in the hour. Also coming up this hour, we'll count you down to the payrolls report with Citi's Veronica Clark. But first, day 7 for the Iran war with more than 1,300 people dead and no end in sight.
Their Navy is gone. 24 ships in 3 days. That's a lot of ships. Their anti-aircraft weapons are gone. So they have no air force. They have no air defense. All of their airplanes are gone. Their communications are gone. Missiles are gone. Launches are gone. About 60% and 64% respectively.
Our soldiers are prepared for any scenario. When I said that we are waiting for them, it didn't mean that we are waiting for continuation of the war. No, but we have prepared ourselves to confront with any scenario, with any eventuality, any possibility, and we know that we can handle that.
All right, let's get to our team coverage now with Jumana Bersachi in Dubai, Brendan Murray, who covers trade, and Bloomberg's EMEA News Director, Will Kennedy. Jumana, just bring us up to speed as we enter the U.S. morning. What's been happening in the last few hours?
Yep, day 7 of the Iran war, and things are not letting up. We actually heard from the Defense Secretary yesterday, Pete Hegseth, and he said that the firepower over Iran is about to surge dramatically. We also just heard President Trump there talking about some of the operational successes that they've had so far. His words saying that they've managed to neutralize about 60% of Iran's missile launchers and air defense system. He also said earlier this week that the U.S. now have complete control over the skies, and what we're hearing overnight is reports of several explosions throughout the capital and around other parts of Iran as well. Central Command saying that they've hit over 200 targets in the last 72 hours. And the other front that has also opened up is in Lebanon too. The IDF warning citizens of the south and in southern parts of Beirut to evacuate, and over 24 strikes have taken place over southern Beirut over the course of the evening as well, and that is in retaliation for rockets that Hezbollah fired into northern Israel earlier on in the week. Now, Iran remained defiant. They have still not formally announced who the successor is going to be to the supreme leader. President Trump saying in an NBC interview that he would like to see a complete overhaul of the leadership structure. And yet, Iran continues to retaliate, mostly against Gulf states. It was a quiet night over in Israel. Just in the last few minutes, it seems a barrage of missiles have once again been directed towards Israel. But again, this part of the world, the UAE, Qatar, Saudi Arabia, Kuwait, continue to intercept many of the incoming drones that had been coming through. Yesterday, once again, energy infrastructure hit. The Bahrain refinery was one of the targets. The drone there intercepted, causing limited damage. But I think all of this to say that as we are entering into day 7 of this war, there are no signs of things letting up on either side.
Well, let me come to you, Will Kennedy, because the Trump administration, Trump himself, put options on the table to try to bring down oil prices. But since then, the Treasury is now ruling out trading in oil futures, the effects of which were moot at best anyway, right? And it says it's also hesitant to tap the Strategic Petroleum Reserve. So what does that leave for the administration?
Well, it has done one significant thing in the last 24 hours, which is to provide a waiver that allows Indian oil refiners to buy Russian crude and without being sanctioned. And there was a lot of Russian crude loaded onto tankers looking for somewhere to go, and the Indians are now going to be able to buy that, put it in their refineries and replace oil that they would have got from the Persian Gulf region. So that is one sort of safety valve that they can use to take a bit of pressure out of the market. The SPR will remain on the table. The IEA, the International Energy Watchdog, which can coordinate a global release among its members of stockpiles, that's another possibility. But as the war keeps going on, the pressure inside the energy system is building, and we've seen prices continue to rise today. Gasoline prices in the US are now as high as they've been since Trump took office. That will start to become uncomfortable for him. And the Financial Times this morning published a very interesting interview with a Qatari energy minister in which he said that there are real dangers of prolonged energy shortages globally. And if this continues, oil could go as high as $150 a barrel. So the risks are building and will continue to build as long as the Strait of Hormuz remains all but closed to shipping.
He actually said that even if the war ended immediately, it would take Qatar weeks to months to return to a normal cycle of deliveries, which is pretty terrifying. Brendan Murray, let me come to you on the India deal, because this takes some Russian barrels, I guess, off the market, or at least off the dark market. Or how does this actually change the calculus for other countries?
Yeah, like Will said, this is it's sort of a relief valve for the oil market. It's also interesting because it plays into the U.S.-India trade dynamic. They're trying to negotiate a trade deal. The President Trump had put pressure on the Indians with this extra tariff because of their Russian oil purchases. So it kind of clouds the outlook for that particular trade deal, which both sides had wanted to finish over the next several weeks. So it's definitely something that complicates the Trump administration's overall strategy with one of the biggest economies that it's trying to sync up with to diversify away from China.
It complicates the relationships between the countries too, right? I mean, on the one hand, you have Russian barrels going to India. Modi was just back from Israel when they started striking. And Modi seems to be a little bit under pressure now to come up with some kind of response, or to take sides, if you like, in this war. Will, let me ask you, I mean, does that change any calculus at all?
The international picture is just so complicated right now, and all of the things you say are parts of it. The other part here is that the move on Russian oil into India is a big win for Vladimir Putin. Putin had been under a lot of pressure. Oil prices were quite low. It was very hard for Russia to place its barrels. Russian oil was trading at a big discount to international benchmarks. All of a sudden, he can sell oil to India. Oil prices are rising again. It will be a huge relief in Moscow to their economic problems, to their budget pressures. And again, what's happening will not be of any comfort to Volodymyr Zelensky, who is seeing all the attention placed elsewhere and is seeing this economic boon to Russia.
And those peace negotiations just had to get postponed indefinitely, right? All right, our thanks to our panelists. Thank you to Will Kennedy just then, Brendan Murray, our trade czar, and Jumana Bersetchi in Dubai. Jumana spoke with Amos Hochstein, former White House top advisor in the Biden administration, earlier on the energy crisis. Let's have a listen.
People in the market think that this is like the 12-day war. This is like Venezuela. It'll be over soon. or we can do some cosmetic changes like this waiver. But when you take out so much oil, such a massive volume of oil and natural gas and refined products and fertilizer off the market for such a lengthy period of time, if it keeps going for a few days, it's not about whether you can buy some Russian barrels off of ships, but rather, will there be shut-in of production in Saudi Arabia, in Kuwait, in Qatar, in UAE? And once you shut that in, it's very much harder to bring that back on than it is to shut it. And so I think if we go into this weekend with these prices, but on Sunday night when oil prices start trading again, if the straits are still closed, I think the spike will be much more significant.
So let me ask you this. If you do think the price is going to be a lot more significant, how influential is the price of oil going to be in determining the duration of this war?
Yeah, I think that's the million-dollar question. Right now, you have two forces that are fighting this war, Israel and the United States. It's very easy to be able to figure out what the national security rationale for this war is for Israel, and it's very popular in Israel. In the United States, Americans are still confused as to why we're in this war to begin with. Is this in the interest of the United States? So when you add to that confusion, and again, this confusion is with the fact that most people believe the Iranians are an evil regime that has enormous amount of blood on their hands of civilians, including many Americans. So no sympathy for Iran here. But understand between that and understanding why we're at war, and then you add a cost of energy prices, which goes to electricity and food and gasoline and a lot of other commodities throughout the economy. I think people say, am I willing to be able to pay for this? And there's going to have to be a way for the administration. It's going to have to explain and to demonstrate that it is either very temporary or that they'll be able to mitigate the cost for the American public. That is a very difficult thing to do in these kind of circumstances.
Yeah. How do you think the U.S. administration is going to define success in this instance?
Well, I think we have two options here. One is success by saying that the regime is gone, it has collapsed, and there is a new regime in place, which is difficult to do without troops on the ground. The other is to declare victory at some point and say unilaterally, look, we defeated their navy, sank all their ships, we destroyed their air force, the leadership has been decapitated, their missiles have been mitigated and destroyed, most of their launchers and missile capacity. The nuclear has been destroyed, and we are stopping this war now, and the Iranians need to change their behavior into the future, or else we will come back. So those are the two options here. Yeah. Either you change the regime, or you leave it intact but weakened.
That was Amos Hochstein, former White House advisor in the Biden administration, speaking with Bloomberg's Jumana Bersetchi. Now to other top stories trending on the terminal this morning. Deutsche Lufthansa is considering adding flights to Asia and Africa due to growing demand for long-haul routes in the wake of the Iran war. The war has upended passenger flows that would have been served by Middle Eastern carriers. It's looking to add flights to Singapore, India, China and South Africa. Liberty Media Formula One has seen $1.9 billion wiped off its market value since the Iran war began. The new F1 season begins this weekend in Melbourne, Australia, the first of 24 races in 2026. Uncertainty surrounds 2 races next month in Bahrain and also Saudi Arabia. And Roche and Zealand Pharma shares plummeted after their experimental obesity shot failed to meet industry expectations in a study. The shot had mild side effects and resulted in 10.7% weight loss after 42 weeks of treatment. That's well short, though, of results for existing treatments from Eli Lilly and Novo Nordisk. Coming up, the U.S. considers permit requirements for AI chip sales abroad. More on that next. This is Bloomberg.
Welcome to Bloomberg This Weekend. I'm David Verrett.
I'm Lisa Mateo.
And I'm Christina Raffini. We're tracking breaking news today from Wall Street to Washington.
Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
Welcome to Bloomberg This Weekend. I'm David Verrett.
I'm Lisa Mateo.
And I'm Christina Raffini. We're tracking breaking news today from Wall Street to Washington.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine. Watch, listen, stream. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
The trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe.
Let's talk about the significant risk transfers to find space in their balance sheet.
Hedging some of that risk.
You could look at it the other way. Obviously, this stuff is risk-weighted.
I would much rather be long than be short.
We're in a kind of sweet spot.
Very, very strong alignment.
3 revolutions in one.
I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie.
This is your opening trade.
Every trading day, only on Bloomberg.
This is Bloomberg Brief. I'm Vonnie Quinn in London. Chip stocks lower in the pre-market as the U.S. proposes a rule to require licenses for AI chip exports. For more, Matt Bloxham of Bloomberg Intelligence joins us now. I thought we were through this period. I mean, wasn't this the whole, NVIDIA chip licensing agreement and so on? The U.S. is now considering it again?
Yeah, I think strategically there's some relevant context there. Clearly, the U.S. wants to be in control of global AI strategy. Obviously, we're seeing them use AI quite extensively in the current Iran conflict, and I think it just is an acknowledgement that AI technology is expanding and improving so quickly that there's a lot more at risk in terms of how this technology spreads and gets into perhaps in kind of rivals' hands that they kind of want to be in control of. And given that there's so much of the AI technology that's being driven by US companies, I can see the sense in having some clearer oversight about that, how that technology spreads around the world.
Are we really mainly talking about NVIDIA and AMD here, or what other companies would be affected?
Potentially you could see the likes of Google, because they're obviously developing their own equivalent TPU chips, which so far they've only really considered for their own use, but they are looking now to kind of sell it to others. And obviously Meta's also developing its own AI accelerators, so there could be a lot of other companies that do kind of get drawn into this, both in terms of the direct kind of AI accelerator technology, but also the components that go into that.
Moving on to the Anthropic story, now Dario Amodei is saying he has no other choice but to basically sue the government because it's taking away a $200 billion contract because they won't let the government use their material.
Exactly, and I think there's a bigger story here is that obviously Anthropic is reported to be looking to do an IPO, almost kind of vying head-to-head with OpenAI. And even though this kind of contract isn't that big for them, I think the broader stigma, if you like, of being designated as a supply chain risk would potentially have quite negative consequences for how their IPO is perceived by some investors. So I think even if getting that removed doesn't really directly impact either their financials or their ability to do kind of business with the US government, I think that broader stigma could be a bigger concern for them.
Just to clarify, that label is on until there is a court case and something gets decided potentially by a judge?
Exactly,
wow.
Yeah.
SoftBank is looking for a loan now to invest again in OpenAI. What is this about and why does Masayoshi Son need the money?
Yeah, so they're obviously doubling down on their investment in OpenAI as one of the best ways, in their view, to play the AI story. They've already kind of invested $30 billion or so into the company and looking to kind of double that investment. They need to kind of raise money to fund that. One of the options is to do it through debt. Now, they do have a bunch of other investments. For example, their big stake in Arm. They've got a big chunk of stock in T-Mobile US, which they've got a plan to kind of sell down anyway. It's about $10 billion. So think to some degree they may ultimately kind of refinance this investment through reshuffling their equity investment portfolio. But in the short term, they need the money to fund that. So yeah, up to $40 billion of debt to cover this $30 billion of investment in OpenAI.
Do we know what the return from Masayoshi Son is yet on AI? I mean, AI so far and his chip bets and AMD and so forth. And
I don't have that number off the top of my head. I mean, I think you'd probably imagine that certainly the original investment in OpenAI, that first $8 billion, which got them to about a 10 or 11% stake, it's probably been pretty good as long as like the OpenAI IPO goes ahead and they get the big valuation that people are expecting.
The big exit. All right, Matt Bloxham, thank you so much. Matt Bloxham of Bloomberg Intelligence there. Coming up, the UAE explores freezing Iranian assets. More on that and what else is making headlines in your front page news next. This is Bloomberg.
What's great about it is it's a well-developed gaming ecosystem, right? So, folks know to find games there, but it's also a highly competitive gaming ecosystem. So it's developed, this gives you both that upside and that downside. But what's exciting is that now we are moving beyond the phone to the TV. So I mentioned like one of the big gaming areas we're going after. One of the big gaming areas we're going after now is social gaming experiences that will show up on your TV. So we are now announcing, we're going to announce here actually, that we're going to have these social party games that you can play on your TV with your phone as the controller. And it's things like, recognizable games like Boggle, you got Pictionary, we've got a Lego party game. We, basically are going to unleash this with a bunch of creators, and they're going to go figure out stuff that we didn't even imagine that they can do with that interactivity.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Know how the market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romaine Bostic, and this is The Close.
Live every weekday.
Only on Bloomberg. Context changes everything.
Is Bloomberg Brief. I'm Bonnie Quinn in London. Time now for your front page news. And first up, the Wall Street Journal leading with the UAE exploring freezing Iranian assets to punish Tehran for attacks. Any crackdown on Iran's shadow financing networks in the Gulf state would strangle Tehran's access to foreign currency and global trade. The Financial Times leading with Gulf states potentially reviewing overseas investments to ease strains caused by the Iran war. A Gulf official said it could have an impact on anything from investment pledges to foreign states, companies, sports sponsorships, contracts with businesses and investors. And finally, the New York Times on the U.S. restarting diplomatic relations with Venezuela. The State Department announcing the reestablishment of diplomatic and consular relations in a statement released Thursday evening. And those are your front page stories. Coming up, we're going to be talking jobs report because that's on everyone's radar today as well. We'll push ahead to that with Veronica Clark of Citi next. This is Bloomberg.
such an incredibly exciting moment with AI. It is really the most profound technology of our lifetimes, and I think it has the potential to help us rethink literally everything. The potential for economic impact, societal benefit is honestly boundless. When we think about the economic impact for Europe in particular, it's around a 1.2 trillion euro estimate of the productivity growth that can be unlocked. This platform shift that we are living through, I think, is going to create untold amounts of value for the world, but also for the businesses and for economies, which is why I'm incredibly optimistic in this moment for Europe, but also for the whole world.
How do you think about job losses or safety for some of the AI tools?
You know, I hear the anxiety, and I understand the anxiety about jobs. I think that we are certainly going to live through a massive transition about how people learn to work alongside these tools. I mean, the reality is I do think there'll be some number of jobs that are displaced. I think it is a smaller number maybe than some anticipate. We estimate it's around 7%. And I think what's important is that we have programs that help those 7% transition into new fields of work. I think what is more likely is that most of us are going to learn to work alongside these tools. So we estimate about 2/3 of us. If you think about the tasks you do in your daily life, when you look at every industry, there are administrative tasks that are happening everywhere, and that's what AI is most helpful in improving.
The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything. Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
It's 5:30 a.m. in New York City, 10:30 a.m. in London. Good morning. I'm Bonnie Quinn with your Bloomberg Brief. Let's get you set up for the day. The war rages on. Iran unleashes a salvo of missiles and drones across the Persian Gulf, while Israel resumes strikes. Oil marching higher, crude on track for its biggest weekly surge since 2022, as the White House lays out all options on the table to tame prices. And it's jobs day, with investors gauging whether the labor market will add to inflation concerns as gasoline prices hit their highest in 18 months. So let's have a look at those markets then. WTI, look at that, up 3.5%. It's close to $84 a barrel. Brent crude is close to $87 a barrel, so it's taken out that $85 mark no problem today and is going ever higher. This after the Qatari energy minister basically gave a chilling interview with the Financial Times, saying that the war in the Middle East could literally, quote, bring down the economies of the world. He said within weeks it could drive oil to $150 a barrel. That is not having a good impact on sentiment today. Earlier, futures were higher, but they are very much turned lower now. The dollar index had also eased off, and it is higher again, as you can see. Gold higher again. The VIX trading above 24. For some stocks to watch now, let's get to Abir Abu Omar. Abir.
Good morning, Vonnie. So the S&P futures are down quite a bit, but there are some bright spots this morning, starting with Marvel. Now, this is a story that we've seen reflected in multiple earnings statements across the S&P so far this quarter, and that is demand for data centers. If you remember, NVIDIA's earnings a couple of weeks ago showed that that segment is doing quite well across NVIDIA's business. So Marvel said that data centers, demand for data centers has exceeded expectations, as well as demand for those AI chips. So the company is doing pretty well. Investors are adding 11.3% to the stock, so adding to those gains from earlier in the session this morning. We flip the board and we turn to a slightly different industry, or a very different industry. Gap, this clothing brand, is not doing as nicely this morning, retreating about 6% in the pre-trade in the U.S., Vonnie. And this is a mixture of things. This is missing estimates. Gross margins were impacted as well. And this is also a story that reflects the tariff shock by President Trump's Liberation Day back in April, possibly prone to some further weakness because of the supply shocks that we could likely see out of the Middle East going forward. And then finally, we turn to a stock that is already trading in Denmark this morning. Pharma, Zealand, not doing very well, down about 33%, and that is on the back of this weight loss drug that it has with Roche in Switzerland that has missed the estimates for Wall Street. So it has delivered a 10.7% weight loss across 42 weeks. That is much lower than rivals in Novo Nordisk and Eli Lilly. So investors are reflecting that in the stock that is retreating about 33% this morning in Europe. Vani, back to you.
Wow, a third of its value. Okay, Abir, thank you so much. That's Abir Abu Omar. A global bond rout deepening as the continued rally in oil prices stokes fear the Iran war will fuel inflation. That's, of course, as markets await the latest jobs report set for just under 3 hours' time. Joining us now is Veronica Clark, U.S. economist at Citi. So, Veronica, how much does the war muddy the waters around this jobs report, if at all?
Yeah, there's not going to be much direct impact, of course, from the market moves we've seen this week. This is February data that we're getting this morning. What it does probably mean is that markets take this number with a bit of a grain of salt, including even the inflation data that we're going to get next week for February. This is just going to maybe look a bit stale in retrospect, given what we've seen developing this week. And yeah, we'll just have to wait and see how that impacts inflation and jobs going forward.
So given that we've had, obviously, developments since this jobs data was collected, what were you anticipating when this was your sole focus?
Yeah. So this is the February read on unemployment. We're expecting to see 30,000 jobs. That's actually down a bit from where we were initially expecting to see this February number. There's actually going to be a larger than expected strike impacting this February data in the healthcare sector. That'll weigh on jobs by maybe 30,000 or so. Of course, those workers would then add to jobs once that strike ends. But adjusting for that strike effect, this is probably a pretty benign reading. We're expecting to see the unemployment rate tick a bit higher to 4.4%. That's where we were in December. This is probably nothing that's going to really shake any change for the Fed right now.
Now, if that's all we had to worry about, would the Fed be quite sanguine about where it stands and where the market stands, frankly, in terms of rate cuts this year? And I suppose the follow-on from that would be, if that's the case, then the change that we've seen in those expectations, is it about right for this war?
Yeah. I think, we already knew that the Fed was going to be on hold in the very near term. So developments this week, the move higher in oil prices, of course, doesn't really change that. I don't think that this jobs data today will change that either. They're very likely on hold at the meeting we'll have in just a couple weeks. It does mean that they have some time to wait and see how things evolve. Of course, the macro impact of higher oil prices is going to depend a lot on how high they stay and how high for how long. At this point, though, it is certainly going to be a boost to headline inflation as we get into March. Gas prices alone, that can add something like 30, 40 basis points potentially to March headline CPI. The real question, though, is what kind of pass-through are we going to get from higher energy costs into core inflation, components that the Fed would maybe care a bit more about. Usually that pass-through is relatively small, but we have already seen other goods prices, input costs going up. So yeah, they are probably going to wait and see how this shakes out for the inflation data.
Yeah, as you say, I mean, there was a time when the Fed chair was tired of telling people not to look at energy prices, right? This was back when inflation and transitory were words that we used to use frequently. But this kind of persistent increase in oil, and we're seeing it again today with Brent crude at 87 and WTI, frankly, the spread there has really narrowed, Veronica. At what point do we need to worry that this is going to really pass through to the economy? You also point out that it's not just oil. Recently, it's been steel, aluminum, copper, all sorts of inputs.
Right. Yeah, that really complicates the picture because, usually we think of the pass-through of just higher oil prices into core inflation as usually relatively limited. You see, obviously higher transportation costs and things like that, but it takes a while for that to trickle down into consumer prices. Maybe for something like airfares, you see higher airfares, jet fuel costs. But we have experienced a couple months now where there is that stickiness to core, goods inflation. We see that in the PPI data, starting with tariffs, of course, in 2025. That's, one cause of it. And if that continues, then you're maybe starting to think that maybe goods prices are stickier for even longer. I would say, though, that this is just a very different labor market than the last time we experienced a supply shock, driven goods inflation, of course, after the pandemic. And I wouldn't expect that you're seeing this filter into, too many services prices. This is just not a tight enough labor market, I think, to allow for that. But still, even stronger inflation for any reason is going to be a bit, worrisome for the Fed right now.
Veronica, what are the conversations at Citi right now surrounding what the president thinks he can do regarding oil prices? What can the president of the United States do?
Yeah, I'm not an oil expert by any means. Yeah, so I'm not super familiar with the plan to try to influence the price via futures. Of course, it is a very physical market, right? It's based on supply and demand. I think obviously, there's probably maybe limited ability, in terms of what you can do instead of actually just pulling back. But I'm not an oil expert by any means.
Yeah, I'm sure a lot of people are scratching their heads about that one. Now, are you still looking for 75 basis points as a base case for this year of decreases, or are you sort of putting that base case on hold until we see how this war progresses?
Yeah, it certainly does depend on what we see progressing over the next couple months. But yeah, for now, that is absolutely still our base case. We're expecting those cuts really more into the summer, maybe even fall, September or so. And that's just really based on the pattern that we've seen in the labor market data for the last couple years, where we always start the year pricing out expectations for Fed cuts. We've gotten some stronger data. But then by the summer, the labor market data is starting to weaken again, and we're starting to price those cuts back in. And then by the fall, we're getting those cuts delivered. I think we'll see that similar pattern this year where, in a very low hiring environment, you do tend to get much weaker data at the time of year when you're usually hiring a lot of people, and that's the spring and summer. So we are expecting to see that weakness in the labor market come up again in a couple months.
All right, Veronica Clark, always a pleasure to speak to you, Jobs Day. That is Veronica Clark of Citi. And don't miss our interview with National Economic Council Director Kevin Hassett and Chicago Fed President Austin Goolsbee. They're at 9:30 a.m. on Open Interest. Now to other top stories trending on the terminal this morning. President Trump is being sued by states over new tariffs after the Supreme Court loss. 24 states said in a lawsuit that Trump's proclamation imposing a 10% tax on imports is, quote, fatally flawed and must be overturned. The lawsuits set up a fresh legal fight over executive power that could take months to resolve. Liberty Media Formula One has seen $1.9 billion wiped off its market value since the Iran war began. The new F1 season begins this weekend in Melbourne, Australia, the first of 24 races in 2026. Uncertainty, though, of course, surrounds 2 races next month, supposed to take place in Bahrain and in Saudi Arabia. Deutsche Lufthansa is considering adding flights to Asia and Africa due to growing demand for long-haul routes in the wake of the Iran war. The war has upended passenger flows that would have been served by Middle Eastern carriers. Lufthansa looking to add flights to Singapore, India, China and South Africa. Coming up, the Trump administration considers options to tame oil prices. This is Bloomberg.
I'm David Weston. Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. We go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
We need more transparency.
Oil and gas is still important.
They said every citizen should be investing in the market.
Accelerate progress in all fields of science.
Watch Wall Street Week right here on Bloomberg. More than what you need to know, it's what you need to think about.
I'm Alex Rodriguez.
And I'm Jason Kelly.
And we're back with another season of The Deal.
With athletes and entrepreneurs who are changing the game on and off the field. Jerry Jones.
Some good-looking trophies.
1-1.
is 3 in sports, not 2. And it's because that 3 is imagination. That 3 is putting yourself in a way, having yourself hit the home run.
Erica Ayers-Badon.
I'm a high-energy board member. I'm very passionate. I have a lot of opinions.
Robin Arzone.
I want to light fires in people's lives, and that is still one of my core mandates for all of my businesses.
Justin Tuck.
I tell all of my friends that play in leagues now, make these relationships now while you're hot. Don't wait till you're your 12th year in and you're just hanging on.
Stay tuned. You won't want to miss it.
Welcome to Bloomberg This Weekend. I'm David Gura.
I'm Lisa Mateo. And I'm Christina Ruffini. We're tracking breaking news today from Wall Street to Washington.
Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
This is Bloomberg Brief. I'm Bonnie Quinn in London. The Iran war in its 7th day now as the House votes down legislation to force a halt to U.S. strikes on the Islamic Republic. That as oil prices rise, with U.S. retail gasoline prices climbing to their highest since September 2022. Joining us now is Jonathan Tamari of Bloomberg Government. Jonathan, how high will the president be okay with gasoline prices going? He did already say, look, it's temporary, so don't worry about it. But at some point, he'll have to give a better answer than that, won't he?
Absolutely. I mean, remember just a week ago or last week, he was bragging in a speech to the country about how low gas prices had fallen under his watch as a sign that he was trying to take care of the economic concerns that voters are worried about. So I don't think that answer is going to last very long for him. I think it'll last even less long for Republicans in Congress who are already worried about losing their majorities in the House and Senate. So this is going to be a major issue that brings pressure onto the administration as they carry out this war.
And I did say 2022, I meant 2024 for gasoline prices. For crude oil itself, we're looking at a longer period than that, but it is basically the highest of President Trump's tenure either time, right? First or second time. Is there anything that the president can do to actually tackle so-called high crude prices, or is it such a global market there's not much he can do?
There's not a lot that he can do directly. I mean, he's trying to take, individual actions. His administration announced that they'll allow India to import oil from Russia, which counters the pressure that they had been trying to place on Russia for a long time now. That's a small move when you talk to analysts. That's kind of a relatively minor step. But people who watch this industry say that as long as the Strait of Hormuz is effectively blocked, you're going to have a worldwide pressure on oil prices, and they're going to keep rising.
The State Department also said Thursday that the U.S. and Venezuela are resuming diplomatic ties now that Maduro is out. Does this change anything? I mean, it comes just after Doug Burgum was there, right?
Yeah, I mean, it moves in the direction that the administration had signaled for some time now, that they were going to work with the remains of the regime of Nicolas Maduro, work with Delcy Rodriguez, and that they're not going to elevate the opposition party. It had been pretty clear that that was the case, but this makes it fairly official that they are not going to elevate the opposition that most people believe won the last election in Venezuela, and they're going to be okay with the current regime. But it also illustrates a big difference between Venezuela and Iran, as we were just talking about, that in one place there was a existing infrastructure left for the president to work with, and the other there is not any longer.
Very, very different regime. Yeah, Jonathan, thank you so much. Jonathan Tamari of Bloomberg Government. So, Brent, continuing to rise, this particular move after the Financial Times reported Qatar's energy minister is warning the war with Iran will likely force Persian Gulf countries to halt energy exports. Let's get to Bloomberg's Will Kennedy now. So this chilling interview with the Financial Times coming after we heard the president was issuing a waiver so that India could buy oil. We're seeing oil dynamics change in real time, aren't we, Will?
We are, and the problem that energy traders have is that on the one hand,
the longer this crisis goes on and the longer that the Strait of Hormuz remains blocked, the reverberations through the global energy system will be more and more felt, and prices are likely to ratchet higher. But on the other hand, traders also have to be wary that this war could end at any time, in which case the straits open and a lot of the pressures come out of the market. So it's a very hard place to be as a trader. It's very hard to be on top of both of those dynamics. But what we got from the Qatari energy minister today was a really stark warning, as you say, that if this does carry on, the impacts on energy markets will not be counted in days, but perhaps in weeks and months, and that energy prices could keep going higher. That's where we are.
Well, and every next piece of infrastructure damage also, causes that deadline to shift back further and further, right? Will, these 11 million barrels that are at sea that India is now allowed to buy, I mean, when you think about the 18 million barrels that go through the Strait of Hormuz every day, it doesn't sound like that much. Does it bring some relief to India? What does it do to Russia?
It does bring some relief to India. India is very reliant on oil that comes out of the Strait of Hormuz, and so it was really feeling the pinch. It had been a big buyer last year of Russian oil. That had stopped to some extent because of sanctions from the US on Russian oil exports. Those have now been waived for a limited period of time, and so it will allow India to take in that Russian oil, and it will bring some relief, at least in the short term. For Russia, this whole crisis is a big boon. It had been really suffering from lower oil prices, especially for its own oil, which was trading at a very, very big discount because it was struggling to find buyers. Now India can become a buyer again. Prices are much higher. This will come as an enormous relief to Vladimir Putin and his budget and his war economy.
Yeah, that discount is getting shaved off, right? It could even turn into a premium in the worst of cases. Just curious about what you think the president has in his toolbox to change the price of oil.
The big thing that he has, and he hasn't done it yet, and I'm not sure it's on the cards, is the Strategic Petroleum Reserve. He can put oil from the SPR, these huge caverns that the US have, which contain many millions of barrels of oil, into the market, and that could bring down the prices. The International Energy Agency, which is a group of developed economies, they have contingency plans to release strategic reserves globally into the market. So there are these relief valves that can be pushed or opened in the coming days and weeks. But if the strait stays closed, if those flows remain constrained, they probably won't be up to the whole task.
Yeah, it's very binary, isn't it? Will, thank you so much. You wonder what level oil prices would cause any of these relief valves to be opened up. That is Bloomberg's Will Kennedy joining us there. Turning to tech, SoftBank is looking for a record loan as much as $40 billion to finance its stake in OpenAI. Matt Bloxham of Bloomberg Intelligence joins us now with more. So it's doubling down on OpenAI, it would seem. Matt, what's SoftBank seeing?
Yeah, that's right. I mean, it's an interesting play on, kind of how to make money out of the AI future. Obviously, they've been historically a big investor in OpenAI anyway, but also in the likes of NVIDIA, but they've kind of trimmed their stakes in NVIDIA historically to kind of fund this, and you're going from a $30 billion current stake to adding another $30 billion to that, really, as you said, doubling down. So, yeah, an interesting kind of focus of their investments. Yeah, I think a lot of people might think that actually owning the picks and shovels, if you like, the kind of NVIDIAs of this world might be a kind of more diverse way to play the trade. But they're clearly showing a lot of confidence in the growth runway ahead for OpenAI.
Matt, this Anthropic story, Dario Amodei now is saying that he has to take it to the courts, and the Pentagon just won't play ball. What's the best case scenario outcome for Anthropic, given that they're on a list now, and either which way, they're probably not going to get that $200 million Pentagon contract back?
Yeah, that's right. I mean, and in the grand scheme of things, $200 million of revenue against an annualized run rate of $20 billion isn't a huge amount. I think what's more at stake here, for me at least, is the potential IPO that they're thinking about, and the fact that if they've got a supply chain risk designation in its own right, that's going to be a bit of a niggle for some investors, and could potentially have contagion risk in terms of other, especially US companies, thinking about whether it's appropriate or not to kind of work with Anthropic or another AI provider. So I think it's really important for them, regardless of kind of future government contract direct opportunity to challenge this in court and get it removed so that they've got a cleaner story in the IPO.
All right, Matt, thank you so much. There's always so much to explore with Matt Bloxham of Bloomberg Intelligence. Coming up, payrolls report on deck. We'll get you all set up for your Friday trading session. This is Bloomberg.
The Middle East and Africa regions are home to some of the biggest deals and fastest growth in the world. Vibrant resources and high-yield investment opportunities abound. I'm Jumana Versace. Join me on Bloomberg Horizon's Middle East and Africa for the stories, newsmakers, and insights shaping the decisions of traders across this exciting region.
You had heightened levels of volatility.
There's still room to maneuver.
We do see opportunities.
It allows you to increase significantly your net income.
Every trading day, only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at Japan's Akasaka Palace in Tokyo, and this is Bloomberg.
Good morning. Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
Watch
Bloomberg Tech. This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television. Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, only on Bloomberg.
Bringing you up to them in the news whenever and wherever it happens. I'm Chevrian in Seoul, and this is Bloomberg.
This is Bloomberg Brief. I'm Bonnie Quinn in London. Now a look at what's ahead today. Fed Governor Chris Waller speaks exclusively to Bloomberg's Michael McKee. That interview at 7:30 a.m. Eastern. Then we have the February jobs report out at 8:30 a.m. Eastern, along with January retail sales also out at that time. They would have been potentially big market movers if it weren't for other things that were going on. Marvell extending post-earnings gains now after the chipmaker said its year-over-year revenue growth rate will accelerate each quarter to fiscal 2027. That's a lovely gain there for Marvell Technology, up more than 11%. Then we have Omada Health up almost 14%. Earnings per share and sales beat the street estimates. Gap, though, disappointed. Old Navy in particular disappointed, having been leading the growth for Gap recently. Its brand and Athleta fell short of expectations, and that had a big impact on Gap earnings. Let's take a look at the macro environment now on yet another day of war. Crude oil has resumed its gains. It was lower earlier, but a few little items, including a Qatari energy minister interview in the FT, causing this market to revive. Brent crude is actually above $87 a barrel today. Another few basis points onto that 10-year yield. We're at 416.54. If you look at futures, they're pointed lower, as you might expect. That VIX index is creeping ever higher as well after an up day yesterday. That's it for Bloomberg Brief. Surveillance is next. Do stay with us. This is Bloomberg.
don't think the court was hurt by the perception that it was a political decision?
The court's always hurt, it seems to me, if we look political. One of my concerns, my present-day concerns, is there's too much partisanship. It's true historically that most presidents have appointed justices to the Supreme Court who are members of their own party. The partisanship should not be an overriding factor. What you look at is temperament, learning, background, reputation, whether or not you have those qualities of independence and caution that make for a good judge.
Increasingly, you see dissenting opinions in the Supreme Court aren't quite as civil as maybe you might prefer. And is that of concern to you?
Yes, it's of great concern to me that our civil discourse, our civic discourse, is not civil enough. Aristotle said that a democracy depends on an open debate where you respect the dignity of those with whom you disagree. He said democracies only live if they are sustained over a period of time by a thoughtful, rational discourse, a discourse in which you respect the dignity of those with whom you disagree.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Jumana Versace in Davos, Switzerland, and this is Bloomberg.
The sentiment clearly is anxiety-ridden.
We didn't call for some of the geopolitical risks that we're seeing, but we expected it to start to increase.
There is a risk that this goes on for longer than what people are pricing in today.
The picture right now is more nuanced, and we're advocating for hedges.
When we look out over the next 4 to 6 months, we think stocks look very good.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Friday with crude at fresh highs.
My administration announced decisive action to help keep down the oil prices, including offering political risk insurance for tankers transiting into the Gulf, as you know, pretty dangerous territory. Further action to reduce pressure on oil is imminent, and the oil seems to have pretty much stabilized.
The White House weighing its options to put a lid on the price of energy as traffic through the Strait of Hormuz is grinding to a complete halt. The U.S. is granting India a temporary waiver to buy Russian crude. Oil is up 20% so far this week.
Yeah, it's the biggest weekly gain going back to 2022 at the height of Russia's invasion of Ukraine. We're looking at a situation where it doesn't seem like there is an off-ramp, number one, but number two, we're getting to a level in time where even if there is an off-ramp, the supplies are building up. Qatar talking about how potentially there could be a complete cessation of any exports of oil from the region, talking about $150 a barrel in the next few weeks unless this gets resolved.
This is getting real right now for Asian refineries, and it's getting real for the administration as well, as they compromise, arguably, some of their foreign policy objectives elsewhere. This from the Treasury Secretary. To enable crude to keep flowing into the global market, the Treasury Department is issuing a temporary 30-day waiver to allow India refiners to purchase Russian crude. That's quite a headline.
Especially given all of the sanctions and given the fact that this administration has been trying to pressure Russia to come to some sort of end with the war in Ukraine. A question about whether this prolongs that, whether that hastens the end or some sort of resolution to that. This is specified as only barrels that are on the sea right now. So this isn't necessarily things that could be shipped from Russia going forward. So there is an expiration date. Nonetheless, it shows the compromises and the difficult decisions that are having to be made at the White House.
So all conversations around this table keep going back to the same thing, the calendar. What's the duration of this operation? To try and figure that out, you've got to go through the goals. So let's go through the objectives piece by piece. Take out the missiles, take out the Navy, prevent them from getting a nuclear weapon. But what about leadership? That's where things get a little bit more confusing. Some comments from the president to Axios yesterday and to NBC. Here's the quote to NBC. We want to go in and clean out everything. We want them to have a good leader. We have some people who I think would do a good job.
Yeah, unclear exactly who those people are. We know who he doesn't think will do a good job, and that would be the son of the recent Supreme Leader Ayatollah Khomeini. There's a question here going forward about how involved the United States will be and what the U.S. will settle for, not only who is going to potentially have the clout within Iran to actually be a leader. A lot of questions, the calendar not very much on the side of either the economy or some of the policymakers.
3 minutes into the program, it's the first time we're going to mention it. It's Payrolls Friday, by the way. 2 hours and about 27 minutes away, we get a payrolls report. The estimate in our survey is 55K, and rate pricing is changing for different reasons. It's not about the payrolls report. The data's been okay. We're pricing out rate cuts because of what's happening abroad as well. And in the ECB, the pricing of that story has become very, very interesting. We're now pricing in a rate hike by the end of the year.
Yeah, which is pretty shocking considering the deflationary effect, or at least the hit to growth that could really be experienced by the region as a result of higher energy prices. Look, we've priced out one rate cut this year for the Federal Reserve, so now there's just one rate cut fully priced for this year. I was expecting that we wouldn't mention non-farm payrolls until the 8 a.m. hour, because right now it is really important in order to meet a threshold showing strength in the U.S. economy. If that comes in below, that is the red alarm, the 5-alarm fire for markets saying, hold on, this is going to get really extreme.
The jobs report at 8:30 Eastern Time. Equity futures this morning, near session lows with negative 0.4%. Coming up this hour, Stuart Kaiser of Citi as volatility grips markets. Dan Stroyven of Goldman Sachs with crude set for its biggest weekly gain in 4 years. And Claudia Saab of New Century Advisors with inflationary risk ramping up. We begin this hour with stocks little changed and crude climbing above $85 a barrel. Stuart Kaiser of Citi looking ahead to payrolls, writing the impact of a weak print will be far larger than an upside surprise given underlying market stress. Stu joins us now for more. Stu, good morning.
Good morning.
How important is the underlying market stress right now?
I mean, extremely. I think the market's obviously a little more fragile, a little more on edge, than it otherwise might have been. U.S. obviously holding out a lot better than the rest of the world. But, to Lisa's point, I think, you kind of want to get through this payroll is almost as a nothing done so we can kind of, get back to the rest of it. Our economists lowered their forecast a bit yesterday just because of the healthcare strikes. But it seems like people are expecting, payrolls in the 30 to 50K range, kind of unemployment rate 4.3 to 4.4. I think if you get kind of an inline print, the market's going to be fairly happy with that. One less thing to worry about, and we can get back to other things.
Well, let's worry about the other things. Market direction right now dictated by arguably the hardest asset class to forecast. And that asset class, the guys in it, energy forecasters right now, the energy experts, the geopolitical experts, they seem far more concerned about the moment we're in than the equity market participants that we speak to on any given day. What explains the difference?
I think a couple things there. I think one, equity markets tend to focus on the middle of the oil curve. So front month crude is up, call it 20%, 2-year crude is up 5%. And equities tend to respond more to that medium to longer term oil price. So I think that's a bit of it. Equities are also, I think, in a little bit of a once bitten, twice shy on this. When you think back to Russia, Ukraine, there was all these concerns. Oil's going to 120, oil's going to 150. It never quite got there, and then equity markets were able to kind of compartmentalize that and move on. So I think you're in a situation where the underlying fundamentals, earnings, economy, et cetera, are still pretty positive, and people want to own this equity market. They're sort of being held on the sidelines now by these incredible uncertainties that you just don't know how far they could spill out. I would say the bar for bad news is quite high right now. I mean, some of the headlines we've seen, in isolation, you would have thought would have been extremely negative for U.S. equities, and the 5-day trading range in the S&P is less than 3%. I mean, it's been pretty well contained in the U.S. Europe and EM, obviously, a different discussion.
That's the difference I wanted to explore. The comfort you might have around the U.S. story. Do you have that comfort of the international trade?
I would say definitely not right now. I mean, Korea, I think, is more of a positioning issue, but clearly Japan and Europe are trading based on the increased or the higher exposure they have to energy cost inputs and shipping, and that's kind of impacted them. Look, it helps that the U.S. is a net energy exporter as well, but it certainly seems like, and you're seeing that with ECB pricing as well, right? The market is pricing a much trickier balancing act in Europe than they are in the U.S. right now.
This is essentially turning the entire narrative of 2026, at least in January and most of February, on its head. How violent has this rotation been, given the fact that everyone was saying, go outside of the U.S.? The U.S. is going to underperform. The rest of the world is where the outperformance is going to be.
It feels a little like last year, doesn't it? Everybody was piling into the Europe, and then you got Liberation Day, and then everybody came back to the U.S., so maybe there's a little bit of a logic to this. Who knows?
Well, hold on a second. No, but just to build on that, I mean, there's a question of how much the sort of technical underpinning of short the dollar has been blown out, of sort of long EM has been blown out, how much the speculative trades have actually fully been unwound. Do you have a sense of where we are in that, or are people trying to hold on, waiting for some sort of further catalyst to fully throw in their chips?
Look, in the U.S. at least, I don't think we've seen much blowout. I mean, you've seen some modest moves under the surface, but that was kind of an ongoing theme for most of the year. It does feel like, particularly in emerging Asia, you've had people, take a lot of risk out. And Europe, I would say as well. Europe's also a little bit less liquid than the U.S., so less dollars of outflow kind of have a little bit more impact on that market. So, it's there. I mean, we are relatively early innings, I think if you're going to quote unquote fully rotate. So I think some progress has been made. I don't know, third, fourth inning, but we're definitely not eighth or ninth inning, not in 3 or 4 trading days.
It's a process, that's for sure. I reached out to Natasha Kaneva over at JP Morgan, runs the energy strategy research. Fantastic details. Take a listen to this. If Hormuz remains effectively closed, supply losses would accelerate. By day 8, we project roughly 3.3 million barrels per day of shut-ins. That rises to 3.8 by day 15 and almost 5 by day 18. That's how things start to stack up as the days go by.
Yeah, some people are talking about 3 to 4 weeks where the pain point really comes in. The fact that Qatar's energy minister is coming out and saying, actually, it'll take a week or 2 before we get to $150 a barrel, indicates that people who are in this, and maybe there's other messaging aspects to this, but that people who are in this see a very different timeline.
Stu, where on the calendar does it get real for you? As you mentioned, we're still, 2% away from all-time highs on the S&P. When does it get real?
Look, I think most equity investors, at least in the U.S., were assuming that, if you did the math, that this would last a week to 2. And if it goes beyond that, then I think you'll start to see some of these pressure points, kind of get triggered. Again, I think going in, the view was, hey, for, let's say, 7 to 10 days, this is an international issue.
Yep.
After 7 to 10 days, as you mentioned with the leadership, it becomes more of a domestic issue. And what we've seen with these is when they become a domestic issue, U.S. equity markets are more than happy to put that in a little box over there and say, as long as oil prices don't move sharply and sustainably higher, I'm willing to kind of leave that in that box over there. And I think that is still kind of the playbook. But look, I think if we're still having this conversation 7 days from now, then it's going to be a bigger issue.
It's not good that we're seeing a tightening of financial conditions in certain pockets of the market. Not an aggressive tightening of financial markets, not as far as I can see. And that raises a different question. Is there a tightening of financial conditions right now that I can't see in private markets?
There could be in private markets. I think you're seeing an effective tightening of financial conditions in volatility and risk pricing. I mean, the size of the risk premium in oil volatility in the VVIX, so the cost of VIX upside, is extremely high. So I think you have people are hedging it that way as opposed to kind of taking down their core risk. On the financial conditions side, I mean, rates are up a bit. I was quite surprised how quickly this became an inflation discussion. I mean, by Monday, we were already talking about, the inflationary impact, and it'll be going on a couple of days. So I think equity markets, frankly, equity investors I speak to were a little bit confused by that. Like, how did we get, we skipped the oil, we skipped the equity selling off, and we were already in an inflationary discussion. And frankly, the inflationary impact is months out, right? So it is quite interesting, I think, that you've seen yields move, and you've also seen the 10-year point move. You don't typically trade inflation through the 10-year part of the curve. So that the bond market seems a little bit more stressed and is treating this a little differently than we might have initially expected.
What would you have to see to get all in bullish again?
It's a great question. I'll tell you, I think to escalate significantly, you're going to need to see successful attacks probably on NATO countries, or you're going to need to see a concerted effort to go after Middle Eastern oil infrastructure. I think those are the 2 types of headlines that would get you much worse off. What gets you out of it? I think it's simply that the Strait is going to be reopened, basically, right? I mean, that's where you need to get to. I mean, we're having client calls this week with investors in the Middle East that are, interrupting calls because of alerts and are worried about how they're going to evacuate buildings, right? I mean, it's hard to manage your portfolio when that's your primary concern. So, look, I think to get out of this, it's simply just de-escalatory, talk. It could simply be, hey, we are done with the initial sort of bombing campaigns, and from now on, anything will be sort of opportunistic, right? And that would be sort of an initial hint that we're starting to de-escalate. I don't think SPR does much, frankly. I don't think that stuff really helps. I think this is a question of when do military operations look like they peaked and are starting to go the other way, so I can start to shorten the duration on this, so I don't need to worry about 2- and 5-year oil prices kind of resetting higher.
It can change quickly. It's just not changing very quickly right now. Stu, it's good to see you. As always, thank you, sir. Stuart Kaiser there of Citi. Bond yield higher for a 5th consecutive session on a 10-year maturity. Yields are up by 3 basis points, approaching 420 on a 10-year. Quick check of crude right now. WTI and Brent. topping $87 a barrel as things trade. Let's give an update on stories elsewhere this morning with your Bloomberg Brief. Yahira has more. Hey, Yahira.
Good morning, John. Iran fired a barrage of missiles and drones targeting countries across the Persian Gulf overnight, including Saudi Arabia, Kuwait, and Bahrain. Meanwhile, Israel renewed its own airstrikes, hitting Tehran and Beirut. Fears of a protracted war around the strategic Strait of Hormuz are roiling markets, with crude headed for its biggest weekly surge since 2022. Meanwhile, shipping giants are suspending container services around the Persian Gulf as the Iran war presses on. Maersk is cutting 2 of its key services that connect the Middle East to East Asia and Europe. Hapag-Lloyd also said it had suspended several services as trade flows face major disruptions. And President Donald Trump saying he needs to be personally involved in picking Iran's next leader. Trump reiterating the son of recently killed Supreme Leader Khamenei is unacceptable choice, despite him being viewed as a front runner. Trump also encouraging Iranian Kurdish forces to go on the defense offensive against the IRGC. That's your Bloomberg Brief, John.
Yahira, thank you. Thanks for the update. Up next on the program, capping the crude crisis.
My administration announced decisive action to help keep down the oil prices. Further action to reduce pressure on oil is imminent, and the oil seems to have pretty much stabilized.
Up next, Terry Haynes of Pangea Policy, live from New York City this morning. Good morning.
Going to be the consequence for U.S. markets?
We are seeing modest gains across European equity markets.
Take a look at how we're faring when it comes to Asian markets.
World's most powerful investors don't ring a bell. They quietly reshape entire industries. This is the money shaping the world, the Dealmaker playbook, where power and billions of dollars change hands every day. From private equity and credit to venture capital and M&A, we bring you the inside scoop on the biggest deals and debates, plus exclusive conversations with finance's ultimate insiders. I'm Danny Berger, and this is Bloomberg Deals. Every week, only on Bloomberg Television.
Asia is at the forefront of some of the world's biggest stories.
And we're here, where the action starts in Sydney.
And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays only on Bloomberg.
It certainly doesn't feel like it, but it is. A payrolls Friday. Your guesses look like this. The estimate 55K, the previous number 130. The 3-month moving average is higher, given the move that we saw last month. Can we get a repeat? A little bit later this morning, we'll get the view. Anticipating this jobs report from Governor Chris Waller of the Federal Reserve. An important conversation coming up on this program later on this morning. That's about an hour away. Let's get you a sneak peek of the price action. Equity futures right now, the S&P 500, the NASDAQ, the Russell, declining by around 1/3 of 1%, given this move right here in commodities. Brent and WTI, the move continues up by 20% so far this week. Brent crude pushing 88, WTI in the 80s.
And this still isn't pricing in a prolonged conflict. I think that's really important to note, that this is actually just flirting with the idea that this closure could keep going for a couple of weeks. It's not thinking about the backup. The fact that we're talking $130, $150 a barrel, should this go on for a couple of weeks, highlights what that threshold could actually look like.
Oil still climbing under surveillance this morning, capping the crude crisis.
My administration announced decisive action to help keep down the oil prices, including offering political risk insurance for tankers transiting into the Gulf, as you know, pretty dangerous territory. Further action to reduce pressure on oil is imminent, and the oil seems to have pretty much stabilized.
Here's the latest this morning. The White House looking at all options to backstop oil prices, with crude set for its biggest weekly gain since 2022. Shipping giants pulling out of the Gulf region, with traffic through the Strait of Hormuz coming to a near total stop. Joining us from Washington, Bloomberg's Jeff Mason joins us now for more. Jeff, welcome to the program. It's getting real for gas prices. What options does the White House have?
Well, they haven't detailed a lot of the options that they're looking at, but you're right to say they're keeping an open mind about them. Certainly the ones that the president outlined there in terms of insurance and having a Navy escort for ships in the Straits of Hormuz. I would like to just highlight the political risk for him in seeing these oil prices go up. That, of course, translates to higher gasoline prices, and gasoline prices really matter in the midterm elections, which is going to be pretty important for the balance of power in Washington coming in November.
Jeff, for markets, we're trying to figure out how long this operation will continue for. And as we try and gauge that, we're following the objectives, and they seem to shift. The core objectives: take out the missiles, take out the Navy, and prevent them from having a nuclear weapon. But on leadership, it gets a little bit more confusing. The president, with some comments recently, both to Axios and NBC. Jeff, this is what he said to NBC. We want to go in and clean out everything. We want them to have a good leader. We have some people who I think would do a good job. Jeff, where are we on that?
Well, the president also said this week that all of the leaders that were sort of in contention for the top position were dead. And that, of course, is a result of the U.S. operation. So he hasn't really outlined how he wants to have the influence that he's suggesting he wants to have. He hasn't ruled out putting ground troops in, but if he talks about ground troops, that's going to have even more political and economic risk. So I don't have an answer to your question in terms of what's next, other than to say he obviously has made clear he wants to have an impact, but that impact is going to be affected by to what extent the U.S. does more than just an aerial campaign.
So, Jeff, from the perspective of a lot of people tracking this story, Tehran is not Caracas. But does the White House see parallels with the effort in Venezuela?
I think the parallels, at least that the president sees, are success. He looks at what happened in Venezuela and sees that as having been a really good operation. It was clean. There weren't U.S. casualties. That does not apply now to the operation in Iran because there have been U.S. casualties. But he's a we're going to keep winning guy, and so I think that's the parallel that he sees. We'll see if that works out.
Hey, Jeff, it's good to see you. Stay close, won't you? Jeff Mason down in Washington, D.C. We'll see Jeff in the next hour. This is a far more open-ended operation than what we saw take place in Venezuela, based on the goals so far and the difficulty achieving them in a place like Tehran relative to a place like Caracas.
That's the reason why when you heard Stuart Kaiser talk about what he was looking for, it could be anything, because we don't know what the off-ramp actually looks like, and I think that is part of the anxiety bleeding into markets.
Terry Haynes of Pangea Policy joins us now for more. Terry, welcome. To Lisa's point, is there an off-ramp available to the president to take, should he wish to take one?
Well, sure, but I think markets should take seriously the idea that they are going to execute and complete their core objectives, and their core objectives are getting rid of the nuclear program, degrading the military capacity, and as part of that, getting rid of the ability of Iran to even fire ballistic missiles and drones. CENTCOM Commander Admiral Cooper said yesterday that the ability to fire drones is down 83%. So they're saying they're well on their way to doing that. So all those are, I think, essentials. Kind of the regime modification, regime change is as much as anything a nice to have. And I would look at, the president in the United States not dictating who becomes the next leader. I would look at this more of a collaboration with our Gulf allies who have so much on the line and, frankly, have been backing us up here for years.
Do we have a sense, Terry, of what the pressure points are right now for this administration? Is it gasoline prices at the pump in the United States? Is it some of the pressure being put on the administration by Gulf allies? I mean, do we have a sense of what nodes of leverage there are out there?
Leverage to stop the invasion and the operation?
Yes.
I would look for them to complete the operation. The Gulf allies were supportive before, broadly speaking. And I think that's important to understand. A lot of the press in the United States plays the Gulf countries as if our major non-NATO allies, let's use the United States terminology, plays them as if they've now just woken up to the Iranian threat, where Iran is trying to exercise whatever leverage it could in the region for the past several years, by and large because it perceived our Gulf allies as threats. So, by and large, we're going to finish this operation on the military side, certainly. And I wouldn't look at even a higher oil price for the next couple of weeks as being a red line there. They're not in this to take half measures and pull back out.
That said, Terry, I mean, and John laid it out pretty clearly. It's kind of unclear what the ultimate goals are. I mean, there are lots of different ones depending on who you talk to, and within each of those outcomes are vagaries, right? I mean, you could sort of discuss what it means to prevent a nuclear program over the long term, what it means to have a hand in selecting the new leadership. Is there something in particular that you think will be sort of the all-clear mark that will signal some sort of, at least, achievement of those goals?
No, when they say they're done, they're going to be done, and then we'll get the opportunity to assess whether or not they actually achieved their aims. But other than that, no, they are not going to be in a position. The commanders, General Kane, Admiral Cooper, and the like, as well as the Secretary of Defense, have said repeatedly they're not going to litigate day by day in the press, and markets shouldn't look for it.
Terry, getting some headlines crossing the Bloomberg terminal from the Iranian president talking about some countries reaching out to mediate and start having talks. No idea which countries they are, which nations, etc. But here's the comment. Our response to them is clear. We're committed to lasting peace in the region, but we do not have the slightest hesitation in defending the dignity and authority of our country. Terry, it keeps begging a question, I think, whenever we get these comments from the foreign minister or the president, who is actually running this operation in Iran?
Well, that's a pretty good question, and I don't have an answer to it. You've got it by all accounts. You've got kind of the top layer or two of the old Iranian leadership kind of cleaved off now, it's putting up Khamenei's son. Struck me as a bunch of people, I mean, just kind of anecdotally, struck me as a bunch of people saying, well, I don't know, let's, on a transition basis, let's put up the son of the previous leader and, see what happens. But I think these people are going to go a little bit hardline. They are people who have been in the kind of third, fourth level, more true believers than anything else. And it's going to take a little bit more to push them in the right direction and actually be constructive about finishing this.
Terry, it's good to see you. As always, Terry Haynes there of Pangea Policy. There is a major power vacuum in that country right now.
There's a lot of questions about exactly how you get leadership and who right now is that leadership.
Up next, Dan Stuyven of Goldman Sachs raising its forecast on the price of crude.
crises, two essential crises, and for both it's now or never: democracy and climate, and they are absolutely interlinked. And we have to solve them together. We're losing the democratic infrastructure and norms to deal with the climate, and we're losing the climate stability that is essential for a democracy. We have to solve them together. We've never faced a threat like this to our democracy at a time when it's a perfect storm, at a time when we're being told by climate scientists, some of you may be in this room, that we have to cut our emissions, fossil fuel emissions, in half in 5 years now. You know, when I started to realize what was happening, it was 12 years, and we haven't done it.
Welcome to Bloomberg This Weekend. I'm David Burr.
I'm Lisa Mateo.
And I'm Christina Ruffini. We're tracking breaking news today from Wall Street to Washington.
Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
Taking back some of Wednesday's bounce in yesterday's session, equity futures declining once again, some negative follow-through. We're down by, let's call it a third of 1% on both the S&P and the NASDAQ. The NASDAQ holding in quite well until recently. Semis started to give way. That's something to keep an eye on. But energy is dictating absolutely everything. Check it out. Commodities, Brent and WTI crude. Brent so far this week is up by about 20%. On the year now, it's up by something like 40%. And this week, the biggest jump on a weekly basis, going back to the energy crisis of 22.
The difference this time around is sometimes when there's an oil price shock, people wonder, is it inflationary or is it disinflationary, outright deflationary as a result of the hit to consumption ability of consumers? This time it's just being a clear read into inflation, and suddenly we're pricing out some of the rate cuts that previously had been in, and as you mentioned earlier, pricing in a rate hike over in the ECB. You just start to wonder how much this is whipping a lot of trades for this year on their head, and how much there's turn onto the markets as a result of being caught offside.
A lot of people caught offside, massively cross-asset. This bond move down by 30 basis points through February on a 10-year maturity, now up for 5 consecutive sessions, up another 3 basis points on 10s, 416.73. And it's not just been about crude. The data's been decent as well. The ISM's been strong. Fantastic news on that front. Claims have held in. That's okay. Payrolls a little bit later this morning.
This is the reason why payrolls is actually incredibly interesting. Stuart Kaiser was saying that it kind of has a high bar to clear. If you see that there is a good momentum in the U.S. labor market, well, people will go back into risk or at least feel more stable with it. If you get a negative print, well, it's all bets are off. And you start to wonder, okay, well, then is a bid into bonds a bad thing? Because if you get a bid into bonds because this is disinflationary, stagflationary, or deflationary, then you have another problem, and you start to question the underpinnings of the economic recovery.
What does it mean for the Federal Reserve? 60 minutes from now, we'll catch up with the Fed Governor, Chris Waller. Look out for that conversation later. What does it mean for the White House? And what's the plan to address this situation in the energy market? We'll catch up with the National Economic Council Director, Kevin Hassett, to react to the payrolls report and get his thoughts on what's happening with energy. That's taking place at 9:30 Eastern Time. As we count you down to that opening bell, also 3 hours away, let's get you some morning movers. Yahira has more. Hey, Yahira.
Hi, John. We start with Gap shares. They are falling nearly 7% in the pre-market after the company missed on sales. The biggest drag came from Athleta. It's athletic wear brand where same-store sales fell 10%. Another drag on the results was these winter storms forcing stores to close. And its results really highlighting the K-shaped consumer trend with its more premium brands like Gap and Banana Republic doing very well, whereas its more value-focused brand Old Navy really struggled. Meanwhile, moving on to technology with Marvel, shares are soaring 12% in the pre-market after it raised its outlook due to stronger than expected growth in its data center business. It echoes what we heard from Broadcom earlier this week, that these cloud companies are still pouring money into the chip makers for the AI build-out. And we end on the top gainer and the S&P, and that is Battalion Oil. Shares are surging 27%, adding to the extraordinary run this stock has had this week, up more than 300%, as the small oil producer out of West Texas tracks that spike in crude prices you were just talking about. John?
Yahara, thank you. Thanks for the update. More from Yahara later this hour. On our radar this morning, the president vowing to take action to slow rising oil prices.
My administration announced decisive action to help keep down the oil prices. Further action to reduce pressure on oil is imminent, and the oil seems to have pretty much stabilized.
The cost of retail gasoline in the United States hitting their highest level since September 2024. Elsewhere, the United States clearing the way for India to increase purchases of Russian crude. The waiver issued late last night expires on April 4th. The Treasury Secretary Scott Bessent saying on X the move is to keep oil flowing in the global market. And finally, container shipping giants Maersk and Hapag-Lloyd suspending key routes due to the war with Iran. Maersk saying in a statement it's halting routes connecting the Middle East with Europe as well as its Gulf shuttle service.
This is going to be an increasing problem because it's not just oil, it's also a key component that goes into fertilizer. A significant amount of it travels through this route, the Strait of Hormuz, which is essentially closed. It's not officially closed, but if you take a look, there are about 1 or 2 ships that are trying to go through there, and then they circle back and they say, never mind. So you start effectively seeing a closure. Raises a question about supply chain disruptions and the ripple effects that go much beyond just the initial couple of days, because why would they go through? I mean, you talk about the insurance plan that the U.S. has proposed. Is that enough? I mean, can they pay anybody enough to go into the line of fire? And I think that the answer, just by virtue of how many ships are in there waiting to get through, is not very many.
If you can't move it, how much can you produce? Where's your storage? What's the release valve? We've talked lots about this east-west pipeline from Saudi Arabia. That could do 5 to 7 million barrels of oil per day, but they're producing maybe upwards of 10. The math doesn't add up. At some point, you have to start cutting production. We've seen it in Iraq. The question is, how quickly do we start to see it elsewhere? And they're the headlines you're looking for in this market.
And then the question of how long does it take to bring that production back? How much does that lead for the oil supply glut to turn into an oil supply deficit at a time when otherwise you have an economy globally that's doing okay? These are the questions that point to a prolonged disruption in supply chain issue that isn't necessarily something that you can stop just by turning on a tap.
Let's keep it on energy. Brent crude on track for the biggest weekly gain since 2022. Qatar warning it's weighing halting all exports until the fighting stops. Dan Stroiven of Goldman Sachs raising its Brent forecast by $10 and writing this. Risk remains significantly skewed to the upside. If Hormuz volumes remain flat for 5 more weeks, Brent would likely reach $100 a barrel. Dan joins us now for more. Dan, welcome to the program. Let's just start with storage capacity. How close are we to bumping up against some limits in key markets, key producers across the Middle East?
Yeah, we already hit it in Iraq. And if you sort of look at the 6 key exporters in the Gulf region, we estimate that most of them would hit storage capacity constraints over the next month if the disruptions were to be sustained, with some producers with more limited storage capacity hitting the constraints earlier. And we're talking days, weeks, not months here.
Dan, what kind of workarounds do they have? We mentioned that pipeline in Saudi Arabia. Do others have a similar release valve?
So the 2 significant pipelines are the East-West pipeline from Saudi Arabia, and then you also have the Fujairah pipeline from the UAE. We estimate that if both pipelines operate at full capacity, and if the ports supporting the transportation of the barrels once they're out of the pipeline to the rest of the world, if all that infrastructure is intact, we estimate around 3.6 million barrels per day of extra pipeline spare capacity beyond what you usually do. That's helpful, but that still leaves roughly 17 million barrels per day of supply at risk. And at the moment, the data we're tracking suggests that the Fujairah pipeline is still not running at full capacity. And you're seeing the spillovers to supply chains. In fact, the ships that need to pick up the barrels in the Fujairah port are reportedly running out of marine fuel, because the marine fuel typically comes via the strait. Other vulnerabilities are attacks on pipelines, attacks on ports. So this could be a partial offset, but it is vulnerable and fragile on its own in an environment with elevated physical risks.
Given all of that, Dan, I'm surprised that you just have $100 a barrel for your target in the next 5 weeks should the Strait of Hormuz continue to be closed. Qatar's energy minister came out and said that he would expect it to be $150 a barrel in the next couple of weeks if the Strait of Hormuz does not open up. Why just $100?
Yeah, so I think the upside to that number is is meaningful. I think in that scenario, we assumed 15% of the flows would still be coming through. At the moment, we're seeing less. That scenario also assumed full pipeline redirection, and that scenario sort of assumed that prices would require price levels to jump to demand destruction levels when you sort of hit the critically low levels of early 2022. During the Russian energy crisis. But the supply shock here is significantly bigger than during the Russian energy crisis. And so it's very plausible that markets start to price demand destruction more quickly at less low inventory levels, just because the speed at which you're approaching these limits is faster. For context, this supply shock, the supply at risk, is around 15 times bigger than in 2022. So absolutely, I think the data that have come out in the last few days since we published that note are all consistent with significant upside risk.
How much, we've been talking a lot about this note that we got from Jeff Curry of Carlyle over the weekend, talking about a structural risk premium that needs to be priced into oil and other commodities. I just wonder how much you're rethinking your full year forecast as a result, not just of this disruption and however long it goes on, but also about the stockpiling that may go on, the change in people's sentiment around using the seas to get goods from one place to another.
Yes, so I think the two main mechanisms to which you could see a persistent impact of only a temporary supply disruption, one is inventory depletion. While drops in exports may be offset by an overshoot of exports down the road if you prevent production shut-ins, if you have production shut-ins, you simply start with lower inventory levels. And that, all things equals, means higher prices. And second, the geopolitical risk premium, or sort of the security premium, as Jeff has coined it, is likely to be stickier for longer, especially in a world where Iran has some asymmetric warfare capabilities, or its proxies have in other places too. To be clear, the Strait of Hormuz is the biggest shock. We're laser focused on it, but I think the events of the last week are a reminder that that broader risks to energy supply have to be monitored and likely priced.
As we speak, Dan, getting some moves on a Bloomberg I want to share with our audience. 88 on Brent, briefly through 85 on WTI for the first time since spring of 2024. Clearly, Dan, as we have this conversation, Asia is exposed to this story. Japan, India, other countries as well. But clearly ahead of time, China stockpiled onshore and Iran actually filled tankers offshore. Now, I'm trying to understand for Asian refineries specifically, what kind of cushions do they have at the moment? What kind of things, levers, can they pull?
Yeah, I think it varies significantly across country. I think China is relatively well positioned, despite the fact that they import about 3/4 of their consumption, because we estimate that China has stockpiled around 110 days of oil demand. Some other Asian countries have lower buffers, and we're already starting to see signs of shortages. In fact, the price of a barrel of jet fuel in Singapore at the moment is already above $200 per barrel. And I think there's a double whammy here. The Middle East exports a lot of jet fuel, and China's main refined products exports is jet, and China is cutting its refined product exports. And so ultimately what matters for the real economy and for the impact on inflation and growth is the impact on refined products. And we're seeing the really violent price action in refined product markets as opposed to the crude market.
It's getting real, that's for sure. Dan, it's good to see you. As always, Dan Stuyven there of Goldman Sachs. Just to recap the price action briefly, and once again, top in 85 on WTI, up by more than 5% on the session so far. Brent crude through 88 and approaching 89, up by 3.8% on the day so far. Asian refiners are in a little bit of a bind right now. There's some levers you can pull, but it's getting real, and you're seeing it in the price big time.
Yeah, and the fact that Asian refineries have to deal with the fact that the input of oil is down, but also the refinery in Bahrain that was attacked. So the refineries are being sort of taken offline around the world as well. So it really puts people who are importing oil in a vulnerable spot. Again, turning the narrative of this year on its head.
I'm pleased you brought up the Jeff Curry piece once again, because this speaks directly to the question mark around just-in-time energy delivery. And China hasn't behaved that way over the last year or so. They've been stockpiling crude for good reason, given what's been playing out. a lot of countries will be conditioned to do exactly the same thing in the year to come.
So it just raises this issue of structurally, do you have a higher price on some of these energy inputs? And frankly, on commodities more broadly at a time when everyone's trying to build out their industrial complex, whether it's for weaponry or whether it's for energy. And this really just, again, points to why people are treating this as an inflationary story more than they have maybe in the past.
Another big move in energy, the headline crossed on a Bloomberg terminal moments ago. WTI crude topping $85 a barrel for the first time since April 2024. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Yahara has more. Hey, Yahara.
Hi, John. AI leader Anthropic saying it will issue a legal challenge to the Pentagon after being declared a threat to the U.S. supply chain. CEO Dario Amodei planning to take the Pentagon to court, saying he sees no choice but to do so. The decision putting Anthropic's $200 million contract with the Defense Department to provide it with classified AI tools at serious risk. Meanwhile, President Trump has fired DHS Secretary Kristi Noem in the first shakeup of his second-term cabinet to date. Noem had recently come under fire from lawmakers on both sides of the aisle over deadly immigration operations in Minneapolis that saw 2 U.S. citizens killed, as well as high-budget advertising campaigns for the DHS that she commissioned. Trump announcing that Oklahoma Senator Markwayne Mullin will succeed her in that role. And President Trump's tariff agenda facing another legal fight. 24 states are suing the president for the 10% global levy he imposed on imports, saying it is fatally flawed in a lawsuit. Trump is using Section 122 of the Trade Act of 1974 to impose the tariffs following the Supreme Court's decision to strike down his IEEPA tariffs from last year. That's your Bloomberg Brief. John.
Yahara, thank you. More from Yahara in the next hour. In the markets right now, oil at new highs, equities at new lows. Up next, inflation at the pump.
Gas prices, obviously, if they're up, that is inflationary. Textbook monetary policy would be you look through a short-term shock, but you don't look through a long-term shock.
Up next, Claudia Sam of New Century Advisors, live from New York City. You're watching Bloomberg TV.
This is a 15, 16 grams tuna. Then sushi rice is still a little bit warm. So take one, like a very, don't make it too tight. So from now, and very light, like a little ball. Put wasabi in the middle. Then my process 1 to 6. 1. This is putting the between the rice air. Then make the 4 fingers curl. Make sushi shape. Then touch this. 2. Then turn. Now that these 2 fingers, top of the bottom, make the sushi shape more beautiful. 3. Then, looks like pushing, not pushing. 3, 4, turn, same way, 5, and 6. So this is 1 to 6.
The trading day
day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe.
Let's talk about the significant risk transfers to find space in their balance sheet.
Hedging some of that risk.
You could look at it the other way. Obviously, this stuff is risk-weighted.
I would much rather be long than be short.
We're in a kind of sweet spot.
Very, very strong alignment.
3 revolutions in one.
I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie.
This is your opening trade.
Every trading day, only on Bloomberg.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Tension in the Middle East cascading through global markets. Equities at new lows for the session, down by 0.5%. On the Nasdaq, down by 0.6%. In the commodity market, new highs through 85 for the first time since April 2024 on WTI. And right now on Brent crude, getting closer to the 90s at 88.60. That's unlocking higher bond yields ahead of payrolls later this morning. Your bond story looks like this. Yields higher for a 5th consecutive session, up by 3 basis points. Still range-bound for the year. I get that. But pushing the top end of the range, 416.93.
And ultimately, the market's doing scenario analysis here, and it's saying on the margins this is inflationary, which is unique because in previous oil shocks, sometimes there is a debate whether it is inflationary or deflationary. This time there isn't. It seems like everyone is just piling in, saying ultimately this will increase prices and it will have a prolonged effect and push the Fed away from cutting rates so soon.
Let's have that conversation right now. Under surveillance this morning, inflation at the pump.
It's still the case that the price at the pump matters a lot. In terms of sentiment, in terms of crowding out other spending. Gas prices, obviously, if they're up, that is inflationary. Textbook monetary policy would be you look through a short-term shock, but you don't look through a long-term shock. You've got a couple months of relatively high inflation. That certainly puts pause to any conclusion that we're done, fighting this.
So here's the latest this morning. U.S. gas prices reaching their highest levels in 18 months. Inflationary risks mounting as the Iran war takes a toll on the global economy. Claudia Salm of New Century Advisors writing, the risks of sticky inflation have become more prominent. A Fed rate cut will likely require data showing a clear slowing in core inflation. Claudia joins us now for more. Claudia, welcome. We've clearly got an energy shock developing before our eyes right now. When do you believe that becomes a problem for the Federal Reserve?
Well, it certainly is a complication. And what I had said about the Fed wanting to see some clear slowing in core inflation, I think that was true before this week as well. I mean, that really was a basis in their pause. Labor market looks like signs of stabilization. Inflation is still running closer to 3% than 2%. And they want to see, now what they'd been watching up until this week was the tariff pass-through to show some completion and core goods prices to start moving down. And now we have another shock for the Fed to be on watch and coming through the economy. And the big piece of this is how long this energy shock lasts. And the context matters. What was said about the textbook response, look through the oil shock, yes, that is correct. But the context here is we have had elevated inflation for several years, and the Fed is very sensitive to making sure that we do not get stuck at higher levels of inflation.
Claudia, the key piece of the puzzle also is the labor market. Given the labor market conditions currently, do you believe that gives them the space to wait and see?
So I think stepping back from the Fed, we should be really wanting to see a labor market in February that is showing further signs of stabilization, right? If we have a shock coming at the economy, and the higher energy prices will be a shock for American consumers. So if you've got a shock coming at you, you want to have the best, most resilient backdrop to buffer it, right? So I think we should all be very thankful that there have been signs for months now that there's been some stabilization in the labor market. Hopefully we'll get some confirmation of that. Yes, that gives Fed less reason to get active in cutting. That's good, right? It's like we don't want a labor market that is in a weakening position, but it does in the Fed context, if that's what you're focused on, they had been moving and cutting rates last year and the year before on concerns about the labor market. They're going to protect this labor market. If it looks okay,
then their attention is shifted to inflation, and there's some problems on the inflation side where they're going to be cautious and wait before they make their next cut.
Claudia, this employment market has been incredibly confusing because of structural demographic changes and all sorts of other compositional changes. What's a good number and what's a bad number for the Federal Reserve?
So frankly, they're going to focus on the unemployment rate. It is very hard to read payrolls. I mean, we're going to look at all the details of the data, including the payroll employment, and we would like to definitely see something that is positive and, notably positive. But it's really the unemployment rate is where you kind of bring together the supply and the demand factors that are really unusual and pretty big movers, like this supply of labor slowing down with less immigration. So an unemployment rate that stays at 4.3%, the Chicago Fed's models have a little extra probability on it even moving down, given some of the recent labor market indicators. But if you kind of stay in that ballpark of where the unemployment rate is, I think the Fed will see this as confirmation of some stabilization. Now, they're watching payrolls very carefully, and I think in particular watching this morning any revisions to payrolls in prior months. So January was a sign of stabilization. If we want to see that survive today's revisions as well.
Yeah, the 130,000 that shocked markets pretty broadly. I am curious also about other changes that have been going on under the surface in the employment market. Yesterday, a huge debate around the upside surprise in productivity numbers coming out in the fourth quarter for the United States. A question of how much this is tied to artificial intelligence and new gains in the workforce on that level. What's your take on that? How important is that to color the debate, both for markets and for the Fed?
Yeah, so I've been taught not to get too excited about any one quarter of productivity growth. I mean, these tend to revise. It's putting together a lot of pieces of data, GDP and hours worked, and those tend to, particularly our early reads in the economy, things revise. So, but what I do think is important to pull out of that productivity report is if we look at the cycle as a whole, so going all the way back to the pandemic, averaging across the time that we've been in this cycle, productivity growth is 2.2%. Relative to the Great Recession cycle, all the way through its expansion, that was 1.5%. 0.75 percentage point increase in productivity growth is enormous because it adds up over time. These are growth rates on average. And so now that puts us something close to historical averages, that a little above 2%. So these aren't like, outsized numbers. But this is really important. And I think the improvement in productivity, you can see signs of it throughout this cycle. It's not just about the last year when we're building AI data centers, right? So that is in the mix, but there has been a much stronger recovery and more in business investment. And I think we saw a lot of movement in the labor market, getting people matched up with better jobs, that we have workers that are more productive. So there was a lot going on, and there's much to piece out of that, but that is really important to see that those productivity numbers have been up over the past several years.
Claudia, it's always good to catch up with you and get some clarity on where we're going. Claudia Sam there of New Century Advisors on the data, what it means for the Fed, and the energy shock developing before our eyes. New numbers on the screen, 89 on Brent, 86 on WTI, crossing those levels just moments ago, and this market at the mercy of this move in crude right now.
Yeah, ultimately, they're looking for an off-ramp. Not only are they not finding one, but the obstacles to reopening some of the supply are increasingly getting large. The idea of refineries getting hit, the idea of oil tankers potentially being attacked, the idea of a question of storage being filled up so people shut off production, as you mentioned. We saw that in Iraq. All of those really adding to the gain that already has been the biggest for a week going back to 2022.
The good news is the data's okay. It'd be a whole lot worse if it wasn't. The bad news is we have some credit jitters as well that we have to keep on tracking. Where's the offset going to come from if that move of energy keeps sparking a tightening of financial conditions?
How much do we need an easing in financial conditions to allow the credit wheel to keep fueling some of the good that we've seen in the economy?
Crude up by 6%. Up next, Priya Misra of JP Morgan, the Republican Congressman French Hill, Fed Governor Chris Waller, and the EU Energy Commissioner Dan Jorgensen. That conversation up next, the second hour of Bloomberg Surveillance, just around the corner.
Know how the market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romaine Bostic, and this is The Close.
Live every weekday.
Only on Bloomberg. Context changes everything.
When I visited Fernandez at IMAX's headquarters outside Toronto, we went to the facility where IMAX designs and maintains its cameras. The latest next-gen equipment was out with directors on filmed for IMAX sets, but there was still plenty of cool gear on view.
As the head of the finance department, do you look at all the things in this room and think, this costs that amount of money, this costs that amount of money?
Thankfully, no, I don't. When I think about cameras in general and what we, when we first, I'll give you a really prime example, the film cameras. When you thought about it, okay, are we building 2? Are we building 4? Are you building 8, right? And that's where I start to think about, well, what makes the most sense from a return perspective? Because yes, Nolan wants the cameras, but how many other filmmakers out there use the film cameras? The lens that I look at it through is essentially, how many do we build and in what way? Because the one thing is we are going to invest to build it right and to build it for longevity. But do you need 10 of them? No. Building 4, that was the right number. And do we potentially want to build a couple more? Maybe a couple more, but I don't think we need 10 because they won't always be in use all the time.
I imagine that at different points you need to tell people no. What's that process like for you?
Oh yeah, it's a key role in the CFO position. It is a word that most people are used to, and yet they still think you're not going to say it.
I'm David Weston. Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. We go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
We need more transparency.
Oil and gas is still important.
They said every citizen should be investing in the market.
Accelerate progress in all fields of science.
Watch Wall Street Week right here on Bloomberg. More than what you need to know, it's what you need to think about.
Welcome to Bloomberg This Weekend. I'm David Gray.
I'm Lisa Mateo. And I'm Christina Raffiti. We're tracking breaking news today from Wall Street to Washington.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine. Watch, listen, stream.
Welcome to Bloomberg This Weekend. I'm David Gray.
I'm Lisa Mateo. And I'm Christina Raffiti. We're tracking breaking news today from Wall Street to Washington.
Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up. Sorry.
We need to be focusing on jobs and economic growth.
What is happening in the labor market, it's not entirely a cyclical story.
I think it's only important now in the context of it creating a really big surprise.
I'm increasingly concerned about the income shock that is coming through to the economy.
We're just kind of waiting on circumstances right now to see where we go.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. The second hour of Bloomberg Surveillance starts right now. Your price action looks like this. Session lows for equities. On the S&P at the moment down by 0.6. On the NASDAQ down by 0.7. Session highs for crude. Check out commodities, Brent and WTI. Brent crude through 89. WTI approaching 86.
Yeah, a real question about A, whether there is an off-ramp, B, how much supply is getting shut down right now as you see storage facilities getting filled up, as you get more threats to potential oil tankers going through the Strait of Hormuz. Guess what? There are none. And as you get even refineries that are coming into harm's way, all of this coming to a confluence of events where suddenly people are trying to game out what this looks like if it goes out 2 weeks, 3 weeks, 4 weeks, and suddenly 5 weeks starts looking like a lifetime that really changes the game.
What's the offset? What's the plan? Coming from the White House, the administration, we've had some vague details about providing insurance, providing escorts through the strait, not seeing any evidence of that right now. And then this on Russia from the Treasury Secretary. To enable crude to keep flowing into the global market, the Treasury Department is issuing a temporary 30-day waiver to allow refiners in India to purchase Russian crude.
It shows that the administration is concerned about oil prices and is looking at all levers, including those that are unpalatable, considering the sanctions currently on Russian crude and the effort to bring Russia-Ukraine to some sort of head and resolution. So you do see the White House, and we're expecting some sort of announcement from the Treasury. Other things that have been flirted with is potentially trading oil futures, but people have sort of shut that down as being relatively ineffective. You've seen other places like Turkey use 15% of their reserves to support their currency as it has has been selling off in dramatic fashion. So a real question is how you mitigate really violent moves as a lot of people get caught off sides.
So how much time do we have? How much longer before it gets a whole lot worse? I mentioned this from JP Morgan's Natasha Kaneva. If Hormuz remains effectively closed, supply losses would accelerate from here. So here are the numbers. By day 8, we project roughly 3.3 million barrels per day of shut-ins, rising to almost 4 around day 15 and close to 5 by day 18.
Yeah.
Things start to get worse very quickly.
Which is the reason why I was really struck by Qatar Energy Minister speaking in the Financial Times, saying that A, production in Qatar will not restart unless there is a complete cessation of violence. And then going on to say, guess what? This goes on a couple of weeks and we're talking $150 a barrel, and we're talking about a real hit to the global economy. Is this an effort to push some resolution and say, hey, guess what? There's a lot at stake and it's your neck too? Or is this an actual projection of what they foresee in a nation very much tied to the energy complex?
We've got a payrolls report to talk about later. Not really been talking about it much. 8:30 Eastern time, jobs drop. We're looking for a number around 55K in our survey. Does this shock weigh on output or fuel inflation? That's the debate in economic circles at the moment.
If the economy is doing okay, which a lot of people say it absolutely is, if the employment market is holding in, and even if people are seeing signs of recovery, well, guess what? This is actually inflationary more so than deflationary, because you have people who can actually go out and to continue to consume, at least in the short run. If you have an economy falling off a cliff, well, that is a very different reaction function to higher oil prices. And, oh, by the way, it undermines the bull case for risk assets, even in the face of oil prices rising, simply because people keep saying, well, otherwise the economy is pretty good.
Sounds dramatic. It is. Yet stocks are still just a few percentage points away from all-time highs, and futures this morning only down by 0.6%. Coming up, we'll catch up with Priya Misra of JP Morgan as crude oil is making new highs. We'll catch up with the Republican Congressman French Hill as President Trump calls on Iran to lay down arms, and the Fed Governor Chris Waller as we wait for a fresh read on the labor market. We begin this hour with stocks slipping as oil heads for its biggest weekly surge since 2022. Priya Misra of JP Morgan writing, overall pricing suggests a short-lived war, so the longer it lasts, the more vulnerable markets and the economy are. Priya joins us now for more. Priya, good morning.
Morning.
How do you price an energy shock in the bond market?
So far what the market's done is those front-dated tips break-evens have gone up, but you look at further out, the market's essentially saying this is very short-lived, next few months, maybe headline CPI picks up, but that's it. And so what the market's done is it's taken out imminent rate cuts. We still have some rate cuts, but I would also look globally. I mean, all year, the market has been driven by what's happening globally. European rates, we've gone from pricing in rate cuts to rate hikes. So I would say that the crowded positioning in a lot of these rate trades, I think that's responsible for the move. I mean, if this lasts longer, I worry about the nonlinear impacts. Certainly on inflation, I feel like all week we've talked about inflation. There's a growth nonlinear impact as well, because look at the consumer. The consumer savings rate has been declining. We're still dealing with the tariff shock. Now you have this additional shock. It's going to hit real disposable income. And if the consumer starts to crack, I think all bets are off, and not just the fixed income market, I would say even in the equity broader risk center.
So I've got to ask you the direct question. 10s are at 417. Given what you just said, is that a buy or a sell?
I would be leaning towards buying, but I think if we think about the fair value of the 10-year, 375, 4.25, we're not at the upper end. Have all of these consensus trades been washed out? Not clear. I mean, we're still seeing pretty big moves. The steepener was very popular. Swap spreads were popular. Owning duration as a hedge. I think the last time I was here, I was talking about we like risk assets, we like owning duration. Well, that was working. It was very popular. So I think there may be still some of that flush out. You get to 4.25, you get a little higher. I think it's a buy, because if rates are rising to that level, that means the market's repricing the severity of the shock as well as the duration. That starts to rise. I think the stagflationary shock that this imposes, the uncertainty shock, starts to weigh on growth. And I think that's when it's a buy. I still think duration will be the hedge. I think we may have gotten too far last week. It was all about credit. I mean, we haven't been talking about the AI disruption, credit cockroaches, but I think duration was acting as a hedge there. We might have gotten a little bit too low in terms of the 10-year. I think this is some of it was a healthy repricing back, but you get a little 10 basis points higher, I think we'd be in buying.
Before you decide whether to buy or sit back, a big question is why has the 10-year traded the way that it has? Is it because of long-term inflation expectations? Because you don't see the parallel in break-even rates. Or is it technical, sell what you can, as you see margin calls getting called all over the place?
Great question. I think this is a VAR shock. I think the fact that people want to de-risk, I mean, we know duration is a risk factor. So if I want to reduce all risk, and it's sometimes you can't sell what you want to, but you sell what you can. So I think there's some element of that, margin calls, and sort of an unwind of consensus trades. Was owning duration a bit of a consensus trade because it was working as a great hedge? If the underlying inflation dynamics were heading lower, I mean, I know PCE is at 3, but look at the underlying. Wages are not accelerating, shelter inflation's coming down. So I think I would put a lot more weight on the technicals, particularly further out the curve. Those break-evens have gone up in the front end. Does this keep the Fed on hold a little bit longer? Possibly. I think the Fed will want to see macro data. They'll want to look at the employment side. We do have payrolls coming up. So, so I think the front end move has some inflation pricing. The long end, I think, is largely a technical move, global rates included.
I mean, I'm trying to understand some of these moves, and some of them defy logic. People looking for havens and selling gold and silver, right? It kind of speaks to what you're talking about. We had Stuart Kaiser from Citi on earlier, and he was saying that this non-farm payrolls report, the hope is for it to be a non-event. The hope for it to be just good enough to kind of not change the underlying backstory for the U.S. economy and the labor market. Do you have a sense of how offsides this market is, say if it comes in below expectations, or even say if it comes in screamingly above?
I think screamingly above, we'll go back to looking at oil. And we'll be looking for what are these off-ramps. If it's regime change, I really worry that we don't have an off-ramp. So I think it is asymmetric for the bond market and for the risk market. If it's weaker, now what does weak mean? I think there's the strike impact, there's the weather impact. So I don't know if it's just payrolls, but if the unemployment rate goes up, you have a really like zero payroll, a high unemployment rate, I think then the market starts to question not just, I mean, you look at overall market pricing, short-term war, and the economy is fundamentally sound. If we start questioning both of these, we talked a lot about the duration part, but if you start to question, is that AI disruption here? I mean, we had questions on productivity. I love that you asked Claudia Sam this question, because I don't think this productivity increase is all AI, but the market, it's at the back of everyone's mind that is that labor disruption about to happen? We get a weak number, and I would look at the number. I would also look at revisions, because I think what gave the market a lot of comfort was the last strong payroll report. That gets revised lower. I think you have to question, maybe the fundamentals are not that sound. And so, do I want to continue to pay back risk, not just because of the oil shock, but that fundamental resilience of the labor market, which feeds through into consumer spending? If I start to question that, I think that, the risk complex will react a lot more, and rates that are obsessing about inflation will start to worry about the growth side.
It would be an absolute nightmare for this Federal Reserve if at the same time, simultaneously, we find out that the firmness in the labor market at the start of the year was a head fake, whilst we're experiencing a supply shock in the Middle East for energy. What do they do with that? That's a big problem for any monetary policy official anywhere.
It has a word that is the nightmare for all central bankers. It is stagflation. And that is what everybody wants to avoid. And right now, really very few people are projecting because of the strength in that January payroll. So that's the reason why revisions are going to be so important.
Let's hope we can avoid it. Priya, it's always good to see you. Thanks for being here. Priya Misra there of JP Morgan Asset Management on the payrolls report, 1 hour and 20 minutes away. A programming note, we will catch up with the Fed Governor Chris Waller in about 20 minutes time. So look out for that conversation. An update on financial markets. Equity futures at the moment on the S&P, near session lows down by 0.6%. Crude near session highs at the moment, 89.44 on Brent. WTI through 86. With an update on stories worldwide with your Bloomberg Brief, Yahara has more. Hey, Yahara.
Hi, John. Iran fired a barrage of missiles and drones targeting countries across the Persian Gulf overnight, including Saudi Arabia, Kuwait, and Bahrain. Meanwhile, Israel renewed its own airstrikes hitting Tehran and Beirut. Fears of a protracted war around the strategic Strait of Hormuz are roiling markets, with crude headed for its biggest weekly surge since 2022. Meanwhile, the U.S. has issued a temporary waiver to allow Indian refiners to purchase Russian oil in an effort to ease pressure on supplies amid the conflict in the Persian Gulf. The waiver, which expires April 4th, covers transactions related to Russian crude oil and petroleum products loaded onto vessels before March 5th. And the U.S. Commerce Department is considering restricting AI chip shipments to anywhere in the world without American approval. The proposed rule would impact imports from chip makers like NVIDIA and AMD, setting up the U.S. government as the gatekeeper for the AI industry. That's your Bloomberg Brief. John?
Yahira, thank you. More from Yahira later this hour. Up next on the program, Seeking Surrender.
I'm once again calling on all members of the Iranian Revolutionary Guard, the military and the police to lay down their arms. But they're tough, and they want to fight. And they're calling, they're saying, how do we make a deal? I said, you're being a little bit late.
The Republican Congressman French Hill joins us next, live from New York City this morning. Good morning.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
The Middle East and Africa regions are home to some of the biggest deals and fastest growth in the world. Vibrant resources and high-yield investment opportunities abound. I'm Jumana Versace. Join me on Bloomberg Horizon's Middle East and Africa for the stories, newsmakers, and insights shaping the decisions of traders across this exciting region.
You had heightened levels of volatility.
There's still room to maneuver.
We do see opportunities. It allows you to increase significantly your net income.
Every trading day, only on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Live from New York City this morning. Good morning to you all. The price action set up as follows on this payrolls Friday. Equity futures declining by 0.6. The Nasdaq down by 0.7. In the commodity market, new highs for Brent and WTI. Brent crude approaching 90, 89.40, and up by close to 5% on the session.
You have shippers, Maersk in particular, suspending shipments through the region. You have questions around ships that aren't even in the Strait of Hormuz, whether they could potentially be targeted. And you have the specter of production being shut down because of a lack of storage capacity. All of this coming together as each day ticks on, as people try to imagine what can be the off-ramp that can get some sort of resolution and get petroleum flowing once again.
Under surveillance this morning, Seeking Surrender.
I'm once again calling on all members of the Iranian Revolutionary Guard, the military and the police to lay down their arms. They're only going to be killed. Their communications are gone. Missiles are gone. I said, what's left? But they're tough, and they want to fight. And they're calling. They're saying, how do we make a deal? I said, you're being a little bit late. We want to fight now more than they do.
So here's the latest this morning. The president urging Iran to stand down as the Middle East conflict rages into a sixth day. Tehran claiming it's confident it could counter a ground invasion, and the U.S. president telling Axios he must be involved in selecting Iran's next leader. Back with us, Jeff Mason out of Washington. Jeff, welcome back to the program. The words of the Treasury Secretary overnight. To enable oil to keep flowing into the global market, the Treasury Department is issuing a temporary 30-day waiver to allow Indian refiners to purchase Russian crude. Is the administration beginning to compromise foreign policy objectives elsewhere?
Well, they're certainly taking all the steps that they can right now to keep oil prices from going up high. But let's do or higher, I should say. Let's do a little bit of a fact check. The president said yesterday in that clip that oil prices were stabilizing. That's not true. The president also said that you were just talking about what's going on in Iran in terms of encouraging people to lay down their arms. Well, there's no evidence that there are talks right now between the United States and Iran, so we'll see. But in terms of the Treasury Secretary, they're looking for every option they can to keep gasoline prices from going up.
Jeff, I'd love your judgment and your observation of how this is playing out at the moment. Do you think that financial markets, equity specifically, are underestimating the president's desire to follow through, regardless of what happens with gas prices?
I think the evidence shows that the president right now cares about success in Iran. It's on his list of things to do, just like he's got a list of things to do domestically. Obviously, he takes into account the politics. He takes into account the economy. He has responded before to the market having sort of a check on him. But yeah, I mean, I think equity markets need to take into account that this is a president on a mission, and Iran is on that mission.
Jeff, appreciate your time. Thanks for this morning. Jeff Mason there of Bloomberg down in Washington, D.C. Jeff's point there is so important. Financial markets have been conditioned. Investors have been conditioned for the president to step down, back away when the market pushes back. Is it different this time?
If this is a legacy play, maybe it is, right? I mean, if this is trying to bring around regime change in some capacity, which there have been mixed messages on, well, then maybe he's not going to stop until it is done. Right now, it doesn't seem like the rise that we've seen in gas prices at the pump, which have reached the highest since 2024, it doesn't seem like that is creating any off-ramps that are foreseeable, at least right now, for markets.
Let's extend the conversation. A good friend of this program over the years, the Republican Congressman French Hill, joins us now for more. Congressman Hill, welcome back to the program. Are you satisfied with the rationale for this operation in Iran?
Well, Jonathan, it's good to be with you. Yes, I am. I mean, this has been 50 years of counting American bodies that caused at the hands of the IRGC, the Quds Force, Iranian IEDs. This has been a long-standing gray zone war between Iran and the West for all these years. And the president set out the goal of they will not obtain a nuclear weapon, and we have not been successful in 4 different presidential administrations of achieving that through negotiation. And the Israelis are concerned with the advancing ballistic missile development technology sharing by Iran, plus the continued dedication to producing a nuclear weapon, that risk in the region had reached a breaking point.
There is, as you know, Congressman, a domestic price to pay in more ways than one. Unfortunately, for this conversation, we're going to focus on the market aspect. There are much more important issues at play as well. Gas prices are climbing. What's your assessment of the disruption to energy flows, 1, and 2, the kind of remedies that the U.S. government can offer right now?
Well, I think some of the remedies are, you've heard Treasury Secretary Bessent talk about supporting the insurance markets. Of course, the United States Navy is going to do their part to support transit of the Strait of Hormuz, which benefits everyone in the markets. But as you pointed out in your reporting, you've just got a risk at the margin of Iran striking a production facility or a transit ship. And so that has really chilled the oil transit market in the Gulf. I think this is temporary. I think it's going to be handled over the next few weeks. I don't think it's going to have a permanent impact on the oil markets. If you think about Iran's contribution to oil production, 80% of it's been sold to China, and during the first Trump administration, it was completely shut down in terms of production due to then maximum pressure sanction campaign that was undone by the Biden administration, with Biden letting them back into the oil markets and back into the financial markets and freeing up a bunch of frozen assets. So I think this, I don't believe will have a lasting effect on markets, but certainly has an important short-term effect, as we're seeing in oil markets and in the insurance markets.
Congressman, would you support measures like using and tapping the SPR, the Strategic Petroleum Reserve, to try to mitigate some of the price increases, even in the short term, that people are already feeling when they go fill up their cars?
Well, I think that's a decision the Treasury Secretary and the Cabinet needs to make. If they think that's in the right reason, then I certainly would urge them to consider it. We experienced that with Joe Biden during the Russia invasion of Ukraine, and it was microscopic. The actual hit, the cents per barrel from a strategic petroleum reserve release are not that measurable. So if the whole production and distribution of oil were disrupted, then that might make a bigger contribution. But we saw, even in the Russian case, that was not worth, in my judgment, draining the strategic petroleum reserve, which Joe Biden did. As you know, Europe pivoted, and the Gulf pivoted, and the sources of both oil and gas quickly replumbed their distribution to benefit Europe after that invasion. So I think that was a premature decision by Joe Biden.
Congressman, there also are some strategic questions that Congress has to face, including how to prepare the United States better and, frankly, restock some of the munitions that are being depleted. There's a $50 billion bill currently in your hands, in your House, and I'm just wondering, would you support an additional funding measure to try to help stockpile some additional supplies should this be a prolonged conflict, and if there are any additional conflicts in the future?
Well, there was a significant work on that in the big, beautiful bill last summer. There was $9 billion allocated to the Pentagon to specifically work on the munitions supply chain. We've certainly seen that taken to action in Arkansas, in Camden, Arkansas, where we've seen a significant increase in munitions and rocket engine production because of the Pentagon's focus on supply chain. Plus, yesterday, we just marked up in the House Financial Services Committee the reauthorization and modernization of the Defense Production Act, which specifically focused on, obviously, DoD production, but also the medical supply chain and the critical mineral supply chain. And we think that's a good bill. It came out of committee 41-0, so it's a strong bipartisan bill, and we're working with the administration on that. But both the Armed Services Committees and the Defense Production Act, the Treasury, are all working on that munitions supply chain. But with all that said, and the money that we've already set aside in the big, beautiful bill, I think if military operations continue in the Gulf, I think the Congress will be confronted with a supplemental appropriation to support that effort.
Congressman, you are the chair of the House Financial Services Committee, of course. Now would be a good time to hear from Chairman Powell. Are there any plans to have that semi-annual testimony anytime soon?
You bet. We have invited him. We're trying to find a date and coordinate that date with the Senate Banking Committee because we typically do those hearings back to back, so I hope that can happen soon.
Are you hopeful that happens this month?
I hope it happens soon.
I'll leave it there. Congressman, thank you. The Republican Congressman French Hill there, hoping that happens soon. We're still waiting.
Yeah, we're still waiting to understand exactly when that Hawkins testimony really comes to pass. And a real question around what kind of clout Fed Chair Jay Powell will have in discussing the rate path ahead when there are questions about who's going to replace him, or we know who,
sure,
maybe, when, and whether he will stay on.
Park the politics. Let's just get rid of the politics for a moment. There are serious things happening in financial markets right now, specifically private markets. There's a lot of institutions throwing shade at each other at the moment and a lot of confusion about what's happening. Clearly, redemptions are accelerating and certain companies are finding different ways to meet them. But I think there's a lot of questions to be asked of that whole industry at the moment that the chairman of the House Financial Service Committee and the chairman of the Federal Reserve needs to get across them pretty quickly.
How much stress do they need to see before they need to take action in some capacity, right? I mean, this is sort of the ultimate question. At what point are private credit stressors systemic? And this is something that people can't really answer right now because we don't have full transparency over the nodes of contagion, and private markets aren't totally isolated. They're also connected to public markets. They're also connected to the banking channels that have credit lines out to a lot of these private asset managers.
They've been a driving force of the U.S. economy for a number of years now. Are we seeing a tightening of financial conditions that we can't really see and have limited visibility on? And that's my question at the moment. Up next, we'll ask that question of the Fed Governor, Chris Waller, as Wall Street awaits fresh payrolls data and some reaction from this Fed on the disruption in the Middle East. Crude at multi-year highs. From New York, this is Bloomberg.
Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, only on Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade. Watch Bloomberg Tech. This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Bringing you the world's business and financial news whenever and wherever it happens. I'm Michael McKee at Mount Everest, and this is Bloomberg.
World's most powerful investors don't ring a bell. They quietly reshape entire industries. This is the money shaping the world. The Dealmaker Playbook, where power and billions of dollars change hands every day. From private equity and credit to venture capital and M&A, we bring you the inside scoop on the biggest deals and debates, plus exclusive conversations with finance's ultimate insiders. I'm Danny Berger, and this is Bloomberg Deals. Every week, only on Bloomberg Television.
Governor Chris Waller just moments away. Mike McKee dropping by to catch up with us as well. Looking forward to this conversation in just a moment. The price action at the moment looks like this and is shaping up as follows. 60 minutes out from a payrolls report, 2 minutes out from the opening bound. This session lows down by 0.6 on the S&P, on the Nasdaq down by 0.8. These moves dictated and at the mercy of what happens here. This move in crude, WTI and Brent new highs for the year, new highs for the session, 89.14 on Brent. WTI briefly through 86, 85.97. Crude's up by 6%. It's dragging yields higher for a fifth consecutive session on a 10-year maturity. Yields up across the curve this morning. 10s, Lisa, approaching 420.
Right now, the market is treating this as an inflationary impulse, leading to questions about how much the Fed can cut rates in the very near term, given the fact that we're already coming off an inflation level that is higher than that 2% target.
At the front end of the curve as well, yields higher by 5 basis points, 363 so far this morning. Let's get you some single names, some morning movers. Joining us now for more, Yahira. Hey, Yahira.
Hi, John. Given your oil market check, it is no surprise we are seeing the U.S. oil majors gaining this morning. Both Chevron and Exxon up 1.6%, and the small driller out of West Texas, Battalion, up 33% as they track this spike in oil prices. And it seems like investors have started to price in more risk due to headlines overnight, including this one from Qatar's energy minister issuing a stark warning, predicting that all Gulf energy exporters would shut down production within weeks if this conflict continues. Moving on to the chip makers, both NVIDIA and AMD lower in the pre-market on our reporting that the U.S. could dramatically tighten its grip when it comes to AI chip exports. We're reporting that officials at the Commerce Department have drafted rules that would require companies to seek U.S. approval for any chips they ship outside the U.S. And we end on another chip maker having a better morning, and that is Marvell Technology. Shares are up 11.25% after it raised its outlook due to stronger than expected growth in its data center business. John?
Hey, Yahira, thank you. More from Yahira later this hour. On our radar this morning, maritime traffic in the Strait of Hormuz grinding to a near complete halt, with no crude shipments passing in the past 24 hours. The escalating conflict in the region prompting dozens of oil and gas tankers to stay within the Persian Gulf. Elsewhere, Qatar's energy minister warning that war could, quote, bring down the economies of the world. The minister telling the Financial Times all Gulf energy exporters could shut down production within weeks, driving crude to $150 a barrel. And crude is pushing higher as the Trump administration weighs options to curb the spike in oil and gas.
Yesterday, my administration announced decisive action to help keep down the oil prices, including offering political risk insurance for tankers transiting into the Gulf, as you know, pretty dangerous territory. Further action to reduce pressure on oil is imminent, and the oil seems to have pretty much stabilized.
No sign of stability this morning. Potential options include releasing crude from the Strategic Petroleum Reserve and waivers of fuel blending requirements.
Yeah, and we're expecting commentary at any point from Doug Burgum, the Secretary of the Interior, about what some of the processes could look like. A real question, though, around what's going to be effective enough to really justify the potential risks, and we hear that being played out. The idea that they could target oil futures, definitely getting a lot of pushback from people saying, really? You're going to try that? Well, I think you got a pretty big groundswell against you.
The U.S. Energy Secretary Chris Wright speaking to the American media at the moment, I'll keep bringing these headlines, ultimately saying that this could last weeks and not months. That's the hope. But nobody really has any idea. And that's all connected to how things play out in the Middle East right now. And that's not just in U.S. hands. That's in Iranian hands and their neighbors' hands as well.
It's not just a question of weeks or months, though. And I think this is where it gets really interesting. Each day matters. This is what people keep talking about. It prolongs how long you can get some of the supply back on, and it creates a very big backlog. If it goes on for 3 weeks, that matters, whether it goes on for 4 weeks. And I think that that's what a lot of analysts are talking about.
Let's keep it on energy. Rising crude adding to inflation fears, potentially for the Federal Reserve. Retail gasoline prices in the United States reaching their highest levels in 18 months. The surge in energy costs coming ahead of fresh reads on the economy, with payrolls data due at 8:30 Eastern Time. Joining us around the table, I'm pleased to say, here in New York, the Fed Governor, Chris Waller. Governor Waller, good to see you, sir.
It's good to see you all again.
When we planned this, I thought you'd come in and talk about the labour market, but something else has taken over. What's your assessment of developments in the Middle East and ultimately what it means for you and the committee?
Yeah, I mean, I guess that's exactly the thing, is what you're going to see is you're going to see a spike in gasoline prices. That's what the American citizens are going to see when they go to the pump, and they're going to stare at it and be a little shocked in terms of how things go. But for us, thinking about policy going forward, this is unlikely to cause sustained inflation. This is one reason we don't look at energy prices when we look at core. Core is a better predictor of future inflation. You're going to see this, but once these kind of supply chain issues that you laid out, Lisa, once they unravel, this will start coming back down. So it's kind of very odd to think about the Fed maybe changing rates 6 months from now based on this. If it's unwound in like as you said, Jonathan, in a couple of weeks or even 2 months, it's not going to be a big factor down the road. So this is why we never look at energy prices. They bounce up, they come back down. It's not that it's something that we don't feel sympathy for people that that's what they have to pay when they put the gas in their cars. But for us, thinking about the longer term in terms of policy, this is something we're just going to have to kind of put off for now.
When does it become something bigger, if at all?
It becomes bigger if it becomes more permanent, because then what's going to happen, you're going to see this jump in prices. Then it'll start bleeding through to other parts of the economy. Energy is a big part. It feeds into everything else. And then somehow those energy costs get passed along like everything else. So that's what you're more worried about.
Economists on any given day, Lisa, Mike, myself, and they'll talk about the experience of the 70s and coming out of the pandemic. And they'll say things like that officials of the Federal Reserve are somewhat conditioned, scarred by some of that. Is that your experience of things?
Well, in the 70s, remember, we didn't just have one. We had massive oil shocks. If you take 73, the price of oil quadrupled overnight. It went from $4 a barrel to $12 a barrel. Or went from 3 to whatever the numbers were. And that was a shock, and it never came back down. And then there was another one. Every time you turned around, there was another oil shock. Then Iran, oil embargo in 79. So that was kind of the problem with the oil shocks. They just kept coming and coming and coming. So it's not clear this will be one shock after another after another. So that's why I'm more willing to say this is, I hate to say it, but more like a one-off event than what we saw in the 1970s.
Well, as Rosanna Dana used to say, it's always something. Because if it's not just the oil shocks, it's the whole idea now we're going to have a whole new round of tariffs coming through the economy. And we've got this low-hire economy. How long do you think that continues? Or does this just push out the time period for companies to sit on their hands, not invest because they don't know what's going to happen?
Yeah, I mean, this is one of the things I've been concerned about since last June, is how weak the labor market has been. There were a lot of factors last summer that were driving this kind of low hire, low fire. It looked like maybe in January we might be turning a corner. We'll find out today whether that was, as I said last week, signal or noise. But, you know, when you're in this world in which the labor market, even with 130,000 jobs, it was really concentrated in a couple of sectors. 80% of the economy, the labor market wasn't doing anything. It was zero to negative. So that kind of fragility wouldn't take much for some sort of a serious shock to sort of start pushing people in another direction. Whether this is that kind of shock or not, we'll start finding out.
Yeah, it's early because, of course, these are going to be January numbers. Yeah. But you've been on record as saying you'd like to cut more because you're still worried about where the labor market is. What would it take to get you to back off on that feeling? Because if we get the same sort of numbers we had in December, it still shows very narrow breadth of hiring, and it still shows some reasonably good numbers for hiring.
Yeah, even with the January report, like I said, it was all concentrated in a couple of sectors. So that was good. They were robust. We got a big number, well above everybody's estimate of break even. But the concentration didn't give me a lot of comfort that the economy as a whole was doing really well. So that's where, my brain is telling me the number was good, the economy looks okay, it was above break even, but my guts are telling me it may not be that good. And that's where I'm waiting to see what today's number is. I'm almost certain it's going to get revised down, because this has been a pattern in January the last few years. Lisa?
Can we pair these two ideas? The idea of the oil shock that's creating some concerns about inflation, and then a labor market that kind of is in question, right? Is it decelerating or is it reaccelerating? How much has your reaction changed potentially to today's report, given the fact that we do see energy prices pushing on inflation? In other words, would you be less inclined to cut rates if there is strength that's demonstrated in the labor market today?
Yeah, that's kind of what I was hinting at last week, that if we get another solid jobs report, then last month, this month, looks like the labor market's turning around. A lot of the downside risk I've been worried about for 6 months is kind of going away. We're going to get a hot PCE number, given what we already have seen coming in. That's going to probably print, from everything I've seen, about a 0.4. Okay, usually that comes down again. We've had this January effect. We have some more pass-throughs of tariffs. But because the inflation's hot, it's going to look even worse now with the oil prices, at least on headline. And then if you get a solid job number, it does say you can sit there and wait.
Let's say the counterfactual. Let's say we don't get a good print. Let's say we see the weakness that you see right now when you talk to people in your district and beyond, or that you speak to in the different districts as well as beyond. How much do you think the Fed should react to this? Because it's sort of the dual mandate is in conflict in absolutely the wrong way.
Yeah, I mean, that's the tension we've had for the last years. I've been more worried about the labor market risk, the inflation risk. I've always believed inflation was going to come back down once tariff effects pass through. My other colleagues on the committee are much more concerned about the inflation. It's been high for 5 years. They're not seeing it coming down, and they think the labor market is all stabilized. It's all supply side. So these are the two different views that people have about thinking about policy. And I was more willing to cut rates because I was more worried about the labor market, not as worried about inflation coming down. But like I said, if the labor market continues to go weak, if this thing comes in, I mean, ADP was promising the other day. So if the labor market is good, inflation's hotter than we think, it's fine to kind of wait another meeting and kind of see. But if we get a bad number, or January's revised down to some really low number, like ADP got revised in half, the labor market's just not that good. And so the question is, why are you just sitting on your hands? So I could certainly see this meeting going other way, depending on how the data this week and the CPI next week comes in.
I hate to be the one to ask this question, but what's a good report? Because at 8:30 Eastern Time, we'll all be asking that question of ourselves. What's good to you? What does good look like?
Well, I think good would be if you saw another number like January. That would be really good, because you're well above everybody's break-even estimates at that point. And that'd be 2 in a row. Looks like it's going through. We got very good numbers off the ISM manufacturing and services this week. That's another indication that maybe things are turning around. So if that's the case, I'm starting to see less downside risk. Now, on the tariff stuff, I still have a view that all the tariff risk is to the downside. I just don't see big increases in tariffs spread all over the place. If anything, they're going to come down. Estimates of this are coming down. Deals are going to potentially get made. So I don't see a lot of tariff risk going, even though there's more uncertainty, there's always the uncertainty. I don't see a lot of price pressures from what we think could happen going forward. So that's going to bring, I think that's going to bring inflation down or take pressure off. And it'll take some of the uncertainty off at some point.
Well, it becomes a question of what problem are you trying to solve and what tool are you using to do it? How would cutting rates by 25 or 50 basis points help the labor market if companies are sitting on their hands because they're still waiting for tariff news and we've got a war going on?
Yeah, I mean, we can always say, we can't do anything, just sit there. That's not my job. My job is to try to help the economy and achieve our dual mandate. And if the labor market's not looking good, then I have to make this trade-off.
But does it make a difference to the CEOs?
Well, maybe not. I mean, that's what I'm saying. We could argue about whether monetary policy has any effect in general on the labor market. There's, you know, you go back in economics back to the 80s and 90s, there's a whole camp of people that said monetary policy is completely irrelevant for the economy. So quit wasting your time.
You're opening up a very different conversation.
Yeah, that's a whole different.
We could spend a long time on. I wanted to squeeze this in. I actually think it's one of the more important topics at the moment. We're not seeing a tightening of financial conditions, a material one, in public markets. I don't see that in stocks. I don't see that in bond yields. I'm wondering what on earth you see in private markets. Because every day there's another headline about another fund, another company struggling to meet redemptions. What is the Federal Reserve assessment of what is happening? Because that has powered this economy. Some people might say in a bigger way than the Federal Reserve, or for that matter, public markets have. What is going on?
Well, there's a couple things. I mean, in general, I don't see really big widespread problems in the private credit market. What you're seeing is a couple cases of certainly fraud. Is that fraud widespread? I don't, you know. It's hard to believe that the entire private credit market is being driven by fraud or bubble posting of collateral. So these are kind of these one-off things that get a lot of headlines, but it's not clear it's systemic. You have to kind of look at whether there are a lot of, you know, there's different types of private credit. There's stuff that's in high yield, you know, risky junk bond stuff, and there's other stuff that's better quality in terms of what they're funding. So I don't think as a whole the private credit market is in any serious trouble, but you're going to have these things popping up here and there. But I don't think there's enough of it that's going to somehow drive down financial markets and create any kind of financial stability problems.
Governor, it's good to see you. Thanks for making time for us.
Great to see you all.
Thank you, sir. Longer conversation about your role in the future. Looking forward to that. Governor, thank you. Federal Reserve Governor Chris Waller there on the economy, the shock in the Middle East, and on markets too. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahara with more. Hey, Yahara.
Hi, John. President Trump saying he needs to be personally involved in picking Iran's next leader. Trump reiterated that Mojtaba Khamenei, the son of the former supreme leader, is not an acceptable choice, despite him being presented as a front runner. Trump also encouraged Iranian Kurdish forces to go on the offensive. In the meantime, shipping giants are suspending container services around the Persian Gulf as the Iran war presses on. Maersk is cutting 2 of its key services that connect the Middle East to East Asia and Europe, while Hapag-Lloyd also said it had suspended several services as trade flows face major disruptions. And Liberty Media, Formula One, has seen $1.9 billion wiped off its market value since the Iran war began due to concerns about its races in the Middle East. The new F1 season begins this weekend in Melbourne, Australia, but uncertainty now surrounds 2 races next month that are planned in Bahrain and Saudi Arabia. That's your Bloomberg Brief. John.
Yeah, Harry, thank you. I woke up this morning and realized what I should have known already. I've got to buy another bloody subscription. And this time it's Apple to watch Formula One.
I'm so sorry.
Do you know how many I've got now?
Yeah.
Just to watch the different. I know you follow the football too. Yeah. You need Peacock.
I know.
You need Apple.
I love this.
You need Paramount.
Yeah. Well, no, he doesn't.
What, the end of the
do it,
season?
though.
Is that what you do?
It doesn't
and
work.
Then sign up again.
That's my daughter's
message to Apple and say, stop raising the prices because it's inflationary.
It's inflation.
Could you do that on our behalf?
Sure.
Thank you, Governor. We appreciate
But you know
that.
the best way to get those prices to come back down is cancel when you're done.
I just want to watch the sport, and then I forget. And then they just like...
That's what they count on.
Exactly. That's the model. That's where behavioral economics has some play.
I'm a victim of it all. Up next on the program, Europe's energy crunch.
If we are to have an increase of energy prices by 10%, inflation would go up.
The duration of the war is the main driver of the inflation outlook.
Up next, we'll catch up with the EU Energy Commissioner, Dan Jorgensen from New York. You're watching Bloomberg TV.
phone is, what's great about it is it's a well-developed gaming ecosystem, right? So, folks know to find games there, but it's also a highly competitive gaming ecosystem. So it's developed, this gives you both that upside and that downside. But what's exciting is that now we are moving beyond the phone to the TV. So I mentioned like one of the big gaming areas we're going after. One of the big gaming areas we're going after now is, social gaming experiences that will show up on your TV. So we are now announcing, we're going to announce here actually, that we're going to have these social party games that you can play on your TV with your phone as the controller. And it's things like, recognizable games like Boggle, you got Pictionary, we've got a Lego party game. We, basically are going to like unleash this with a bunch of creators, and they're going to go figure out stuff that we didn't even imagine that they can do with that interactivity.
Welcome to Bloomberg This Weekend. I'm David Burrow.
I'm Lisa Mateo.
And I'm Christina Raffini. We're tracking breaking news today from Wall Street to Washington.
Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Haslinda Amin in Davos, Switzerland, and this is Bloomberg.
Once again, stocks at session lows, crude near session highs. Equities right now negative 0.7 on the S&P, down by 0.9 on the Nasdaq. Crude shaping up as follows. Brent and WTI. Brent approaching 90, 89.40 this morning. Call it 89.30. Under surveillance this morning, Europe's energy crunch.
If we are to have an increase of energy prices by 10%, and that stays for some time, inflation would go up by 40 basis points.
The duration of the war is the main driver of the inflation outlook. We see a lot on the energy price front, and now it's the question, how is that maybe spilling over to the rest of the economy?
So here's the latest this morning. The war in the Middle East sending energy costs surging across the globe. The price of crude sitting at a multi-year high, while European natural gas is set for its biggest weekly gain since the energy crisis of 2022. Joining us now is the European Energy Commissioner, Dan Jorgensen. Commissioner, welcome to the programme, sir. What's your assessment of the disruption to supply to Europe over the past few days?
Well, first of all, it's important to say that it's not actually so much the disruption of supply that creates problems, because, first of all, we don't get any oil or gas from Iran directly, and we get some limited amounts of gas from the Gulf region overall. But that's not, it's not nothing, but it's not the big problem. The big problem is the effects on the global markets. And of course, those effects on the global markets also hits consumers in Europe, especially on oil and on LNG.
So, Commissioner, do you see a reason to try to step in and stave off some of the increases in price, or do you think that this will right-size itself because ultimately the EU isn't as dependent on Iran and sort of some of the regional supplies?
So I saw earlier that you compared this crisis to the crisis in 22 when Russia started its full-scale invasion in Ukraine, and I understand why, because this is the worst crisis we've had since. But it's also important to say that we are not close to the level of crisis that we have in 22. The prices are higher, yes, but not close to as high as they were there. So that's number one. Number two, we are also much better situated to dealing with these price increases. We have a more diversified energy system, meaning that, for instance, on gas, we get the gas from more different sources. So our number one source is Norway. Number two is the US. few years back, that used to be Russia. Now we've said we want to stop the import from Russia for obvious reasons. So this diversification puts us in a better place. Also, we've reduced our consumption of gas, and we're deploying more renewables every year. This means that we get cheaper energy. It means that we get homegrown energy. And it, of course, also means that we are in better control of our own destiny in these areas than we were before. But we are still exposed to the global markets, so we don't take it lightly.
Commissioner, have you had any conversations with Chris Wright over in the United States about potentially increasing liquefied natural gas exports to Europe in order to stave off any output from Qatar that is interrupted?
Yes, we have a continuous dialogue across the Atlantic, both with the American administration, but also, of course, with the companies and with the sector. And we have to be thankful that American companies have been able to supply us with LNG that we've needed because we have decided to ban the import of Russian gas. We needed, of course, to ban this import because we didn't want to continue to indirectly help finance Putin's war, and of course also Putin has weaponized energy against us, and we could not accept that. So we needed other sources, and here the American gas has been very welcome. And the projections, also because of the political talks that we've had and what we've done to facilitate it, the projections are that that will also increase in the future.
Commissioner, on Russian crude, the Treasury Department, as you know, I'm sure you saw the news, issued a temporary waiver to the Indian refiners to purchase Russian crude. What's your reaction to that, given what you just said?
For us, it's very clear. We do not wish to buy Russian energy. We have got a combination of sanctions and also...
Are you disappointed that the Americans are allowing the Indians to buy that crude?
That's not up for me to comment on. I can definitely say what we want in the European Union is to hit Russia as hard as possible on their incomes from energy. Russia, they're conducting a terrible, brutal war in Ukraine right now. We're talking about energy. What they do, for instance, is that they target the energy infrastructure of Ukraine, leaving the Ukrainians to freeze without electricity in a very, very cold winter. And then when the Ukrainians send people to repair what's been destroyed, they bomb and kill those people also. So for us, this is a very serious matter, and we want to stop our imports completely, and we hope that others will do the same and follow this example.
Commissioner, appreciate your time. The EU Energy Commissioner, Dan Jorgensen, there on the situation. Shocking that the Europeans are still purchasing any Russian energy whatsoever.
Yeah, a question here about what the interchange will be between the U.S. and Europe on this.
Up next on the programme, we'll catch up with Nadia Lovell of UBS, Mike Collins of PGIM, Stephanie Roth of Wolfe Research, Jeff Rosenberg of BlackRock. Next hour, the payrolls report, the jobs report, 34 minutes away.
Tariffs, I think, are probably the first time in my career I've had to deal with like a fundamental change in government policy in terms of how we think about how markets work.
The challenge, especially within my supply chain, is now how do you have enough productivity initiatives to offset the increased cost of all the product?
Can you just move your supply chain out of China and into the U.S. or out of Mexico and up to Canada? Is it that easy?
It's not that easy, but we do have flexibility. And we had been, prior to tariffs, prior to any of this, we had been on a journey to diversify our footprint out of China. So probably 2-ish years ago, roughly 65% of our toy and game volume was coming from China. Today, as we entered into 2025, that was around 50%. All we've done is really accelerate the path to get down to roughly, call it 30% by the time we enter into 2027. For us, I mean, if tariffs stay, if tariffs go, it's never good to have so much of your manufacturing base centered on one geography. We think the diversification is good, but it does take a bit of time to get vendors and suppliers up to speed. Quality is a big deal, especially when you're dealing with toys and kids. It's not an instantaneous thing, but it's not also a 5-year, have to build a new plant from scratch.
The
Trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe.
Let's talk about the significant risk transfers to find space in their balance sheet.
Hedging some of that risk. You could look at it the other way. Obviously, this stuff is risk-weighted.
I would much rather be long than be short.
We're in a kind of sweet spot.
Very, very strong alignment.
3 revolutions in one.
I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie.
This is your opening trade.
Every trading day, only on Bloomberg.
I'm Alex Rodriguez.
And I'm Jason Kelly.
And we're back with another season of The Deal.
With athletes and entrepreneurs who are changing the game on and off the field. Jerry Jones. Some good-looking trophies.
1-1 is 3 in sports, not 2. And it's because that 3 is imagination. That 3 is putting yourself in a way, having yourself hit the home run.
Erica Ayers-Badon.
I'm a high-energy board member. I'm very passionate. I have a lot of opinions.
Robin Arzón.
I want to light fires in people's lives, and that is still one of my core mandates for all of my businesses.
Justin Tuck.
I tell all of my friends that play in leagues now, make these relationships now while you're hot. Don't wait till you're like your 12th year in and you're just hanging on.
Stay tuned. You won't want to miss it.
Know how the market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romaine Bostic, and this is The Close.
Live every weekday.
Only on Bloomberg. Context changes everything.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
The sentiment clearly is anxiety-ridden.
We didn't call for some of the geopolitical risks that we're seeing, but we expected it to start to increase.
There is a risk that this goes on for longer than what people are pricing in today.
The picture right now is more nuanced, and we're advocating for hedges.
When we look out over the next 2 to 4 to 6 months, we think stocks look very good.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Big hour coming up. The payrolls report 30 minutes away. Live from New York City this morning. Good morning, good morning. For our audience worldwide, the third hour of Bloomberg Surveillance starts right now. Your price action and scores look like this. Session lows on the S&P, negative by around 0.6%, down by about 0.8% on the NASDAQ. Close to session highs in the commodity market on crude, WTI, and on Brent. Brent crude earlier in the session, we crossed through 88 and had a little look at 90.
Markets are forward-looking instruments, and when you're in the oil market, that is a very high task right now. Always is, as you pointed out, John, but a real question about how you price in oil that potentially could be up to $130, $150 a barrel in the next 3, 4, 5 weeks. Should this be prolonged, how do you price that in while searching for an off-ramp, searching to understand what the goals are, and searching for who even the leadership is in Iran to negotiate? It is a difficult thing to get any clarity on, and that's what we are all operating in right now.
Very vague talk about how you offset this, the Treasury trading energy futures, maybe doing something with some kind of insurance framework, supporting vessels as they go through the Strait of Hormuz. The fact of the matter is traffic through the Strait right now is basically at zero, and that's what this market is responding to.
And frankly, all of those sort of band-aids that people are talking about, whether it's energy futures, whether it's the SPR, or whether it's insurance, are thought of as just that, band-aids. And frankly, the market isn't taking that all that seriously in terms of a true off-ramp. The only thing that actually will create a sense of confidence will be if the military action stops and if oil starts traveling again. And until that continues, there are big questions about the ramifications for the underlying economy.
The good news so far is the underlying economy is okay. The data so far this week has been fairly decent. That's the question mark at 8:30 Eastern Time. Do we get a repeat with the payrolls report? The estimate in our survey here at Bloomberg, 55K. The previous number, a very strong 130. The good news for risk is that the good data has been good.
And that's the reason why there is an asymmetry right now in markets. If you get data that isn't good, and people are saying that that would be a rise in the unemployment rate, let alone a headline figure that came in below that 55,000 mark. If you do get a bad number, whatever you define that as, that could be a really negative impulse for risk assets, considering that that is what everyone keeps pointing to. As long as this gets taken off the table, get out of our way, and this economy will keep booming, that works. As long as this economy still has that momentum.
We caught up with Governor Waller about 30 minutes ago, and the governor of the Federal Reserve made the point that, yes, once again, it's a coin flip as to whether they cut interest rates or at least whether he votes for an interest rate cut at the next meeting. What's a good number for him that pushes this one way or the other? He said a repeat of last month. So something around 100K, I guess, would get him to say, you know what? No change.
It's a pretty high bar, and I think other people might define it differently. What he also pointed to, and this is something that a lot of economists are looking for, the downward revisions. He is expecting a downward revision to January's 130,000. What does that look like? If you do get a downward revision that is significant, does that reshape the entire landscape? Or on the converse, if you don't, and you do get a solid number, how much do people say, look, we got some juice left in this economy to withstand whatever shock you want to throw at it?
Fantastic lineup of guests over the next few hours right here on Bloomberg TV. Later on this morning, around 9:30 Eastern Time, we'll catch up with the National Economic Council Director, Kevin Hassett. Look out for that reaction from the White House to the payrolls report that drops in 26 minutes' time. Coming up this hour, we'll catch up with Nadia Lovell of UBS as crude hits multi-year highs. Mike Collins of PGIM Fixed Income on finding opportunity in geopolitical risk, and Stephanie Roth of Wolfe Research predicting a soft jobs report. We begin this hour with stocks heading lower as crude hits new heights. Nadia Lovell of UBS writing, markets may be volatile in the short term, but we emphasize the importance of letting diversification, not policy bets, do the heavy lifting. Nadia joins us now for more. Nadia, good morning.
Good morning.
There was a bet on global equities, a bet on a good economy, and a bet on accommodative monetary policy. Does the shock of the last week upend some of that for you?
A little bit in the near term, but again, not over the medium to longer term. And so we do think that markets will remain volatile, but we want to remain focused on the underlying growth impulse, which still remains intact. I mean, we've seen it in the macro data. But of course, we recognize as if oil prices continue to move high, it's hard for investors to step in this environment. So you could see near term a cap on where the market goes. I think also heading into the weekend, it is difficult for the market to hold risk, and that's why you probably see the market weak ahead of payrolls. Even if you get a strong payrolls number, I question whether you will see a rally in the market because we're not sure what's going to happen over the weekend. You know, history has told us over the last year that things tends to happen over the weekend that can cause volatility in the market on Monday. So you might see the market sort of waiting to the hold and see pattern until they get a little bit more clarity on the situation.
You had positive views on Europe, on Japan, on China. Both are very exposed to this situation. Both are big energy importers. Have you changed those views?
We have not changed those views, but we recognize that the risk that higher energy prices have to these areas of the market that are importers, right? And their economic growth will be sensitive to that. But again, assuming that this gets wrapped up in the next couple of weeks, and I understand that that is a tall order and there's a lot of uncertainty around that. We think that these markets are still positioned to do well. I mean, I'll take, for example, this past week, we did upgrade a market like South Korea. Why? You know, the market was down significantly because of what's going on in the Middle East and concerns around oil imports and the increase that we're seeing in oil prices. But the core of the story in South Korea is really around memory. That hasn't changed fundamentally. So this is an opportunity. So my point is, what we're looking for is for massive dislocation in the market that also could be a buying opportunity, recognizing that near-term volatility can continue. But if you're looking out, 3 to 6 months to a year from now, that might not be a bad entry point for some of those markets.
So in the surveillance war room, John and I have a huge calendar, and we are checking the boxes of when it's okay and then when it's not okay for this conflict to keep going. And we use this red marker to circle that date. And we can't really decide where to put it because everyone seems to have a different place where they're putting it. At what point in the calendar do you end up saying, I got to reset? I got to rethink some of my assumptions, and maybe some of these markets that previously looked positive are going to be structurally challenged by this oil embargo, by this oil seizure in terms of inability to transport in the seas.
Yes, I think if this continues for another 1 to 2 weeks, then you're probably in that scenario. Now, remember, Russia-Ukraine, where you saw that the market was concerned about 3 million barrels a day potentially getting disrupted, and oil prices spike to almost 130 Brent. If we're sort of in that situation, then this situation will be worse because we know that we're kind of frozen in the Strait of Hormuz right now, and it's a matter of, it's not about insurance, right? It's about safety and passing through the strait. And so if there isn't an unlocking of that blockage in the next couple of weeks, you could see oil prices spike, and then it's hard for people to step into risk at that. It becomes even harder to step into risk at that point.
1 to 2 weeks is a pretty short timeline.
It is a short timeline.
Yeah, we're talking about something that seems to be very close, especially given the lack of an off-ramp right now. How much downside could there be in markets right now? Should we have the other pillar of bullish sentiment fall away, which is that the economy otherwise is pretty good?
Yeah, so you have the supply shock, and so markets are likely going to trade off on that. You know, you're going to have that knee-jerk reaction. You could see markets down, you know, 5 or 10% from here just in the next few weeks if you do see the spike to oil, you know, above $100 and approaching $130. But again, I think it goes back to, like, what does this mean for the fundamental outlook for the economy? Now, if by the time you get to April that you can have some unlocking of that, then it shouldn't be too disruptive to the overall economic growth pictures. You still have consumer stimulus that's coming through. You still have inflation that I wouldn't say that it takes about 3 months, right, for oil prices, sustained oil prices, for that to really pass through to inflation. So inflation should be well behaved by the time we get in the back half of the year. You have a Fed that's also on standby if this becomes too disruptive to the economy. So again, it's about taking that longer term view in the back half of the year, but recognizing that near term that you could be in for some volatile markets.
Everybody is caught so offside. Think about the consensus trades. The consensus trades that were really building up. Get long international equities, reduce your exposure to tech, get long the cyclicals, short the US dollar, and that has all flipped in the last week.
If you ask somebody at the beginning of the year, what's the pain trade? They would say a strong dollar, because everyone was expecting a weak dollar and a move away from dollar-denominated assets. Just overall, guess what? We just got a rip-roaring rally in the dollar, and guess what? A rip-roaring face-off in terms of people who have been following the trends, and all of those trend-following funds are facing some interesting moments.
And a change in the way that people look at the US equity market. Tech was a source of risk. Now it's a pillar of support. Is that the story for you?
So tech, we downgraded tech to a neutral a few weeks ago, and we still think that the risk reward is balanced in tech. And again, it's not a negative view. It's be more selective within tech. And so it's tech, you're seeing software getting a bit of a relief rally now because valuation has come in. We question the sustainability of that, just given the overall still concerns of that are there around AI disruption risk. Right now, the market is focused on what happened in Iran, but I think in a few weeks, once this subsides, then those old risks will start to come back to the forefront of it. So you still want to remain balanced. What we've been talking to our clients about this year is really managing concentrated position. And when we look on our clients' books, a lot of it is in tech. So we're not necessarily saying add more to tech right now. We're saying also use the opportunity to right-size those positions and really add diversification across the portfolio.
We caught up with Jonathan Krinsky of BTIG just yesterday. He's written extensively about the need for semis to hold in there, that you need semis to hold in there for this index to hold up. Just a bit of weakness coming in yesterday, even with decent numbers out of Broadcom.
Which is why we subsequently got a note from Jonathan Krinsky saying, I don't know, this is looking a little more sketchy. Again, this is moving so quickly, and a question about the underlying hit to the U.S. economy really depends on the calendar, which is an unknown.
Nadia, it's good to see you. Thanks for being here. Nadia Lovell there of UBS. Nadia's point on going into the weekend, I think, is such an important one. It might sound unsophisticated, but ultimately it's real. It's how people think about going into the weekend right now, facing the risk of this escalating even more, and a reluctance to get long even if you get a good jobs number in 20 minutes' time.
We are conditioned by our circumstance, considering that every weekend is not a weekend, and it hasn't been for this year, which is why it feels so long. But it really, right now, we're dealing with people who have been burned every single weekend with some news headline that completely upends their assumptions. So why would anyone want to take any risk?
There's a human aspect to this. People are exhausted in this market. It's the longest first quarter ever. We've only just started March.
Yeah.
And this is how we started it.
And they've gotten their hands slapped many times when they try to get any conviction on anything. So why would you have strong positioning given that backdrop?
Let's get you an update on stories worldwide with your Bloomberg Brief. Yahara has more. Hey, Yahara.
Hi, John. The latest out of Iran. Iran fired a barrage of missiles and drones targeting countries across the Persian Gulf overnight, including Saudi Arabia, Kuwait, and Bahrain. Meanwhile, Israel renewed its own airstrikes, hitting Tehran and Beirut. Fears of a protracted war around the strategic Strait of Hormuz are roiling markets, with crude headed for its biggest weekly surge since 2022. In the meantime, the White House is ruling out using the Treasury Department to trade oil futures for now, as it considers a range of options to ease the surge in oil prices. According to a person familiar, the administration thinks the Treasury Department's ability to affect the market is limited. The White House is also wary of tapping the Strategic Petroleum Reserve right away. And President Trump has fired DHS Secretary Kristi Noem in the first shakeup of his second-term cabinet to date. Noem had recently come under fire from lawmakers over deadly immigration operations in Minneapolis that saw 2 U.S. citizens killed, as well as high-budget ad campaigns for the DHS that she commissioned. Trump announcing that Oklahoma Senator Markwayne Mullin will succeed her in that role. That's your brief, John.
Yahara, thank you. Have you seen the commercial?
Yes, I have.
It is so high-end, the production value of that commercial.
I was thinking the same thing.
I can only imagine how much that cost. I've heard hundreds of millions.
Well,
not just tens of millions.
Yeah, the whole campaign cost $220 million. And the message, she said, was very well received. She talked about the impressions, but I believe that the production company was 8 days old when it won
My goodness.
the more than $100 million contract.
What kind of waste you'd expect from the Harris campaign for the presidency, right? It's kind of scary how quickly these government members can spend this kind of money.
It is pretty remarkable. It also is remarkable what gets someone over the line in terms of getting into the firing line, what it takes, what the bar is to get someone to potentially
Forgive the
have a
shade
shakeup.
thrown at the Harris campaign there. It just reminded me of that kind of wasteful expense, you know?
Yeah,
Anyway.
I understand.
All right. Up next on the programme, the Morning Calls Plus, Michael Collins repeating fixed income as we count you down to the payrolls report. That report, 16 minutes away from New York City this morning. Good morning.
Is going to be the consequence for U.S. markets?
We are seeing modest gains across European equity markets.
Take a look at how we're faring when it comes to Asian markets.
I'm David Weston. Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. We go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
We need more transparency. Oil and gas is still important.
They said every citizen should be investing in the market.
Accelerate progress in all fields of science.
Watch Wall Street Week right here on Bloomberg. More than what you need to know, it's what you need to think about.
Asia is at the forefront of some of the world's biggest stories.
And we're here, where the action starts in Sydney.
And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays only on Bloomberg.
Because the inflation's hot, it's going to look even worse now with the oil prices, at least on headline. And then if you get a solid job number, it does say you can sit there and wait. For us, thinking about the longer term in terms of policy, this is something we're just going to have to kind of put off for now. It's not clear this will be one shock after another after another.
That was the Fed Governor Chris Waller on the shock coming out of the Middle East in anticipation of what we might see in a payrolls report 13 minutes away. Going into that jobs report, equity futures declining by 0.6% on the S&P, down by 0.8 on the Nasdaq. In the commodity market, quick update on what's happening in commodities right now for Brent and for WTI. Brent just off session highs, but still up by 4%, and WTI just short of 86 at 85.83. Let's get you some morning calls. That's the price section. First up, Barclays upgrading Maersk to equal weight, saying the Red Sea reopening is unlikely in the short term, keeping freight rates elevated. Elsewhere, Piper Sandler upgrading defense company Carmen to overweight, saying the war in Iran is serving as the latest funding-driven initiative. And finally, JP Morgan upgrading Dow to overweight, citing inflationary pressures in the energy sector and shipment restrictions across the Middle East. Dow is up in a pre-market by 3.8%, and that's kind of the inflationary story we're all keeping on top of at the moment.
Yeah, and how much do some of these companies have the pricing power to actually pass that through to customers? Well, there's some price inelastic customers looking for materials right now, so this actually might be a real boon for the companies doing the providing.
Do you think there's some tech spending?
I am thinking of some tech spending.
$650 billion of CapEx.
A lot of money to go around. You can spare an extra few dollars. I think I've got some spare coins.
We do a whip around, Alan Blackstone.
Let's do a whip around and see. I can come up with some spare metal if you can give me a couple $100 million.
8:30 Eastern Time, the jobs report is 12 minutes away. Mike Collins of PGM Fixed Income writing, while the Fed's hands may be tied for the next couple of quarters, the longer-term potential for much lower interest rates is not fully appreciated. Mike joins us now for more. Mike, welcome. You've got to build on that for me, buddy, because right now there's a threat to lower interest rates. Why do you think ultimately that's the direction of travel?
Yeah, certainly in the near term, Jonathan, as Governor Waller just said, you know, there's a lot of challenges for the FOMC to move the dial at all right now, right? It seems like the path of least resistance is for them to sit on their hands, to wait for the shakeout from this war in the Middle East to play out in terms of energy markets and inflation and the economic impact. But also, you know, looking at the jobs market, what is the trend there? Has it stabilized? We'll get more in a few minutes, obviously. But, you know, what the markets are pricing in is that the Fed cuts twice, basically for the rest of our lives, right? And gets the funds rate down into the low threes and keeps it there for a while and then eventually hikes it back up toward 4, right? I think that is the mispricing I'm talking about over the long term. I don't think the markets are really pricing in a scenario where you do have a decline in global economic activity. Maybe you have disinflation, right? Maybe this AI capital investment results in a productivity enhancement that creates disinflation, which is the playbook, right, for productivity. And that could allow the Fed to cut, you know, 200 basis points, not 25 basis points, right? Remember, you have a president, a Treasury secretary, and ultimately a new Fed chair in Kevin Warsh, who all want rates to be a lot lower, right, over the long term. So that's something that we're always kind of thinking about in terms of positioning our portfolios.
So, Mike, is that an argument for 10-year bond yields to be closer to 3 than they are to 4?
You know, I've been telling our clients, Jonathan, if you're kind of between 4 and 4.5 on the 10-year, that's kind of the buy zone. Anything above 4.5 is an overshoot. We've breached that a couple times in the last year or two, and it has been a buying opportunity. I think 3.5 to 4, at least for the next couple of years, feels like closer to fair value for me. Anything below 3.5, it means you're having that big slowdown or that big disinflationary event. But yeah, I mean, we're looking when bond yields back up into the kind of lower to mid 4s. We've been adding duration tactically generally. And I do think that is the right trade over the longer term. I know it's not working today, but over the longer term, and I know we've talked about this, Lisa, on this program before, I do think the hedging qualities of high quality fixed income, of having duration, will benefit your portfolios. It will work as a hedge in a real flight to quality, in a real risk off.
Michael, you talked about a couple of different scenarios for why rates would go down, and they have polar opposite ramifications for risk assets. One is a potential global slowdown that's significant. Another is increased productivity from artificial intelligence that allows growth to continue with a Federal Reserve chair that wants to cut rates at the same time that inflation is coming down. Which do you think is more probable? How do you position for risk?
Yeah, I mean, I think the most probable scenario, our base case, as we put it, Lisa, is that the Fed does what the markets are pricing in. And maybe they cut once or twice. They probably don't do anything for 3 or 6 months, and maybe worse can get a couple of cuts in over the next 12 months, and that seems like a reasonable scenario. But again, over the longer term, if you do have this productivity boost and you do have this disinflation reemerging, which I think is actually a reasonably high probability that the markets really aren't pricing in that much. I mean, obviously, if you look at the inflation rate that's priced in over the long term via TIPS markets and inflation swaps, it's been very sticky, right? Like 2.3%. I mean, the markets are not pricing in this runaway inflation. So the markets have been pretty sanguine on inflation, but what's not priced in is kind of, you know, a disinflationary trend. You've seen it in other places like in Europe, right? And obviously in China, they're fighting deflation, and I wouldn't discount that scenario, right? And you're looking at consumers. We'll get retail sales this morning as well, you know, who are strapped. I mean, 80% of consumers in this country and probably in the world are really strapped on spending their next discretionary dollar. And I think you're seeing more companies realize that and have the inability to pass through any higher prices and with regards to these tariffs. So that, I think, is something that could happen. We could have a one handle on inflation in a year from now. And wow, what would the Fed be doing then, right? Then they have two green lights. They have the job market green light and they have the inflation green light. And you can see the funds rate, you know, into the twos really quickly in that scenario.
But Mike, what does it do right now for, say, high yield bonds? The idea that we could be getting a Fed that's on hold, at least in the near term, because of the oil price shock at the same time that you see disinflation and a slowing down in the global economy. Is this a time to just get out of riskier assets altogether?
You know, spreads are fully valued, just like equities have become fully valued. And I think they probably leak a little bit wider, right? And we're positioned for that. We've been, as we've talked about on this program, for probably a couple of years now, Lisa. We're, you know, very defensively positioned in credit. We've been very careful in the private credit space, really scrutinizing these new deals and being very selective. And that is the right position to be in. And we have generally avoided a lot of these cockroaches, right? But add on the weakness. I mean, spreads generally right now are about 15% off their tights across investment grade corporates, high yield corporates, CDX indices. They're 15% wider, I'm sorry, off their recent tights. And that in the past, you know, couple of years has been a little bit of an opportunity to add. But I think the tendency is for these to continue to widen, and we would be adding on that weakness.
Mike, you've been careful. The market is everybody else. Has everybody else been careful?
You know, I think generally credit underwriting in the public markets, Jonathan, the gigantic investment grade and high yield corporate bond markets has been really good. You know, it's really these pockets of the levered loan market and the private markets that you're seeing some of the excesses. You've had a lot of new entrants, a lot of money chasing those markets. People have been asking me, Jonathan, for years now, what do you think about the private debt markets, right? And I say, well, in my 40 years of experience, whenever you have too much money chasing, you know, a limited opportunity, it creates problems. And we're certainly seeing that happen, right? I mean, you have to be really selective in that market and be careful who you invest in. And so you're going to have problems. What we're seeing now, to me, is just part and parcel of what happens when you have an imbalance in supply and demand.
Mike, it's good to see you, buddy. As always, Michael Collins there of PGIM Fixed Income, looking for one handles on inflation and yields gapping lower.
Yeah, and talking about the idea that the Fed will be cutting significantly more. I also love the point. Everyone just talks about these couple new entrants. This is kind of reminds me of 2010. Two guys in a Bloomberg are creating a new investment broker. It's sort of like right. Two guys in a,
it's not me.
You know, a spreadsheet or creating a private equity shop.
Everyone says, you know, we've been careful.
I know, so there you go.
Okay. Up next on the program, the jobs report, the estimate as follows, 55K, the previous number 130. Reaction from Stephanie Roth in just a moment.
Welcome to Bloomberg This Weekend. I'm David Burr.
I'm Lisa Mateo.
And I'm Christina Raffini. We're tracking breaking news today from Wall Street to Washington.
Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
The Middle East and Africa regions are home to some of the biggest deals and fastest growth in the world. Vibrant resources and high-yield investment opportunities abound. I'm Jumana Versace. Join me on Bloomberg Horizon's Middle East and Africa for the stories, newsmakers, and insights shaping the decisions of traders across this exciting region.
You had heightened levels of volatility.
There's still room to maneuver.
We do see opportunities.
It allows you to increase significantly your net income.
Every trading day, only on Bloomberg.
The open about 60 minutes away, the data seconds away, payrolls and retail sales in just a moment. Mike McKee will break that down for you. The scores look like this going into it. Equity futures on the S&P down by 0.5, on the Nasdaq negative 0.7. In the bond market, yields higher for 5 consecutive sessions going into this. A 10-year bond yield this morning up by 2 basis points, 4.16. And this move in crude dictating almost everything and every conversation we're having. WTI at 86, Brent at 89. With your jobs report, here's Mike McKee. Morning, Mike.
Well, Chris Waller is going to be having a heart attack now. 92,000 jobs lost during the month. Last month's 130,000 revised down to 126,000. Not a major revision down, but a loss of 92,000 jobs. Now, there is certainly going to be some weather involved in that, and we'll check on that in just a second. The total payroll revision over 2 months is minus 69,000. So you got to add those two things together. Change in private payrolls down 86,000. Manufacturing payrolls down 12,000. Average hourly earnings up 0.4%, puts the year over year at 3.8%. That's a tick higher than it was. Average weekly hours, 34.3, and the Labor Department says we'd see a decline in that probably if there was a weather effect. So it isn't clear that that is the case yet. And labor force participation drops to 62%. So some bad news on the labor front now. On the retail sales front, and these are January numbers delayed by the government shutdown. Retail sales headlines dropped by 0.2, but ex-autos, they are flat. Weather may be an impact there. Control group up 0.3% after a flat reading in December. So a bit of an improvement, but not a huge jump in retail sales. So the numbers aren't particularly overall good this morning. I'll look at the further details for you and get back to you in just a minute.
Mike McKee, thank you, buddy. Looking forward to those details. Right now, the headline, bad news is bad news. Equity futures near session lows. We're down across the board on the S&P 500 at the moment, declining by 0.8%. Underperformance from the Russell, as you might expect. We're down by more than 1%. In the bond market, yields flip from being positive to negative. We're down at the front end of the curve by 3 or 4 basis points on a 2-year at 354. This is double bad because I'll tell you a market that isn't moving in response to this, and it's the commodity market. Brent and WTI still near session highs. Brent close to 89, WTI close to 86, and this is the problem for the Federal Reserve. This is what you don't want. You don't want to see downside surprises on the economic data and then see upside surprises when it comes to inflation. That is not what you want to see at all.
This is the worst case scenario of, and I'm dreading to saying this, but stagflationary shocks. Essentially, oil prices rising rapidly at a time where there doesn't seem to be that much strength in the underlying employment market. The good news is that January wasn't revised significantly lower, only 126,000 versus the 130,000 previously stated. The bad news is it's not just that there was a job destruction in the month of February, but that the unemployment rate rose to 4.4%, raising questions about how you can look through this if you're trying to come up with policy.
Does it go against the grain? Let's think about the data we've had so far. ISM has been pretty good now for a couple of months, both services and manufacturing. The data we've seen elsewhere Claims didn't scream weakness. Didn't see that in initial jobless claims this week or the week prior, for that matter. Does this data point go against the grain, given what we've seen?
Well, it certainly has gone against the sentiment that we've heard from a lot of investors and the reason why people had confidence in the strength of the U.S. economy. People might say, though, that the ISM services data hasn't really cohered with what we've seen in the labor market for quite a while, and it hasn't really been a good forward-looking indicator. Other people say, look, the responses to the survey, the job survey, have come down significantly, so can we count on this data in the same way? And then the pushback to that is, it's the best we've got. So if this is the best we've got, what do you do with that as a policymaker, given a lot of conflicting data signals, given that other signs, the Beige Book included, say things are okay?
Let's go through the headlines then. The change in non-farm payrolls, negative 92,000 against an estimate of 55K. That's a big downside surprise on the payrolls report. The revisions, not great either. To Bramo's point, unemployment should anchor the conversation around how much slack is there. Is there greater slack, less slack? There's greater slack based on this. Unemployment rate coming at a 4.4%, previously 4.3%. The expectations was it would stay there. For more details, Mike, I want to bring you back into the conversation. Are there potential distortions? Does it go against the grain? What do the details tell you this morning?
Well, right now, it doesn't look like some of the outside influences we might have thought of had an influence. Only 228,000 people not at work because of weather. However, there is an impact on the strike side. There was a strike at Kaiser Health Insurance, 31,000 workers off the job, and we see a decline in health and social assistance of 34,000 during the month. So there is a significant issue there. We also see that average weekly hours did not move. So along with the weather, that's the basic issue that we have. Construction jobs down 11,000. That might have been weather. We were expecting a rise. We saw a rise in ADP. There's been a rise in the last couple of months because of the AI constructions. Private service producing jobs overall, led by these healthcare numbers, down 61,000. Financial activity is one of the few that gained 10,000. And government down by 6,000. So it looks like some of the Doge firings have worked their way through the system right now. Still looking at some more of this data, and I'll get you some retail sales data in just a second.
We'll come back to you, Mike. Thanks for that, buddy. Appreciate it. So this from Neil Dutta of RunMac. For him, this is why 2026 is not 2022. There was an energy shock in 22. We had a strong job market, excess savings to draw down. Today, the labour market sucks, and saving buffers have been drawn down. Neil's opinion this morning.
Yeah, and the reason why it's complicated is because of some of these other peripheral issues that you point to, whether it's the ADP report, whether it's the fact that you have other job search engines talking about emergence of some recovery. So how do you trust the data? The data is different. How do you look at an economy that's changing structurally? And then how do you understand whether it's inflationary or disinflationary when you have an oil price shock, but you also potentially have an AI shock, which also could potentially have a productivity shock? I mean, this is a moment of shocks that is leaving us all reeling.
Is your head spinning?
It has been.
People's heads are spinning right now.
Literally, I lay down at night 2 nights ago.
Feeling dizzy.
And I closed my eyes, and the entire room started spinning. Maybe that says more about me. I had not been drinking anything, but I just want to let you know.
Thanks for clarifying, Bramo. Thanks for clarifying. People were asking questions.
Maybe I should have.
Equities down by about 0.7% as things stand. On the Russell, we're down by 1%. Yields were positive, now they're negative. We're down by 2 basis points on the session at 355 on 2s, on 10s at about 412. Stephanie Roth of Wolf Research is with us around the table. Stephanie, good morning.
Good morning.
So we've got the strikes in healthcare, largely anticipated. We were looking for that data to come through. We've got the weather effect as well. How weak is this week report?
I mean, it's certainly soft. I think another thing that we haven't talked about appears to be something with birth death, although we're still looking into it. The birth death adjustment was 90,000 compared to something well over 100,000 in the year ago print, because it's not seasonally adjusted. So that might have also been the reverse of what we got in January, where it was a very strong adjustment. So that added about 50,000 in January. Perhaps you got somewhat of the reverse in February. That said, it still was a fairly weak report. And that does leave the Fed in a tough spot, because we're in this stagflationary backdrop. But like Neil Dutta said, we're not in 2022, where we had a lot of supply chain shocks. We had a very strong demand backdrop. There were stimulus checks that were continuing to come through. This is a very different backdrop, and I expect them to look through it a lot more than they were able to in 22.
I'm wondering what you make of this report, how distorted it is versus actually expressing weakness. I'm looking at some of the components underneath it, and it does look like the Kaiser strike, the healthcare strike, did have some influence over this. 34,000 jobs removed because of that, but it's also leisure, 27,000 jobs down. You've got private services down 6,000 61,000. In information, down 11,000. So there are these other points of weakness. This is pretty broad-based. It's not just coming from one sector. Can you look at this and make some conclusion about how much heat there is still in this employment market?
I mean, if you take a step back and look at some of the other indicators, because we know there was a lot of things going on in February. Claims look largely fine. The other measures of the labor market look a little bit better. Challenger this week didn't show the same type of layoffs that you got in January. The broad picture tells you we're still in this low hire, low fire environment. It's not strong by any means, but it's probably not as weak as today's data suggests. And if we were to rewind a month ago, or at least the market narrative was such that the labor market is on fire and we're in a much different situation. So I think looking through all of the noise, it's a labor market that is okay, but not strong.
We've talked a lot, and you've said that you should look through the noise, and this is not a Fed that needs to cut rates. How much does the oil shock change that, given the fact that that's going to really pressure a lot of households? They're going to be spending $160 filling up their gas tanks rather than, say, $120 in short order. I mean, how does that affect how you see us looking through this?
Yeah, I mean, interestingly, the market has been trading it the other way, where the oil shock makes the Fed be able to be less accommodative. I agree with you, though. The oil shock, especially in the backdrop of an economy that is not overly strong or overheating, tells you that if anything, the Fed should sort of wait and watch the demand implications, because we might see softer demand such that they need to be a little bit more accommodative, although perhaps it might take a little longer for them to be able to cut rates.
I think it's fair to say that Governor Waller's voting for a rate cut at the next meeting. We'll have some company in Governor Myron. How much company do those two have right now in the committee?
Probably not many, and the Fed speakers most recently have said we want to watch and kind of see the implications of the oil price shock. And one payroll's print is not going to change that, although they might sound a little bit more dovish than would otherwise be the case.
Mike McKee, standing by, still with us. Mike, I want to bring you back into the conversation for the people just tuning in, just arriving this morning and checking what's happening with payrolls. I can tell you a big downside surprise, negative 92K on non-farm payrolls, the headline number. The estimate we were looking for was positive 55,000. The unemployment rate higher than expected as well at 4.4% against an estimate of 4.3 and some negative revisions as well, Mike. You went through the details. Mike, what stands out for you?
Well, looking at the unemployment side of it, and this is the household survey, we see a change of 18,000 people added to the labor force. Hardly anything. We'd seen more than 1,000, a million, 100,000, sorry, the prior month who went away. The employment situation, the level change for employment was down 185,000 jobs, while the unemployment level was up 203,000 jobs, people who were unemployed. So there's your rise to 4.4%. But the interesting thing here is that the number of people who are unable to work comes off of the household side. So to the effect there was an impact, it's on the household survey of the number of people who were not working. Retail sales, we've got numbers for them now, and the big drop was in motor vehicles, 0.9%, 0.9%. That's largely probably because of weather. All the cars on the new car lots buried in snow. Not going to get a lot of people who are out to look. 2.9% drop in gasoline station sales. Remember back when gasoline prices were falling? That was during the month of January. Clothing store sales down 1.7%, sporting goods down 1.2%, and those are post-Christmas kind of numbers. General merchandise stores up 0.4%, and food up 0.2%. So a mixed picture, people buying staples, not going out and buying things that they don't really need. And the overall picture here is that the economy was slower in January in terms of retail sales as people consolidated, and then the labor market was hit in February, and the question is how much of it is, as Stephanie pointed out, the birth-death model, and which was revised, and how much of that is also weather. But it is not a pretty picture, and I think you've reached the right conclusion. Chris Waller will probably vote for a rate cut.
I think it's fair to say. Mike, thank you. We'll come back to you in just a moment. There are some excuses, some reasons for this weak number. The strikes in healthcare being one, the weather being two. Ultimately, though, there's a trend here. The labour market has been weak over the last 12 months. That's been a problem. It's why the Federal Reserve has been reducing interest rates. And more problematic now, you've got this move in energy. Because as we speak, we seem to be approaching new highs in the energy market. Brent crude at $89.50. and WTI north of 86.
Yeah, the crude market's not responding to the demand side right now. It's not a demand side issue. So if people feel constrained in any way to spend, it does not matter at all for crude prices, given the fact that that is a supply side shock driven by the fact that oil cannot get through the Strait of Hormuz and frankly is not being produced in a lot of locations in the Middle East. This is a huge issue, given the fact that this is a stagflationary mix. How much weakness there actually is in the labor market, a big question, but it's happening at a time of structural change, which adds the extra anxiety on top of it of A, how to read this, and how much you want to see a hot labor market going into this transition period.
There's a better story to tell for the American economy coming into 26. We've had the rate cuts, we're about to get the tax refunds, and some big companies want to spend some big money. But moves like that in gas prices could undermine the whole thing. If you're getting a tax refund, you start to see the price of things that you pay for every single day starting to creep higher, you'll be a bit more conservative, a bit more cautious about how you interact with the economy.
This is the reason why I'm actually surprised that no one's talking about the disinflationary shock of oil prices going up. There always has been a debate between whether it is inflationary or disinflationary, and over a medium and longer term, it is disinflationary or deflationary because of demand destruction. That has not been priced too long into the yield curve. I'm wondering if it's going to start being reflected a little bit more after this.
So the opening bound's about 46 minutes away, and here's the setup. Session lows on equities, down by about 1% on the S&P 500. Yields were higher for a fifth consecutive session, now off the back of that downside surprise on payrolls, now slightly lower at the front end on 2s and the long end on 10s. 10s back to about 412. And in the commodity market, crude higher by more than 4% on Brent to 89, on WTI up by more than 6 to 86. Joining us now to extend the conversation, Jeffrey Rosenberg of BlackRock. Jeff, we've got a lot to get through with you, sir, so let's start with what's happening in the labor market. What's your assessment of things at the moment?
Yeah, listening to you guys, Lisa, like you, my head's spinning as well, and you guys have really covered it very well. I mean, a lot of excuses, a lot of unique factors, but it is a weak report overall, and you're seeing that in the bond market, and it is this tension, between the weakening in the labor market and then the near-term inflationary shock coming out of the oil price increase. One thing I would highlight, and Lisa, you kind of touched on it, is sort of the tension between the short-term impact and the long-term impact. If you look at five-year forward break-even inflation, certainly what you're seeing here is a move on the front end, about 80 basis points in the 2-year. But if you look at the forward curve in terms of oil futures, you look at the forward curve in terms of inflation, the expectation here is that this is a temporary shock. And so for the Fed, when they're faced with the trade-off between a temporary shock to inflation and this more sustained movement downward in payrolls, I think they're going to err on the side of the payroll and the growth side. And the other point that you highlighted, which I think is really important, is the longer and the stronger that the oil price increases, you start to bring about the thing you just mentioned, which is demand destruction and the flip side. And that makes the treasury market move here very much on the knife's edge, because you could very quickly swing from a focus on inflation to a focus on the Fed's focus on the downside risk protection in terms of cutting rates.
Hey, Jeff, I just want to jump in because we're getting some headlines crossing the Bloomberg and seeing crude gap out to new highs on the session. This from the Journal. The Kuwait is cutting oil production at some oil fields. The Saudi Arabia, UAE are also nearing limits of storage facilities. Now, this has been what we've been tracking all week. There's a problem with the movement of crude. So even if you're free to produce as much as you want, at some point, if there's no release valve for that, to get the crude out of the country through a pipeline or through the Strait of Hormuz, you're going to breach storage capacity, and then you have to start shutting in production. We saw that with Iraq, reducing production early this week. And Lisa, now according to the Wall Street Journal, you're starting to see it in other nations as well.
Yeah, because their storage facilities are full. And how much does this end up just continuing to push up prices, simply because even if this is a conflict that's resolved in relatively near term, there is an actual supply mismatch that is not happening in terms of how much is being supplied, and there's going to be a lag time to bring those supplies back online and actually get them circulating. So it's dual, right? On one hand, yes, you're having an obstruction between the free flow of crude and other energy supplies through the Strait of Hormuz and elsewhere. And number two, now you're getting a true shuttering of the actual supplies, of the actual production, and that takes a long time to get back online.
Just to point out once again, this coming from the Wall Street Journal, their latest reporting that Kuwait is cutting oil production production after running out of room to store crude, and other more major producers in the region are getting closer to those levels as well. How close, we don't know for sure. If you look at the reaction, WTI approaching 87 and Brent getting closer to 90 now at 89.73 and higher on the day by 5%. Jeff, a question we've been asking continuously is how bond traders should trade that shock in the energy market. Does it mean higher yields, or eventually should it mean lower yields?
Well, you know, we're all focused on what the oil analysts are saying about that, and they have been talking about this shut-in risk and how much time there is based on storage, and it was, you know, in weeks, 22, 25 days, you know, we're 7 days, 6 days into this. So that headline is not so much a surprise. Obviously, it's a negative headline. And the issue is really both the duration of the conflict and is there an ability to mitigate the blockage of the straits. But the bottom line is the longer this goes on, the greater the risk that the movement of oil beyond this kind of 85, 90, you know, what some of the oil analysts talking about, you know, bigger shock, that's when you start to tip the bond market from inflation to demand destruction. And I think that's what we're watching for in terms of a much more aggressive move in terms of the oil price. You start to think about the demand destruction, the deflationary aspect, and what I just talked about in terms of the Fed's response. You may start pricing back in some of the cuts that we just priced out based on the inflationary impact, which is the first order impact right now.
Jeff, do you think that the equity market and risk assets in general are just way too complacent about what's going on right now in oil?
Well, you know, there's a really interesting story, and I know you guys have covered it, about kind of what's going on in the surface, which kind of masks what's going on underneath. And if you look at what's going on underneath, there is spectacular amounts of volatility that if you saw that happening. Now, it's a lot of some stocks are going up and some stocks are going down. And so the impact on the index levels is actually not being seen. But the volatility and the rotation that you're seeing underneath the surface really does say there's no complacency here. There's a lot of kind of defensive rotation and risk mitigation reflective of both themes. Obviously, the war theme is the new one, but the prior theme that we have been talking so much about is, of course, is the AI disruption theme. Well,
Jeff, there's this real issue that a lot of people have been coming into this oil shock saying, let's look through it, and the fact that there still is momentum and strength in the U.S. economy. Okay, got it. That was 130,000 jobs created in January. Oh, wait a second, maybe not. There's actually a downward revision of, I believe, retracting 67,000 jobs from that figure, and we now have a negative print that is substantial for the February read. Does that shake this narrative that the U.S. economy is plenty strong enough to look through any shock, even if it's sustained for 3 or 4 weeks into the oil market?
Yeah, it's a good question, Lisa, because all of these, excuse me, all of these pieces of information, right, they operate on the margin, right? So you replace the 130 and there's a revision and now you have a negative print, and yes, there's some special factors, and obviously the big new shock to the relatively benign economic outlook for 2026 is the oil shock. So all of that is going to undermine some of the confidence in that kind of benign macroeconomic environment, and you're seeing that. You're seeing that in risk pricing. You're seeing it at some level in the overall index levels. You're seeing it in credit markets and credit spreads. So there is a reasonable, rational response there. The issue, and no one knows right now, is really the duration. I'd say the market response is kind of short and contained, but that oil price discussion we were having, you know, that's really going to be the breakout issue, whether the market continues to price it as short and contained and more mitigated for the economic and the financial market pricing, or something that is going to be much more impactful.
Hey, Jeff, it's good to see you. Thanks for being here, sir. Jeff Rosenberg there of BlackRock. 3 issues to get through here, so I'll work through them one by one. We'll start with and after that, and the selection of a great and acceptable leader.
This is an off-ramp that does not feel like it's a tomorrow kind of goal, or even a Sunday or Monday kind of goal. And we had Nadia Lovell speaking with us earlier, talking about how she thinks in about a week or 2 weeks, the game starts to change for markets. You also have to add the fact that we just got not a very good labor market print. So that's really another underpinning that we've gotten for the risk assets that are really being undermined on 2 fronts right now.
Stephanie Roth of Wolf Research still with us around the table. Stephanie, it's difficult to follow all of this. What are you looking for together with the team going into the weekend?
Yeah, I think we're going to be certainly digging into some of the details of the print. It seems right now like birth-death model was also about 40 to 50,000 headwind. So the combination of that plus weather plus strikes makes it still a bad report, but maybe a little bit less scary. Energy prices is, of course, going to be one of the primary concerns. And then something we haven't even talked about is the potential for some food scarcity issues down the line if this continues. That's something that is certainly not getting a lot of focus, but perhaps might become a real issue at some point. This is a real challenge, and it's a Fed that I think will ultimately have to be a little bit more dovish than would otherwise be the case. I agree with exactly your points, Lisa.
Stephanie, it's good to see you. Thanks for being here. Stephanie Roth there of Wolf Research. Thanks again to Jeff Rosenberg of BlackRock and to Mike McKee for breaking down those numbers a little bit earlier. Just frame out the last 24 minutes. Just the last 24 minutes. Never mind this morning, the last week or so, the last 24 minutes. A big downside surprise on payrolls, a president that's rolling out a deal anytime soon, and then also the other point that's kicking oil out to new highs for the session, that we're starting to breach storage capacity in key producers who need to reduce production. All of that in the last 24 minutes going into the weekend.
This is a massive supply shock, and it is a stagflationary shock when you look at the labor market. You put that together with how long this is going to last, what the off-ramp is, given the president's Truth Social post saying that unconditional surrender is going to be the only off-ramp that we can look for. And you can understand that people have a lot of jitters. Still so many questions remain. This has been the longest first quarter ever. You have said this many, many times. Well, it just got a whole lot longer because we just have a new narrative now that we have to grapple with.
Equity futures this morning down by 1.3% on the S&P 500 in the bond market at the moment. Yields lower and then higher again by a basis point on twos and by a basis point on tens. Tracking that bond market is getting harder and harder.
I'm really not understanding the long end of the yield curve. I'm just not understanding it because on one hand, you have to think, are we going to see some sort of long-term inflationary shock, or is this going to ultimately cause the Fed to be more dovish?
Up next for us here at Bloomberg, we'll catch up with Kevin Hassett, the NEC director. We'll do that in about 35 minutes' time. On Monday, Cameron Dawson of New Edge Wealth, Subhadra Rajappa of SocGen, Kate Moore of Citi Wealth, Savita Subramaniam of Bank of America. From New York City this morning, good morning. Stay safe. This was Bloomberg Surveillance.
Day 2 at the BNP Paribas Open. Legend Venus Williams wows the fans wherever she plays, but the 7-time major champion was knocked out by Diane Parry in 3 sets. The French woman firing 10 aces in the win that took 2 hours and 18 minutes on Stadium 1. And don't forget, you can watch all the action live daily and head on over to tennischannel.com to download the app.
World's most powerful investors don't ring a bell. They quietly reshape entire industries. This is the money shaping the world. The Dealmaker Playbook, where power and billions of dollars change hands every day. From private equity and credit to venture capital and M&A, we bring you the inside scoop on the biggest deals and debates, plus exclusive conversations with finance's ultimate insiders. I'm Danny Berger, and this is Bloomberg Deals. Every week, only on Bloomberg Television.
We are in such an incredibly exciting moment with AI. It is really the most profound technology of our lifetimes, and I think it has the potential to help us rethink literally everything. The potential for economic impact, societal benefit is honestly boundless. When we think about the economic impact for Europe in particular, it's around a 1.2 trillion euro estimate of the productivity growth that can be unlocked. This platform shift that we are living through, I think, is going to create untold amounts of value for the world, but also for the businesses and for economies, which is why I'm incredibly optimistic in this moment for Europe, but also for the whole world.
How do you think about job losses or safety for some of the AI tools?
You know, I hear the anxiety, and I understand the anxiety about jobs. I think that we are certainly going to live through a massive transition about how people learn to work alongside these tools. I mean, the reality is I do think there'll be some number of jobs that are displaced. I think it is a smaller number maybe than some anticipate. We estimate it's around 7%. And I think what's important is that we have programs that help those 7% transition into new fields of work. I think what is more likely is that most of us are going to learn to work alongside these tools. So we estimate about 2/3 of us. If you think about the tasks you do in your daily life, when you look at every industry, there are administrative tasks happening everywhere, and that's what AI is most helpful in improving.
This is a 15, 16 grams tuna. Then sushi rice is still a little bit warm. So take one, like a very, don't make it too tight. So from now, and very light, like a little ball. Put wasabi in the middle. Then my process 1 to 6. 1. This is putting the between the rice air. Then make the 4 fingers curl. Make sushi shape. Then touch this. 2. Then turn. Now these 2 fingers, top to the bottom, make the sushi shape more beautiful. 3. Then, looks like pushing, not pushing. 3, 4, turn, same way, 5, and 6. So this is 1 to 6.
Bringing you up to them in the news whenever and wherever it happens. I'm Chevrian in Seoul, and this is Bloomberg.
The U.S. unexpectedly lost 92,000 jobs in February, with economists expecting a 55,000 gain for the month. The unemployment rate also ticked higher, and as a result, futures are down sharply. We see yields off across the curve. Bloomberg's Michael McKee, our international policy and economics correspondent, joins me now on set to kick off Bloomberg Open Interest. Mike, thanks for coming on to the desk. What are you seeing here that doesn't make sense? Because obviously you'd see the yields sell off, but I would expect futures to rise as equity investors price in rate cuts.
I think the confusion about what's going on and how long this is going to last in the Gulf, Persian Gulf, and how long energy prices are still going up has got people worried about what's going to happen next. They just don't have an off-ramp at this point, and the numbers were bad this morning, and you could see the reaction in the markets when those came across. 92,000 jobs lost, and one of the interesting things here is the only category that's been hiring lately is healthcare, and healthcare had almost no jobs during the month, and physician services lost 37,000 jobs, and that was because of a strike at Kaiser, 31,000 people. But if we can't withstand one strike like that in the labor market, you got a problem. And we see that the unemployment rate went up to 4.4%. Labor force change was only 18,000. People thought that maybe there would be a weather effect, but only 228,000 people, not an unusual number, were unable to work because of weather. So this is just really showing us weakness in the labor market. Now, the retail sales numbers that came out, they're a month delayed because of the shutdown. These were January numbers, but they weren't good either. Retail sales basically down 0.2 on a headline basis, driven down by a 0.9 drop in auto sales, all those cars under snow on the lots. Nobody went out to look. But the retail control number just up 0.3%. And across the board in retail sales, it was a fairly weak number. So this, Matt, I would say basically is a catch-up alert day at the White House, because you've got weak employment, and people have been afraid. We've seen this in the data about losing their jobs. And you've also got rising gasoline prices, and they're going up rapidly this morning. We're at the highest point for gasoline prices than we ever have been under a Trump presidency already. So he's got political problems in these bad numbers and what's going on with petroleum.
Right, and reportedly, there are times when the president throws condiments.
There are, yes.
So the interesting thing to me is looking through these charts, and I use the GIP charts on the Bloomberg to see what happened when the data crossed at 8:30 and then in the moments after that. Initially, futures bounced higher, probably on rate cut expectations, and you saw yields drop drastically. I mean, yields were up across the curve, and then they all fell far below the zero line. Now we see a reversal of that. Futures down sharply, and yields back up. Look at the two-year yield here. Right now, adding almost a basis point to 358.33. So why do you think yields now are rising on this?
Well, it seems to be a status quo trade. We reacted immediately to where people were positioned going into the jobs report, and obviously this was a huge shock to everybody. And now you're getting back to the trade of we don't know what's going to happen, so we're just going to sit there. And I think that's what you'll see for a little bit while this is going on. And you mentioned rate cut if you look at WIRP, the function on the Bloomberg, you'll see that there have been some moves toward pricing back in some rate cuts, but very little. Not what you normally see if you saw a number like 92,000, and that's because you got, on the other side, the inflation question coming from oil and other products that can't get through the Gulf.
All right, Mike, thanks very much. Michael McKee there talking to us about the jobs number that came in far lower than expected. The non-farm payrolls print, typically one of the most important economic data points that this market trades on. We're going to have more on the economy and jobs with White House National Economic Council Director Kevin Hassett, as well as Chicago Fed President Austin Goolsbee. They'll be joining us later this hour. Right now, though, I want to bring in BlackRock Chief Investment Officer of Global Fixed Income, Rick Reeder. And Rick, your take first on the jobs number. What do you make of the U.S. economy now looking at 4.4% unemployment?
So it's interesting the way you phrased it. And thanks, Matt, for having me on. So I think the U.S. economy is doing fine. I actually think U.S. economy, I was just looking at the numbers before coming down here, I think we're going to grow 2.5% to 3% first quarter growth. The economy and employment are quite different conditions today. We have a productivity revolution. We talk about it. You know, people were encouraged last month. You had 137,000 jobs last month, but 130,000 were in healthcare. You strip out healthcare, we have no hiring. So I looked at the next 9 months. If you strip out healthcare, the last 9 months, total jobs in the country is negative 358,000. Negative 358,000. Stripping out healthcare. We're going to keep hiring healthcare workers, even though today this number was a little bit softer. Again, last month was really strong. We're going to still hire healthcare workers because the population's aging. We looked at a metric, people 65 and above. We haven't even kept up with that rate of growth. A friend of mine was showing me that. So we're going to keep hiring healthcare. The problem is we're not hiring other people because there's productivity going on. And it's not AI hasn't really kicked in yet, but productivity. I mean, you see this. You know, I read tons of earnings reports. You look at what companies are doing. Run your business more efficiently, keep your top line in a reasonable position, and get your cost infrastructure down. So point being, I think, by the way, economy's fine. And then, but it's just, for the people dynamic, it's harder. And it's part of why I believe you need to have more policy to help impact that.
You know, it's interesting, Rick, I've been doing this for 25 years plus, and we always say the markets are not the economy, because there can be times when the people on Main Street are feeling pain and equity indexes are doing just fine. But what you're saying now is that jobs are not the economy, which is a little bit more concerning for those on Main Street.
I mean, I have a strong view that, there's a problem in that, what people describe as a K-shaped economy. I think we have a problem today in what are particularly routine-oriented jobs, low income, is having a really tough time today. The aggregate economy, because you actually got part of the economy, you got CapEx, and certainly data center infrastructure, et cetera. CapEx is in very solid shape. And then you got consumption that's being held up because you have a cohort that's actually still doing well, which is older, higher income. But we have what is a continuing and even a growing bifurcation that I think, and by the way, I think some of the initiatives you heard from the administration on affordability, things of that ilk will help. Listen, I think the Fed, I know we've talked about it before, you have a near-term dynamic around energy shock, a supply shock. I still think the Fed, I think we still have to get the mortgage rate down in this country to get labor mobility moving, to get housing moving. And so I think there's some initiatives to try and stabilize what, quite frankly, is a bit of a concerning dynamic today.
I talked a lot with Bruce Richards over the last couple of weeks. He sees an E-shaped economy because we know the top 20% is doing well. The bottom 40% are struggling. But he said we have a strong and growing middle class because of President Trump's initiatives to bring industrial jobs back to the U.S. I know we lost manufacturing jobs in 2025, and it looks like we lost manufacturing jobs again today, but there is so much confidence that the tax changes in the big, beautiful bill and the tariff policy, frankly, are going to bring jobs, manufacturing jobs back to the U.S. Rick, do you buy into that?
So I think some good initiatives out there, and I do think there are places that you will see in pharma, in chip manufacturing, chip production, et cetera, that I do think you'll see. And then, yes, some manufacturing I think will come back. Maybe I challenge a little bit that the middle is doing okay. I still think you have, particularly when you've got, some prices moving up in some of these areas today in healthcare, education, insurance, obviously recently fuel. I still think the middle is, I wouldn't say the middle is doing great, at all. So anyway, I still think you have that bifurcation. But yes, I believe some of these initiatives to stimulate, to buoy the economy in a bunch of different ways that are labor intensive. I mean, like I said, healthcare is a labor intensive industry. The good news is we have a demographic that will continue to instigate job growth there. If we stimulate job growth in some of those other areas, no question that will be beneficial. I personally think housing is by far the most, because of the sheer size of it, because of what it does for labor mobility, because of what it does for people who can move, and we put people to work, a lot of people to work when we build houses in this country. So all those initiatives, I think, are quite welcome.
Rick, you know, you are running fixed income at BlackRock, and we're looking at, with the exception of today, or maybe even right now, real yields kind of driving the move in nominal yields. I was talking to Cameron Kreese from our MLive team, and he points out that before today, the big gain that we'd seen in nominal yields was mostly taken out of or driven by real yields, and that we're not seeing a real sign from break-evens. How do you interpret that?
I mean, that was right up until, obviously, we've had this energy shock, and you are starting to see elevation in break-evens. Listen, I think, you know, it's an interesting dynamic across, you know, it depends on what part of the yield curve you're looking at today. Listen, I think these real rates are attractive, and I think, you know, a question of, like, you know, we think about this today, you know, we're in one of those modes now, even though I think the Fed could cut rates, has room to cut rates. I think you have to adjust to, you have to consider they're probably going to sit and wait for a while. So can you have some rate backup? So you have to manage around that. And, you know, I think these real rates, if you take a longer term perspective and say, gosh, where are these real rates going? Where are nominal rates going? Boy, I think we're going to, and by the way, we just got a very, very, very strong reminder of productivity. Productivity will bring down wage pressure. Productivity will bring down inflation post, obviously, the energy shock. So I think we're going to a different place. Do you position for that today, or give it a few weeks to let the Mideast situation die down? But there's no question in my mind we're moving to a different place in terms of real rates, and nominal rates will come down, and break evens will come down, obviously.
I mean, but if real rates continue to rise, or if we go back to that scenario, Rick, typically that's not a good sign. Is that sustainable? Because typically when real rates are rising is when things start to break, right?
They do. Yes and no. I mean, I think you can have some elevation. I mean, listen, you got an economy that's actually operating, away from the employment picture. You have an economy that's operating at a solid level today. I think you get to these points in time where you get higher real rates. I don't think there's a systemic problem today at all. I will say the place where, when that real rate elevates, particularly in the front end of the curve, the debt in the country is too big. And so part of why, when you think about if you're running policy, there is a very significant mechanism that you need to think about. If we keep that real rate too high, the sheer borrowing costs of the United States move up significantly. The only way we diffuse the debt in this country is the economy has to continue to operate at the solid level it's operating at, and we got to get the cost of that debt. You got to get that real rate down, and you got to get the cost of the debt down. And then that, by the way, that's the longer term benefits for the currency are tremendous. We get debate near term dollar strength or weakness, but that has got to be the most important dynamic over the next couple of years.
Rick, I'm going to get to the war as we round out the first week of war in Iran, and how markets are reacting to that, and how that's driving oil prices, and what that'll mean for inflation and growth in a moment. But because you are the CIO of fixed income at BlackRock, because you were in the running, widely reported to be in the running for the chairmanship at the Fed, because people on both sides of the aisle look to you for economic analysis, how can we be in a good place if GDP is rising with a strong economy, and yet we're not adding jobs? I mean, this brings up the whole sort of ghost GDP nightmare scenario that James von Gielen put into his Citrini research piece a couple of weeks ago. What happens if productivity rises without people doing that, driving that trend?
So it's a hard question. I think it's unequivocal that we're going to have productivity enhancements. Obviously the amount of CapEx will lead to productivity enhancement. There's no question about it. You're talking about cognitive, technology that replaces cognitive thinking in many ways. So we're going to have some productivity. It's part of why I'm a deep believer. You know, the U.S. is the most flexible, innovative, ingenuity-rich economy in the world. These initiatives, you talked about some of them, but some of these initiatives that are labor-intensive or labor-accretive are unbelievably powerful. We talked about real estate, as you said, and manufacturing. As you said, technology orientation in the U.S., where you bring back some of that chip development, et cetera. Like those things all have to happen to mute what is an unequivocal condition that we're going to have productivity increase. But, you know, good economy, but an efficient economy, but we've got, you know, things that will stabilize and improve the condition for workers and for people in the United States, I think is absolutely essential.
Let's talk about oil for a moment, because another thing that Bruce Richards was outlining for us at the Bloomberg Invest Conference this week, which I think makes a lot of sense, is that as the oil price rises, his expectations for growth come down. So he was saying 3%, like you, at $60, $65 a barrel. But as we get to 80, if we hold there sustainably or over, maybe only 2% growth. At $100 a barrel, maybe only 1% growth. And if we get to 120 or above, sustainably, that we could be in a recession. How do you view the effect of these oil prices on the U.S. economy?
You know, Matt, the reason why it's a great question is, you know, and you know, when you step back and think about when you have a supply shock, and you know, if you're setting policy, monetary policy, when you have a supply shock, the derivative impact of that is very clear. You dull growth significantly. It is, you know, I wouldn't have argued. I don't believe that there's that significant a drop-off per those numbers. I have to think about it a little bit more. I don't think it's that significant because we're still a service-oriented economy. 70% of the U.S. is services. We don't have that same manufacturing hard asset commodity transmission as you would have had in the past. But yes, I think you slow growth. I think it's unequivocal you slow growth. And if that's the case, that's part of why I believe monetary policy, and people say they should raise rates to combat this inflation. Actually, you know, I couldn't disagree with that more. Actually, you know, if anything, I actually think you should cut. Will they do that? No, I don't think so. I think they'll sit and wait and see what the inflation transmission is. But that point about what happens, a derivative impact when you have a supply shock, is quite clear around the growth impact.
Rick, one of the other things that we pay very close attention, one of the other reasons we pay very close attention to what you say is the outperformance of the ETF that you run. And we show it a lot here on Bloomberg. BINC is the ticker BINC. But if we pull up a comp screen of that on the Bloomberg terminal, it's just undeniable that you're crushing your benchmark here. So what changes might you make, or what would you be considering with your holdings? And we can find that by typing BINC Equity DES and click on the Holdings tab. After this number, as we start to see, or if we start to see, the jobs picture weaken.
So, Adam, you know, and people can look at it, and you know, listen, when you have a shock like we've had, and you don't know the duration of the shock, and we talk about the impact it can have on trade and the uncertainty that it can have in the near term. I mean, you know, we start to cut beta, and you got to bring, you know, in an environment like this, particularly, you think about what does your interest rate exposure do for you? Well, if interest rate doesn't help you to manage the risk, you got to bring your risk down. And so we've been on a mode of let's pull some of the higher beta income down in the interim. And so can you run a little bit lower income in the short term because you're trying to manage to a total return paradigm? So a bit of that, you know, reduce some of the beta, a little bit of the credit, a little bit of the interest rate exposure, a little bit of mortgage exposure. Just, you know, can you, you know, quite frankly, this period you hunker down a little bit. But, you know, the big thing for us, the markets always react to the next 2 weeks, week to week. There's presenting some opportunities. We're looking at the securitization market, emerging markets, that, you know, even though we pull down a little bit of EM, it's like, gosh, you know, on the other side of this, where are we going? Because you know, the opportunity set's getting better. You just got to be a bit patient, and then be tactical about where and when you step in.
Rick, great to get some time with you. Thanks very much for joining us on this Jobs Friday. BlackRock's CIO of Global Fixed Income, Rick Reeder. Now let's take a look at what's going on with markets. We've got about 10 minutes to go, 12 minutes to go until the opening bell, and we're looking at futures that are now down 1.33%. We were down before this jobs number came out, but we've moved lower. We did see yields drop across the curve, but they have now come back. I should say, to where they were trading before 8:30. So equity index futures off and yields trading right where they were before the number came out. You got crude as one of the biggest drivers that markets are watching right now, up 8% on Brent, on NYMEX, I should say. NYMEX crude, $87.85. That looks an awful lot like Brent. More reaction to the surprising jobs report with White House economic advisor Kevin Hassett, Chicago Fed President Austin Goolsbee, former Fed economist Julia Coronado, and strategist Emily Rowland at Manulife John Hancock Investments. We've got it all coming up for you on Bloomberg Open Interest, as well as an appearance with surveillance anchor and my buddy John Farrow. Definitely keep it tuned here. This is Bloomberg.
Welcome to Bloomberg This Weekend. I'm David Gura.
I'm Lisa Mateo. And I'm Christina Raffini. We're tracking breaking news today from Wall Street to Washington.
Let's start overseas. The sector is really propelling this yield forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
Bringing you up to them in the news whenever and wherever it happens. I'm Chevrillon in Seoul, and this is Bloomberg.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
The U.S. economy lost 92,000 jobs in the month. We are expecting to add more than 50,000, according to a survey of economists, and unemployment rose to 4.4%. As a result, the S&P futures are falling right now, 1.3%. Typically, this would be a bad news is good news scenario for equity investors because you'd expect Fed rate cuts. But the big problem is Brent crude, or really oil across the industry, the energy universe. Brent is over $90 a barrel now. You can see it trading there at $90.13. NYMEX crude is up to $87.84. When I read that, I actually thought that we had a mistake on the screen because it looks like higher than Brent was yesterday. So huge jumps across oil. This is, as Mike McKee was saying, the highest price at the pump since President Trump has been in office, and the war in the Middle East continues to drive disruption across energy markets, natural gas being no less of a problem than crude. Amos Hochstein, a former White House advisor, spoke about the crisis.
But understand between that and understanding why we're at war, and then you add a cost of energy prices, which goes to electricity and food and gasoline and a lot of other commodities throughout the economy. I think people say, am I willing to be able to pay for this? And there's going to have to be a way for the administration, it's going to have to explain and to demonstrate that it is either very temporary or that they'll be able to mitigate the cost for the American public.
Joining us now is Alaric Nightingale. He helps lead Bloomberg's global oil coverage out of Europe. And, you know, we see such big spikes that I think at some points I'm misreading these numbers, Alaric. I mean, $87, $88 for NYMEX crude, Brent over $90 a barrel. Why this leg up in concern, this leg up in alarm?
Well, I think the thing is that every day that goes past, you're getting new disruptions, and it means you're baking in a longer-term kind of recovery period from this conflict. The Strait of Hormuz has effectively been closed pretty much since the war began. Tankers are piling up outside waiting to get in and on the inside waiting to get out. And that's a huge problem. It just effectively means that the energy can't be exported. Production is having to cut back, and here we are.
So in terms of what energy traders are doing, Alaric, why aren't they trying to price this all in earlier? Why are they adding, you know, $5 a barrel each day? Is the idea that this could somehow, we could find an off-ramp and things could go back to normal in terms of price?
I mean, is the oil price really that high now? You're talking $90, sure, but, you know, they have closed an avenue for a fifth of the world's crude oil and a fifth of the world's liquefied natural gas. Is it really that high? That's the issue. As this goes on, I think people maybe were hoping for a disruption, an end to the disruption, but when that doesn't happen, you start to see these issues, you know, becoming obvious, the kind of loss of production in different countries, refineries closing, refineries having to cut back. This is a really, really, really serious issue. So, you know, in some ways, the market has actually managed it quite well.
Alaric, you have the best view of trading desks across Europe and the Middle East. Talk to us about the specific regions that this oil is destined for, the contracts that we need to be watching, because it's my understanding that although it's a fifth of the world's energy supply, a lot of it is headed to Asia.
That's right. So well, the vast majority of the Persian Gulf's oil does go to Asia, then the liquefied natural gas is more dispersed. But I don't think you have to worry too much about individual contracts. This is a global thing. You can't lose a fifth of the world's oil and a fifth of the world's liquefied natural gas and focus on one contract. This is going to disperse everywhere. That's why you've got jet fuel in some parts of the world that is above $200 a barrel. That's why you've seen diesel prices absolutely skyrocket. That's why, as you said, the price of gasoline is more expensive in the US than at any time during President Trump's office, either this one or the last one. So that's the issue.
Alaric, thanks so much for your coverage. Alaric Nightingale runs our oil team out of Europe. Less than 4 minutes until the opening bell. Kevin Hassett joins us next from the White House. This is Bloomberg Open Interest.
Estava sitiada.
Nisso eu começo, eu tremia, não sabia o que fazer. Foi a mais terrível que eu passei na minha vida. Eu temo, né, que o Brasil se torne
num futuro próximo, um narco-estado.
Porque no final, tudo é dinheiro.
People back home, they are suffering, and someone is driving a Range Rover with their money.
Where is my money? I think she's a scam up to now.
It's some of the world's most desperate people who are getting ripped off.
Repeat after me. I am a winner.
I didn't know how big it was. I didn't really understand what I was getting myself into.
If you tell me you have a vision of being $1 billion business, then you're going to have to do what it takes. And if you're not going to do that, everybody's going to suffer.
Una batalla a muerte.
Money can do a lot of good. It can really transform people's lives, but it can also hurt them.
The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
We are moments away from the start of trading. We are looking at futures that are down pretty sharply after the jobs number missed by a mile. S&P futures off by 1.25%. The U.S. economy lost 92,000 jobs, including manufacturing jobs, in the month. We were expecting a gain of more than 50,000. NASDAQ futures down 1.5%. The small caps down more than 2%, which is interesting because normally this kind of job loss would spook the market into thinking, oh, we're going to get more Fed rate cuts or at least pull them forward, and that should be good for the small caps. That is not the case today. We saw yields come down and then spike back up to the levels that they were. Vlad Tenev, you'll recognize, ringing the bell at the New York Stock Exchange. He's got an IPO of a fund that Robinhood is launching to trade shares in privately held companies. We'll talk about that because we're going to talk to him in just a moment. At the NASDAQ, you've got Minimed ringing the opening bell. But let's take a look at the move screen first of all. As the cash trade starts to populate, and it'll take a couple minutes for everything to come online, but right now only 66 stocks are up and almost 400 are down. Microsoft, ConocoPhillips, Netflix are gaining, but Nvidia is off 1.6% and Apple is down 1.4%. Let's take a look at the GLCO screen. Global commodity prices is what many traders have up on a permanent Bloomberg screen right now because the gas price is moving so severely. NYMEX crude is trading at more than $88 a barrel. That's West Texas Intermediate, folks. And Brent is up over $90 a barrel. There's real concern that as this war in the Gulf reaches the end of its first week, we're not going to be able to find an off-ramp quickly enough to bring these prices down. Let's bring now White House National Economic Council Director Kevin Hassett on with John Farrow from Bloomberg Surveillance. John?
Hey, Matt, appreciate it, buddy. Thank you for that. Live on TV and radio, I'm pleased to say that joining us now, following the jobs report, is the National Economic Council Director, Kevin Hassett. Kevin, you're a good man. Thanks for making time for us this morning. John. It's an obvious downside surprise on the jobs report. The 3-month average has dropped to 6K. I think some people looking at this report at the headline level might be a bit nervous about what's inside it. Are there some one-offs here that make this look worse than maybe it is?
Yeah, there are a few. First of all, we had the crazy weather in February. The worst of it was actually outside of the survey week, but there was a lot of lingering junk, as you might recall, with the ice that was everywhere. We had some strikes on the West Coast that knocked off between 30 and 40,000 jobs. And so I think that on net, it's almost like a wash number. And the final thing is that there's a new procedure, birth-death model at the BLS, which we believe is going to make the number more volatile. And so I think more and more we're going to have to average through the months. And remember, we had a really surprisingly positive number last month. And I think if you average the two, then it's about at the rate of job growth that's consistent with 3 or 4% GDP growth.
Kevin, it goes against the grain as well. ISM data earlier this week was really pretty decent. Claims were stable too. Next time we speak next month, do you expect to have a better story to tell?
Yeah, Yeah, I think that right now what's going to happen, right, is that the variability in the data will be apparent to folks. And so what's going to happen, I think, is that there'll be some anxiety that another number like this or 2 or 3 numbers like this is ahead for us. But we really don't believe that because, as you and I have discussed, like every other indicator is consistent with very strong GDP growth right now. And so this really is an outlier number.
Tax refunds are a big part of the bull case for the US economy. I've got the Bloomberg lighting up in front of me right now with energy prices surging. How those refunds are going to be spent is key, Kevin, with energy bills still climbing. What's your assessment of the disruption we're seeing to supply in the Middle East?
Well, our expectation is that we've got our eyes on the horizon, that we know that sometime soon we're going to have a much more stable Venezuela with high, stable energy output, a much more stable Iran with high and stable energy output, which is going to be very good not only for energy markets, but for risk premia around the world. Don't forget that this move against Iran is happening because they've promised to destroy us all. Like, if that's not something that affects risk premia, I don't know what is. And so I think with an eye on the horizon, then you can see that this is a huge positive for the global economy and global markets. The question is, when will the current near-term disruption end? And that's something that'll be decided by the military. And of course, will be some uncertainty about when they decide to move, in part because the uncertainty protects the lives of American soldiers.
Kevin, in the meantime,
but we expect that it'll be resolved, quite soon.
As you see, we're starting to see a hit to production. Because we can't move the oil, we're breaching storage capacity in select producers right now. You saw some of that with Iraq earlier this week. The Journal reporting moments ago, we're seeing the same thing in Kuwait, and UAE and Saudi Arabia might follow. That's obviously a bigger, more acute issue for the Asian refiners right now, which is why the Treasury Secretary came out and issued a waiver for the Indians to buy from Russia, the Russian crude that's offshore in tankers right now. But Kevin, I wonder what else the White House has got in store. Not just to tell people to wait, because in the future it will be better, but what are the remedies that you can produce right now?
Oh, sure. The sanction waiver that Secretary Bessent came out with is just one of many, many tools that we have ready. We've got a whole flow chart of tools to use depending on this or that, and we're ready to move them as soon as we have to, but we're also very optimistic that we're going to be able to get this near-term problem resolved relatively quickly.
The Biden administration, as you know, burned through the SPR, took it down quite dramatically. Is there space left in the SPR to deploy some of that, to bring down prices just a bit for consumers?
There is no conversation right now to dip into that, but we've got something like 400 million barrels ready to go if needed. But there is, I reemphasize, that there has not been a conversation to dip into that yet, because our expectation is that this effort in Iran is way ahead of schedule, and that we understand that there are near-term market fluctuations, but we have our eyes on the horizon, and we think that's where people should be looking to.
Kevin, you say ahead of schedule. Is there a schedule?
Yes, but obviously we're not going to go through the schedule on TV.
The timing of this is so important to people, though. They need to understand the duration, to understand how acute the problem will be. It feels very open-ended. It feels different to what we saw in Caracas. Tehran is not Caracas. Iran, as you know, is not Venezuela. Can you assure people this won't be something that goes on for months? This is something that will go on for weeks?
There's nobody that expects that we're going to have a disruption that is anything like what the bears right now fear.
Kevin, the president's also said there'll be naval escorts as well to help tankers get through the Strait of Hormuz. As we understand, tracking the traffic here at Bloomberg, that's grounded to an effective halt as of this morning. What can we do to help those tankers get through that strait, and how quickly can we do it?
This is a matter that is being studied very closely by the military and discussed constantly, and I expect a heck of a lot of progress was made in coming up with a plan that can do exactly what the president has suggested.
There were 2 dimensions to the president's suggestion, one with the naval escorts, and the second piece was insurance. How long do you think it will take to put together something more comprehensive to give people the certainty that these things are insurable?
Well, I think it's really the insurance and the naval effort and the destruction of the Iranian assault capability. Those things are all on the table, and I think that the markets will move forward quickly once it's clear that the U.S. military has resolved those matters.
Kevin, there's another aspect to the price action that's making some people nervous. I'd love your thoughts on it. It's not just the disruption that we're seeing in the Middle East and the disruption to energy supply. There's also issues in private credit. Every day there is a headline about redemptions and certain firms trying to meet redemptions in different ways. We've talked a lot about financial conditions, but are financial conditions tightening in a way that we can't see in private markets? And how are you tracking things?
Oh, we're tracking it very closely. We're keeping an eye on things that are liquid, things that are illiquid, and so on. And right now we see a very well-functioning market that's under a tiny little bit of stress, but for the most part, outside of the one firm that had the significant issue, it looks like everybody's in good shape. But we're following it very closely.
Kevin, how do you track those things? Are you in touch with the big firms right now about what they're doing? Are there certain blow-ups that are making you more concerned than other things? How do you track these things?
There are behaviors that make you concerned, like when you see a radical amount of shorting of assets of firms that are starting to feel some distress and so on. And we're seeing, and that's something that we really haven't seen since the financial crisis in 2008, and we're seeing nothing like that kind of activity.
Kevin, Lloyd Blank finds someone with both respect, said he sees echoes of what happened in the financial crisis. Jamie Dimon of JP Morgan has said some people have done some dumb things. Mark Rohn of Apollo has said something similar. Do you think people have done some dumb things that are going to come to the surface later this year?
I think people have made some bets that didn't pay off, but that's kind of what happens in financial markets, right? So whether it's dumb or not, ex post, it looks dumb.
Does it pose a risk to all of us?
Excuse me?
Does it pose a risk to all of us? Is there a systemic aspect to some of this?
I believe that there's so much security in that space that they can handle the stress that we're observing right now.
Kevin Hassett, thanks for the update. We appreciate it, sir.
Thank you.
Thank you very much. The National Economic Council Director, Kevin Hassett there. Matt, you heard it from the man himself there. Clearly there are some issues that we need to get through right now, but it's going to take time. How much longer this is going to go on for, I've got absolutely no idea. But Matt, that's what's dictating the moves in energy, and that's what's dictating the moves elsewhere.
That's right. And he said he doesn't want to give us the schedule because he doesn't want to endanger the lives of American soldiers. It's very rare to hear that in an interview on non-farm payrolls day, as almost a defense for a number that was surprisingly low, a loss of 92,000 jobs when we were looking for a gain of 55,000. John Farrow from Bloomberg Surveillance, really appreciate you joining us for this interview. Let's get a check of what's going on in markets right now with futures down 1.5%. Sorry, futures. This is cash trade for the last 10 minutes, down 1.5%. Right now, the level at 67.27 on the S&P, and I'm looking at messages from traders who say maybe we should just fold up shop until the S&P index hits its 200-day moving average at 65.82. Right now, it's really the crude price that's driving everything, and you continue to see it rise higher. NYMEX crude approaching, this is WTI, folks, $89 a barrel with Brent well over 90. That is the driver of all of the angst in these equity markets. Joining me now is Elena Popina. She runs our U.S. equities team here on the Bloomberg News side, and we're ending our first week of war with Iran. So I wanted just to get a look at how equity markets have been responding. How has your team been reading these things?
Yeah, Matt, so far this week, up until Friday, there were no signs of outright panic. In fact, the S&P and the Dow and the NASDAQ changed direction every day so far this week. Traders have been trying to figure out what that means for the fundamentals longer term. We all know that geopolitical conflicts have historically presented good deep buying opportunities. Since the Cuban Missile Crisis, going back to 1962, the S&P has added 15% a year after major geopolitical events. So longer term, traders are not that concerned about fundamentals. With the big if of crude prices going up, with the big if of inflation expectations on the rise. We have an inflation report next week, and guess what? The break-even tips for inflation are starting to creep higher. That feeds into the broader anxiety we're seeing right now with the S&P and the NASDAQ down about 1.5% as we speak.
Yeah, I've been talking to the MLive team. They sit right across from your team, and they have been saying, real rates are driving these gains, but now we're starting to see the break-evens break out, if I may, and that's a real concern. You have seen some real turnarounds in equity trading, though. You know, there will be days, the one day that we were down more than 2%, we actually closed higher, and that seems to happen every day.
Yeah, I mean, the markets are trading on geopolitical headlines, you know, with the tape ticking every second. But what's actually happening right now beneath the surface is we have a big rotation out of global equities and into the U.S. Remember, for most of February, we saw the tape of traders going into global stocks. MSCI ex-US outperformed the S&P. The opposite is happening right now. In fact, this week through Thursday, US stocks are on track for the best week since global peers since April 2025. So there is a big rotation from global into the US. You know, the S&P still provides some safe haven. And there is a second rotation going on with traders seeing companies with good balance sheets, good finances as a relative safe haven, because you know we did see some of the hesitation in the Max 7 trade for most of January and February. Right now, trading desks are saying, guess what? Maybe it's a good idea to go into those high quality stocks with high balance sheets, high capex opportunities. And now, you know, the Max 7 group is down 7.5% from a record high. Maybe it's a relative haven asset during volatile times like this.
Yeah, I was just looking at the so the equal weight S&P has been outperforming the price-weighted S&P all year long, and that has turned around in the last few sessions.
Yeah.
So those Mag 7 stocks are starting to become or get a real bid from investors in this market, and you see that going on under the surface, as well as a shift from the Sell America trade.
Yeah.
We see the same thing happening with the dollar. We haven't really seen it with treasuries because of the concern about inflation, right?
Yeah, but you know, the dollar is on track for the best week since 2022. So the relative strength of the dollar and the relative status of a safe haven asset that the U.S. Large cap companies have may make sure that the trade of going back into the U.S. into the high quality U.S. may continue. You know, you look at the small caps, micro caps; they all plunging right now.
Had been outperforming and are now plunging.
Before Friday, the Nasdaq 100 though has been up for the week. The S&P was down, yes, equal weight S&P was down. Nasdaq 100 has been holding ground. Today is always an exception. We saw a very concerning headlines about Iran, about a rise in crude oil prices. But let's see what happens next week. We have a few very important economic announcements, with the CPI being the major one.
And a ton of Fed speakers today as well. As your team talks to investors, what are people saying about the Federal Reserve? Because we had been expecting a number of cuts until we saw these increases in the price of oil, and now it looks like inflation is the main driver of concerns for the equity market, and as well maybe for Fed speakers we're going to talk to today.
Yeah, I mean the Federal Reserve is in this catch-22 type of situation where they really need to go by what the data show and what the economic announcements show, because we don't know what the price of crude is. JP Morgan was out with an announcement that it can reach up to $125 per barrel. That would mean a very different economic environment than where crude is trading right now and where crude has been trading. So it's a very tough situation for the Federal Reserve at this point.
Elena, thanks so much for joining us. Elena Popina runs our U.S. equities team on the BN side. Catch-22, by the way, my second favorite fictional book by James Heller. If you haven't read it, I highly, highly recommend it. Coming up, how will the Middle East war impact inflation and therefore interest rates? These are the questions that we have been asking all week, and these are the questions that Mike McKee is going to put to Chicago Fed President Austin Goolsbee next. This is Bloomberg.
Rodriguez.
And I'm Jason Kelly.
And we're back with another season of The Deal.
With athletes and entrepreneurs who are changing the game on and off the field. Jerry Jones.
Some good-looking trophies.
1 and 1 is 3 in sports, not 2. And it's because that 3 is imagination. That 3 is putting yourself in a way, having yourself hit the home run.
Erica Ayers-Badon.
I'm a high-energy board member. I'm very passionate. I have a lot of opinions.
Robin Arzón.
I want to light fires in people's lives, and that is still one of my core mandates for all of my businesses.
Justin Tuck.
I tell all of my friends that play in leagues now, make these relationships now while you're hot. Don't wait till you're like your 12th year in and you're just hanging on.
Stay tuned. You won't want to miss it.
Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at Japan's Akasaka Palace in Tokyo, and this is Bloomberg.
The trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe. I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie. This is your opening trade.
Only on Bloomberg. From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Let's turn now to Bloomberg's Michael McKee with Chicago Fed President Austin Goolsbee. Mike?
Welcome back to Bloomberg Radio and Television viewers and listeners around the world. Our guest this morning now, Austin Goolsbee, the president of the Chicago Federal Reserve. And of course, everybody wants to know what the Fed's going to do. The Fed's worried about jobs, and today you had a number to worry about.
Yeah, it's a tough miss on the jobs report today. You never want to over-index on 1 month's report, and I've been consistently saying, let's not index on total payroll employment anyway, because a lot of stuff is going on with immigration, with population growth. That said, you saw the unemployment rate inching up, and it's 1 month is not a trend, but it's not a good month. If you got several months like that, that'd be a concerning spot for the labor market.
Well, what's your feeling about what the Open Market Committee is going to do? I know you've been waiting to see data. Chris Waller has been saying he's still in favor of cutting, as is Stephen Myron. Where do you come down now?
Well, as you know, and I appreciate you asked it that way, I'm not allowed to speak for the committee or for anybody else, just myself. I've been saying for some months that we've had relative steadiness in the job market, in my view. The strongest thing in the economy is not AI data center investment, has been consumer spending being solid in a kind of a broad-based way in the economy. But the inflation hasn't been ideal. It's at least stalled out at kind of 3%, and in some of the latest measures, the inflation disturbingly high in non-tariff categories like services. I think we're still basically in that same spot. I remain hopeful / expecting that conditions will improve, that we'll start to see some progress on inflation, head us back to 2%, and by the end of this year, that we would be in a situation that we could commence our march back down to something like the settling point, which is below where we are today. But each time we add an uncertainty, I think the job market characterized by low hiring simultaneously with low layoffs is a weird combination. And when I talk to business people out in the Midwest, they characterize as because of the uncertainty. So as we get more uncertainties, I kind of think the time at which it makes sense to act keeps getting pushed back. I always say the first rule of the data dogs is to recognize there's a time for sniffing and there's a time for walking. And when there's uncertainty and you're getting conflicting data points, that's the time for sniffing.
I'm sure everyone out there is very glad to hear you bring back the data dogs. It's been a while since we've heard that. Speaking of data dogs, one dog that is barking very loudly right now is oil prices, but the Fed tends to look through that.
Yes, I mean, as with any supply side shock, it can lead you in a stagflationary direction, which is to say the inflation side of the mandate getting worse at the same time the employment side of the mandate is getting worse. And that's always the worst case scenario for the central bank, because there's not an obvious monetary policy answer to a stagflationary shock. Oil prices going up, we need to think about, is this a transitory thing that's going to be temporary? Is this going to be long-lived? How big will it be? How long will it last? And how is it affecting the supply chain before we can really say anything about it?
I would assume that you would assume that March 18th is not going to see any kind of rate move because there's still too much uncertainty. Do you think you would have enough data by April to even make a decision one way or another?
You know that I don't like, and you assume that I assume. I don't know.
What would a data dog do?
You know, I don't like tying our hands ahead of the meetings. I want to hear what my colleagues have to say. I want to get as much information as possible, especially at moments like this where we're getting conflicting pieces of information. But you've been there. It's the biggest table that I've ever seen in my life in that FOMC room. So there's plenty of room for everything to be on the table at every meeting. So I'm not going to rule anything out.
We are, from the data that we already have, and other Fed officials have said this, expecting a bad PCE number. Are you still thinking of that PCE inflation as residual tariff as opposed to an underlying fundamental problem with inflation?
Maybe a little of both. I mean, that's why I've been uncertain and highlighting the inflation numbers. There's been some encouraging signs in inflation. Housing inflation has come down a lot and is likely to continue to come down. We had the run-up of goods inflation. That, I think a lot of it is tied to tariffs, and we're still trying to sort out, is there more to come, or is that basically all there was with tariffs and then it'll go away? But there's also been a kind of a disturbing persistence of services inflation, which I don't think you can attribute to tariffs because the tariff content of the services industry is not very high. So we'll have to see what the PCE number says. The Open Market Committee has said we watch PCE inflation. That's in our framework review. That's the best measure that we have of inflation, I think. And if it comes in hot and it's just goods, I would be more comfortable saying that looks more like a tariff-driven thing, and that's the optimist case maybe, that it would prove transitory. If it comes in hot, but it's heavily on healthcare, a bunch of service sector industries, that's a different kettle of fish, and that's a little more, feels a little more persistent.
A sentiment question, the sentiment you get not just from CEOs, but also from just talking to regular people in your district. You've got a situation where people are seeing gas prices go up and up and up. And now you have a really bad employment report at a time when people have already said they're worried about losing their jobs. Are you concerned that this could tip us into the stagflationary environment? I don't want to say recession yet, but could cause people to pull back?
It might cause people to pull back. The last 5 to 8 years, however, there's been a breaking of the link between consumer sentiment and actual consumer spending. for some reasons we understand and some reasons we don't understand. So if you saw deterioration of consumer sentiment as, say, gas prices go up, which historically when gas prices go up, consumer sentiment goes down. If that did not translate into a slowing of consumer spending, I would be much less nervous. As I've highlighted, in 2025, the strongest thing that we have going for us was not AI data center investment. Yeah, that was great, but the main thing driving growth was a strong, stable consumer, broad-based spending, which drove growth in the country. And that still continues until it doesn't. So if sentiment deteriorated, and there's a lot of concern as I'm going around the Midwest and the Chicago Fed district, a lot of expression of concern about affordability, about costs on both the business side and the consumer side. If people begin to be nervous about their employment, historically that tends to show up as they're trying to build a little precautionary buffer, so the savings rate would start to rise. That'd be a thing to watch out for.
Let's end on a little bit of a positive note here. Productivity down from the third quarter, but still 2.8% for the fourth quarter. That's got to be something that makes you feel a little bit better.
Yeah, all of our inner economists are getting a little bit of a warm glow. Productivity growth is what makes us rich. Incomes can go up. Wages can grow faster without inflation if productivity growth is going to remain high like this. So I don't think that the adoption of AI has been big enough to explain that number completely. So I think there actually might be even some more running room to go with the productivity.
Austin Goolsbee, thank you very much. We'll have you back and have a Name the Data Dogs contest or something like that. President of the Chicago Fed. We'll send it back to you.
All right, thanks very much. Chicago Fed President Austin Goolsbee and Bloomberg Policy and Economics correspondent Michael McKee. Now let's get a check on what's going on in the markets after a very disappointing jobs number, to say the least. You have a drop of 1.5% on the S&P 500. The NASDAQ not doing
so much of the cacophony, the frenzy. Yep. You know, we've been through this. The only one in the company that hasn't been through this before is John Tucker.
I know.
I mean, it's all new to him.
It's all new to him.
Yeah,
we're breaking him in.
So, you know, I'm looking at the Bloomberg Launchpad folks, which is what I lived. I mean, Tucker has a tattoo like one, but the bottom line is, while Dr. Goolsbee was speaking, I'm looking at Brent crude with a dash to 92. We're not there.
Nope.
Up 26% off the Friday before the Iran weekend.
Yep, that's where you go. And we're starting to see it at the pump.
But that's just one of the papers here through it. And, you know, here at 10 o'clock Global Wall Street time, it's time to continue the conversation.
We will, and we'll continue it, Tom. We'll let you go, Tom. Tom's had a long week. We appreciate him sticking by for a couple extra minutes here. This is the Bloomberg Intelligence Program. We have Christina Kino sitting in for Scarlett Fu. Scarlett will be back on Monday, her people tell me. So that'll be a good thing. But we got a lot going on today. Market's really moving. So what we want to do is we want to get right to John Tucker and get a Bloomberg Business Flash in New York.
And this report being brought to you by IBKR. In 2025, IBKR retail clients averaged a 19.2% return, beating the S&P 500's 17.9%. The broker you choose matters. Visit ibkr.com/2025. It is a sell-off this Friday. And this is the word, well, one of the words that Wall Street hates, stagflation. And that's the fear that's sending stocks lower. This comes after the U.S. unexpectedly lost 92,000 jobs, and the unemployment rate went up. And with the war spreading, oil continues to surge. What you pay at the pump up, maybe you'll slow down your spending on the other stuff as a result. Brent crude, this is the international benchmark. It is up $5.20, 90.61 right now. As far as the major averages, S&P 500, 92 points lower, 67.40 on the index. That's down 1.3%. The Dow down 720 points, a decline of 1.5%. And right now, the NASDAQ 100, 280 points lower. That is down 1.1%. Earlier, we heard from Fed Governor Chris Waller. He tells Bloomberg higher energy prices unlikely to move the needle on policy.
For us, thinking about policy going forward, this is unlikely to cause sustained inflation. This is one reason we don't look at energy prices when we look at core. Core is a better predictor of future inflation. You're going to see this, but once these kind of supply chain issues that you laid out, once they unravel, this will start coming back down.
And Gap reporting fourth quarter sales and profit coming in slightly below expectations. Taking a beating today. Gap shares down 13%. And then on the tech side, Marvell Technology shares, after the chip maker said its year-over-year revenue growth will accelerate each quarter throughout fiscal 2027. Those shares right now 16% higher. Oh, it's a birthday today.
It is?
Alan Greenspan.
Oh, that's right, 100.
Do you believe that?
Yeah, good for him. Yeah, Tom made some comments earlier today because that's important.
The 13th chair of the Central Bank, appointed by Ronald Reagan.
Yep.
He had been up here in the studio a couple of times after
bet.
he retired.
Okay.
Impressive guy in person.
Yes.
Anyway, we check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker, and that's your Bloomberg Business Flash. Christine and Paul, happy Friday.
Happy Friday.
Happy Friday, absolutely. Friday? Yeah, and especially when you're going skiing on Sunday, it's even a better Friday. So Christine Aquino sits in for Scarlett Fu here today. Christine, welcome.
Thanks for having me.
We were in the Bloomberg Interactive Broker Studio today. We're streaming live on YouTube and on Bloomberg.com, so check us out there. As John Tucker was just reporting, stocks are on the move. Oil on the move. We got WTI crude oil up 8.5% to just under $88 per gallon. Do you remember a few weeks ago we were at $57 a barrel, and here we are at 88. So it's just been an extraordinary 50% plus move up in oil. Let's take a look at some of the stocks on the move today. We can do that with Bloomberg's Tatiana Darie. Tatiana, what are you looking at?
Well, let me start with some good news because there are pockets of screen on the screen, even in this ugly open. Marvell Technology is one stock moving to the upside, up 16% after delivering a bullish sales outlook, saying that data center demand was growing even faster than anticipated. California-based company now expects fiscal 2027 revenue to grow to $11 billion. That compares to previous estimates for about $10 billion. This comes as the cloud computing operators are boosting their capital spending, something we know very well. But Marvell is a major player in the market for application-specific circuit chips, which are ASICs, which are the custom chips that compete with NVIDIA. So there's still pockets of green in this AI trade.
Yeah, very interesting. Yeah. All right, well, not pockets of green. Let's talk about your next stop. Gap, what's going on there?
Yeah, not pockets of green when it comes to the consumer. Gap shares falling 13% after reporting fourth quarter sales and profit that came in below expectations as two chains underperformed. Old Navy, the company's biggest brand, and Athleta, its smallest, both missed comparable sales estimates. Results show that its turnaround remains uneven as plans to revitalize Athleta are still taking time, but this is overshadowing actually a better than expected profit for the full year and sales range in line with estimates. So it appears that jitters are really concentrated for this brand, and analysts calling it relatively bland in the world of Lululemon and other brands. I don't know, maybe you guys would disagree there.
I don't think either of us are Lululemon people, right, Paul?
No. But everybody else says, like, Alex Steele, Scarlett will say, like Lululemon, but pricey. And I can probably get something similar for less. That's kind of the feedback I've gotten.
And apparently their last line of leggings is see-through, so that's not good.
Oh, interesting. Yeah. Okay, that could be a strategy. Blue Owl.
Blue Owl, the private credit firm under pressure again today, down 6% after Bloomberg reported that it has nearly $48 million exposure to the collapsed UK lender Century Capital Partners. Sources tell Bloomberg that Blue Owl funded the riskiest tranche of loans there originated by Century, a lender that is focused on high-end central London real estate. And the company entered administration, which is really a fancy term to describe insolvency process in the UK, days after a larger rival market Financial Solutions fell into a UK form of insolvency. So I picked this stock because private credit is such a big worry right now, and here we are, the dominoes keep falling in this space.
Well, that's a very big story. The other huge story for, I think, Global Wall Street was BlackRock's story. BlackRock curbed withdrawals from one of its biggest private credit funds today after clients' requests for redemption spiked. The latest sign of retail anxiety about the $1.8 trillion private credit market. BlackRock stock's down 5.5%. So it's not just Blue Owl, it's BlackRock. And Tom asked me what surprised me the most about this was it's BlackRock. I mean, they're the biggest. They are arguably the best. And if they're seeing problems, the stress is real across the market. So maybe, and so what I'm going to be like Jamie Dimon, going to keep an eye on it. That's what he told us to do. I think that's good advice here.
Keeping an eye on cockroaches, Paul.
Yeah. So that's the way to do it here in private credit. There might be something there, to say the least. Tatiana, thanks so much. We appreciate it. Tatiana Derrier, Bloomberg News, giving us the latest there. For more conversations like this, subscribe to our Stock Movers Reports. Listen for 5-minute audio reports on the biggest winners and losers in the stock market. Subscribe to Stock Movers on Apple Podcasts, Spotify, or anywhere you listen here. The eco data, the jobs data, coming in much weaker than expected. It's only 1 month, but just to review, change in non-farm payrolls consensus was positive 55,000. The actual came in at negative 92,000. Ira Jersey, Chief U.S. Interest Rate Strategist, joins us here. Ira, what are you and your fellow folks in the U.S. Treasury bond market, how are you guys interpreting the economic data from today?
Yeah, well, the data wasn't particularly good, particularly on the job front. I'm sure there's some pieces in there that some people will take out as positives, but generally speaking, negative 92,000 jobs created is not a positive. In fact, it was pretty broad-based declines in terms of what sectors saw the largest losses. The other kind of puzzling thing out of all of this was that the participation rate went down. So you have less people looking for work. So someone brought up to me this morning that the weeks of unemployed actually went down, but it went down, I think, in part because people just dropped out of the labor force. So when that happens, that's actually a very bad sign for the labor market on a going forward basis. That being said, the Treasury market today, it's focused on what you talked about a minute ago, Paul. It's all about oil. Everyone's really, really worried about that. You look at inflation break-evens and inflation expectations, those are shooting higher. You look at TIPS real yields, which is usually a sign of what is growth and potential Fed activity, and those are lower. If you look at 5-year TIPS right now, those are rallying and you have lower yields there where you have higher inflation expectations pretty significantly across the board.
Yeah, I mean, very interesting. So many variables here just kind of weighing in on the bond market. Where do you see kind of all of that squaring up? Is it a potential impact on the shape of the curve, perhaps? Because there seems to be an adjustment on the front end with regard to the reaction to the jobs number. But as you say, inflationary pressure is still very much a factor for the long end. How do you think the curve shapes out?
Yeah, so it's that is probably the trickiest thing right now. It was for a long time. I think almost a no-brainer trade was that the curve was going to be steeper over a long period of time, and that worked, right? We went from inverted by 100 basis points to positive 70 basis points at one point. I think the challenge right now that the market's going to continue to have is, how does this affect short-end rates and monetary policy? So that's going to be where the curve adjustment is most likely to be, because we've been saying all along that we thought that the 10-year would be relatively sticky between 4 and 4.5%. So yeah, wide range, but also kind of range-bound within that kind of range. But it was really the 2-year that was going to drive the curve, and why we thought we'd get to 100 basis points in the 2-year versus 10-year yield curve was because eventually that the Federal Reserve would cut below 3%. But when inflation's so high, there is a question, should they be cutting interest rates when there is this fear of inflation? Now, I do think that the Fed is going to worry about this, because one thing is, when you have higher oil prices, in a way that's a tax on the consumer. So if you're spending a lot more on gasoline and oil, heating oil and things like that, heating oil, we're ending that season now, but eventually that means that you're not buying other goods and services that really tend to grow the economy. So the market often looks at it as a tax on the consumer, and therefore kind of looks through an oil shock, versus, say, if this was more related to demand for oil, which would be a different situation, where if demand for oil was growing because growth was very high, that's a different situation completely.
So Ira, we've talked to Mike McGlone about how the energy markets and what's going on there with the oil markets, as he's our commodity strategist, and he says the trading in the energy market's been pretty orderly this week, not really sensing any panic. How has it been in the Treasury market these days?
Yeah, the Treasury market's been pretty calm, generally speaking. I was out of the office for a couple of days, but you come back and you say, okay, well, we rallied a lot early in the week, right, on kind of flight to quality fears. You had the risk assets, equity market off quite a bit, and now we're bouncing back. You look at volumes; volumes are kind of average-ish, and so you're not seeing a gappy market like you might if there was a real systemic problem. You also look at the repo market, so you look at where secured overnight financing rate, where SOFR's trading, 3.66%, exactly in the middle of the Fed's range for their target. So all of that suggests that the market's been very orderly, and we haven't seen any stresses in terms of the financial market stresses that you might see. So this is more of a supply shock, and I think it's not a banking issue. This is much more of a macroeconomic geopolitical issues that are going on.
All right, Ira, well, we're going to hear from the Federal Reserve, of course, in just a couple of weeks. Do you think they're going to run the usual line of we don't pay attention to one data point and it's not going to change their trajectory? Or do you think things have transpired to a degree that they're going to have to respond in some way, at least through words, even if they're not expected to do anything?
Yeah, I do think it'll be through words. We do anticipate the Federal Reserve cutting interest rates 2 or 3 times this year. Even with the oil shock, that might push things back a meeting or so, depending on how that might filter into the rest of the economy and inflation expectations. But ultimately, the Fed has already shifted to what Jay Powell has called balanced risks for both inflation and for the job market. But when you have a number like this, that is going to open eyes within the Fed and certainly increase fears for among the more dovish members of the Federal Reserve, who are going to get pretty vocal and loud. But so I think that they might get a little bit more dovish in their statement, not actually do anything this meeting. It'll be interesting to see the dots. We do get the summary of economic projections this year, so those might be revised pretty significantly with some of the things that are going on and where oil prices are. So you could see a weird thing where maybe they keep the core PCE expectations kind of where they are, maybe even lower them a little bit, but you see headline CPI or headline PCE higher because of what's going on with oil right now. So that'll be something that we'll look at and see what the preponderance of members of the FOMC are really looking at in terms of inflation dynamics. But more importantly, is going to be the unemployment rate, right? If they think that the unemployment rate's going up to 4.6, 4.7, 4.8%, then the likelihood that they're going to cut interest rates another 75 to 100 basis points, I think, increases quite a lot.
Ira, should we be concerned about these World Cup games coming up here? Iran, some of the other countries are maybe concerned here. What's the latest from the World Cup chatter these days?
Yeah, so I was actually just down in North Carolina doing a U.S. soccer coaching course. Took a couple of paid vacation days to go do that. The talk around there is, will Iran be participating, because they were supposed to be in Seattle for some of their games later this year. It's hard to imagine that they're going to participate, and this is geopolitically, this is one of the weirdest World Cups ever, in that who's going to be allowed to come in, whether it's fans or players. So nobody really knows, right? And certainly the government has not focused on that at all. FIFA's been quiet about it, at least as far as I've heard. So it is going to be strange. And remember, this is the first 48-team World Cup. So there's probably 16 teams that wouldn't have been at. Well, there would have been 16 teams that wouldn't have even been at this World Cup had it been a smaller World Cup. And Iran probably would have been one of them, quite frankly.
And in Mexico, what's the latest from FIFA about whether they want to conduct games in Mexico?
Yeah, they said that they were reviewing it. That's the last thing that we heard about Guadalajara. Yeah, there's supposed to be there's 3 different sites in Mexico where they're playing games, and obviously Guadalajara is one of them.
Folks, the reason we talk soccer with Ira, because he is our chief soccer correspondent for Bloomberg Radio, in addition to his title as chief U.S. interest rate strategist for Bloomberg Intelligence. Ira Jersey, thanks so much for joining us there. Get the update on the Treasury bond market as well as global soccer. And let's go down to North Carolina and get licensed to be something else in soccer. So that's our Ira Jersey. That's how he rolls. What are you looking at here today, Christine?
I mean, I'm just looking at this treasury market. I mean, very interesting. I mean, as Ira said, right, it feels really very much a market caught in between that deterioration in the labor market, obviously, but also inflation pressures.
Absolutely. All right, we're going to get the latest coming out of the Middle East. Coming up, we're going to speak with Ethan Bronner. He's Bloomberg Israel Bureau Chief. We'll get the latest on Iran, Israel. They're trading fire as we speak. Does not seem to be de-escalating at all. And again, oil, that's where you see it reflected. WTI up 9%. This is Bloomberg. Good morning.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
All right, well, it's not too hard to figure out. All 11 major industry groups in the S&P 500 are down. Even energy is down right now. So the jobs report, that was weak, a lot weaker than forecast. And then the unemployment rate, that ticked higher. Brent crude, the international benchmark, that continues to push higher, above 90 a barrel right now, up $5.55 a barrel. And this is going to translate into, higher pump prices. The current nationwide average, $3.32 a gallon. At least that's what AAA tells us. Old Dominion Freight, worst performing stock right now in the S&P 500. They are down 7.3%. Overall, the S&P 500 down 82 points. This is a decline of 1.2%, 67.49 on the index. The Dow Jones Industrial Average 620 points lower. The NASDAQ 100 down 261 points. That is down 1%. And let me do for the year, the Dow's down now 1.5%. The S&P 500 down 1.4%. The NASDAQ for the year since the start is down 3.1%. Then there's a story on the Bloomberg electronic warfare. That's the latest thing to worry about in the Gulf for shipping because it's disrupting and jamming GPS signals.
Sure.
The one thing I learned from Javier Blas, well, I learned a lot, but he's saying, at least in the early days, it's more important for shipping to get into the Gulf than out, because you think of a tanker, not just a vehicle with which to transport oil, but it's also a floating storage facility. And if you don't have the facilities to store, you can't produce. And once you shut down production, it doesn't come right back.
And that's what's happening in Kuwait. The story I'm reading.
So anyway, that's for whatever that's worth. We check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash. Christina Paul.
John Tucker, thank you so much. We appreciate it. Christina Aquino sitting in for Scarlett Fu. I'm Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio in New York City. We're streaming live on YouTube, and now we're also streaming live on Bloomberg.com. You just have to hit /video, and that's where you'll find all the live and curated video here. Let's get the latest reporting from the Middle East. We can check in with Ethan Bronner. He is the bureau chief, Israel bureau chief for Bloomberg News, based in Tel Aviv. Ethan, I don't really sense any movement to de-escalate today or in the last 48 hours. Can you give us the latest, what you're hearing and seeing there?
To talk to you. Look, I know that there's a desire in the United States and elsewhere for de-escalation. I see no desire in the U.S. military or in Israel for such de-escalation. They've decided that this is a job that they're going to take on. It's going to take them some weeks to do it. And so the idea that they might be slowing down is the opposite of the impression we get. Meanwhile, I have to say one other thing, which is that the Israelis have taken out a whole bunch of the launchers, and at least as far as Israel's concerned, it was a pretty quiet day in terms of incoming missiles.
Well, Ethan, we of course heard from President Donald Trump this morning talking about how there will be no deal with Iran except for, quote, unconditional surrender. How is that being received in Israel and across the region?
Well, I mean, the Israelis, of course, that's exactly what they want. I mean, most of the rest of the world, I think, feels differently, and much of America feels differently, and that's why this is such an interesting conflict to watch and to observe. I mean, I think that, and consistently, people are assuming that there will be space between the Americans and the Israelis on this matter, and perhaps there will be eventually. At the moment, there does not seem to be any. President Trump and Prime Minister Netanyahu together want to take apart this government in Iran and put something else in its place.
Ethan, are your sources telling you that there's a level of surprise, perhaps, that the degree to which Iran has retaliated, particularly as it relates to other countries in the Gulf region? Because a lot of countries are being pulled into this.
A lot of countries are being pulled into it. I think at the beginning, people were, I mean, at least, you know, in a kind of the Israeli world of analysis, the argument has been this is kind of crazy on the part of Iran. It's making enemies of countries that it had decent relations with. On the other hand, you know, the next thought that comes out is, hey, this is what you do when you're desperate, and it will put pressure on the Americans. It will put pressure. These Gulf countries are desperate to have this stop and to go back to being havens of calm in the region. And, so some people say it makes sense, although it's going to ultimately, they hope, redound toward Israel, but that's impossible to know. Because one of the other things is, should Iran actually be deeply weakened or nearly destroyed, then the attraction for these Gulf countries to build a relationship with Israel is reduced, because part of it was to protect them against Iran, which will no longer be a risk.
All right, well, Ethan, big question for markets, of course, is whether there's going to be an off-ramp that emerges. Given the developments this week, what's your sense of that happening within the month of March?
Month of March, I mean, that's 3 more weeks. I think that's a reasonable guess. I would guess that by the end of this month, there will be some conclusion, but really, truly don't know any more than you. I mean, and I think the dynamic of these kinds of wars is always sui generis, always unusual and unique in its own way. And we can't know. I mean, the biggest armada in more than 2 decades from the United States was brought into this region for a reason. And they are using it. And I don't know where this is going. There's a lot of reason to be nervous about it going somewhere scary. But this is the conclusion that these 2 leaders have drawn, and we'll see where it goes.
Ethan, thank you so much. We appreciate getting some of your time. Ethan Bronner, Israel Bureau Chief for Bloomberg News. He is based in Tel Aviv, boots on the ground, gives us a sense of kind of how things are on the ground, how the folks in Israel are feeling on a day-to-day basis, and clearly supportive of the U.S. efforts here in Iran. Let's get back to the economics here. We've got, a couple of the top headlines on the Bloomberg Terminal tell you what you need to know here. It's about labor and it's about inflation. Number 1, U.S. unexpectedly sheds 92,000 jobs. Unemployment rises. That's the top headline. Number 2, Brent surges past $90 on a report. Kuwait reducing output. So there you go. That's the dual mandate, labor and inflation. Let's check in with Jeffrey Cleveland, Chief Economist at Payton and Regal. Jeffrey, thanks so much for joining us here. First, let's start on the labor front.
Good morning.
I'd love for you to just kind of tell us your thoughts on that labor print we saw today, which was unexpectedly weak.
Yeah, Paul, I was told that the labor market was stabilizing, and we're just not seeing that from our perspective. 5 out of the last 10 months, we've had negative readings. So it wasn't just last month. 5 out of the last 10. The 3-month average, so if you want to average some of the seasonal or month-to-month volatility, the weather, sometimes people point that out. The 3-month average is very weak, just 6,000 jobs. Even if you exclude government payrolls, it's like 18,000 jobs over that time frame. So I think the labor market is very weak and not picking back up, at least not yet. And that's, I think, the key risk for the U.S. economy that I see.
Yeah, well, Jeffrey, I mean, very interesting when you dig into the details, right? Some of the declines that we've seen in the subcomponents of the labor market had to do with strikes, but then some of the commentary that we've seen this morning saying that essentially, if the labor market isn't even robust enough to weather a strike action, what does that really say? Yeah. What's your take on that?
I think that's right. I mean, when we look at our cheat sheet that we send around right after the number drops, every single sector, maybe except one, we saw shedding jobs. So it's really across the board, the slowdown, the weakness. And when you're only adding 10 or 15,000 jobs per month on average over the last 12 months, any little shock is enough to upset the economy. So I think this, for investors, has to be the chief concern, not inflation. I know inflation is getting all the headline based on the news, but I don't think that should be the main concern. This labor market situation still disturbs me.
And so is it still reasonable? I mean, I guess a lot of folks have been characterizing the U.S. labor market as kind of a no hire, no fire. Maybe that's not such a terrible thing and may have some negative implications for growth, but is that still the world we're in, do you think?
Yeah, layoffs still low, Paul, through this latest week of data, if you look at initial claims. I think that's true. It's just, for me, when we look at the data, adding 10,000 jobs per month on average is far too few. I could understand that the break-even rate of payroll growth has slowed. We have an aging population. Workforce growth has slowed. But 10,000 or even negative seems too low. So I think the risk here is the unemployment rate continues to rise. We were just shy of a cycle high on the unemployment rate. It's at 4.4. I think so far for the cycle, we did edge up to 4.5. And if you look at that on a chart, it does look like it's going higher. So I think that the risk is too few jobs being created. The unemployment rate goes higher from here.
Yeah, well, just looking at kind of how markets are taking this, Jeffrey, I mean, they're still leaning towards maybe 2 rate cuts for the year. And, seeing the data today, does that give you a sense that maybe markets are underpricing this? There perhaps is room for the Fed to do more this year?
Yeah, we think at least 3 cuts for this year. And the reason for that is not just the weak labor market, but also inflation. So when I talk to a lot of clients, colleagues, competitors, if you will, very still worried about inflation. The rise in the oil prices, the energy prices this week, I think are adding to that. Our view, though, is that the pass-through from energy prices to core inflation is very minimal, especially for the U.S., where we're pretty well insulated. And we do think over the course of the next 12 months, inflation will cool, and that will also open the door to rate cuts. So too much fear about inflation and not enough concern about this weak labor market, and that tells me that too few cuts are still priced in.
Jeffrey, let's on that inflation call here. We got Brent crude at $91 a barrel. I mean, I think the concern is if that stays at or near that level for some extended period of time, that's got to be inflationary, and we're already seeing the price at the pump surge.
Yeah, I mean, these geopolitical events, you can look at 6, 7, 8 major ones in the last 30 or 40 years. You do tend to see a spike in oil prices. They tend to be pretty short-lived. Within the 6-month time frame, they come back down. So I think that's something to keep in mind. The second thing, Paul, is what is the pass-through from Brent or from WTI into U.S. Core inflation? It was a much bigger pass-through in the 1970s and 1980s. That's right. But over time, it's come down. So we just think there's a minimal amount of pass-through there to core inflation, which is the key metric I think the central bank will look at.
Yeah, I was out in California last week, and I paid like $5.25 a barrel. Yeah. I don't know what these people
That's
are doing.
A different animal out
That's
there.
A different. You guys are a different animal out there, Jeffrey. That's why every other car.
Special formula.
Yeah, exactly. That's why every other car was a Tesla. Jeffrey, thanks so much for joining us. Jeffrey Cleveland, he's the chief economist at Payton and Regal. They're based out there in Los Angeles. So yeah, that's a kind of a big deal out there. So, but again, I think you're looking at some of these energy prices just surging here, continuing their surge again. Brent crude up about 7% here, $91.20. WTI up almost 10% today, or almost $8, just below, right around $89 per barrel. And again, we were at $57 a barrel just a few months ago. So a big surge in energy prices.
Yeah, now we're talking about what, $100 oil?
Yeah,
and the implications.
Yeah, and I think we talked to Mike McGlone, a Bloomberg intelligence strategist, commodity strategist. And he said, "Yeah, this is the premium. This is the Iran premium, and as quickly as it went in, it can come right back out when and if this thing calms down." So we'll keep an eye on that as well. But again, the sell-off in the market today. That has pretty much been the tone for most of the week. We did have one up day, so stay on top of these markets for you. Coming up, we're going to check in with Dan Ives, the Global Head of Technology Research and Wedbush Securities, get his thoughts on some of these tech names. The NASDAQ's actually been doing a little bit better than the S&P here in the last several days, so we'll see if that rotation trade out of tech or out of into value is still a call. This is Bloomberg. Good morning.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
I'm John Tucker, the Bloomberg Newsroom with this Bloomberg Business Flash. So America is shedding jobs. The payrolls decreased 92,000 from the report this morning. The unemployment rate moving a tick higher to 4.4%. So you take that and combine it with higher energy prices. Brent crude above $90 a barrel. You've got stagflation fears, so the major averages are all lower, although off the worst levels of the session, pairing some of those earlier losses. The Dow down 540 points, down 1.1%. The S&P 500, 65 points lower, down just about 1%. The NASDAQ 100, 186 points lower, and that is down 0.75%. Meantime, economist Sarah House at Wells Fargo, she remains firmly focused on the price of gasoline.
Well, if consumers are getting squeezed in terms of their purchasing power with that jump in gasoline prices, then that could feed into their spending in other categories and can make firms cautious. So I think really this just depends on how long we see this conflict drag on.
Let me pick out some of the movers to the upside. Kroger, the supermarket grocery giant, up 3%, raising the game in its battle for customers. They say they're working on improving the customer experience. The company rolling out a number of initiatives, also reintroducing paper coupons after listening to older customers who didn't know how to use digital coupons. I'll leave it there. Oracle planning to axe thousands of jobs, historic build-out of data centers at the company to power AI workloads for customers like ChatGPT maker OpenAI. This is a real no-no.
No.
And you have more experience at this than anybody else. 2 junior Goldman bankers have set off a blame game inside the firm. They took part in a glossy magazine feature about the finest boys in finance. So these 20-somethings, you can see their pictures, said compliance at Goldman was okay with their participation in this, but Goldman's press office, they never got word. And you'll recall back in 1986, way back when, there was this young punk named Jim Cramer. He was 31 at the time. I call him this because he's a friend. He posted to the New York Times about his wealth. He was out the door in days. So it's like, no, they're just, kids. Kids out there, you don't do this, okay? Career advice right here from Bloomberg. I'm John Tucker. That's your Bloomberg Business Flash. Christina Paul.
All right, John Tucker, thank you so much. We appreciate that. Christina Aquino sitting in for Scarlett Fu. I'm Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio in New York City. We're streaming live on YouTube as well. Let's talk a little technology stocks here. Here's a note from a recent analyst who says investors are now navigating an uncertain Iran military conflict in the Middle East, adding to the nervousness already in the tech trade with the AI ghost trade and Anthropic worries abound. The author of that note is Dan Ives, global head of technology research at Wedbush Securities here. Dan, love to get your thoughts. He's somewhere in the swamps of Jersey. I don't know where he is right now. But what is the AI ghost trade, Dan, and how's it impacted tech stocks?
Yeah, look, Paul, I mean, the AI ghost trade, it goes back to the Anthropic worries that's crushed software this year. In terms of cybersecurity software, that these LLMs are going to replace the software layer. And I'd say to some extent it's also been a huge overhang on names like Microsoft. But we continue to view it. It's a good trend. I think last week's Anthropic event earlier in the week will be the start of a bottoming event. I think we've already seen it in software. And I think it's a fictional tale, a fairy tale that Anthropic is going to replace software.
Yeah, well, I'm sure, Dan, that you've read the Citrini report from a couple of weeks ago that really sparked some of these worries or continue to stoke these software worries. What's your take on that scenario? Are you in a camp that it's too much doomsday, especially because they were calling for this or rather, it was a hypothetical scenario that they were potentially seeing play out as soon as 2028. But what are your thoughts around that?
I mean, that's like me saying in 2 years, I'm going to be in pole vault in the Olympics in LA.
You could be.
I mean, look, I get, to each its own, but I believe we're in the early days of an AI revolution and what's going to be a secular tech bull market. Look, I get the jitters, the white knuckles that we're going through in terms of the ghost trade, worries about CapEx, obviously the Iran conflict, war, which is adding to that. But it just speaks to my view, like this will also pass. Like these are going to be opportunities to own the core tech winners in a revolution where the U.S. for the first time in 30 years is ahead of China when it comes to tech.
Dan, as it relates to risk or potential risk to software, is there a way to differentiate ones that are maybe more at risk versus less at risk?
Yeah, Paul, I think it's a great point. Look, I think first off, the most disconnected of all of software is cybersecurity. Like when I look, like nothing is replacing to some extent, AI just increases the surface area and the miles are going to have to be protected. CrowdStrike, Palo Alto, Checkpoint, Zscaler. Like I think that's probably one of the areas that I think is a huge misnomer. And then you look at like the Salesforces, the ServiceNows, the Microsoft, like nothing is replacing that layer and that data. Palantir would be a good example. Even when you look at like everything that's happened with Anthropic and the Pentagon, it's just going to increase the ability for Palantir, less reliant. It's a plug and play in terms of the models. Are there companies like UiPath, some others that have maybe more one-trick pony business models that could be disintermediated? Yeah, but you can't paint them all at the same brush. And that's why this is the most disconnected sell-off that I've seen in my history on Wall Street going back to the late 90s.
Yeah, well, Dan, I know that you've also written recently about how the tech trade and the developments in that space connects to the broader macro environment that we're seeing. Obviously, the Iran conflict driving a lot of price action this week. What are your thoughts around that then? How does this new catalyst kind of further upend what we're seeing in the tech space at the moment?
Look, I think right now, like investors are trying to put pieces of the puzzle together. And the puzzle keeps getting thrown apart, right, in terms of like other risk and other fears. I think at the end of the day, you take a step back. The Anthropic fears, the ghost trade, that is way disconnected in terms of what I see it's happening in software and broader tech. The CapEx dollars are going to continue to increase. And even though you're going through these jitters, that's not going to stop. That's going to continue to accelerate. I think when you look what's happening, with Iran conflict and war and what this is doing, look, to some extent, military is going to just have to rely more and more on technology players. And I think that's playing out. We've talked about like our top 10 names, like there's names like Planet Labs, there's names like Voyager, of course, like, safety tech names, cybersecurity names like Palantir. I think tech investors need to navigate this uncertainty, but own the winners. And you cannot get caught on what's still the long-term thesis that we're less than a third of the way through.
Dan, last question, 30 seconds left about how do you put into context the Anthropics and the OpenAIs and some of the discussions they've been having with the government, particularly the Pentagon, about how technology is used?
Look, Anthropic, like, they touched the third rail, essentially, right? Now they're trying, I think, starting to backtrack and some of the apologies, but you cannot tell the government, and I think there needs to be guardrails, and I think OpenAI and Altman's talked about, and others that have worked with the government. But I think for them, like, it got them into a very precarious situation, supply chain risk and others. And it's a cautionary tale, right, in terms of what's happening. And others will gain from that opportunity. But look, we're going into unprecedented territory. But I think Anthropic, like last Friday night, that was I think that was a black eye situation that they're trying to navigate.
Are we going to get Anthropic and OpenAI IPO in 2026?
Look, I think it's one where I'd be surprised if that happened in 2026. I mean, you talk about SpaceX and others, yeah. But listen, when you get supply chain designation like that from the Pentagon, which essentially is the same as Huawei, that's you're not digesting that over a Cabernet over the weekend.
Exactly. Very good, Dan. Thank you so much. Dan Ives, Global Head of Technology Research, Wedbush Securities, joining us for what is always a wide-ranging discussion on all things technology. And again, you think about warfare these days. You buy the defense primes, but you buy some software company. Technology's all over the war business these days.
Yeah, it's part of the supply chain too. Yes.
Exactly. So you think that a lot of these tech names would be rallying on some of this news. But S&P off 80 points, 1.2%. This is Bloomberg.
This is Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio.
Christina Aquino sitting in for Scarlett Fu. I'm Paul Sweeney, live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube and on Bloomberg.com as well. But one of the undercurrents out there in the marketplace is credit quality, particularly in the private credit business. We've been reading stories over the last several weeks and months, including Blue Owl, for example, and there's another about some credit tightness there and some concerns there. Then BlackRock today. BlackRock curbed withdrawals from its HPS corporate lending fund after client requests for redemption spike. I wasn't expecting BlackRock. That's just such a high quality name. I was not expecting to see the BlackRock come into this conversation. But let's get the latest reporting there. Brian Chapata joins us, managing editor of leverage finance and distressed debt for Bloomberg News. Brian, talk to us about what's happening in the private credit market here today. Are these cockroaches, as Jamie Dimon suggests, or is this something now maybe a little bit more systematic or systemic?
Well, you know, I think you talked about at the jump, you weren't expecting necessarily BlackRock. And, you know, one of the big things that BlackRock has been pushing into is private markets and is private credit. So this HPS fund is one of the major funds that it acquired as part of its acquisition last year of HPS Investment Partners. So what you were seeing here in this fund is 9.3% withdrawal requests. And they have stated in their language, as many of these private credit funds do, if we reserve the right to halt redemptions at 5% if they become too overwhelming for us because we can't really sell our assets. So they threw up the gates, as they like to say, and as a result, investors aren't getting the full money back that they expected. We'll see if that continues, and if it does, that will be something that will play out over the quarters to come.
Well, Brian, BlackRock saying that this step is in line with its existing management of liquidity, as they put it. Are investors buying that? Is the street buying that?
Yeah, well, one of the things that we've kind of observed on the private credit team here at Bloomberg is that even just as recently as this week, Blackstone opted to meet all investor redemption requests, even though it was 7.9% in excess of that 5% threshold. They were allowed to go all the way up to 7%, and then they also actually put some of the firm's money and some of the employees' own money into kind of offsetting the withdrawals. So for a long time, we have not seen any asset manager actually say we are limiting withdrawals, because it's not a good look necessarily if you can't get your full money back. But it is, as they said, kind of part of why you got into private credit in the first place is illiquidity to get paid for that.
So, Brian, is there, or put it this way, is there a consensus building as to whether there really is a systemic credit problem in private credit?
Well, right now, it's kind of a liquidity problem, right? There's a mismatch, I think, between maybe some of the retail investors that got into these products that kind of expect that if they want their money back, they can get their money back and do something else with it. So I think this has to all play out. And I think the question that everyone's asking is, will there eventually be kind of a liquidity problem become, kind of there's a feedback loop, right? Like if there's forced selling, then prices go down, that hurts returns, and then that necessitates kind of, people wanting to pull their money more, and it becomes this kind of very negative feedback loop. We kind of saw this with commercial real estate a few years ago when the Fed was hiking rates. So we have to see how this cycle plays out and whether it continues in the coming months and quarters.
And are we seeing any read across through the broader credit space? I know that, for instance, in publicly traded credit markets, spreads have been quite favorable at the beginning of this year. We've seen a lot of issuers benefit from that. But now that we're seeing more jitters in the private credit space, is that something that you expect to ripple across the rest of the market as well?
It's a really good point. I mean, some of these private credit vehicles have leveraged loans, which are kind of more publicly traded, broadly syndicated in their portfolios, so that they have some sort of liquidity. So we are actually seeing some evidence of this trickling out into the other more like risky lending markets, where a lot of managers are selling what they're able to and selling what's easy, and that's actually hitting loan prices a little bit more than we might expect, even though those loans are relatively higher quality and are generally doing fine. Investors are kind of trying to get liquidity where they can, and so they're kind of selling the stuff that they're able.
Are fund managers, are they out there in the market trying to raise capital for private credit funds? I would think this would be a tough time.
They are still. I think it was Dan Loeb who came out recently and said he was actually raising a BDC. There are pockets of fundraising that are still working, but I do think that's obviously a fair question. There's been this big, obviously, push into retail, 401ks, private markets, and it comes at perhaps not the most optimal time, as there's kind of a reassessment of risk and kind of liquidity. Nobody really cares about liquidity until they do, and when they do, it can be kind of what we're seeing today.
Yeah, well, are we seeing also any signs of stress given what's happening in the broader space with the Iran conflict at this moment? How is that going to play into private credit and credit markets broadly?
Yeah, it's still, I would say, early days as far as the spillover effects, but obviously there are a lot of borrowers out there that are exposed to commodity prices, for example, and so I think those are some of the markets where you're seeing the most dramatic moves as a result of the conflict in Iran. So something that I think the credit markets have to be watching pretty closely, but for now it was mostly just the markets kind of just really quieted down quite a bit as everybody kind of assessed what was happening and how long the conflict might be going on. So I think we'll see that maybe next week or the week after as some of these big deals come down the pike.
Brian, thanks so much for joining us. Really appreciate it. Brian Chapata, managing editor of Leveraged Finance and Distressed Debt at Bloomberg News, joining us via the Zoom thing as we continue to follow the credit challenges, maybe the liquidity challenges, as Brian was saying, in private credit. For our listeners in the U.S., a reminder, you can listen to us via satellite radio on Sirius XM Channel 121. Access the world's only global audio business network, coast to coast, 24 hours a day. Bloomberg Radio on Sirius XM Channel 121 is presented by Golden Crest Metals. Stay tuned for the latest market news and industry research the next hour. A Bloomberg Intelligence, it starts right now.
Bloomberg Intelligence with Scarlett Fu and Paul Sweeney.
Concern about rising prices spooking investors.
What does renewables investment look like in the U.S.?
More tariff talk coming out of this administration.
Breaking market headlines and corporate news from across the globe.
The president wants lower interest rates. He wants a rate cut cycle.
How do you broaden out the AI play?
Are people just looking for something to worry about when it comes to China?
Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio, Originals, and the Bloomberg Business app.
All right, we're here. We got Christina Aquino sitting in for Scarlett Fu, and I'm Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube and streaming live on Bloomberg.com. Coming up here, we're going to check in with Mike McGlone, Bloomberg Intelligence Senior Commodity Strategist, get his thoughts on the oil markets. They are moving yet again with Brent north of $90 a barrel. Yelena Shaylotieva joins us. She's an economist over there at the Conference Board. We'll get her thoughts on this jobs report and the inflation outlook, again, with higher oil here. It's Friday, which means we talk municipal bonds, munis in focus. How about that? My favorite part of the week, that's for sure. Neeraj Patel, Bloomberg Intelligence Senior Software Analyst, get his thoughts on what's going on there in the software market. Again, there's been a sell-off in software. The threat from AI, where are we? Is that trade played out? So we'll get the latest there. Right now, let's kick off this hour with John Tucker and the Bloomberg Business Flash.
All right, with no ends in sight to the Waitlist, at this point, Brent over $91 a barrel after a report of output cuts in Kuwait. So that's translating into higher gasoline prices as well. You're seeing that as you fill up right now. And maybe you'll back up your spending on other things as a result. So that's one element of the worry out there. And then you had the data today, employers cutting jobs, the unemployment rate rising, and the major averages almost predictably are selling off. Although we are at off the worst levels of the session, the Dow down 473 points. The S&P 500, 64 points lower, down about 1%, 67.65 in the index. The Dow Jones Industrial Average, the NASDAQ 100, 182 points lower. That is down about 0.7%. Stu Kaiser at Citigroup Global Markets says this is kind of just a wait-and-see moment for investors.
I think you're in a situation where the underlying fundamentals, earnings, economy, et cetera, are still pretty positive, and people want to own this equity market. They're sort of being held on the sidelines now by these incredible uncertainties that you just don't know how far they could spill out.
Yeah, let's do yields. The 2-year down 2 basis points right now, 355. And among the stocks on the move, Marvell Technology delivering a bullish sales forecast. Those shares 16% higher. And Costco wholesales profit rising more than expected. Costco shares up 1.5% right now. UPS, they deliver package delivery freight, 119 years they've been in business.
Is that right?
I didn't know
Must
that.
have been on
Anyway,
horseback.
They've always been number one in terms of market cap over FedEx. That may be changing.
Okay.
FedEx is moving up. The lead has shrunk to less than $1 billion. Shares of both companies have been lower as a result of the tensions in the Gulf and the impact of shipping there. But UPS shares have suffered more than FedEx as a result. So it's something to look out for. Anyway, we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash, Christina Paul.
All right, John Tucker, thank you so much. We appreciate it. Christina Aquino sitting in for Scarlett Fu today. Scarlett's back on Monday, so I'm told. I'm Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube and streaming live on Bloomberg.com. That's where you can find us as well. Let's take a look at some of the stocks on the move today. We can do that with the Lisa Mateo. Wow, what a that's a highlight.
All right, I got to start with Gap because there's
highlight.
All right, I got to start with Gap because their shares really taking a hit. Okay, so down about 13%, as much as 13%. A few things. So you had their fourth quarter sales profit below expectations. Two of the apparel chains, they underperformed. We're talking about Old Navy, that's their biggest brand. Athleta, that's their smallest. They missed on comparable sales estimates. Its CEO said that Athleta, he kind of pointed to that a little bit more, saying that its performance had been disappointing. He talked about, turnaround efforts are going to take some time. But Athleta, they sell the women's activewear. you know, but it's a popular market. Like there's a lot of businesses in that, especially new competition from companies like Alo Yoga, which I know a lot of people are a fan of. But Gap and Banana Republic, they did a lot better. Their brands beat. Gap grew same-store sales by about 7%, attracted more customers across a range of ages, including Gen Z. That's a big draw for them. Increased 4% at Banana Republic, and then that was because of improved marketing and merchandising. When it comes to tariffs, though, the company said something interesting. They said their guidance doesn't reflect the Supreme Court's ruling that kind of struck down President Trump's global tariffs last month, so it doesn't reflect that. You remember Wednesday, the federal judge ordered the Trump administration to start refunding the billions it collected in global tariffs. So its finance chief said the company is just going to wait for some more clarity before starting to change their plans.
Yeah, very interesting. I guess that is one good example of how the tariff policy has unfolded.
Sure.
Is really hampering a lot of operations for businesses, right?
Oh, most definitely. So taking it.
All right, what else you got for us?
Okay, this one I want to start. It's a decliner too as well. That's Nutex Health, ticker NUTX. They're a health-focused application software firm. Their shares are plunging as much as 18%. Now it's kind of pared back a bit. It's down maybe about 11 or 12%. So basically, they reported a miss on revenue for the fourth quarter. Not much on this one. $55 million charge for arbitration claims. That kind of dragged down that fourth quarter profit. If you look at the company across there, $735 million market cap, already down about 36% year to date, but it was up more than 120% in the past year. But it is taking a hit. Their shares down today.
Marvell,
MRVL. Their shares have been up as much as 17%. It's a Santa Clara, California-based company. Their chips are used in servers, networking systems, you know, that needed to fire up those data centers that we're always talking about. So a bullish sales outlook. That was John Tucker was just saying. They're saying data center demand's growing even faster than they expected. So revenue as much as $2.5 billion for the fiscal first quarter. Analysts estimated about $2.28 billion. Expects fiscal 2027 revenue to grow about more than 30% to nearly $11 billion. Now you compare that to their outlook of $9.5 billion in September, roughly $10 billion back in December. I mean, but think about it. They're cloud computing operators. They're boosting their capital spending, and that's increasing demands for Marvell's chips. If you look what their chief executive officer said, that's Matt Murphy. He said cloud CapEx expectations, they've continued to increase. They've seen their bookings continue to accelerate. And you remember Broadcom, too. Similarly strong report. They said AI chip sales are going to top about $100 billion next year.
All right, very good. Lisa Mateo, well, you know, we're not going to let you go right now. Talk to us about, you've got a real job now where you work on the weekends.
Yes.
Bloomberg Weekend.
Bloomberg this weekend.
Bloomberg this weekend.
You got to watch it every Saturday and Sunday, 7 to 10 a.m. Eastern. We've got you covered because, as you know, there's been a lot going on the weekends, especially for our launch weekend. But we're back with you guys this weekend to have you covered on everything from business to lifestyle to politics and culture.
Good stuff. So that's with David Gura, Christina Ruffini, and our very own Lisa Mateo. That's 7 a.m. to 10 a.m. Saturday and Sunday on Bloomberg. What's really cool, it's on Bloomberg TV, Bloomberg Radio, all the streaming platforms, all this, the .com stuff, all the digital outlets covering Bloomberg this weekend. So that's good stuff. Lisa Mateo, thank you so much. Appreciate it. As always, for more conversations like this, subscribe to our Stock Movers Reports. Listen for 5-minute audio reports on the biggest winners and losers in the stock market. Subscribe to Stock Movers on Apple's podcast, Spotify, or anywhere you listen. One of the big stories again today is global oil. WTI crude oil up nearly 10% to just about $89 per barrel, really reflecting the stresses in the global energy supply chain. Think about the Strait of Hormuz, that type of stuff. Mike McGlone follows all the commodities for us. He's done it for decades in his career. Mike McGlone, senior commodity strategist for Bloomberg Intelligence. Mike, this is just, I guess an efficient market right here, reflecting potential constraints on supply. And does this look efficient to you?
Well, Paul, I'm glad you went there because it's switching over to a classic significant short cleansing in the U.S. contract. Now, Brent's up. Brent's running $91 a barrel, but WTI is caught up to Brent. It's almost the same price. Typically trades about a $5 per dollar discount. That's classic sign of get me out. I can't be short for the weekend. If something goes worse, I have a problem. But if this unprecedented event, which I did not expect the Strait of Hormuz to close, if it opens up, maybe by Monday, that's going to be a big problem because we've cleansed this market of shorts. The key thing to remember, though, is the U.S. is a massive net producer, net exporter of crude oil. So this actually benefits U.S. producers. It's the rest of the world, most notably China. China is the #1 place where that Gulf oil goes, and they're kind of bottlenecked by Strait of Hormuz, but there's a pattern there. So for now, that's all that matters. But the bottom line is Strait of Hormuz is closed. If it stays closed, crude oil is strong. If it opens, crude oil is going to collapse.
Yeah, well, Mike, I mean, obviously the conversation around $100 oil back in play here. And, you know, a lot of questions about how that's going to impact the economy and markets. But what's your take? I mean, is it actually possible to see as much as $100 oil within the month, or is it still very much a tail risk sort of scenario?
Every bit that crude oil goes up like this enhances the potential for recession. That's the way it works. I just remember very clearly when the average price of gasoline got to $4 a gallon in 2008, that was a signal the recession was kicking in. But that's when crude oil peaked at 145. Now we're talking maybe it gets to 100 in the U.S. or Brent. So to me, that's what shifted. Back then, the U.S. was a massive net importer. We're a massive net exporter. But what you saw in the data today, the bottom line for all these markets is we're seeing significant volatility in commodities, most notably energy and precious metals. It's very rare to have that kind of volatility without it trickling over to the stock market. So to me, that's the bottom line. If the volatility from commodities trickles over to the stock market, there's your recession.
So, Mike, is all this, I guess, war premium in the oil markets, will that come out dollar for dollar when this thing is over, or will there be some residual damage, I guess, and maybe a little bit higher prices?
Oh, I think it's going to make accelerate the bear market. So look what happened in natural gas this year. In January, on the year, the front natural gas future was up 100%. Now it's down 15%. It went to 7, now it's down to 3. To me, that's a guide what to expect in crude oil. It's getting near 100 in the front contract. That December contract, which will be front month when there's midterms, is running around 68. And by the time we get the midterms, if this is cleared up, it's probably running below 50 or lower, particularly if the stock market drops a little bit. So this is what accelerates the bear market. And the bottom line is the U.S. is a major glut of food and energy. In the past, we were a net importer, not of food, but of energy. That's how the world shifted.
Do you think people, traders, I guess, smart people that you know are, I don't know, lack of a better word, shorting oil right here?
Well, it's hard to short. You don't want to really look at the front contract as short. Maybe short further out, but I can almost guarantee you what the U.S. producers are saying is, oh boy, we can lock in profits for a year or two out at much higher prices and bring on more supply. Thank you very much. They've been waiting for that. That's what happened when Russia invaded Ukraine, particularly with all the grains. And they ended up bringing up too much supply. That's why they're in a bear market. Let's remember, this is a bear market bounce in crude oil. Prices go up. What's it going to do? Bring on more supply. Now, the Gulf is a different story. You have to cut off that supply for a long time. I doubt that's going to happen.
Mike, thanks so much for joining us. As always, Mike McGlone, Senior Commodity Strategist for Bloomberg Intelligence, giving us the latest thoughts there on oil. And again, WTI up 10% here, $89 and change here, and Brent at $91. That's up about 6.7% here today. Let's get a sense of kind of the economic impact, both from what we're seeing in the oil markets and what we're seeing in some of the economic data that we've been receiving today with the jobs report and all week with a bunch of data. Yelena Shilatieva joins us, senior economist at the Conference Board. Yelena, let's just start with energy. How are you viewing, when you think about your economic outlook, the current state of the global energy markets?
Thank you so much, Paul. I think it's a tax on a consumer. It's as simple as that. And if this increase in oil prices continues, it might not be detrimental to U.S. economy overall, as my former colleague Mike McGlone alluded to. But it will certainly weigh on consumer spending. I think that if we ran some scenarios on Brent oil, and if Brent oil remains at around $80 per barrel or rises to 100 in a more severe scenario, that would take off 0.1 to 0.3 of GDP growth for the year as a whole if this continues into the end of, say, the second quarter of this year. But inflation will rise much more substantially in such a scenario, and that in turn will weigh on consumer spending much more than it could hurt GDP growth overall.
All right. Well, Yelena, we've been talking to other analysts as well, just taking a look at these jobs numbers. And there seems to be a sense that a lot of the market and just people looking at this very much focused on the inflation angle, understandably because of what we've seen with oil. But do you think that markets in general are underpricing the risk of an economic deterioration as well, this whole stagflationary environment that could potentially unfold from this week's events?
Yeah, a whiff of stagflation we got, right, this morning. I think, it is a big dilemma for the Fed, of course. We are facing the risks of much higher inflation on the back of the war with Iran, for sure. It all depends on how long it lasts. And I'm sure everybody else on this program were saying the same thing. So, short-term oil spikes, short-term supply shocks are okay for the economy, and the Fed would usually look through that. But if it continues and that impacts inflation expectations, it's going to basically prevent the Fed from cutting rates further, even if the labor market continues to soften. So you mentioned the payrolls report this morning, and my take on that is that, well, the labor market is far from collapsing, so the decline of 92K probably overstates significantly the underlying weakness in the labor market. But nonetheless, I estimate the underlying pace of job creation at around zero following this report, if you account for strikes and storms. But that is significantly below the pace that is needed to keep the unemployment rate steady. So that's why we saw a little bit of a pickup in the unemployment rate, despite the fact that participation rate declined quite significantly over the last 3 months. So that even didn't help the unemployment rate to remain steady. So I think that we will continue to see some softness in the labor market in the coming months, and that does create a big dilemma for the Fed, indeed.
So about 30 seconds left here. How concerned should I be about a negative print here today of 92,000?
It's not as negative as it looks again. I estimate that most of the 92K decline was due to temporary factors, but it's probably around zero at this point, which is not that great at all.
All right, very good. Yelena, thank you so much for joining us. Always appreciate getting a few minutes of your time. Yelena Shulyatieva, she is a senior economist at the Conference Boards, former Bloomberg intelligence economist as well. So we know Yelena's work very, very well. Markets here continuing to sell off here. We are off the lows. That is the good news, but the S&P is down 72 points, 1%. The NASDAQ down just under 1% here, so we'll keep an eye on that. Coming up, it is Friday, which means we talk municipal bonds. Munis in focus. Ashna Shah joins us, Bloomberg municipal finance reporter. We can see how the muni bond market is doing. They're talking about a lot of issuance this year coming from municipalities, so we'll see how that's playing out here in a very volatile and uncertain market. This is Bloomberg.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker, the Bloomberg Newsroom of this Bloomberg Business Flash. We are brought to you by Golden Crest Metals. Inflation, tariffs, and volatility have some investors turning to gold for stability. You get a free gold and silver information guide and learn how to add metals to your IRA or 401k, tax and penalty free. Go to goldencrestmetals.com/guide. That's goldencrestmetals.com/guide. Right now, you have 10 of the 11 major industry groups in the S&P 500 lower, being dragged by financials and consumer discretionary. And the only group that's in the green, well, you guessed it, it's energy. As crude oil continues its march higher, Brent right now is above just about $91 a barrel. So that's up $5.59 a barrel. That's translating into higher gasoline prices and worries over higher prices in general, because as Paul's landman reminds us, oil is in everything.
Everything.
The worry combined with today's jobs figures, you get stagflation concerns, employers unexpectedly cutting jobs in February, unemployment rate rising, and right now the Dow is down 578 points, 1.2% decline. The S&P 500, 78 points lower. That's down 1.2%. The tech-heavy NASDAQ 100 down 248 points, down just about 1%. And the health-focused application software firm Nutex, those shares, on the other hand, well, they are dropping right now just about 10%, reporting revenue for the fourth quarter missing the average analyst estimate. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that is your Bloomberg Business Flash.
Now on Bloomberg Intelligence, Munis in Focus.
All right, today's Focus on Munis is brought to you by BAM Mutual. Put America's strength to work in your portfolio with BAM Insured Municipal Bonds. Protect your investments with an added layer of security and guaranteed income. Invest with strength. Build a stronger tomorrow with BAM Mutual. There you go, our good friends at BAM Mutual. Just reading this article in the break. Tough title. This is one that got my attention. This headline: U.S. bonds see worst week since Liberation Day on inflation angst. Perfect segue to our next guest, Ashna Shah, municipal finance reporter, Bloomberg News, UNC Tar Heel. We're not talking to each other for the next 36 hours. Duke, Carolina, Saturday night at Duke. Ashna, I hate to ask, how has the municipal bond market been these days?
You know, well, I have to start off by saying UNC will win. So we'll talk again once the game's over.
It'll be a good game.
Yeah, but I mean, it's been a tough week in the muni market, same as all other fixed income markets. But, you know, we saw that the muni market was having a sell-off this week, earlier in the week. Right now, today, munis are unchanged, but the sell-off was caused by the geopolitical unrest happening in the Middle East. And generally, the muni market is a safe haven for investors. It's sheltered from geopolitical unrest and, you know, a war overseas. However, earlier this week in the sell-off, the height was on Tuesday, and we saw yields jump as much as 11 basis points. And that was the worst day in the bond market since last April, which, if you remember, was during the tariff policy announcements and Liberation Day. So the sell-off in munis was mirroring what was happening in the Treasury market, but yeah, worst day since last April.
Yeah, well, Ashna, I mean, very interesting because you've reported as well this week that some people are seeing this as a buying opportunity, right? So which one is it? It feels like it's two sides of the same coin. You know, you get a big sell-off and then some people coming out of the woodwork to hunt for bargains. Is it really the time, though, to go bargain hunting at this point?
Yeah, so March is an interesting month for the muni market in general. We see that some investors are looking to sell their holdings to pay their tax bills that come up due in April. So March is a tough month for the muni market in general. But we were talking to some portfolio managers, you know, earlier this week, and they were saying that it could be a buying opportunity. You know, the prices have dropped, and so this could be a time for investors who aren't in the muni market to really invest and get some better levels.
New issuance, has that taken a pause here with all this volatility? Because we know 2026 is going to be a big year for issuance.
Yeah, so investors are expecting a record year for issuance this year, beating the record of last year, some say. And we've seen deals get done this year. We haven't, buyers and investors are definitely more cautious from what we're hearing, but deals are getting done. Issuers are in the market this week. So I think we're still in a good environment, but there's just definitely some caution being exercised right now.
Yeah, well, of course, we did get the jobs report earlier today. Big shocker to the downside there. And of course, the market very much tied to local domestic economies here. Any kind of early signs of jitters around that data and perhaps the prospect of the labor market weakening much further from here?
Well, one thing that we were hearing from investors is that they're keeping an eye out on how long this war goes on for and, other macro activity. So if this becomes a protracted war and it does end up having any sort of impacts on state and local governments, if macro events continue to have an impact on state and local governments, then we could see them, either raising taxes or finding other ways to supplement that revenue. So I know that's a thing that's top of mind for investors right now.
Is there any credit concerns out there in the marketplace? We saw in the private credit market, we've seen some news about Blue Owl and even today BlackRock restricting some of the withdrawals from their private credit funds. Has that rippled through at all to the municipal bond public market?
So what's been going on this week is more so a macro event and hasn't really had any impact on the credit or the issuers. So we're seeing that play out. That's why people are saying it's a buying opportunity because there's that disconnect.
Where are you going to watch the game tomorrow? Is there like a Chapel Hill bar in the city?
There is. It's called Slattery's, and it's in Midtown, and all my friends are going to be there.
Is that right?
Yeah.
Boy, maybe I should. Have you seen the ad with the Duke kid coming over to the home?
Yes, I have. Yeah.
Oh, don't be that guy.
Don't be that guy. Don't be that guy.
God, that would be ugly. All right, Ashna Shah, thank you so much. Appreciate it. Ashna Shah, she's a municipal finance reporter for Bloomberg News and a UNC Tar Heel fan. Good for her. Joining us live here in our Bloomberg Interactive Brokers studio. Let's get back to the economic discussions out there. Again, that jobs data took a lot of folks by surprise. But again, maybe just kind of one data point doesn't make a trend. So we'll get to see what's going on out there. Stuart Paul, U.S. economist with Bloomberg Economics on the jobs market. And Stuart, what did you make of that print we saw today? Again, the consensus was for a positive 55,000 in non-farm payrolls. It came in at negative 92,000. Is that just a blip, or is that something we need to pay attention to? Talk to me, Stuart.
It's mostly just a blip. Most of the headline numbers released today, whether it's non-farm payrolls, the unemployment rate, or even wage growth, overstate what actually happened during the month. I will say that heading into this report, we were wavering between around minus 30,000 jobs during the month and about positive 15,000. So this even caught us by surprise. But the things that we were really focused on coming into this report, we saw a lot of evidence of. Hiring in constructions, total headcount in construction, leisure and hospitality were really affected by weather, it looks like. You'll remember in late January and early February, that winter storm that swept the lower 48 states really created a hiring freeze. That pun definitely was intended. I couldn't lie to you about that. We also saw revisions to the household survey that resulted in a major downward revision and a monthly decline in the labor force participation rate, which despite that decline in participation, we saw, again, a little uptick in the unemployment rate. When you look at the wage side, which was really stoking a little bit of stagflation fears, yes, hourly wages surprised to the upside, rising 0.4% during the month. But a lot of that was because of composition. When you see layoffs or you see a reduction in headcount because of nursing strikes or because of weather effects in construction and leisure and hospitality, and some of the workers at the lower end of the wage pool are laid off for at least some portion of the month, it artificially and temporarily inflates wages. So all of these headline numbers that stoked a lot of stagflation risk really overstate the case. Instead, and just in summation, if we read through the last couple months, we're really just seeing an extension of what we saw throughout 2025, which is basically zero headcount growth, slightly softer than the break-even pace we estimate, which is about 20,000 jobs added during the month.
Yeah, well, sir, it sounds like that's basically aligning with the description of this, low fire, low hire sort of economy. It's not exactly a labor market that's roaring, though, is it? I mean, is it something that's maybe fragile enough that, we get the next macro shock, for instance, from the Iran conflict, that it could all kind of topple or deteriorate further than the current baseline level that we're looking at?
I think it's fragile enough for the Fed to, let's say, keep a cutting bias, but I don't think that there is anything that's shocking enough yet that would warrant something like rate cuts. And when you factor in the type of shock that we're seeing, given this war in the Middle East, because it adds a little bit of headline inflation pressure to the tune of 30 to 50 basis points of additional headline inflation pressure coming from energy prices. Again, the Fed is probably very comfortable just remaining on pause certainly through the first half of this year. One jobs report like the one that we just saw with a major downside surprise in payrolls isn't going to be enough to warrant any sort of material monetary policy response, not going to even quicken the pace of any sort of monetary policy response. Instead, it's going to be the Fed sitting back and questioning what the underlying trends look like. And from our vantage point, it just looks like zero headcount growth, slightly softer demand for labor than we would expect, or slightly softer than is necessary to maintain a stable unemployment rate. Look, when we synthesize about a dozen different alternative labor market indicators, we get to an index on our alternative labor market index that shows that the labor market is about 1/3 of a standard deviation weaker than the historical average. That's not screaming that there's an imminent crisis or that the softness in the labor market warrants any material monetary policy response right now.
Christine, Stuart is an expert skier, so I'm going to take great joy in telling him this next thing, because I know he's going to be bummed. Stuart, Sunday, I'm hopping on a plane, heading out to Colorado, strap on the boards for a week. How about that?
Oh, man, I'm jealous.
See?
I'll tell you, I'm jealous, especially we're going to have a heat wave here next week. So
yeah, I saw
you're going to be getting good snow. I won't be. Yeah, it's going to be brutal here. So
you've had I would say you guys in the East, and Stuart skis in the East. He's a great skier, ski patrol dude. You guys have had great snow, right, this winter?
It's been a good season so far. I worry that we're going to get sort of an early end, a week or two earlier than we typically would, given the warm weather that we're going to get in the middle of this week, unfortunately. But I'm happy for you. I'll share in your joy.
And it is snowing out there today. My friend sent me back a little text there. So Stuart Paul, expert skier. He's also a U.S. economist. I think he's got a PhD in that economy stuff. I don't know. Bloomberg Economics, he's really good. We appreciate getting a few minutes of his time, because we got some pretty significant economic data today. I think the jobs data certainly took people by surprise there, just on the headline print.
Yeah, absolutely, Paul. I mean, yeah, because people were expecting, based on the previous number, that it's on the mend, it's on the up and up, but clearly not.
Exactly. So we'll see how that plays out with this Federal Reserve. A little bit of renewed selling here in the marketplace. We got the S&P off 82 points. That's 1.2%. The Dow off 613 points. That's 1.3%. The NASDAQ off 235 points. That's 1%. The VIX last out 2.5 points here, 26 and change. So we'll keep an eye on that. WTI crude oil up 10%. Brent crude up 7% to $91. Coming up, we're going to check in with some good, smart people talking about this economy.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. So you have renewed concerns about stagflationary outcomes. That's the latest headwind for stocks. The labor market report, that was bad. And with the Strait of Hormuz effectively closed, Brent crude up above $91 a barrel. Major averages all lower as a result. S&P 500 down 69 points. That's a 1% decline. Dow is down 515 points. That's a 1% decline. The NASDAQ 100 down 193 points. That's down just about 0.8%. Economist Claudia Sahm at New Century Advisors, she was on the program earlier today. She says central bankers are paying close attention to oil prices.
Now we have another shock for the Fed to be on watch and coming through the economy. And the big piece of this is how long this energy shock lasts.
And of course, that translates into higher gasoline prices, what we pay at the pump. Among some of the stocks on the move today, best performing stock in the S&P 500, CF Industry Holdings, that is up close to 8%. The worst performer in the S&P 500, Old Dominion Freight Line, those shares down 8.5%. Really some fascinating reading on the Bloomberg, this story. Looking for a job? Go build a data center. Companies competing for workers. This is getting intense to build data centers. They're offering amenities like free steaks, I'm in, and golf simulators and temporary housing villages. We know them as man camps to lure in people like electricians, welders, and pipe fitters.
You're good with a hammer. You could do that.
I probably could, you know, but I don't want to live in a man camp. I will take the steak, but not the man camp. You know, sorry, guys. Anyway, we check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker, and that's your Bloomberg Business Flash, Christine and Paul.
John, do you hydrate?
I mean, I drink water. Is that
okay? So you're not doing it right. Christine, show them how to do it properly.
Oh, look at that thing.
So you have to
That's
have
like half a gallon.
What all the kids have. They walk around carrying these things all over Bloomberg, and they stay hydrated. That's the way you do it.
Could I fill mine up with a 98 Bordeaux?
Exactly.
Would anybody notice?
Yeah, we're doing it all wrong, John. All right, John, thanks so much. We appreciate it. Christina Aquino sitting in for Scarlett Fu. I'm Paul Sweeney. We're live here in our Bloomberg Interactive Brokerage Studio, streaming live on YouTube as well. Federal Reserve Governor Christopher Waller says the Iran war is unlikely to cause sustained inflation. Earlier, Waller told Bloomberg's Mike McKee, Lisa Bromwitz, and Jonathan Farrow he expects consumers will experience sticker shock as gas prices rise, and policymakers will look through any one-off increases. Take a listen.
What you're going to see is you're going to see a spike in gasoline prices. That's what the American citizens are going to see when they go to the pump, and they're going to stare at it and be a little shocked in terms of how things go. But for us, thinking about policy going forward, this is unlikely to cause sustained inflation. This is one reason we don't look at energy prices when we look at core. Core is a better predictor of future inflation. You're going to see this, but once these kind of supply chain issues that you laid out, Lisa, once they unravel, this will start coming back down. So it's kind of very odd to think about the Fed maybe changing rates 6 months from now based on this. If it's unwound in like as you said, Jonathan, in a couple of weeks or even 2 months, it's not going to be a big factor down the road. So this is why we never look at energy prices. They bounce up, they come back down. It's not that it's something that we don't feel sympathy for people that's what they have to pay when they put gas in their cars. But for us, thinking about the longer term in terms of policy, this is something we're just going to have to kind of put off for now.
When does it become something bigger, if it's so?
It becomes bigger if it becomes more permanent, because then what's going to happen, you're going to see this jump in prices. Then it'll start bleeding through to other parts of the economy. Energy is a big part. It feeds into everything else. And then somehow those energy costs get passed along like everything else. So that's what you're more worried about.
Economists on any given day, Lisa, Mike, myself, and they'll talk about the experience of the 70s and coming out of the pandemic. And they'll say things like that officials of the Federal Reserve are somewhat conditioned, scarred by some of that. Is that your experience of things?
Well, in the 70s, remember, we didn't just have one. We had massive oil shocks. If you take 73, the price of oil quadrupled overnight. It went from $4 a barrel to $12 a barrel. It went from 3 to whatever the numbers were. And that was a shock, and it never came back down. And then there was another one. Every time you turned around, there was another oil shock. Then Iran, oil embargo in 79. So that was kind of the problem with the oil shocks. They just kept coming and coming and coming. So it's not clear this will be one shock after another after another. So that's why I'm more willing to say this is, I hate to say it, but more like a one-off event than what we saw in the 1970s.
All right, that was Federal Reserve Governor Christopher Waller. Joining us now from the Intercontinental Hotel in New York City is Michael McKee, Bloomberg International Economics and Policy Correspondent. Mike, I think I heard Mr. Waller utter the phrase transitory. That seems to be kind of his message here.
Well, it's his message on inflation, and it is one echoed by other Federal Reserve officials. We're at the Chicago Booth School Monetary Policy Forum, and when you talk to Fed officials, they all kind of have the same answer, and that is, we know that this oil price level is caused by this war shock. And when the war shock goes away, oil prices should go back down. Now, the question is, how long does that take is where they leave it. But they are talking about the fact that you don't want to cut rates to offset a oil price shock because it will go away, and then maybe you have overstimulated the economy.
Well, Mike, of course, the other side of this is we got the labor data today, and that's a bit of a shocker to the downside. We know that the Fed wants to be patient on inflation. Do you think they will have the same kind of patience when it comes to addressing the labor market?
Well, it's going to depend on who you talk to. I talked to Chris Waller when I got here. Of course, he was on with us on Bloomberg Radio before the payrolls report came out, and he said, this is kind of my worst nightmare. This is what I was afraid of, maybe worse than what I thought might happen. But it just puts him back in the category of we're going to need to cut rates at some point. Once they get a feel for whether this is lasting or how long it goes on, because the labor market is an issue. Growth is also an issue. After we talked to Chris Waller, we talked to the Chicago Fed president, Austin Goolsbee, who said he's worried about the level of growth and whether or not all of this uncertainty about tariffs and war leads to stagflation.
As with any supply side shock, it can lead you in a stagflationary direction, which is to say the inflation side of the mandate getting worse at the same time the employment side of the mandate is getting worse. And that's always the worst case scenario for the central bank, because there's not an obvious monetary policy answer to a stagflationary shock. Oil prices going up, we need to think about, is this a transitory thing that's going to be temporary? Is this going to be long-lived? How big will it be? How long will it last? And how is it affecting the supply chain before we can really say anything about it?
I would assume that you would assume that March 18th is not going to see any kind of rate move because there's still too much uncertainty. Do you think you would have enough data by April to even make a decision one way or another?
You know that I don't like, and you assume that I assume. I don't know.
What would a data dog do?
You know I don't like tying our hands ahead of the meetings. I want to hear what my colleagues have to say. I want to get as much information as possible, especially at moments like this where we're getting conflicting pieces of information.
Hi.
But
hi, Lauren, how are you?
You've been there. It's the biggest table that I've ever seen in my life in that FOMC room. So there's plenty of room for everything to be on the table at every meeting. So I'm not going to rule anything out.
We are, from the data that we already have, and other Fed officials have said this, expecting a bad PCE number. Are you still thinking of that PCE inflation as residual tariff as opposed to an underlying fundamental problem with inflation?
Maybe a little of both. I mean, that's why I've been uncertain and highlighting the inflation numbers. There's been some encouraging signs in inflation. Housing inflation has come down a lot and is likely to continue to come down. We had the run-up of goods inflation. That, I think a lot of it is tied to tariffs, and we're still trying to sort out, is there more to come, or is that basically all there was with tariffs and then it'll go away? But there's also been a kind of a disturbing persistence of services inflation, which I don't think you can attribute to tariffs because the tariff content of the services industry is not very high.
So the bottom line, when you put them together with the interview we did with Tom Barkin and Stephen Myron earlier this week, we've talked to a lot of Fed officials, and they're all kind of coming to the same conclusion. Whatever their views about where the policy rate is, changing that one way or another is going to take more time because of the tariffs uncertainty, because of the war uncertainty. They're going to be on hold probably longer than they anticipated one way or another because they have to wait and see how this all develops.
Yeah,
and
Mike,
that may not make people on Wall Street happy who want to know exactly what's going to happen, but we're going to have to wait a little bit.
I mean, this administration really is making the Fed's job difficult with tariffs. And now with the war in Iran, I mean, that just adds another layer of complexity to their business.
It does. It drags out the process, especially with the tariffs, because now we're going to have 4 or 5 months until the new tariffs come on. We'll see how the 15% tariffs affect things. They should bring down the average tariff rate just a little bit. But once we get the new tariffs, what's tariffed for how long and how high? And how long does this war go on? What happens with oil prices, and how does that affect gasoline prices? And how does that affect consumer sentiment to the point that Donald Trump might change his war aims? So the Fed is basically saying, you know, we can't predict any of this stuff, so let's sit on the sidelines and let's hope, as Austin Goolsbee said, that we don't get stagflation because the Fed cannot address that. It's on both sides of their mandate.
All right, Mike, thank you so much. As always, Michael McKee, he's an economics guru for Bloomberg Television. He is at the Intercontinental Hotel. The Booth Graduate School of Business has a conference there. Mike's been corralling a bunch of the Fed officials down there, so that's good stuff. Let's talk to the real estate business. We always like to talk about the commercial real estate business because we're in New York City, just with amazing real estate here in town. And we have Morgan Stanley. We've talked about this before. Lauren Hochfelder, head of global real estate assets at Morgan Stanley. And as long as I've been in this business since the mid-'80s, it's been Morgan Stanley, really the leaders in the investment banking side of real estate and the ownership of real estate. Lauren, thanks so much for joining us here. Is the worst behind us here, do you think?
Thank you for having me, first of all. And yes, I absolutely think the worst is behind us. I think we talked the last time we were together that it felt like a bottom was forming. And I think today there's pretty clear evidence it has formed. Clear evidence on the ground when we look at public markets, when we look at private capital formation, we're feeling pretty good.
Yeah, well, Lauren, I think one of the things that you cited as part of this improvement process is the fact that the cost of capital is falling, right? And debt markets also more favorable to real estate borrowers. How durable do you think that development will be?
Yeah, so debt markets are wide open. Real estate lending last year was up 30% and across categories. So even the banks are back. And I think perhaps most interestingly, you know, in the beginning, it was sort of a pretty narrow subset of what lenders would lend to. Today, they're even lending to office. And so, you know, what they say, when the corpse has a pulse, you can infer what's going on in the markets.
All right, so as I understand it, we have a housing shortage in this country. Let's say I'm entrepreneurial. I want to build a multi-family community out there or some type of property. Where am I going to get the capital to do that?
Yeah. So look, real estate lending is absolutely back for multifamily in particular, certainly a bit less on the construction lending side, and I think for good reason. So in the US in particular, what ends every cycle? It's new supply, right? Rents run, values run, and builders build. It is a very efficient supply side response. And we saw a lot of excess supply this time around. So fortunately, we've seen a real pullback in that.
What could upend this development here, the fact that it is on the rise? I mean, we have seen a few macro stories unfolding this week that are quite major. And so is any of that kind of a potential halt or that could potentially stop the recovery that we've seen so far in real estate?
Look, the perspective matters. And I look across Morgan Stanley's real assets business. We own real estate assets, infrastructure assets, equity, credit, et cetera. And so we have a really global perspective. And I would say, of course, all of this geopolitical risk has massive implications. The difference, perhaps, is that whereas the broader investable universe is at all-time highs and facing a lot of volatility in the public markets, real estate values are still down roughly 20% as you look across the world. And so you have a really attractive entry point. You have, as you referenced, cost of capital going down, and you have new construction down. So when you put aside all of the noise, I think the relative value proposition for real estate is really strong. And when you think about the flow-through risks created by some of this geopolitical, these dynamics, it's inflation, it's a risk-off appetite. And what do we know about real estate? Real estate is a pretty effective inflation hedge, and it tends to be a lower risk asset class with durable cash flow, among other things.
Lauren, you say one of your higher conviction real estate strategies is industrial. Does that include the data center thing, or is that something different?
So data centers tend to be adjacent to industrial.
Okay.
We do invest in data centers as well, in particular in our infrastructure business. But I'd say when you look, actually, AI is really impacting both data centers and industrial.
Okay.
Yeah, well, one of the things that you're looking at as well in terms of high conviction areas is senior housing. What's been the trend there?
Yeah, well, look, in investing, you have knowns and unknowns. And one thing we know for sure is that our population is getting older. And with that, our housing needs change. So the 80-plus population in this country is growing at nearly 5% against a backdrop of the overall population dead flat.
Yep.
And so we have a lot of growth in that segment. And by the way, they control a lot of the wealth in this country. They control more than 50% of the wealth. So you have a lot of them with a lot of money. That is a lot of demand for senior housing. And we're seeing across our portfolio a lot of growth.
All right, before we let you go, just office. If I want to go buy an office building on 3rd Avenue on 48th Street, what should my bid be relative to, like, the last transaction? Am I coming in at a 50% discount, 30%, or is that thing already cleared, maybe?
Well, here's what's so interesting is we debated for years, including here with you, the sort of return to office trend, right?
Yeah.
Would work from home just decimate office? And fortunately, I think that debate is over. People are back in the office.
Yep.
But now what you're seeing is this new debate of the AI office scare, right? And are all the jobs going from 3rd Avenue and 47th Street to data centers in God knows where? We still think that the highest quality office will really prevail.
So that A+ story, that's still the play. What are we doing now? For the B and C, does that stuff just clear at a price? Does it get torn down? Like, I don't know.
I think that there is going to be a reasonable amount of conversion.
Okay.
So there's demand destruction, and there are higher and better uses of these pieces of clay. That's just the reality. Now, we need the private and public sector to come together to make those economically viable.
So why is Morgan Stanley so good? Have been forever in real estate. Is it just you've had a commitment through cycles that maybe others didn't?
We have an extraordinary team, and we have the combination of a global perspective, right? And being part of Morgan Stanley, the best economists in the world, the best global perspective, but amazing local teams. And real estate is fundamentally local.
Local business. Yeah. I mean, just folks, again, I've been on Wall Street since '86. Morgan Stanley has always been the real estate investment bank. So I don't know how they do it, but they do it, and they do it consistently. Lauren, thanks so much for joining us. Lauren Hochfelder. She's head of global real estate at Morgan Stanley. We have a tweet from or social media post from the president. Trump administration to allow sale of some Venezuelan gold in the U.S. I don't know. We'll have some more reporting on that, I'm sure, going forward. All right, for our listeners, a reminder, you can listen to us via satellite radio on Sirius XM Channel 121. Access the world's only global audio business network, coast to coast, 24 hours a day. Bloomberg Radio on Sirius XM Channel 121 is presented by Golden Crest Metals. Stay tuned for the latest market news and industry research. Christine, thanks so much for sitting in for Scarlett Fu. I think she's back Monday.
Always a pleasure. I'm sure we'll be happy to have her back.
Yeah, I won't be back. I will be skiing out in Colorado, so you guys have fun next week. The sell-off continues here in the marketplace. The S&P is off 65 points, right down towards its low of the day. That's 0.9%. The Dow's off 1.1%. That's 530 points. NASDAQ doing a little bit better. I think that rotation trade might be going back the other way, down about 0.7%. But it's all about the oil, folks. Brent crude up 8.3%, $92.50, and WTI crude oil right at $90. This is Bloomberg.
fixed today.
Ratings on their ship. And Soviet troops on the Iranian.
Work on the missile launchers, decreasing the missile capability of Iran by about 80% at this point.
Officials with one of the armed Kurdish Iranian dissident groups based in Iraq say they're not planning an imminent cross-border attack on Iran, but would join a ground invasion if the U.S. were to launch one. CBS's Sabina Castelfranco reports the war has impacted at least one athlete at the Paralympic Games in Italy.
With just hours before the official opening of the Games, the only athlete from Iran has decided to pull out of his two cross-country skiing events because he cannot travel safely to Italy due to the intensifying Middle East conflict.
Well, here at home, the government says the economy lost 92,000 jobs last month. CBS's Kelly O'Grady.
This is a particularly bad month for manufacturing. Other months we have seen manufacturing jobs increase. So this is a snapshot in time. Overall, we have seen a push to bring jobs, but I think not at that scale that we would have expected.
Sources tell CBS News a multi-million-dollar DHS ad campaign that caught the White House off guard may have been one of the final tipping points in the move to fire Homeland Secretary Kristi Noem. CBS's Natalie Brand.
Sources have told CBS News that tensions had been building for weeks between Noem and the White House, calling this kind of a culmination of what they called or laid out as multiple leadership failures, noting the fallout after Minnesota and the enforcement operation there, as well as allegations of infidelity, which she has denied.
Pope Leo has something to go alongside the Pope Mobile at the Vatican Garage, as we hear from Jeff Gilbert of affiliate WWJ Detroit.
Sports CEO Jim Farley giving the Pope a new Explorer. The Explorer is built on Chicago's South Side, an area where the Pope once lived. It has extras like the Chicago skyline stitched into the center console. Workers at Ford Chicago Assembly Plant knew this vehicle was being made for a VIP. They just didn't know who.
The Dow is down 550. This is CBS News. Turns out a lot of us don't think very much of our fellow Americans.
Who are the people in your neighborhood?
Ask more than half of American adults that question, and they might tell you they're people they'd rather not know. A new survey from Pew Research finds 53% describe their fellow citizens as somewhat or very bad when it comes to morals and ethics. But that doesn't hold true everywhere. In 24 nations, the poll finds most believe others are somewhat good or good. Canadians are even more generous. 92% give a thumbs up to their fellow countrymen and women. There were no follow-up questions on why so many Americans give bad reviews. Deborah Rodriguez, CBS News.
This is the weekend we spring forward with clocks moving ahead an hour for daylight saving time. At least 19 states have passed laws to stay in daylight saving time if Washington allows it. Steve Kathan, CBS.
Live from Washington, D.C., this is Balance of Power with Joe Matthew.
Unconditional surrender. Welcome to the Friday edition, as President Trump says he does not want to negotiate an end to the war, now demanding that Iran capitulate, even as Russia helps Iran with intelligence. We're going to explore all of these developments, and we're joined in a moment by Bloomberg National Security Editor Ian Marlowe. And as crude oil tops $90 a barrel in Texas, we're going to talk with an expert this hour, Tom Kloza, who's chief oil advisor at Gulf Oil. He'll be with us shortly. And a day after President Trump dismissed Kristi Noem as the Secretary of the Department of Homeland Security, we'll explore the fallout with our political panelist. Senator Mark Wayne Mullin prepares to step up for the job. Let's get to Wall Street, though. It's Jobs Day, another major story that's impacting stocks. Charlie Pellet's got the latest from World Headquarters in New York. Hey, Charlie.
Hi, thank you very much, Joe Matthew. Lots of moving parts. Listen, you touched on $90 crude. WTI, West Texas Intermediate, $90.08 a barrel right now. Certainly a shock to the energy market. We've got WTI up right now by 11.2%. Major theme for traders. Brent, the global benchmark, above 92 right now, up by 8.2%. Bottom line here, we also got that weak jobs report, a widening war in the Middle East. We'll keep you updated right here on Balance of Power, but that is lifting oil and fueling inflation jitters. The Dow, the S&P, NASDAQ, all moving lower. S&P on track for its worst week since November. Worst is defined as down 1.7% for the S&P on the week. So here's where we stand. We got the S&P down 73, drop right now of 1.1%. Dow Industrials down 622 on the Dow, decline there of 1.3%. NASDAQ down 190 for the NASDAQ Composite Index, down right now by 0.8%. The VIX this time yesterday, right around 21. The VIX today, just above 26. The 10-year, 4.13%. The 2-year, 3.55%. Gold up another $49 the ounce, 51.32, up 0.9%. Crude bears repeating. West Texas Intermediate surging 11.3%, 90.15 a barrel. And Bitcoin, 68,500 on Bitcoin, down by just about 3.7%. Fed Governor Chris Waller tells Bloomberg he does not think the Iran war will have a lasting impact on inflation, even as it impacts the price at the pump right now.
What you're going to see is you're going to see a spike in gasoline prices. That's what the American citizens are going to see when they go to the pump, and they're going to stare at it and be a little shocked in terms of how things go. But for us, thinking about policy going forward, this is unlikely to cause sustained inflation.
And you can watch the full conversation with Fed Governor Chris Waller on the Bloomberg podcast channel. Indeed, staring at West Texas Intermediate crude right now, up by 11.4%, 90.22 a barrel. Mixed bag for the major oil companies. The oil majors such as ExxonMobil up 0.1%, Chevron down 0.5, ConocoPhillips up by about 0.6%. I'm Charlie Pellet. Back we go to Washington. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. And thank you for being with us here on the Friday edition of Balance of Power. Live from Washington on Bloomberg Radio, streaming live on YouTube. If you want to find us there, search Bloomberg Business News Live. A very happy birthday, a happy 100 years to Alan Greenspan. Did you hear that? He's 100 years old today. Remembering what he said in his book back in 2007. Remember this? That the Iraq War was largely about oil? At the time, he said it was politically inconvenient to acknowledge what everyone knows, and ended up having to clarify those remarks, saying it was more about securing the global supply. And here we find ourselves in a world in which we're paying more than $90 a barrel. And I wonder what's going through Alan Greenspan's head today. We know what's going through Donald Trump's head. Unconditional surrender. Now, we're about to talk with Ian Marlowe, who specializes in the art of diplomacy. There will be none here. The president writing on Truth Social, there will be no deal with Iran except unconditional surrender. After that, and the selection of a great and acceptable leader, plural in parens, maybe there'll be more than one. We and many of our wonderful and very brave allies and partners will work tirelessly to bring Iran back from the brink of destruction, making it economically bigger, better, stronger than ever before. Sounds like his writing. It does end with, thank you for your attention to this matter. And he essentially said the same thing at the White House yesterday. Here's the president.
I'm once again calling on all members of the Iranian Revolutionary Guard, the military, and the police to lay down their arms. They're only going to be killed. Their communications are gone. Missiles are gone. I said, what's left? But they're tough, and they want to fight. And they're calling. They're saying, how do we make a deal? I said, you're being a little bit late. We want to fight now more than they do.
They're calling and saying, we want to make a deal. Apparently, there will not be one, and that's where we start our conversation with Ian. He's Bloomberg's national security editor, having spent years covering statecraft and diplomacy. Ian, what do we call this?
I don't know.
That's okay.
Anymore.
You don't have to have an answer.
I think.
Do you take him at his word?
I mean,
if they're calling to talk?
Since the war has started, we've seen the rationale for the war, what they're hoping to achieve, shift numerous times. It depends who's talking. Is it Hegseth? Is it Rubio? Is it Trump? Is it someone else?
Yeah.
The goals change. The aims change. We're hearing sort of tactical accomplishments. You know, we've destroyed this, we've destroyed that, kind of dressed up as strategic aims and goals when they're not the same thing. I think at the moment, people are just wondering how long this is going to last. How long is the Strait of Hormuz going to be effectively shut? And I think this gives us something of an answer. One of the scenarios people have been talking about is just some kind of ceasefire, some kind of deal where Iran says, all right, we agree to XYZ, just stop bombing us. And Trump goes, okay, and turns around and focuses on something else. Now it looks like that might not happen.
Do we believe that they're calling? Because we've heard this a couple of times. It's sort of offhand comments like the one we just heard from President Trump. Who's reaching out? I mean, who would we talk to?
Yeah, it's unclear. There's been a few reports about, some people in Iran reaching out through the CIA, saying we want to talk, all this kind of stuff. Wow. We know that there was some kind of, at least from indications from what Trump has said, some kind of indication that the U.S., or at least his administration, had some idea of people who might take over. I don't know if you recall those quotes from the other day.
Yeah.
Most of the people we had in mind are dead.
They're dead.
And then the second wave of people apparently also dead. And then there's a third wave of people, and let's hope they survive potentially long enough to take over from the second wave. But at the moment, we don't really know. So they obviously had some people in mind. That who they have in mind is shifting.
Yes.
But there's probably some people they could still deal with. And as you recall, in Trump's comments to the New York Times on Sunday, he said the Venezuela scenario would be a perfect scenario.
Yes.
And if we remember what happened there, they took Maduro's number 2 and just left her in charge. It seems like Trump would not be too perturbed if the protesters he had called to take over the government don't take over, and in fact just some hardliner takes over who can just lay down
He said that worst case scenario, someone as bad as the Ayatollah shows up, allowing for that possibility, although now he says he wants to play a direct role in choosing that new leader for obvious reasons. The Washington Post had some interesting reporting today, Ian, that there are no reports of significant defections within regime ranks, no popular uprisings. U.S. intelligence sees no signs of uprisings or defections in the first days of the campaign. What does that tell you about what's happening on the ground there?
I think it tells you that you have an incredibly securitized state. Iran has been a sort of theocratic security state that has formally exported terrorism and other things across the region for a very long time. The Islamic, the Revolutionary Guard Corps, they are in control.
Yes.
There is no one who thinks that if, say, protesters came up now, that the Revolutionary Guards wouldn't gun them down immediately. So those people are in control right now, in particular since some of the civilian leadership has been wiped out. So David Petraeus had some interesting comments in a Bloomberg piece the other day saying, in times like these, it's the people who take control are the people who can control the most, who can command the most guns and are willing to use them. And so that tells you something about what type of regime we might see come out of this, hardliners potentially, and so I think that's one of the issues, and that's why we've seen reports of the last few days of people, whether it's Israel or whether it's the U.S., arming the Iranian Kurds. They are people who know how to use weapons, unlike the sort of the protest groups that flooded into the streets in December and January against the regime, who were unarmed. And so, you know, right now it seems like they are throwing things at the wall to see what will stick. And that's leaving a little bit of confusion about what the actual strategy is.
Wow. We're going to be talking with David Petraeus on the late edition of Balance of Power, and we'll ask him about that. Ian, also remarkable reporting that Russia is indirectly involved by providing intelligence, targeting assistance to Iran, as we know that this has now involved 12 countries across the Middle East. When you draw on your experience and sort of pull back the lens here, how concerned are you about this being a global conflict?
Yeah, I think that's something interesting. We saw it both with Venezuela and now also with Iran. There've been a few stories coming out saying, where are Iran's friends? You know, and it, to some degree, there was this axis of, you know, axis of chaos, axis of the sanctioned, whatever you want to call it, you know, Iran, North Korea, Russia, China. But a lot of those countries don't tend to get involved unless they really need to. They have a sort of alliance that is not one necessarily of friends, but it's one out of, it's out of necessity in some way. You know, Iran will give drones to Russia because they are sanctioned from providing equipment anywhere else in the world. So you see those kind of relationships forming, but they are not airtight alliances like NATO with a mutual defense pact. I think what we're seeing here is potentially just Russia showing that it still does have some residual influence maybe in the Middle East. They do have more advanced, you know, technology than Iran, and even though they're stressed with the war in Ukraine. But yeah, it's not clear. It's not clear whether, especially given the U.S. targeting and technology that they've deployed there, how effective Russia will be. Iran seems very effective at causing chaos and retaliating around the region, potentially beyond what the U.S. and Israel had thought was possible, given the type of damage we've seen to energy facilities in Qatar, Saudi Arabia, you know, the Dubai airport, all sorts of places that you would have thought would have been defended.
Really something. Ian, thank you so much for being with us here. Bloomberg's national security editor, Ian Marlowe, live from Washington here on Balance of Power. We're going to have much more ahead as we track the price of oil here. West Texas Intermediate, not even Brent, is now above $90 a barrel. We're up almost 12% right now. Charlie Pellet will check the markets ahead. We're going to hear some comments from earlier in our interview with Kevin Hassett on Bloomberg TV and radio, and we'll talk to Tom Closa about the situation in the oil pits. This is Bloomberg.
It's 12:21 on Wall Street. We do check markets all day long here at Bloomberg. We're off session lows. Still a down day for the Dow, the S&P, NASDAQ as investors to keep one eye on the Middle East, another eye on rising oil prices. Let me begin with what's happening with West Texas Intermediate crude. Right around $90 a barrel right now, 90.03. It is up 11.2%. We've got Brent crude surging to 92.41 a barrel, up by 8.2%. We'll have a whole lot more on the energy markets for you coming up in just a moment. Bottom line here, though, stocks lower across the board. We are off session lows, but that weak jobs report this morning, the widening war in the Middle East, all lifting oil prices and fueling inflation jitters. Right now, the S&P is down 71 to 67.60. That is a drop of 1%. The Dow down 1.1%. Dow Industrial is down 539, while NASDAQ is down 188. For NASDAQ, a decline of 0.8%. The 10-year at 4.11%, with the 2-year 3.53%. Gold is up $62 the ounce now, up 1.2%, 51.44 the ounce. Crude bears repeating, up 11.2%, 90.05 a barrel for West Texas Intermediate crude. At a retreat right now for Bitcoin, down 3.6%, 68,550 on Bitcoin. Earnings news. Gap reported fourth quarter sales and profit that came in below expectations. Gap shares plunging now by 12.8%. Another retailer out with earnings after the bell last night. Costco, its quarterly profit more than expected, doubled more than expected, actually rose more than expected, showing the club chain is capitalizing on an extended period of sales growth. Right now, we do have shares of Costco. They are advancing by 1.5%. So again, recapping here, oil is surging 90.31 right now for a barrel of WTI by 11.4%. The S&P is down by 1%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcast. And back we go to Washington. Balance of Power continues right now. Once again, your host, here he is, Joe Matthew.
Okay, Charlie, we do thank you. Charlie will be back in about 20 minutes with more on the markets. I knew that family-sized tub of gummy bears at Costco was going to get the job done for them, and I'm happy to hear that they're well. Oil's an issue, guys. We're at $90 a barrel. If you're just tuning in here or firing up the terminal, this is not Brent. This is West Texas Intermediate. You heard Charlie. We're up about 12% right now. We're not fooling around. This is a big deal. We went red when it crossed 70 the other day, and that's where we are now at 90. And, of course, the White House is acutely aware of this issue. There have been talks about potentially tapping the SPR, and the president has said he's not worried. As soon as this is done in Iran, the price is going to come back down. And Kevin Hassett didn't seem too worried either when he appeared this morning on Bloomberg TV and radio. Listen to what he said about the impact on energy prices.
We know that sometime soon we're going to have a much more stable Venezuela with high stable energy output, a much more stable Iran with high and stable energy output, which is going to be very good not only for energy markets but for risk premia around the world. Don't forget that this move against Iran is happening because they've promised to destroy us all. Like if that's not something that affects risk premia, I don't know what is. And so I think with an eye on the horizon, then you can see that this is a huge positive for the global economy and global markets. The question is, when will the current near-term disruption end? And that's something that'll be decided by the military. And of course, will be some uncertainty about when they decide to move, in part because the uncertainty protects the lives of American soldiers.
Kevin, in the meantime,
but we expect that it'll be resolved, quite soon.
As you see, we're starting to see a hit to production. Because we can't move the oil, we're breaching storage capacity in select producers right now. You saw some of that with Iraq earlier this week. The Journal reporting moments ago, we're seeing the same thing in Kuwait, and UAE and Saudi Arabia might follow. That's obviously a bigger, more acute issue for the Asian refiners right now, which is why the Treasury Secretary came out and issued a waiver for the Indians to buy from Russia, the Russian crude that's offshore in tankers right now. But Kevin, I wonder what else the White House has got in store. Not just to tell people to wait, because in the future it'll be better, but what are the remedies that you can produce right now?
Oh, sure. The the sanction waiver that Secretary Bessent came out with is just one of many, many tools that we have ready. We've got a whole flow chart of tools to use depending on this or that, and we're ready to move them as soon as we have to, but we're also very optimistic that we're going to be able to get this near-term problem resolved relatively quickly.
The Biden administration, as you know, burned through the SPR, took it down quite dramatically. Is there space left in the SPR to deploy some of that to bring down prices just a bit for consumers?
You know, there is no conversation right now to dip into that, but we've got something like 400 million barrels ready to go if needed. But there is, I reemphasize, that there has not been a conversation to dip into that yet, because our expectation is that this effort in Iran is way ahead of schedule, and that we understand that there are near-term market fluctuations, but we have our eyes on the horizon, and we think that's where people should be looking to.
Kevin, you say ahead of schedule. Is there a schedule?
Yes, but obviously we're not going to go through the schedule on TV.
Well, we'd love to hear it even off TV, because there have been so many questions about timeline here. I will add another log on the fire here as Qatar halts production of liquefied natural gas, LNG. Qatar expects all Gulf energy producers to shut down exports within weeks if this continues, potentially driving oil to $150 a barrel, according to the country's energy minister. Now, we've got a couple tough headlines here, of course, on the terminal. I already talked about crude at 90. It's coming through the other end, though, in gas prices, now looking at the highest gas prices ever under a President Trump. Not great as we get above the $3 level on a national average. Not great considering the midterm campaign cycle that we're entering. That's the political side of things. We want to stick with the energy side of things and bring in Tom Kloza. This is one of the first phone calls that we made when missiles started flying last weekend. Tom's been in this space for a long time, and I've had the pleasure of talking to him for the better part of 20 years. As an oil trader, as an analyst, he is now chief oil advisor at Gulf Oil. And Tom, it's great to see you. How high could we go here, and how worried are you?
Well, I think that we're talking about an abstraction when we're talking about the price of crude oil right now. I went ahead and looked at what one might expect for gasoline prices with crude at $90. I thought I had some time. I did that this morning, and we're already above 90. But we're going to see it manifest itself at the pump. I think we're going to see 350 to 375 almost immediately, certainly before St. Patrick's Day. And if we stick around or we move higher, and we've been moving higher by like 6 and 12% every day, we're going to see a return of $4 in a bunch of different markets. You know, the one thing, Joe, is that we're talking about $90 for crude, and that's really exciting. Gasoline is costing, on a spot basis without taxes, anywhere from like $125 to $134 a barrel now. Diesel's about $150 a barrel, no tax. And jet fuel, that's about $185. And that may be the first product that hits $200 a barrel, which I don't think, well, no, we did see some of those numbers back in the 2022 Russia-Ukraine war.
Remember the spike we saw at that very time? This was, of course, inspired by Russia's invasion of Ukraine. Now it's the United States that's initiating conflict here. Do you expect similar levels? Will Donald Trump have the similar experience that Joe Biden had?
Well, it's possible. When I heard Kevin Heston talking about flowcharts, that worried me a little bit. This isn't going to be solved with flowcharts and Excel spreadsheets. I mean, the Strait of Hormuz needs to be reopened, and how they do that is questionable at this moment. But we're talking 15 or 16 million barrels a day of crude oil, and then 5 or 6 million barrels a day of refined products. We've seen it manifest itself more on the refined product side, and particularly for products like diesel, heating oil, jet fuel, marine gas oil, that were very, very tight despite the glut in crude and the glut in gasoline. So it's changing very quickly. I do think that a month from now, we're going to be looking at something different, because I just don't believe that this can be allowed to happen for weeks upon weeks.
Wow. Okay. To what extent can any of this be rerouted by vessel or by pipeline, Tom?
They are rerouting some things. Saudi Arabia has the most wherewithal to do that. They can move things to the Red Sea port of Yanbu. Kuwait, not so much. The Emirates, not so much. So you really do need the strait reopened. I mean, I'm guilty, like most people, of thinking they couldn't possibly shut down the Strait of Hormuz. But when you think about it, and you think about the technology now, and the technology of $10,000 or $20,000 drones that can knock out billions of dollars of infrastructure and certainly could knock out some of these expensive vessels, that's the big game changer. You know, back in 1985 or 86, you did have escorts take vessels through the region, but you didn't have drones and you didn't have a lot of the missiles that you have out there right now and that capability.
Yeah. I've always been fascinated by the hats that oil analysts, energy analysts, and traders need to wear. You have to be a geopolitical expert to work in this space, which is why it's always fascinating to talk to you guys. Now, Chris Wright knows a lot about this, too. He's not projecting it so much in interviews. He showed up on Fox earlier to talk about, I guess we could frame his lack of concern about this issue. Here's the Secretary of Energy.
Yeah, I think it's of order weeks. I would say in the worst case, but it's weeks, not months. And look, Iran has been an escalator of energy prices 47 years, the whole history of their regime. We've got a little bit of an interruption right now to finally put an end to their ability to wreak havoc, to kill Americans, and to terrorize their neighbors.
A little interruption right now, Tom. It doesn't sound like that's how you're characterizing this.
Yeah, but let me tell you where they're coming from. You know, you've heard this administration talk a lot about energy dominance, and energy dominance really started with the high prices in the Arab Spring 15 or 16 years ago and with the shale revolution. If you were having an Olympics for continents, the North American continent is so superior to every other continent right now. We've got cheap natural gas. We've got cheap crude oil, much cheaper than the rest of the world. We've got world-class refineries and world-class technology. And, you know, we're producing just between the United States and Canada about 17 or 18 million barrels a day of crude. So I understand that compared to the rest of the world, North America, and particularly the United States, is in great shape, dominant shape.
Only got a minute left, Tom. Do you agree with the administration that the long-term story here is a more stable energy market?
Probably would agree with that. Yeah, I think, you know, you never know when these things happen, how long it's going to take to play out. But 2026 was shaping up as a very, very sloppy year for crude oil. And if they get the strait reopened, it'll at some point go back to that sloppy nature, probably in the second half of the year. There's a reason why banks who are predicting $90 or $100 or even $120 right now, that they're predicting something in the 60s for, you know, the back half of the year. And I think that unless it really blows up in the region, we can get there.
Tom, I'm glad you're still at it. Tom Closa with Gulf Oil, if you didn't get the hint on YouTube. Tom, thank you so much. $90 a barrel, our reality today. This is Bloomberg.
It's 12:40 on Wall Street. We do check markets all day long here at Bloomberg. Jobs Friday and a widening war in the Middle East. Stocks are on track for their worst week since November. The Dow, the S&P, NASDAQ again in the red. S&P at 6743, down 87 right now, down 1.3%. The Dow is down 660, a decline there of 1.4%, while NASDAQ is down 267 points, a drop of 1.2%. The VIX now above 27. The 10-year yield, 4.13%, with a 2-year at 3.55%. Gold is surging 1.2%, 51.44 the ounce. Crude, though, the big story today. West Texas Intermediate crude now surging 13%, 91.56 a barrel. Barrel of Brent, the global benchmark, 93.66. That is a gain of 9.7%. But I'll say it again, we got WTI up now by 13%. Tom Closa is chief oil advisor at Gulf Oil. Moments ago, right here on Bloomberg Balance of Power, he told us he is not ruling out $4 gasoline.
We're going to see it manifest itself at the pump. I think we're going to see $3.50 to $3.75 almost immediately, certainly before St. Patrick's Day. And if we stick around or we move higher, and we've been moving higher by like 6 and 12% every day, we're going to see a return of $4 in a bunch of different markets.
Tom Closa, chief oil advisor at Gulf Oil. He mentioned that 12% number. That was as he spoke. Right now, we've got WTI up by 13.1%. Again, recapping here, the Dow, the S&P, NASDAQ, all in the red. S&P 500 index down 1.3%. But again, WTI, West Texas Intermediate crude now up by 13.3%, 91.88 a barrel. Keep it locked into Bloomberg for the latest on any and all energy developments. I'm Charlie Pellet. Joe Matthew, that is a Bloomberg Business Flash.
All right, Charlie, he's working for the money today, and we'll have more from Charlie Pellet coming up at the top of the hour. I mean, he's always working for the money. It's the voice of Wall Street we're talking about, and the New York subway. Charlie Pellet, live from New York. Not a great session here as we consider what's happening in Iran. And I want to just let you know what we have coming up in our second hour, about 20 minutes away from our conversation with retired General Wesley Clark. We'll also get an update from Jeff Mason, Bloomberg White House correspondent, as we welcome our global television audience to the conversation. It's the day after for Kristi Noem, I guess for Mark Wayne Mullen as well. Two pretty different scenarios here and two pretty different politicians as the President of the United States reassigns Secretary Noem to a new role. What is this, the Shield of the Americas, James? Was that the... Nobody's ever heard of this. It'll be introduced this weekend. Something that presumably came out of a Marvel movie. Mark Wayne Mullen, on the other hand, he's going to hang it up as the senator from Oklahoma and run DHS. And it's been amazing reading about Mark Wayne Mullen because everyone reaches for the same line. Mullen, comma, known to be a fighter, comma. I actually put it in Google, and it turns out that he is not just a fighter, he's a black belt. He's like an MMA guy. Did you guys know this? Brazilian jiu-jitsu. He is a Brazilian jiu-jitsu black belt. So he could kill you with his bare hands. By the way, has a 5-0 record and was in fact inducted into the Oklahoma Wrestling Hall of Fame in 2016. I wonder if Sean O'Brien knew that when they almost came to blows in the hearing room. I'll tell you what, you want to talk about Mark Wayne Mullen, the fighter. He even took his ring off do you remember this? The head of the Teamsters was up there testifying, Sean O'Brien, and he had been kind of trolling Mullen online on social media, talking about him. And well, Mullen had just about heard enough, as Bernie Sanders, the chair of that committee, realized a bit too late. Remember this? This is just a couple of years ago.
Sir, this is a time, this is a place. If you want to run your mouth, we can be two consenting adults. We can finish it here.
Okay, that's fine. Perfect.
You want to do it now?
I'd love to do it right now.
Well, stand your butt up then.
You stand your butt up.
Oh, hold on. Oh, stop it.
Is that your solution?
Hold on. No, sit down.
The ring's off.
Sit down. Okay. You know, you're a United States Senator.
You're an embarrassment.
You're an
embarrassment.
Look,
After an embarrassment to the state of
this
Oklahoma.
hearing is about the condition of the working class in America. That's what we're talking about.
You're the biggest thug here.
Listen, if you're with us on 92.9, you know well you don't pick a fight with a kid from Dorchester, but Mullen did. And we assembled our political panel to talk about Well, the political fallout. Jeannie Shanzano is with us, our, of course, Bloomberg Politics contributor and democracy visiting fellow at Harvard Kennedy School's Ash Center. Rick Davis at World Headquarters in New York, Republican strategist and partner at Stone Court Capital. Rick, I guess, want to meet Mark Wayne Mullen in a dark alley. This all developed while we were on the air yesterday, by the way, and Rick has weighed in a bit here. I'm just wondering what comes next for him, if this is going to be an accelerated confirmation process, if he's as good as got the job, Rick.
Yeah, I think the accelerated process is important because you don't want any lapse of leadership at an important agency like this, especially one that's been shut down for almost 20 days. And the reality, too, is he should be able to get senatorial courtesy and fast track through the nomination process. That would be typical. Obviously, he's a bit of a firebrand, as you just indicated, and Democrats should probably put up a pretty vociferous opposition to him. But at the end of the day, this is a done deal, and I think you'll probably see this move pretty quickly.
You might have heard he's a fighter, Jeannie. What will Democrats do in that confirmation hearing?
Joe, my head is still reeling from that intro you just gave. Let's just say about his confirmation hearing, it goes through the Department of Homeland Security, chaired by a one Senator Rand Paul, who Mark Wayne Mullen recently called a freaking snake. And so there should be fireworks, not only from the Democrats, but we may see some from the Republicans as well. To your point, that is how most of us around the country outside of Oklahoma first got to know him, was in this very odd Bernie Sanders refereed fight with O'Brien that didn't come to blows. But good news, Joe, they made up. Donald Trump, the peacemaker he is, brought them together. As we remember, because we all were there, O'Brien spoke at the Republican convention, not at the Democratic. So all's well. I hear even O'Brien yesterday made a statement mildly supporting Mullen. So I think from that perspective, it was just two guys in a Senate committee having a brawl. And I think that Democrats are going to, they will put up a fight, but I think he's likely to get through this. But I don't know that it's going to change much in terms of the shutdown in terms of DHS.
Well, these guys are fast friends now. As CC said, he respects a worthy opponent. There's no better way than to make friends with a fighter than to get in a fight with him, right? So here we have the Teamsters leader actually endorsing this idea, which is fantastic. Sean O'Brien offering unexpected praise for Mark Wayne Mullen's nomination to lead the Department of Homeland Security. They're fast friends now. They had like a beer summit or something. And there are big questions about what happens to the seat. And this is really what I'd like to get into with the two of you. What happens to Mullen's seat? And what happens to Kristi Noem? Because we understand that the governor, Kevin Stitt, will appoint an interim senator, and per state law, Rick, that person must pledge not to run for a full term in November. How is this all going to shake out?
Yeah, you're going to have a group of people probably vying to, on both the Republican and the Democratic side, to jump into this race. There's still time to get into the primaries in Oklahoma, so the timing is good. None of these campaigns will have raised any money or positioned themselves with the voters yet, so it'll be a fast track to a primary. But somebody will be a caretaker that'll sit through that seat until January 2027, and you'll have a knockdown, drag-out fight. Highly likely a Republican will prevail because Oklahoma is a solidly red state, but the primary may not be that interesting unless Donald Trump doesn't endorse, but likely he'll find someone he wants, he'll endorse him, and that person will win the primary.
Interesting. Speaker Johnson, Jeannie, told reporters yesterday that Governor Stitt promised him not to tap a House Republican. We can't lose anyone right now, was the quote. And I'm curious, to be honest with you, as to why he would want this job. He's the United States Senator. He seems to be very well regarded on Capitol Hill as not only a team member for Republicans, but a negotiator, Jeannie. He's been negotiating between the two chambers and between Republicans and Democrats. He talked about during the shutdown sitting down at Democrats' kitchen tables and having fruitful conversations with them. But when I heard him talk about the challenges that Kristi Noem faced in the job, it made me think, well, why would he want this? Listen to Mark Wayne Mullen on the steps of the Capitol yesterday.
She was tasked to do a very difficult job, and I think she has performed the best she can do underneath the circumstances. Is there always lessons to be learned? You know, listen, my wife and I, we have, over the years, we have been fortunate enough to purchase companies and grow our companies, and every day there's something you can do better. And so I think there's an opportunity to build off successes, and there's also opportunities to build off things that maybe didn't go quite as planned.
Well, there's going to be a lot that comes with this job, Jeannie. Is this a promotion? I mean, I guess he's joining the cabinet, but why do you leave a Senate seat for this?
Yeah, and let's just underscore what Johnson said. Literally, he can't afford to lose one seat. That is quite literal for Johnson. And, you know, Mullen is very close, by all accounts, to Donald Trump. And here is a guy who went from being an MMA fighter and a plumber owning his own plumbing company into politics about 15 years ago, and just this stratospheric rise and in the political realm, finding himself as a senator of the United States. I think it's very, very tough for anybody to say no to the president when called on. So absolutely, I have no question that he, when the president called, he was there and willing to do what he can and what he's asked to do. I think there is a little bit of, it's a little bit ingenuous of the White House to suggest that, for instance, on this $220 million, you know, Yellowstone, Taylor Sheridan style campaign that Kristi Noem had, that they just didn't know about it. This thing had been out for a year. The president is featured prominently in it. So I think a lot of this has to do with discomfort with Kristi Noem, and not just coming from Donald Trump personally, but from Stephen Miller, who late last year was making that clear in terms of her spending. And so they want somebody to do their bidding. And I think that is what's most troubling about this. It has very little to do with change of ICE tactics or ICE strategies or the killing of Renee Good and the killing of Preddy. It has to do with a replacement of somebody who blamed her boss publicly for wasteful spending and has done other things. And they want her out. But Mark Wayne Mullen is going to find himself having to execute on the same really unpopular ICE tactics that she was, with absolutely no, you know, willingness on the part of the White House beyond the body cameras to pull back on that.
Hey, Rick, Senator John Kennedy of Louisiana, who played a big role in leading us to this moment following his questioning of Kristi Noem in the hearing earlier this week, said Donald Trump called him after the hearing. The president was not a happy cowboy, the senator said. I remember thinking, this is such classic John Kennedy, I remember thinking the secretary, quote, pretty much as dead as fried chicken, unquote. What's going to happen to Kristi Noem? What, is this new job real, or is this a way of sunsetting her as a member of the administration?
Yeah, I'm sure some you know, interesting person in the White House said, "Oh, we can't just fire her. We've got to give her an exit plan." So they concocted this scenario for the Western Summit Shield. Who knows what that's going to be, and it probably doesn't really matter that much. Maybe she's going to wind up running Venezuela. Who knows? But at the end of the day, all eyes are on Mark Wayne Mullen. And look, I mean, this is an agency that's in dire need of help, right? They need new leadership. They need new direction. They need new funding. I mean, this is a severe test of leadership that he's going to face. And I don't know if his appointment will break the log jam of funding for an agency like this that has been, you know, frozen in time. But we can hope that this is the kind of thing that'll get everything back on track and create some kind of an outcome where people can get paid and new policies can be pursued, not just to meet Donald Trump's administration's agenda, but also to build confidence with the American public that the agency's not against American citizens.
Sounds kind of painful, to be honest, Jeannie. Democrats say that this doesn't change anything for them when it comes to DHS funding, that he needs to still make good on demasking and judicial warrants. He's not about to change his tune on that, is he?
He's not. We've seen no sign of that. And I think that is what's troubling. Although Senator Blumenthal, prior to the firing, said, well, if she was removed, it might be easier for us to negotiate. So maybe there's something there, but I still think it's going to have to be substantial. And Joe, by the way, can we just agree that this was some redemption for little Cricket, the puppy that Kristi Noem killed, 14 months old. And, you know, Cricket needed to see his day. And thank goodness for Donald Trump and Stephen Miller, a bit of redemption for the little puppy.
Say his name, Jeannie. Say it out loud. With apologies to little Cricket. Jeannie Shanzano and Rick Davis will be back in our second hour as we welcome our global television audience to the conversation. Tyler Kendall's on the way in, too. Let's get to it. One more hour on Balance of Power, only on Bloomberg.
From Washington, D.C., this is Balance of Power with Joe Matthew and Kaylee Lines.
Crude oil tops $90 a barrel as President Trump demands unconditional surrender. Welcome to the Friday edition of Balance of Power here on Bloomberg TV and radio as President Trump says he does not want to negotiate an end to this conflict, demanding that Iran capitulate. I'm Joe Matthew, alongside Tyler Kendall in Washington. And Tyler, we're only 6 days into this conflict.
Only 6 days in, and no clarity on just how long this will go, as President Trump's comments seem to reinforce the idea that he needs to see a leadership change when it comes to Iran. And there are questions about what that is going to look like, as he says he wants to be personally involved in that decision.
Absolutely. We're going to get the latest on this from Bloomberg Washington correspondent Jeff Mason, and a conversation ahead we've been looking forward to. Tyler, retired General Wesley Clark will be with us to give us his read on what's happening on the ground right now.
Particularly when there's questions about weapons stockpiles, right?
Exactly.
And I'll point out that today President Trump is set to meet with some of the nation's largest defense contractors. Right. We're talking about Lockheed Martin, RTX, companies like that, as it appears that this conflict is going to be sustained, the administration says, at least until its objectives are fulfilled.
We've been talking about the DIB around here for a long time, since the beginning of the war in Ukraine, the defense industrial base. This administration is trying to get its arms around it with those defense contractors that Tyler mentioned. That'll be part of our coverage today and part of our conversation with the general. We've got our political panel, Rick Davis and Jeannie Shanzano, with us as well for the hour. So let's get started, Tyler.
Right, and as you mentioned, WTI topping $90 a barrel, first time since October of 2023. The markets are, of course, watching this very closely, and we can't forget it's also Jobs Day around here, so we're going to check in with Charlie Pellet in World Headquarters in New York. Happy Friday, Charlie.
Well, happy Friday to you and Joe. We have got the Dow, the S&P, NASDAQ, all very much in the red right now. We'll get to crude oil in just a moment. That's a major story today, helping combine to send stocks lower. S&P right now down 83, drop there of 1.2%. We got the Dow Industrials down 589 now, down 1.2%. The NASDAQ Composite Index lower by 1.1%. The VIX 26 right now, 10-year 4.11%. Spot gold is up $60 the ounce to $51.42, up 1.2%. But the move in crude, West Texas Intermediate up 13% right now. It is at $91.55 a barrel. Brent, the global benchmark, up 9%, $93.30, and Bitcoin down 4.2%, 68,160 on Bitcoin. But certainly the move in crude attracting a lot of scrutiny. WTI again up now by 13%. And Balance of Power continues now. Back we go to Washington. Once again, your hosts, Tyler Kendall and Joe Matthew.
All right, Charlie, thank you so much. Charlie Pellet will have more on the markets in about 20 minutes' time here on Balance of Power. Thanks for spending part of your Friday with us. Thanks for meeting us at the threshold of the weekend. Happy 100 years to Alan Greenspan, who famously said increased jobs are the consequence of increased trade. And we'll talk later this hour with Liz Pancotti from Groundwork for her read on today's jobs report. But we want to seize on what's happening with Iran as the President of the United States takes to Truth Social to say there will be no deal with Iran except unconditional surrender, all caps, exclamation point, similar to what he said at the White House yesterday. Listen.
I'm once again calling on all members of the Iranian Revolutionary Guard, the military and the police to lay down their arms. They're only going to be killed. Their communications are gone. Missiles are gone. I said, what's left? But they're tough, and they want to fight. And they're calling. They're saying, how do we make a deal? I said, you're being a little bit late. We want to fight now more than they do.
Sounds like they're more than a little bit late. Jeff Mason joins us, Bloomberg White House correspondent, who we're lucky to have in studio with us today in Washington. Jeff, why are we walking away from diplomacy? Is it too late?
Well, I think one thing that's important to fact check here is I don't think that there are actually any calls going. There's no evidence of any calls.
Is that true?
I mean,
he said that multiple times recently.
He has, but he hasn't. I mean, who is he talking to?
I'd love to know.
And Jared Kushner and Steve Witkoff walked away from talks right before this war started in Vienna. So, I mean, at least it's a question, whether that's hyperbole or whether that's factual, that Iran is calling. I don't know who those calls would be with. Is it too late for diplomacy? It seems like it. I mean, the United States made the decision to go in when they did because they determined that, according to senior officials, that Iran was not serious about giving up its ballistic missile program and also was intent on getting a nuclear weapon. That's at least the justification that U.S. officials have used, and that's what led the president to decide to go in when he did.
So that's perhaps an update when it comes to the foreign policy front, but I wanted to make sure that we also asked you about domestic policy. And do we have a sense of how high a tolerance the Trump administration has when it comes to oil prices? Because we had the NEC director, Kevin Hassett, on earlier today on Bloomberg saying that there are many, many tools in the toolkit to help bring down prices, but at least tapping the Strategic Petroleum Reserve for now doesn't seem to be one of them.
And that's always a hot question for White House reporters. Are you going to go after the SPR? Are you going to go after the SPR? Right. And Kevin said, no, you're right to mention that, Tyler. I do think it's a worry. I mean, it takes away what has been a pretty big talking point for President Trump going into the midterm elections. He likes to take credit for the fact that gasoline prices have been really quite low across the country, at least in many states. And boy, oh boy, with the oil prices going up today, that's going to have an impact on gasoline prices as well. So for sure, it is on their radar. The question is, what actions will they take? What are they willing to take? And just to do another quick fact check, yesterday the president in that same event that you just played a clip from said that oil prices were stabilizing. Not true.
Well, boy, no, far from it. We're $3.32 for the national average now, according to AAA. That number predicted to get closer to $4 a gallon, according to Tom Closa at Gulf, who we spoke with earlier in the program. You've covered a number of administrations, including the last one. And we all remember what happened to energy prices when Russia invaded Ukraine. That was something that dogged Joe Biden for a good chunk of his administration because that was not of his own doing. Is this a forced error when it comes to this administration?
Well, it's certainly not my job to say whether it's an error or not. But what I will say is it was a decision by this administration, for sure. And the president is the one who decided we're going to attack, or the United States is going to attack Iran, and certainly must have known that there would be ramifications for that in terms of the oil markets. That said, they don't really seem like they have a plan for it, or at least they're not sharing what that plan was. Also, they're not, telegraphing. I mean, his confidence that things are going to be okay in terms of the markets, or that these ramifications are not going to affect him and his party politically. At least that's the impression he gives. May or may not be well founded, and that will really depend on how long this operation goes. I mean, you hear people talking about an off ramp. I mean, what's the off ramp? He has at least said this is going to be 4 to 5 weeks, and when he's calling for surrender like he did today, there's no indication that the people in Iran, or at least that the military and the leadership in Iran, is open to that word. Wow.
All right. Bloomberg News White House correspondent Jeff Mason, thanks
Jeff.
So much for being here. And today, President Trump is going to be meeting with defense companies as the war in Iran continues. And it's part of a bid to bolster the defense industrial base, the DIB, as Joe called it at the top of the program. Secretary Pete Hegseth was asked about this yesterday and maintains that the U.S.'s weapon stockpiles are still in a strong positioning, even as the U.S. confirms it has hit more than 2,000 Iranian targets.
Our munitions are full up, and our will is ironclad, which means our timeline is ours and ours alone to control. As long as it takes to ensure the United States of America achieves these objectives, and as we flow more forces, and as we flow more capabilities, and as our munitions, as we're flying over the top, have even more devastating effects, we set the tempo, we set the timeline.
For more on this, we're going to bring in Wesley Clark, retired 4-star general in the U.S. Army. He served as a commander of U.S. Southern Command and is the founder of Wesley K. Clark and Associates. General, thanks so much for being here. It was announced this week that the U.S. and Israel are going to start a new phase of their military operation in Iran, which will require striking deeper into the country using different types of weapons. Can you just outline for us from an operational standpoint, how much more difficult is this going to get?
Well, it is going to get more difficult. And just by way of your viewers, I was the NATO commander who led the campaign against Slobodan Milosevic. We had an 11-week air campaign. So many of these issues that are coming up now are very familiar to me and very personal to me. And I can tell you that this campaign is off to a good start, but there's a lot more to be done, as Secretary of War said. And that is, we've got to go deeper. We've got to isolate the theater of operations. We heard today that the Russians are providing targeted information. Well, we need to stop that. And we know they've still got drones left. And we need to be able to protect our friends and allies, Israel and our Gulf friends, from those drone strikes. And we also have to get the ships moving through that channel of the Straits of Hormuz and get the oil market moving again. So these are big challenges. And so this campaign's a long way from being over.
We spoke, General, and it's great to have you back on Bloomberg with Ben Jensen at the Center for Strategic and International Studies, who's been tracking as closely as one can our level of munitions, with a lot of questions about our stockpile of missiles, particularly interceptors. Here's what he told us last evening.
So once you take out their air defenses, you don't need stealth fighters like the F-35. You can have high-altitude, slow-flying MQ-9s doing what's called a strike box. I can have that sit, because there's no person in the cockpit. I can have it sit for hours over a target of a potential launch site and wait for the Iranians to move in position. That's a target I can shoot with a Hellfire. We have no problem with our Hellfire stockpiles. So if you go on the offense the right way, you reduce the strain on your munition stockpile for defense.
Is that how you see this evolving, General?
Sure. That's part of it. You see, the problem with the air campaign, any air campaign, is you start with a certain target set. Is it 2,000, 4,000, 6,000 targets? You bring up the aircraft, you have the ordnance to strike that target set. But then if that target set doesn't get you to your desired end state, you have to develop more targets. And generating these targets, that's the whole key to this air campaign. So where are those launch sites? Where are the underground storage? Where is the nuclear stuff that's been hidden and moved into the interior of the country? So we have to have the ability to generate those target sets. Otherwise, the air power doesn't do any good. Now, I think it's a good thing to have the ability to stand off above and wait for a target to show up. And you might get it. But Iran's a big country. And one of the basic principles of any military operation is you have to isolate the theater of operations. You don't want the Chinese sending more Shahed motors in. You don't want the Russians providing targeting information. So you want to isolate it. This is a big country, so there's a lot to be done before we're able to really give effect to what the president's calling for.
Well, I am wondering what you make of the targets that Iran is hitting. We have a headline crossing the Bloomberg terminal right now that a military base at Baghdad airport was targeted by a drone attack, according to the AFP. We also saw energy infrastructure in Saudi Arabia hit, data centers in the UAE hit. How exposed are critical infrastructure assets in the region, and how does the U.S. think about that, along with our allies, amid a large military campaign?
Well, first of all, of course, I wasn't part of the planning, so I'm not sure how we anticipated this, but it should have been anticipated. And these countries all have certain defense systems. We probably didn't anticipate the effectiveness of the Russian targeting of the Iranian assets. It's been pretty exact and maybe contributed to the 6 Americans we lost there in Kuwait. But the key to this is a better offense, not just defense. So we've got to be more effective at taking out the launch sites and the stockpiles of the drones. And this is a big, big target set, and we probably don't have the target set for it. So it's important to intensify that part of the campaign and get this cut off.
General, how much do you worry about this widening? This is a war that has now involved 12 countries, if I can call it a war. And there's reporting today by the Washington Post that Russia is now providing Iran with targeting information and intelligence to help attack American forces in theater. What are the odds that this becomes a much wider regional, if not global, conflict?
It depends on how quickly it can be concluded. And this is why it's important that some channel be kept open while the pressure is put on the Iranians to, at some point, hear them when they cry uncle and get it stopped. That's what we would want to see. And of course, they would have to meet our objectives. But the longer it goes on, sure, the more opportunity there is that it will widen and escalate. But I think it's really about the tempo of taking out the Iranian capacities for drones and ballistic missiles. The more rapidly you can do it, the more effectively you can contain the escalation. It's in Iran's interest to escalate, to make a mess of the situation, to cause all kinds of pressures internationally and domestically on the United States to stop this. So we have to take out their abilities to escalate.
We've had a number of memories, General, this week of the updates and the briefings that you were providing in that campaign against Slobodan Milosevic in Kosovo. And we appreciate your being with us today to share your experience. Retired General Wesley Clark, retired 4-star U.S. Army Commander, U.S. Southern Command, and now Wesley Clark and Associates. I'm Joe Matthew alongside Tyler Kendall in Washington. Let's assemble our political panel for their take on this. Bloomberg Politics contributors Rick Davis and Jeannie Shanzano are with us. Rick is our Republican strategist, partner at Stone Court Capital, and Jeannie, Democracy visiting fellow at Harvard Kennedy School's Ash Center. Rick, unconditional surrender is the line from President Trump today. Hasn't that really been the case all along?
Yeah, I think that was the premise going in, is that this massive bombing campaign would elicit, cries of surrender from what's left of the Iranian leadership. And maybe that will happen. Who knows? But I think we've heard from expert all week that a bombing campaign on its own does not tend to cow a country, especially one with as many people, 90 million, and as large a landmass as Iran has. And so I think that everyone is left right now kind of scratching their head as we go into the weekend as to what is the end game here. The administration articulation of it as a unconditional surrender doesn't piece together the how do we get to that point. And so and I was raised too. Is that what Israel is thinking? Because Israel, by all accounts, has sort of been the leader of the tasking of this attack and has been following up significantly with their own bombing campaign. Are they ready to quit anytime soon? I haven't heard that from any Israeli leader.
Well, Jeannie, to follow on that, we've heard a lot about tactical accomplishments on the battlefield from U.S. officials, but do we have a clear sense on how the White House is measuring progress as we try to glean details on just how long this conflict will go?
Yeah, I don't think we do, Tyler. And, I was struck by the last thing that General Clark said to you and Joe, which was essentially, it is in Iran's interest to spread this fight as far as they can and as wide as they can, because Iran has a clear goal, and that is a very difficult but clear goal of survival, waiting out the United States. We, on the other hand, and this gets to your point about the White House, we don't have a clear goal. We have enormous military prowess. We have enormous power. We can bomb. But if, as the president says, he is waiting for unconditional surrender, and he would like to help choose the supreme leader of Iran in the way he did with Venezuela, that should be concerning to everybody, because Iran is not by any stretch of the means Venezuela. The differences are so important. And the fact that the president would articulate that and now say the goal is unconditional surrender, that's fine. But how do you get there? How do you get to regime change? And how do you ensure this new regime is tougher, it is less tough and more friendly to the U.S. than the old one? We have no articulation of that.
All right, our political panel today, they're both Bloomberg Politics contributors, Rick Davis and Jeannie Shanzano. Thank you both for watching. White House Press Secretary Caroline Leavitt seems to be talking to reporters. We'll bring you any updates there as we track the Iran conflict closely. This is Bloomberg.
It's 121 on Wall Street. We do check markets all day long here at Bloomberg. We are well off session lows, but still a down day for the Dow, the S&P, NASDAQ, Jobs Friday, but today's focus very much on the energy markets. Right to the numbers for the equities. We have got the S&P down 0.9% right now, down 59 at 67.70. The Dow down 441 now, down 0.9%. The NASDAQ Composite Index down 0.8%. The VIX holding above 26 now with a 10-year, 4.10%. Gold up 1.2%, 51.46 the ounce. Crude, West Texas Intermediate, major story, 89.95 a barrel. WTI up right now by about 11.1%. After earnings, Marvell Technology shares, they are surging today. We do have Marvell up now by 23%. And Oracle said to be planning to axe thousands of jobs among its moves to handle a cash crunch from massive AI data center expansion efforts. Oracle up by 2%. Recapping, West Texas Intermediate crude up 11.5%. WTI 90.35 a barrel. I'm Charlie Pellet. Balance of Power continues now. Back we go to Washington. Once again, your hosts, Tyler Kendall and Joe Matthew.
All right, Charlie, thanks so much. As Charlie mentioned, I'm Tyler Kendall alongside Joe Matthew here in Washington, and we've had our eyes on the foreign policy front, but we've also seen some major headlines related to domestic policies in the Trump administration this week. As you well know by now, we saw President Trump nominate a new DHS secretary, ousting Noem, the current one, and announcing, Joe Matthew, that it's going to be Senator Mark Wayne Mullen, a Republican from Oklahoma, who's known to be, in some sense, a negotiator on Capitol Hill, because we have to keep in mind DHS, the Department of Homeland Security, is still amid a partial DHS is fully closed, but we are still amid a partial government shutdown.
That's the truth. This is quite a time to be taking the helm at DHS. And of course, you've got a senator who probably could have kept that job for the balance of his career, leaving the Senate to lead this department at a very chaotic time. We have big questions, of course, what happens to Kristi Noem from here. This shield of the Americas is unknown to us. I guess the president will be unveiling this coming weekend. But it, of course, also sets off a fight to fill that Senate seat in Oklahoma. And that's where we start our conversation with Mark Short. Don't worry, we will get to foreign policy with the former chief of staff to former Vice President Mike Pence, former White House Director of Legislative Affairs. Mark, it's great to see you. Happy Friday, and thanks for joining us. Why would Mark Wayne Mullen want to do this? This is a seat he could have held for, the balance of his career. Why jump on DHS at a moment of chaos if only you don't say no to the boss?
Well, perhaps the Senate isn't as much fun as some people think it is, and people want it out. Bored? But I think it could be. But I think it's a really good question, Joe, because the reality is that I think the policies that are really guiding the Department of Homeland Security are going to be driven by the White House, and particularly by Stephen. And so, So to what extent are you having operational control as secretary? I think you've seen there were 4 secretaries in the first administration and now 1 in the second administration. This is really, it's not like he's going to have a chance to really direct this himself. So I think it's a fair question to ask. And I think it's also, Oklahoma's a safe Republican seat, sure, but a lot of focus has been on the likelihood of the House flipping. There's a big risk to the Senate flipping, too. And I think a lot of people assume 53-47, the map's favorable to Republicans. But when you start going through the states of the Democrats recruiting who they want in Ohio against a freshman, who they wanted in Alaska, what's happened in North Carolina, Texas variable. It's like the last thing we need right now is more open seats. And I think, the situation the way it ended in Montana also is ruffled feathers, too. So this creates a lot more consternation in the Senate as well.
So I do want to stick with domestic policy, but I am going to mention a foreign policy adjacent headline that's crossing the Bloomberg terminal right now, causing Boeing shares to jump more than 3%. Reportedly, Boeing is closing in on one of the largest sales in its history, a 500 aircraft order for 737 MAX jets to be unveiled when President Trump travels to Beijing. This is going to be a deal with China, as we know that trade deal right now is currently up in the air, as we just saw the Supreme Court strike down some of President Trump's broad-based tariffs. So that's going to be a headline that we're tracking.
3%. That's a big deal. They were hoping, the Biden administration was hoping for a deal like this coming out of COVID. It never happened.
Right, and it's raising questions, too, about leverage for President Trump going into this meeting after it was largely seen that he had been offset from the Supreme Court's ruling. So something that I'm sure we'll talk more about
Glad
later
you mentioned it.
this hour. But Mark, I do want to bring it back to this conversation. We can keep with the midterms, and maybe this kind of threads into it, but I'm wondering if Senator Mullen's selection is more about style versus substance. Are we going to see
You didn't think there was a lot of substance in the previous secretary?
No. More along the lines of a question. Are we actually going to see policy change here when we know Democrats are demanding some changes when it comes to DHS, and maybe there just needed to be a different type of messenger amid what had been bipartisan pushback to the last DHS secretary?
Well, look, senators like their own, and so I don't think there's any doubt the Senate will confirm Mark Wayne Mullen. So that's a plus as far as who the replacement pick is. But again, I think that the policy is not going to change. The policy is still being driven by the White House and by Stephen Miller on Homeland Security issues. And so, yes, you might have a different face for them, but you're not really going to have a change in the policies. But I really think this is, at this time when we're at war with Iran, it's a real opportunity for Republicans to be pushing the fact that Democrats are refusing to fund Homeland Security when you know there's sleeper cells in this country. And instead, there's so much chaos that you're actually not allowed to get on offense and prosecute the case against Democrats for not funding it. Instead, you're sitting here having news interviews every day about the chaos with the outgoing secretary and what are the chances for the new secretary. And so Republicans are really missing an opportunity here politically to be scoring points about Democrats keeping DHS shut down.
Speak to us about the significance of this change. You saw a lot of cabinet secretaries come and go in the first term. The president has been very careful to not give anyone the opportunity to use the word fired. And I think a number of folks reached for that line of first to be fired. Well, then there was Michael Waltz, but he didn't get fired either. Do we just reassign people now? You send them to another parish in this second term?
Well, I think that there's probably been too much sensitivity to that, and yes, I think I'm not offering a vote of confidence when you're having constant turnover, but frankly, I think Americans sent Donald Trump in part because of the role he played on Apprentice. They wanted somebody to go to Washington, D.C. and fire them all and basically take a wrecking ball to Washington, D.C. And so how much that really hurt him, I don't know. And I've questioned a lot of his picks in the second administration, and I think probably would have benefited from replacing some of them sooner.
Wow.
We did promise that we would ask you about foreign policy, and you already brought it up in some ways, too. There's reporting that congressional Republicans are bracing for this White House to ask them for a supplemental funding request for the Pentagon to help bolster our own defenses as the Iran campaign continues. I'm wondering if you have any sense of how much money we're potentially talking about here and what the appetite right now is on Capitol Hill, the pressure to make sure that we are adequately funding as the military operation continues.
I would imagine you see a pretty large ask, and I think the reality is that in a time of war, that those are generally approved by Congress, and it's perceived if you're voting against our troops, if you're opposed to it. And the reality is that, I think that truly this is a transformational opportunity for President Trump. I applaud his decisions. I think after 47 years of all the attacks, whether it's our embassy or whether the attacks in Beirut or funding Hamas and Hezbollah, the fact that Iran for 47 years has been prosecuting a war against the West and demanding death to America and death to Israel, it's about time that we actually had this action. So I applaud him for it. But Tyler, I think the concern that I would have if I'm in Congress elected Republican is that I think the president lowering energy prices for the first 15 months masked a lot of his trade policy implications. Now that you have energy prices spiking, I think you're going to see the real downside of these tariff policies, and you see inflation coming back as you're heading into the midterms. And so I think I applaud the foreign policy move, but I think there are really significant implications you head in the midterms if you continue to see inflation like this.
You would have been walking over this supplemental request, right, in the old days as the head of Leg Affairs in the White House. Democrats are going to say, whoa, I thought we had the first $1 trillion budget in history for the Pentagon, and it just went up by 50%. Why do we need more?
Well, the reality is that our deficits are so far out of control that actually we're now at 3% of GDP is going toward defense spending, which is the lowest it's been since World War II, Joe. So we've actually been underfunding. So
this is about catching up.
I think it is. Now, to be fair, there are plenty of people inside this administration who argued for more cuts initially to the Pentagon, which I think was wrong. But I think we have been underfunding it. So, but I think at times, I think typically when you're going to see something like this is you'll see other stuff put in the bill. Because again, there's a notion that Congress is not going to vote against something that's perceived as voting against our troops when they're at war. And so you can attach a lot of things to a bill like that. Yes.
The memories.
Whether that's coming from the White House or it's coming from Congress.
Understood.
They'll either see
if you want some Democrats on board.
Yes, they'll see this thing
Put
going
decorations
through.
on the tree.
Let me jump on board.
Thank you, Mark.
All right, Mark Short, former Chief of Staff to Vice President Mike Pence and former White House Director of Ledge Affairs. I'll echo Joe. It's always nice to see you in person. We want to continue this conversation and bring in Christina Ruffini, Bloomberg This Weekend co-host. She always has one eye on geopolitics. So, Christina, the big news today, President Trump calling for unconditional surrender, but then also nodding at the fact that the U.S. wants to have a say when it comes to the next leader of Iran. Can you just give us the latest? What do we know about the administration's thinking here when President Trump said earlier this week that a lot of the contenders they've been eyeing have been killed in the airstrikes?
I think that's a pretty startling admission. I'm not sure that was something most people would recommend you say out loud. But I also think the odds are slim that the United States is going to have a real say into who the next leader of Iran is, right? This is a very entrenched regime that has been there since the revolution. They do still have some support on the ground, and there are layers and layers and layers of these loyalists, all of whom have going to be and will be vying for this top spot. The U.S. found this out the hard way when they put who they wanted in charge of Iran, and then there was this thing called the Iranian Revolution, and that's how we got the guys we had until very recently. So there is a longstanding issue with puppet governments, especially in the region, especially in Iran, and if the U.S. is looking for a more durable solution and a more U.S.-friendly solution, people in Iran do not like this regime. People in Iran, the average person I've talked to some Iranian friends, are grateful that the Ayatollah is gone, but they also don't want to be a puppet state of the United States. And finding something in the middle there is probably the best solution. Now, whether or not that's going to happen, I think there's no way we can tell at this point.
Christina, U.S. intelligence seeing no signs of uprisings or defections as we approach the 1 week mark here. What does that tell you? Is that a sign of stability in what's left of the regime, or the fact that, as we just established, we've taken so many people off the board?
I think it's that. I think it's a couple things. It's also fear. People are hunkering down. I mean, I talked to a woman who said she doesn't even know where her family is because last time they bombed, they left Tehran and went out into the mountains to try to be safe. People are not home. People are not organized. People can't communicate. It's really hard to organize a protest against a repressive regime if you can't even talk to one another. WhatsApp, these messaging signals have been shut down for the most part by the regime. And it's also the IRGC, it has been significantly degraded by the United States and by Israel, but it does still exist. The president openly offered amnesty to IRGC members, to people who would defect and be willing to come into the fold. And to your point, we haven't seen a lot of that. I think the president was trying to export the Venezuela model here. These are very different countries with very different political systems, and it may not go as quickly as he had hoped.
Well, I'll tell you something. It's a pretty good situation when one of the best analysts you have on this also is hosting her own program, and that's Miss Ruffini, along with David Gura. It's Bloomberg This Weekend. We just started a week ago. Tomorrow morning at 7 a.m., you will have the very latest on this, and I'll remind you that it was Miss Ruffini who walked you through the initial stages of these strikes 1 week ago, minus 1 day. Ruffini and Gura only on Bloomberg. Thank you, Christina. I'm Joe Matthew alongside Tyler Kendall. We're live in Washington on the fastest show in politics. It's Balance of Power, only on Bloomberg.
It's 1:40 on Wall Street. We do check markets all day long here at Bloomberg. We have got a sell-off on Wall Street. Jobs Friday, but we're keeping an eye on energy right now. The Dow, the S&P, NASDAQ, all declining. At one point, the S&P 500 index was down 1.7%. Right now, looking at a loss of 1.1%. The S&P down 72, 67.57 where we stand. A weak jobs report on the widening war in the Mideast, lifting oil prices. That is fueling inflation jitters. The Dow down 560, down 1.2%. NASDAQ down 219, drop there of 1%. And the VIX at 26. We've got the 10-year 4.10%. Spot gold is up $73 the ounce, up 1.4%, $51.55 the ounce. West Texas Intermediate crude oil, major story, trading above $91 a barrel now. This is on WTI, up 12.8%. Brent, the global benchmark, above 93. That is a gain right now of 9%. Bitcoin down 3.8%, 68,420 on Bitcoin. Sources tell Bloomberg Boeing is closing in on one of the largest sales in its history, a 500 aircraft order for 737 MAX jets, set to be unveiled when President Trump travels to Beijing for his first state visit to China since 2017. Again, recapping, the Dow, the S&P, NASDAQ, all in the red. S&P 500 index down now by 1.1%. We are looking at the 10-year 4.10%. Crude, the big story today, West Texas Intermediate up 12.6%. 91.37 a barrel. Balance of Power continues right now in Washington. Back we go. Your hosts, Tyler Kendall and Joe Matthew.
All right, Charlie, thanks so much. As Charlie mentioned, I'm Tyler Kendall here alongside Joe Matthew in Washington. And of course, the conflict in Iran is moving the markets, but we also got February's payrolls report today. And Joe, it was a huge downside surprise. The estimate had been a gain of 55,000 jobs. Instead, non-farm payrolls fell by 92,000 last month.
Happy Jobs Day. This is one of the biggest declines since the pandemic, and it really kind of spooked the markets here, particularly when you add the layer, and we'll talk to Liz Pancotti about this in a moment, of high prices. And now that we've got $90 a barrel oil, you're going to have a Federal Reserve with some really difficult decisions to make.
Right, and that decision coming up later this month. Of course, our eyes on the middle of March, but it is raising questions about just the underlying strength of the labor market at a time where the idea had been that we'd seen this steadiness. But of course, big job losses last year. It's just adding to the picture.
Well, that's absolutely right. The markets are speaking for themselves. And when we consider the risk that's presenting itself in different corners of the market here, it was fascinating to hear from the former boss at Goldman Sachs. Lloyd Blankfein sat down with David Weston, the host of Bloomberg Wall Street Week. Listen.
Do you manage risk differently when you think you're late in the cycle?
Well, it's a funny concept of late in the cycle. I'm not sure how long the cycle has to go, but I could tell you every day we get closer to the end of it. That's a joke, goes without saying, that we get every day we get closer to the end of it. But just think about this. We haven't had a reckoning in a long time. What do I mean? What's a reckoning? We haven't had some disaster that forced people to sell things that they didn't want to sell, accumulate cash capital, find out and have to discover what the value of the inventories that they're accumulating in their balance sheet. We haven't had that in a while, and the longer it takes, really not since the global financial crisis. That was a long time. 2008 was a long time ago. Usually we had these things every 4 or 5 years. I could tick through them, but we had them, and we haven't had it for a long time. And because we haven't, the sheer fact that we haven't had it for a long time means there's undoubtedly a lack of discipline. Interest rates were very low for a long time, so investments were made. Anytime the commodity is free, you're not husbanding it and you're not disciplined about it. And you know that there must be things out there that nobody's been forced to sell, nobody's been forced to price discover, and at some point, the longer the reckoning takes, the worse it's going to be. Again, my base case is wind at our back, but eventually it will come to an end, and people will have to take stock of what the assets that they've been accumulating and had their notion of what the value was. Those things are going to have to pour into the market, probably at the least convenient time.
One of the things you observed over the course of your career, and you talk about in the book, is the rise and at least retrenchment of globalization. You talk about the fact Thomas Friedman wrote the World is Flat book, which looks a little antiquated right now. You saw it
didn't age well.
Yeah, exactly. And you saw China. Everybody thought China was going to surpass the United States, to come up in the United States. Not working out. So what does that mean? Sort of a multipolar world.
The gloss from this is that you can't take anything for granted. I mean, you shouldn't take anything for granted. Strange things happen. And by the way, when sentiment shifts, it affects your memory. You forgot what you used to think. But when I was starting out, I went to Wall Street in the kind of mid-'80s, early to mid-'80s, and the idea of going to China or Russia, the middle of the Cold War, was crazy. Then, of course, it opened up, and the idea that we'd ever be hostile to them, that they wouldn't be joining, the Western-oriented capitalistic market, over time, that was crazy. Now it's not crazy. I've seen these things shift, and with each shift, you kind of forget what you used to think. Because, again, when sentiment shifts, it sort of erases and reprograms your memory. You think you always thought this. It could yet change. It will yet change again. But it's, it's very hard. People invested so much in their connections in Russia and in China. And you know something? That turns out not to have been a very profitable enterprise. But I believe that will come back again.
And you can watch and listen to that full conversation tonight on Wall Street Week with David Weston. That's at 6 p.m. Wall Street time on Bloomberg TV and radio. And we want to dive deeper into the economy because today, of course, we got the jobs report. U.S. employers unexpectedly cut jobs last month and the unemployment rate rose. To discuss, we're joined now by Liz Pancotti. She's the Managing Director of Policy and Advocacy at the Groundwork Collaborative. Liz, it's good to see you. The figures today seem to be calling into question whether or not the labor market is actually steadying. Our own analysts at Bloomberg Economics write that the decline was partly due to a combination of temporary disruptions. I'm wondering if you can take us through this and what you're gleaning from the data we got today.
Yeah, so this morning, the Labor Department reported that jobs were down about $100,000 jobs last month. That cut was primarily driven by a temporary work stoppage of some doctors and physicians, a couple of healthcare strikes going on last month. The issue with that is that over the last year, the only sector driving the vast majority of job growth has been the healthcare one. And so the precarity of that was really shown over the past month, that a temporary strike of really not that many workers in the grand scheme of things was able to tip our labor market into the negative. We saw declines in transportation and warehousing and manufacturing and construction. Across the board, things are really clearing up that the picture in the labor market is not good.
So what was the weather? We're actually hearing that was part of the blame was the weather, and
yes.
I'm obviously being sort of cute here. So take the weather, and we had snowcrete, and everybody was locked in their house for a couple of weeks. Remove the storm, remove the strikes. What would this number have looked like?
I think what we have seen is really a stagnating labor market. Yeah. But I will note that the Labor Department revised down the December number considerably, such that went into the negative. Mm-hmm. The January revision wasn't as extreme, but I think if you look at the kind of 3-month, 6-month picture, that's a little less noisy. Mm-hmm. We are seeing at best stagnation and at worst a tip into the red that is here to stay. Wow.
So we did hear from the administration on these numbers earlier today. The NEC director, Kevin Hassett, joined Bloomberg Television and Radio with Jonathan Farrow earlier, and he said at this point the administration isn't concerned by the data. Let's take a listen and get your reaction on the other side.
On net, it's almost like a wash number. There's a new procedure birth-death model at the BLS, which we believe is going to make the number more volatile. And so I think more and more we're going to have to average through the months. And remember, we had a really surprisingly positive number last month. And I think if you average the two, then it's about at the rate of job growth that's consistent with 3 or 4% GDP growth.
So is this more a math problem when you're hearing the NEC director there talking about maybe some of the broader context that we should be taking into account?
In my opinion, no. If you take the last 3 months of job growth and you average them, you get about 0. And so I'm not sure that's what you're looking for in a roaring economy is job growth of 0. We also saw pretty concerning ticks down based on some population adjustments to labor force participation rate and to the employment population ratio that I'm keeping an eye on over the next few months to see if those are sustained. But, reports from this morning are that we wiped out about 4 years of gains in both of those, which from a, broader picture perspective is really not great. Wage growth is slowing, and as we know, looking at prices, we saw a big beat on PCE the week before last, and as the Fed heads into meetings here in the next couple of weeks, they are looking at rising prices, oil above 90 this morning, commodity pressures given the war on Iran, plus a real big bust this morning on jobs. It's not a great picture.
Well, that's what I wanted to add. So what the heck do you do if you're the Fed here? You look over the course of a year, zero job growth. And what else is new today is $90 a barrel oil.
Yeah, it's not just oil. I mean, the number of commodities that come through the Strait of Hormuz, you've got fertilizer, which has already been affected over the last year by President Trump's tariffs. You've got rare earth minerals affecting clean energy and other imports. I just think the commodity picture is really likely to show more of what we saw in PCE.
How about $4 a gallon gas? We talked to Tom Closer earlier from Gulf. He made that prediction. I mean, that could be on our doorstep any minute, right?
I think what we saw out of CENTCOM yesterday is that they're expecting this war will not end until September at the earliest. Jet fuel is up massively. I mean, summer airfare is going to be a problem, and so will prices at the pump.
Well, to that point, we're not at $4 yet, but AAA this morning saying the national average is at about $3.32 a gallon. How does this impact the broader consumer spending picture when you have Americans paying more for their everyday essentials, or does a lot of that have to depend on the timeline, just how long they will be willing to pay for those things that they need to get along in their lives?
We have seen over the past year, we're about a year out from Liberation Day, and those tariffs that have ticked on and ticked off, obviously with the Supreme Court IEEPA ruling the week before last, and then President Trump imposing Section 122 tariffs at 10 and now at 15%, according to Treasury Secretary Bessent. That pass-through takes about 6 to 9 months, just given what's on the shelves and when it hits. These other supply shocks driven by the war in Iran and these commodity prices, those will show up considerably faster. And now consumers are going to be really taking it from both sides, and they were already struggling to stay above board with what we were seeing with the tariff picture. So I'm really worried about pressures, especially on those lower and middle income consumers.
Are you, Liz, at Groundwork, are you factoring in, or is it even possible to quantify the impact of AI? Is there a chance that we look back at this last year and say, oh, wow, it's very obvious what happened? AI changed the job market permanently and brought efficiencies that we never could have forecast.
I think we're seeing some evidence of some productivity gains in some concentrated sectors, but across the board, we are not seeing that bear out. I've seen the estimates from Goldman and from Brookings and from others. I think what we are looking at at Groundwork is, are we seeing job quality declines? We are really not seeing differences in hours or in pay show up in the job market yet. We are seeing in some of those earlier career workers less hiring in those industries that drive young adult labor market outcomes. But so far, we're not seeing a ton in AI productivity gains. What I will say is that a lot of companies are using AI-enabled pricing techniques, which are actually allowing them to grow margins and grow productivity by way of increasing prices, and that, of course, will trickle down to consumers in unfortunate ways. So I'm not sure we've seen an entire redo of our economy yet, to be determined, I think. But from my perspective, we are not seeing evidence of that, and that is not driving what we're seeing in the picture of economic growth or the labor market.
In the final minute we have you, I wanted to go back to tariffs since you did mention it. And we hear the administration talk a lot about how tariff revenue is an offset to those tax cuts in the One Big Beautiful Bill. And we didn't get to it today on the program, but there is this murmuring that we could see a reconciliation package 2.0. I'm wondering what you're gaming out here when it comes to the fiscal health and the balance sheet of the country, if we've seen the Supreme Court strike down those broad-based tariffs, but the administration's still using other authorities.
Yeah, that Section 122 authority can be in place for about 6 months, and so we'll see that play out here over the next 6 months. There are obviously other authorities. The administration has announced a number of Section 301 investigations, which just take time to play out, and you could see Congress kind of reassert their role in trade and tariff policy. I haven't seen appetite for that on Capitol Hill in my conversations on either side of the aisle, so I wouldn't hold our breath for that reconciliation package, but from the administrative authorities that the president has, he seems to have he's not holding back on using those, so I think it'll be mostly driven by those actions.
We only have about 30 seconds, Liz. Could we be in the second half of the year talking about the benefits of massive tax returns that the president has been predicting?
Not in my opinion, but I think really, I'm not sure if folks will have their tax returns by the end of the year, given the cuts to the IRS. I mean, they are really slowing down customer service and processing returns over there.
It's great to have you back. Liz Pencotti, it's been too long. Groundwork Collaborative. Many thanks for your insights, as always, Liz, and being part of our conversation. I'm Joe Matthew in Washington alongside Tyler Kendall. I'll meet you back here, Tyler, 5 p.m. for the late edition of Balance of Power. If you'll meet me.
Oh, I'll be there.
That's
Make
all
sure
right.
to tune in. Oh, no. Bloomberg Television Radio.
Make
Stick
sure
with
she's
us.
there.
Bloomberg Business Week Daily. That's up next.
This is Bloomberg.
This is Bloomberg Business Week Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy, plus global business, finance, and tech news as it happens. Bloomberg Business Week Daily with Carol Masser and Tim Stenivek, live on Bloomberg Radio, television, YouTube, and Bloomberg Originals.
And a very good afternoon, everybody, across Bloomberg platforms. Welcome to Bloomberg Business Week Daily on this Friday, March 6th. Carol Master, Tim Stanovic, live here at Bloomberg headquarters. Dare we say the S word? We're talking about
you just did
stagflation. We did get that disappointing U.S. monthly jobs report, and that's happening amid a backdrop of inflationary pressures that are flamed by those higher energy prices as a result of the U.S. war in Iran. I'm looking at WTI crude, folks. It is up double-digit percentage-wise today. It's up about almost 40% for the week overall, and it's up about 60% year-to-date here in 2026, Tim.
Yeah, $91.53 a barrel on oil. Brent crude up over $92, close to $93. That's up another 7.5% today. That goes right to gas prices. It goes to higher input costs for companies. The repercussions of this are just massive across the economy.
And we're trying to figure all that out for you folks. So we're going to get into, over the next 60 minutes, more on the U.S. economy as jobs do come in weaker than expected and those inflationary pressures abound. Also on that, we're going to talk, Tim, about the global energy squeeze thanks to the U.S. war in Iran. We have a great voice on that, someone who has tracked the global oil markets and energy markets for a long time.
Yeah, she literally wrote the book on Saudi Arabia and Aramco. Ellen Wald is going to be joining us a little later. Also, the private credit market woes continue again. This time, another story at the world's largest asset manager.
All right, a lot coming. It's not a quiet Friday, so a lot over the next 60 minutes, over the next 3 hours on Bloomberg Business Week Daily. First up, though, let's get a check on that trading session. Let's toss things over to Charlie Pellet.
All right, thank you very much. And what a Friday. Lots of moving parts, and we got you covered. We begin with where markets are right now. Dow Jones Industrial Average down 555. That is a decline now of 1.2%. Keep in mind, the Dow at one point was down 2%, down 945, recovering just a tad, down 1.2% right now. The S&P at 6754, S&P 500 index down 75, a decline of 1.1%. The NASDAQ Composite Index down 1%, with a VIX, the fear gauge, closing in right now on 27. 10-year, 4.11%. The 2-year, 3.52%. Gold is surging $80 the ounce, up 1.6%, 51.62. Crude, though, the major story, one we'll be covering right here on Bloomberg Business Week Daily. WTI right around $91 a barrel, up 12.3%. We've got Brent, the global benchmark, above 93. Barrel of Brent up by 8.9%. So again, the Dow, the S&P, NASDAQ, all declining. I mentioned the move in oil stocks, trading mixed right now among the oil majors. ExxonMobil up 0.7%. Chevron down 0.1%. ConocoPhillips up by about 0.7%. S&P 500 index down 1.1%. West Texas Intermediate crude up 12.5%. For on-demand news, 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcast. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
All right, so appreciate it. Charlie Pellet there. Well, U.S. employers unexpectedly cut jobs in the month of February. The unemployment rate rose, pointing to lingering fragility in a labor market that was thought to be stabilizing. Bloomberg TV and radio international economics and policy correspondent Michael McKee has been talking to a lot of Fed officials this week. He is at the Booth School Monetary Policy Forum in New York City. And earlier today, Mike caught up with Federal Reserve Bank of Chicago President Austin Goolsbee. They talked about today's labor report and a lot more.
It's a tough miss on the jobs report today. You never want to over-index on 1 month's report, and I've been consistently saying, let's not index on total payroll employment anyway, because a lot of stuff is going on with immigration, with population growth. That said, you saw the unemployment rate inching up, and it's 1 month. It's not a trend, but it's not a good month. If you got several months like that, that'd be a concerning spot for the labor market. I've been saying for some months that we've had relative steadiness in the job market, in my view. The strongest thing in the economy is not AI data center investment, has been consumer spending being solid in a kind of a broad-based way in the economy. But the inflation hasn't been ideal. It's at least stalled out at kind of 3%. And some of the latest measures, the inflation disturbingly high in non-tariff categories like services. I think we're still basically in that same spot. I remain hopeful / expecting that conditions will improve, that we'll start to see some progress on inflation, head us back to 2%, and by the end of this year, that we would be in a situation that we could commence our march back down to something like the settling point, which is below where we are today.
There you have it. Bloomberg TV and Radio International Economics and Policy Correspondent Michael McKee earlier with Federal Reserve Bank of Chicago President Austin Goolsbee. Michael McKee joins us now from the Booth School Monetary Policy Forum in New York City. Mike, I want to go back to something that Austin Goolsbee said to you about this unemployment report, this payrolls report. He said, 1 month is not a trend, but it's not a good month if you've got several months like that. That would be concerning. A concerning spot for the labor market. If you peel back sort of the layers of this report, is this a one-off for a host of reasons, or is this the start of a bigger trend?
Well, it's hard to know, but it doesn't look good on the surface. When you look at the numbers, you look at the overall decline in jobs, a lot of it was in healthcare, which had been the only sector that was really hiring. And also, part of that was because of a strike against Kaiser Permanente out in the West Coast with nurses on strike. But even if you add them back in, healthcare hiring was very weak. So if the one driver of employment has slowed down, then you may have trouble ahead. That's the big question going forward. Is this a one-off? Is this showing that things are going to remain weak? And I think what Fed officials are saying is the labor market is weak, and some of us are worried about whether or not we should do something about it, while the inflation hawks are looking at the oil prices and saying, you know, we're hopeful that inflation will go down, but we don't know how long this war is going to last, so we don't know how long oil prices are going to remain elevated, so we've got to kind of sit on the sidelines for the moment.
All right, we want to talk more about that in a moment, but Mike, I want to get to Kevin Hassett, who spoke on Bloomberg TV earlier, of course, the White House National Economic Council Director. He said the poor February jobs report was down in part to crazy weather. Though, as we noted, the number of people unable to work last month wasn't out of line with historical averages. He also said that revisions to population figures are making month-to-month changes more volatile. And so he says it's important to average things out, that this was still a strong increase in payrolls. Do you agree?
I would say that he is talking his book and trying to make things sound better than they are for the administration. Weather didn't really have anything to do with what we saw in the labor market report, and the BLS sort of points that out. 228,000 people who couldn't go to work because of weather was not substantially different from what we saw in January, and it's about what you would expect for this time of year. So that's not really an excuse. We do have the changes to the population survey, but that really isn't making a major difference in the numbers that we got this month because they split it up. We got a new population control number, but the seasonal adjustment factors and the adjustments to hiring were in the January numbers. So really, you kind of have to take this report at face value. Like I said, it may not sustain, but you really can't wave it off.
And I just want to be clear, Hassett did say, speaking on TV earlier, it's important to average things out, and there was still a strong increase in payrolls for January. You just talked about the January number. We got a lot of questions.
Yeah, it raises the question about what the Federal Reserve does on March 18th and what the Federal Reserve does at the end of April 29th for that following meeting. Mike, does it change the picture at all?
Well, we're not sure if it changes the picture for April. That's going to really depend on what happens with the war and with energy prices and if they stay elevated. The March 18th, they're going to sit on their hands because you have a smaller minority, maybe Mickey Bowman, Chris Waller, and definitely Stephen Myron, who think that you should be cutting rates more to get ahead of the problems in the labor market. But the people who are worried about inflation have an argument that we can't really move because we don't know what's going to happen with this, and we don't want to get inflation established in the economy. We don't want inflation expectations to start to rise when people go to the gas station and see their gas prices going up quite a bit. So take that one off the table, and then let's wait and see on April. April is going to be Jay Powell's last meeting as chair. So that might argue against doing anything dramatic. But if we do see a dramatic change in the inflation picture, you could see it.
So you just got me thinking about the Warsh confirmation process. Does that mean that Warsh gets confirmed by the meeting after April 29th?
Well, we don't know. They just sent his nomination up yesterday to the Senate Banking Committee. They've got to schedule a hearing, and then there's this whole Tom Tillis not going to let anybody through while this investigation into Jay Powell is underway thing. So they've got to get that out of the way, and it isn't clear exactly how they do that. But if for some reason Kevin Warsh is not confirmed, then Powell would stay on the job as a governor, and the Open Market Committee would likely just reelect him as chairman of the Open Market Committee. They don't even really need to do that because they elected him for this whole year. So nothing would really change, but we don't have another meeting after the April meeting until later in June. So there's still a lot of time between now and then for Warsh to get confirmed and be in place for what would be his first meeting.
Hey, Mike, you've been having lots of conversations with Fed officials. Is there a common narrative or something interesting in terms of the gaps between what you're hearing? And I'm just curious, is anybody saying stagflation?
Well, Austin Goolsbee was saying stagflation, and that's been a result of previous energy crises. Now, is this a crisis? Javier Blas, our columnist, our brilliant oil columnist, was pointing out this morning that if you take a chart of oil prices and then move it out, expand the time period, you'll see that this really isn't that big a move for oil these days, that we've seen bigger moves in recent years. And so it's not a crisis yet. If it continues, then that could be a crisis. And as Tim was saying at the top of the show, oil gets into all kinds of other products. And if it gets into those products, then prices go up, then maybe economic activity slows. But at this point, it's not likely that we're going to see stagflation, but it's a danger that the Fed is going to talk about or mention just to let people know they're on the case, they're watching this.
They're on
All
the
right.
case.
Well, we're always watching you. Great stuff, Mr. McKee, this week, and I highly recommend anybody who missed any of it, check it out. It's on the Bloomberg and at Bloomberg.com. Mike, have a great weekend. Bloomberg TV and Radio International Economics and Policy correspondent Michael McKee from the Booth School Monetary Policy Forum. And we should point out at 3:10 p.m. Wall Street time, Mike's going to actually have another interview from the event. He's going to be talking with Cleveland Fed President Beth Hammack from that forum, and we will be carrying it live on Bloomberg Radio and Bloomberg TV and on YouTube across our platforms.
Well, in the meantime, related absolutely to the Fed, let's stay on the labor market. Back with us is Karen Kimbrough, chief economist at LinkedIn. Karen joins us from Sunnyvale, California. Karen, good to have you back with us. You were managing director and head of macro policy at Bank of America. You were vice president of the markets group at the Fed in New York during the financial crisis. So you've seen your share of cycles and macroeconomic events. That said, in the context of what we got today from the payrolls report, and in the context of this new conflict with the U.S. and Israel and Iran, what does that do for the labor market?
Yeah, so I'm going to confine my remarks to the labor market, which is what I've been focused on right now. And I think where we are right now is at a place where obviously the labor market is been cooling for a couple of years. We've seen it in our data here at LinkedIn with a very sluggish hiring rate. It has not picked up. The hiring rate is running, 20% slower than in 2019, 7% slower than last year, and that's just the U.S. So I think where we are is a place where policymakers for monetary policy need to consider all of the forces. They've got, obviously, to consider the oil prices you just mentioned, which are an inflationary push, but they also need to consider what the everyday worker is looking at. And here's what I would leave you with. I think as long as workers feel like they can find a job and get a steady income, they will continue to spend. But if they don't, then you have concerns around whether the K-shaped economy is really taking root and going to pose a problem down the road.
Can you say those numbers again? You said 7% lower in terms of hiring rate than last year. That's in the U.S. And what was the other number?
So yes, the hiring rate in the U.S. is running 7% slower than a year ago and running over 20% slower than in 2019. So pre-pandemic baseline, when things were looking pretty good and pretty stable, we were hiring a lot faster. And what that really means is just there was a lot more turnover and churn and moving around in the markets. Think about where we were in 2021 when you had a lot of people getting hired and changing jobs. This is the inverse. People are staying put. We see it in our data. One of the most interesting things I see is the fact that there are actually fewer job applications per applicant on our platform in the last couple of months. And what that suggests to us is that people are getting a little bit fatigued out. They're a little bit discouraged. Wow. And you also see it in the government data where you've got people staying in unemployment for longer and longer periods of time. I think it's 25% now the unemployed have been unemployed for nearly 7 months.
It's a long time.
So people are getting a little discouraged. And I think that's one of the more interesting signals coming from our data.
Hey, Karen, Tim mentioned your background. I mean, you were VP in the markets group of the Federal Bank of New York during the financial crisis. We've had some prominent names, whether it's Jamie Dimon and some others who remember the financial crisis so well, being there, leading banks during that. Is there anything that what you are seeing in terms of labor data that says to you that we are headed towards some kind of crisis or some kind of recession or something more significant than a word that we're using currently today?
Right. Yeah. So look, this is how I think about it. You have the macro data. This is the GDP, how quickly the economy is running. And that is, that's going to tell us GDP growth and inflation. And so far that hasn't looked too bad over the last few quarters. I think if you average it out, it's been running around 2%. We'll see what it comes in for this current quarter. And then you've got the jobs market, which is a totally different story. That really means very little job growth. By our own data, we're seeing something like 15,000 jobs being created a month on average if you smooth out across a year. So it's really low. And so I think what's happening is we're having sort of a jobless growth in our economy right now. That doesn't speak to me as a crisis. What would be a crisis? And I don't think we're there yet at all. Let me be really clear. I think the labor market is pretty stable. It's just running in first gear as opposed to fifth gear. What would be concerning would be if the consumer didn't feel confident about their ability to find and get a job, and then they, as a result, stop spending. I think that would be the transmission effect or the shock that you'd be looking for. But right now, for the moment, the consumer is sort of holding in, and I think we have our fingers crossed that will continue despite the most recent pickups, in geopolitical tension.
What's the data point that we should look at to understand if the consumer is going to pull back? That would be like a sort of a preview or an indication that, hey, this might happen. You should pay attention to this.
Look, I spend my time mainly looking at the labor market, so I'm looking a lot at things like the unemployment rate, just generally across different cohorts, whether you have a graduate degree or you have an associate's degree, whether you are living in a certain region in the U.S. or working in a certain industry. But I think overall, it would be looking to see how people are doing with their credit. Are they running behind in terms of running up credit, being unable to pay, delinquencies, things like that are sort of a canary in the coal mine for whether consumers are starting to be under stress. What I will say now is that the job market's okay. People who have a job, you're doing just fine. If you don't, it's a bit of a challenge.
Okay, that makes sense, certainly based on the data that you and the government seeing. Karen Kimbrough, Chief Economist at LinkedIn. Reminder, coming up at 3:10 p.m. Wall Street time, Mike McKee talking with Cleveland Fed President Beth Hammack, and we will carry that live on Bloomberg Radio and TV. Coming up next, we've got to talk about the energy markets.
It's 2:21 on Wall Street. We do check markets all day long here at Bloomberg. We are looking at a down day for the U.S. stock market. We're heading for a down week as well. The Dow, the S&P, NASDAQ, they're all in the red, right to the numbers here. Jobs Friday, but also a focus on oil and inflation. The S&P right now down 1%, as is the Dow. The S&P down 70 to 67.60. Dow Industrials down 480 right now. At one point, the Dow was down 945 points. The NASDAQ Composite Index down 1%. The NASDAQ 100 Index also down 1%, with the VIX, the fear gauge, at 26. The 10-year, 4.11%. Spot gold up 1.7%, 51.67 a barrel. West Texas Intermediate crude now below 91, 90.76. WTI surging today by 12%. This on a widening war in the Middle East that is lifting oil prices. Brent, the global benchmark, up now by 8.6%. Barrel of Brent crude, 92.77, but that WTI quote bears repeating. Right now, it is up by 12.3%. Sources tell Bloomberg Boeing is closing in on one of the largest sales in its history, a 500 aircraft order for 737 MAX jets, set to be unveiled when President Trump travels to Beijing for his first-day visit to China since 2017. Boeing shares up now by 3.9%. Recapping a drop of 1% on the S&P 500 index, the 10-year 4.11%. West Texas Intermediate crude up 12.5%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, got it. Thank you so much. Charlie setting us up, as he always does, so well in terms of the energy markets. Of course, that widening conflict in the Middle East is stoking fears over a global energy crunch. You've got exporters scrambling for routes out of the region while a swath of refineries are reducing output. This is certainly some of the big stories that are going on here.
The near halt of traffic through the Strait of Hormuz is causing storage tanks across the region to top out. Drone and missile attacks have targeted refineries in Saudi Arabia, Kuwait, and Bahrain. The escalating war has choked off oil and gas supplies to key customers in Asia and Europe and sent energy prices soaring.
Charlie mentioned it. We've got WTI almost up 40% so far this week, 60% year to date. You've been talking about Brent crude, same story. We are just seeing the global energy picture in terms of prices move up. So we've got a great voice joining us once again. Dr. Ellen Wald is president of Transversal Consulting and senior fellow at the Atlantic Council. She's also author of Saudi Inc., understands the region so much. She joins us once again from Boca Raton, Florida. Ellen, big picture first, a lot coming at us. We're trying to figure out, and I think a lot of it has to do with how long this war goes on. But short term, long term, how are you thinking about the global energy markets?
I would say both short term and I think short term, we are right on the precipice of what could be a global energy crisis. If we don't get traffic moving through the Strait of Hormuz soon, and even at a reduced rate would be fine, but we've got to get some sort of movement going. If we don't see that by the end of next week, I would say that we're looking at shortages across Asia and all sorts of other dislocations that are going to happen simply because you've got tons of tankers just sitting there, okay? You've got storage facilities filling up to the point where producers in the Middle East are already having to cut production, and yet that oil is desperately needed everywhere else, particularly in Asia and then Europe. We've already got a crisis in natural gas prices in Europe simply because Qatar has shut down natural gas production. And that's not something that can be turned on immediately. That's going to take a while to restart, even if the hostilities ended tomorrow. And I think that the world is really waiting to hear from the Trump administration, what are their plans to alleviate this crisis, because it doesn't have to get as bad as it could get. There are steps and things that we can do right now to start alleviating this crisis.
Ellen, like what, for example? Does it mean reinsurance for ships that are in the region to provide at least confidence to the folks who are at the shipping companies that, okay, your investments will be protected? What could the Trump administration do?
I mean, that's I would say that's like the tip of the iceberg.
Okay.
I mean, we need to see some concerted military effort to protect ships. Now, I understand that's very difficult when the primary issue here are drones that are flying, and it's really hard to protect against that. But there's got to be some kind of military presence protecting tankers. There are other things that can be done. They can reroute ships out of the current traffic scheme that takes them right through Iranian waters to a shipping route that's farther south that used to be used in, before 1979, that might take them somewhat away from the Iranian shoreline. They can make efforts to, and I said this recently in a piece for Atlantic Council, to remove the Iranian military presence from certain islands in the Strait of Hormuz that ships have to pass by in order to get out. If they can, if our military can remove Iranian troops from those islands, then there's a much better chance in ships having actual safe passage. And then there's just this issue of these drones flying everywhere that are now starting to hit oil production, oil facilities, oil infrastructure across the Middle East. There was an oil field in Iraq that was hit recently. You've got refineries that are being hit. These are the kinds of things that can't necessarily be repaired quickly and that are also jacking up oil prices in addition to this tanker crisis.
Well, it's interesting. We've been thinking about history as a guide or not as a guide, Ellen, and we were talking with a guest about the energy crisis during the 70s, right, when there were lines in the United States and odd and even license plates.
We brought that up with Steve Moore.
Exactly.
This week.
And we've talked about, early 90s, right, the Persian Gulf War and what we saw in terms of energy prices. You've got, it's fair to say, you now have the U.S. that's kind of has energy independence. You've got alternative energy at play. So what's similar? What can we lean on in terms of history? What can we not?
So I think that the U.S., I wouldn't say we're energy independent, but I would say that we are particularly isolated from some of these issues that other countries are going to face much sooner than us. Some countries have ample storage. China's got a lot of oil in storage, but other countries don't. And so they're going to start to feel the effects first. It's interesting. These are the two historical examples that were pulled. I would actually look a little bit farther back to the Suez crisis in the 1950s. And actually, before Britain and France went and invaded the Suez Canal to try to take it back from Nasser, they and the United States, all three of them, coordinated plans for what to do in the event that there was an energy crisis involving the Suez Canal. And there were actually all sorts of plans put in place for which ships would go where and how Europe would be supplied with oil in the event that they couldn't get it through the Suez Canal. And the fact that we didn't put these plans in place, we didn't even reach out to communicate to the people who might be most affected by this, I think was a serious problem, and we should be correcting that. We should be looking at this example, establishing coordinating committees, talking to these Asian countries and seeing what can be arranged so that we can make these oil shortages that they might suffer less, particularly if this military confrontation is going to last for 6 months now. Just earlier we were hearing 4 weeks and now we're hearing 6 months. So, there are things that we can do to help. And I think that we're not necessarily doing them.
We're speaking with Dr. Ellen Wald. She's president of Transversal Consulting. She's senior fellow at the Atlantic Council. She's the author of Saudi Inc., about Aramco and the country of Saudi Arabia. I bring that up right now because a story just crossing our Bloomberg terminal. This is a Bloomberg exclusive about how Saudi Arabia has stepped up direct engagement with Iran to try and contain a war in the Middle East that's wreaking havoc and stressing global markets. This is according to several European officials. Bloomberg News is the first to report on these Saudi efforts. You know the country of Saudi Arabia very well. You understand how inextricably bound it is to Aramco and the oil industry. As the price of oil goes up, that's a good thing for the Kingdom of Saudi Arabia. So there is this, it's an awkward question to ask, but there are these sort of competing tensions here when it comes to Saudi Arabia and its role in ending this conflict.
Well, let's remember, it's only a good thing for Aramco if they can actually sell oil. If they can't actually sell any oil at, $91 a barrel,
it's
then,
just sitting there
and
it's at risk, yeah.
Now, Aramco is actually in a very unique situation, and they have the ability to send oil out to their port in Yanbu, which is on the Red Sea. And they can send about 7 million barrels a day that way, and so they have that ability. They're using that ability. They also have oil stored all over the place, and that they can utilize at least to avert, energy shortages, or they can fulfill their customer orders from that for a period of time. Then they'll obviously have to refill their storage. They could make a lot more money if they could sell more than 7 million barrels a day, but they can't get it out of the Persian Gulf. So it's kind of interesting. I do think that the real winners here are Russia and the U.S. oil industry. If the U.S. oil industry, or at least some parts of the U.S. oil industry, could put more rigs into production and produce more oil and sell more oil, they could certainly make money off of this. And Russia is, of course, making a lot of money as well.
Well, do we see U.S. producers kind of kick into high gear over this, or not so fast?
So this is the interesting question, because initially I think they're very wary of putting in more capital, of doing this, because they've been burned before. And so I think that, if they were receiving some kind of guidance from the Trump administration, some kind of thoughts on what would be helpful, they might be likely to put more investment in to produce more, if they had a sense that, okay, yes, this is going to be valuable over the next several months, as opposed to, well, the conflict could be over in 5 days, and then, we've just wasted our time and money.
Hey, one thing I wanted to ask you, because for some reason, because I have my dumb moments, is China and energy. I know that they are reliant so much on the global energy markets, but I had no idea all the refining that goes on there, because I know that they specifically, the Chinese government, I think this was earlier this week, has told the country's top oil refiners to suspend exports of diesel and gasoline. I didn't know that they were the third largest supplier of oil products into the region. So I do think about where the pressure comes maybe from the U.S. to kind of put an end to this, because how much does China get hurt in all of this?
Well, exactly. I mean, China gets huge amounts of oil and products from the Middle East. They're also, by the way, invested in refineries and in petrochemical facilities in Saudi Arabia. So they may be losing money in that there also. But yeah, China is saying, hey, we need to conserve this for domestic use, because we can't necessarily depend on these, imports that we may have been getting from the Middle East. So we're not going to be selling to the region. And now they're leaving, they're leaving other Asian customers there high and dry, and they're saying, well, we used to get this diesel, from these refiners in China. Now where are we going to get it? We can't get it from the Middle East. And I think there's a whole lot of dislocation that's happening now, and I do believe the market will sort it out. Okay. People will have to pay higher prices, but there's also this element of we're missing a huge amount of supply right now.
Hey, Ellen, we only have 20 seconds left. We started the conversation out. You said if things don't get cleared up by the end of next week, then we'll face a full-blown crisis. What does that mean for oil prices? Just 20 seconds.
Triple digits.
Triple digits.
Like how far? Do we go back up to 140?
I definitely think 120 is possible. I mean, we're already at 90, 92. So if nothing moves, then we could definitely see 100, I would say, by early next week.
All right. Ellen, thank you so much. Good to have you back here. Dr. Ellen Wald, President of Transversal Consulting, Senior Fellow at the Atlantic Council, author of Saudi Inc. As we head to a break, you're looking at New York crude, folks, up almost 12%. Brent crude, a gain of 8%. We are up almost 40% on the week overall.
It's 2:40 on Wall Street. We do check markets all day long here at Bloomberg. The Dow, the S&P, NASDAQ, all in the red off session lows. At one point, the S&P 500 index was down 119 points, down 1.7%. Right now, looking at a loss of 69 points on the S&P. That is a drop of 1%. The Dow Industrials also down by 1%. NASDAQ Composite Index down 1.1%. The VIX, the fear gauge at 26, the 10-year 4.11%. Spot gold is up $78 the ounce to $51.60, up 1.5%. West Texas Intermediate Crude, big story today, holding just below $91 a barrel. WTI up right now by 12.1%, and Bitcoin now down 4.1%, 68,235 on Bitcoin. A weak jobs report hitting stocks at a time when that widening war in the Middle East is lifting oil prices and fueling inflation jitters. Again, the S&P down 1%, West Texas Intermediate Crude up 12% at $90.77 a barrel. Marvell Technology shares are surging 20.4% after the chipmaker delivered a bullish sales outlook. Oracle, meanwhile, said to be planning to axe thousands of jobs among its moves to handle a cash crunch from a massive AI data center expansion effort. Oracle up today by 2.6%. S&P 500 index down 1%. West Texas Intermediate Crude Oil up 12.1%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcast. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
All right, Charlie, thanks so much. Well, yes, the U.S. war in Iran was the top concern, I think it's safe to say, in the trade this week, although markets seem to kind of take a lot of it in stride. Yeah. There has also been continued concerns when it comes to private credit. A few stories we just want to point out today, including how some 146 companies in Europe have ceded control to direct lending funds after they could no longer afford to pay their debts. That's according to Goldman Sachs.
And I'm looking at shares at BlackRock down 6.5%. The world's largest asset manager, that company curbing withdrawals from its $26 billion private credit fund.
And then we've got Blue Owl, of course, the U.S. private credit firm. That firm has a $48 million exposure to Century Capital Partners. That's that London-based property lender that filed for administration last month. We've been following that one as well.
Yeah, Blue Owl shares down just a little over 3% as we speak. The private credit hits keep on coming. Today. Just look at the longer-term chart for a fuller picture. With an update, back with us is Bloomberg News Senior Editor for Credit, James Crombie, joins us here in the studio. James is also the host of the Credit Edge podcast by Bloomberg Intelligence. So it's not clear sort of where to begin. We actually had to erase some of the stories we were going to mention because it would have just taken too much time to update everybody on everything happening just in the last 24 hours with concerns around private credit. What's the main concern to you?
Well, private credit is experiencing its Roach Motel moment in terms of retail getting spooked. Retail is really worried. Retail's trying to take out more money than you're allowed to take out. But I would say also look at the prospectus. You know, the BlackRock prospectus for the fund that is being redeemed right now. It says on page 1, 5%, and it's up to them whether they even do that. So you should read the paperwork. The problem with credit in a lot of markets over the last 5 years or so of easy money is people just haven't been doing that work.
So
do people ever do that work?
Well,
it's on page 1.
But but shame on you. I mean, this is one of the things that we always talk about when we talk about private credit. And I've had terminal users like, do people understand what private credit, how this market works? That's an understanding. It's not liquid, right?
It's not liquid. These are long-term investments in direct loans, which you sign a contract, you agree to lend the company money for, let's say, 5 years, and you get it back after 5 years plus a premium. Plus, I'll tell you, investment grade bonds right now 5%. I'm going to offer you something else for 3 times that.
Right.
What do you have to do for me to get that extra return? Read page 1 of the prospectus. You're going to have to lock your money up, and there will be a penalty, and you probably won't be able to get your money back when you want it.
James, there's locking your money up, and then there's problems. So how do you distinguish between what we are seeing is that it's just not the right market environment yet for private credit, and so it's going to maybe take longer for either the exits, for the returns, and so investors, you got to understand that. Or is there problems somewhere within the lending and the whole process? Like, how do we, and that maybe people are investing these firms are actually investing in things that aren't so great, and that transparency isn't truly there for investors.
There are certainly problems on the the software side, which we're now starting to see. A lot of these loans were made 5 years ago when rates were zero and the money was flowing and people weren't asking too many questions and leverage was going on pretty high. Now those things are coming up for refinancing. Those companies are in a much more difficult situation. Some of them may be completely replaced by AI, so you're not going to get your money back. We did see BlackRock write off a loan, $25 million in a kind of Amazon-adjacent space. That's $25 million for a very large fund.
Right. The point we made yesterday, not a lot of money for a company like BlackRock, but for, it sounds still $25 million, $25 million.
But it's BlackRock.
And it's going to zero.
The world's largest asset manager. Yes. Like there's, to be fair, you put firms in a certain category, and we do that, rightfully so. And so you're like, well, if they missed it, or does every great investor, Warren Buffett would probably say, I've missed some things, right? Like, how do you assess that?
I mean, there's a lot of pick your manager, get the right manager, don't be a tourist, all these things. Use someone specialized, but you're right, when it's BlackRock losing money, then you start to be concerned. But, again, I point to the returns. The returns expectations were very high. Sometimes as high as 20%. So, you've got to assume a bit of a loss there along the way. You're going to take some risk. So I think, the whole outcome, the upshot for me would be, on the one hand, curb your enthusiasm about private credit returns. They're not going to be 20%. They may be closer to, less than 10. On the other hand, curb your enthusiasm about the growth of this market because it all relies on retail money piling in and getting you to 40 trillion from 2 trillion currently. I just don't think that's going to happen.
Well, to that point, shares of Blue Owl are down more than 60% from the highs just about a year ago on January 24th, 2025. James, I think the question that people have, and this is literally the $2 trillion question, is about contagion and about to what extent, since you and I, we last spoke to you 2 weeks ago. Since you were last on our program, have fears about contagion, this spreading to other asset classes, this spreading to big banks, has that shifted?
We're seeing more definitely shorts on the BDCs. We're seeing shorts on the credit market as a whole in terms of the CDX, which is the CDS index, which is a liquid way to take a position if you wanted to. We're seeing outflows from some of the ETFs that are related. So there is a fear that starts to feed on itself, that when you start getting big redemptions, then you have to sell not necessarily the bad stuff, but the good stuff to get liquidity, and that results in just a bit of a downward spiral.
I just want to go to BDCs. It's certainly something we've talked about a lot here at Bloomberg for years. The business development companies, where are they when it comes to the private credit market? Like, how much of private credit are BDCs?
Well, it's a big proportion of it, but they are the only visible side of it. That's why we look at them, because they actually
some transparency.
There is a bit of transparency there, and it's a growing part of the market. Maybe that growth starts to slow because of what we're seeing right now, but it is a big. If you wanted to get into private credit, that is a decent channel to do it.
How do you suss out if whether or not this is going to be? I mean, a lot of financial crises are credit-based, so this is why it's got everybody, their hairs on their neck kind of standing up. So how do you guys suss it out, or like what are you watching, as it feels like every day there are several stories?
I mean, to me, it's an orderly sell-off. It's a repricing of a market that got very, very expensive. Credit has been overpriced for a long time, and now it's slightly cheaper, but every time it gets cheaper, people buy into it. People buy that dip. They get very well rewarded for doing that. So there is a lot of cash on the sidelines that wants 7% yield in a junk bond, because that's a good coupon to get, especially if rates continue to go down. We just don't know that at this point.
Right.
If
rates go up, will there be more pressure points, more stress?
It will certainly stress out the weak borrowers with a lot of debt coming due because they can't cover those bills. On the other side, it may make private credit even more attractive because that is a floating rate asset. So there's going to be a push to floating. So there are lots of, I think, ramifications, lots of we don't know yet.
Yeah.
Well, sorry, we just have 20 seconds left, but I wonder at the end of the day if when this passes, if it passes, if sort of a stronger product emerges on the other side.
That would be the hope, that it grows up and people actually read.
This is a maturing moment.
People actually read page 1 of the prospectus.
You've said that so many times.
But it's something to think about, right? As we
Yeah.
look to expand the market, right?
Read the small print. Know what you're doing and why you're getting paid more to do it.
Right. Risk reward, folks. That's how it works. Bloomberg News senior editor of credit, James Crombie. Hey, as we head to a break, a look at some of the names in the private credit space, including Blue Owl, BlackRock, Apollo Global, Blackstone. You can see all of them. Blue Owl down 4%, BlackRock down about 7%, Apollo down about almost 2%, and Blackstone down about 4%. Stick around, everybody. This is Bloomberg.